Imagine it's 2008 and the global financial crisis has just hit. Banks are collapsing, markets are crashing, and the world is in chaos. But amidst all of this, the investment banks thrived and helped economies across the world settle down. They analyzed finances, restructured debt, carried out mergers and acquisitions, and helped the businesses' economies grow. At this moment, if we talk about the financial assets held by top 5 investment banking firms, then you would be amazed to know that it is more than 30% of US's GDP, which is again the world's largest economy. Now you must be wondering how these financial wizards make such critical decisions. The answer lies in combining finance, strategy, and analytics. Here's the thing, investment banking isn't just about numbers. It's about understanding markets, predicting trends, and making decisions that can impact economies. And guess what? This industry is booming. According to Statista, the revenue in the investment banking market is projected to reach 390 billion USD in 2025. Moreover, companies such as JP Morgan Chase, Goldman Sachs, and Morgan Stanley pay an average salary of 20 lakh rupees. Top investment banking organizations are always on the lookout for skilled investment bankers. So if you have a keen interest in cracking how the financial world works, it's time you start learning the skills of investment banking. And to help you with that, we bring you a free investment banking and capital markets course. This investment banking program has been taught by top industry experts from companies like JP Morgan Chase, Bank of America, Goldman Sachs, etc., and aims at making you job ready. Now let me take you guys through the agenda for this session. We'll begin by understanding the structure of the financial system. This forms the foundation of investment banking, defining how different financial institutions, markets, and instruments interact. Next, we'll explore derivative markets, which are essential for risk management and speculation. Within this, we have different types of derivatives such as forwards, futures, options, and swaps. Moving on, we'll discuss the role of a central exchange in facilitating trades, swap contracts like plain vanilla swap, which involves exchanging fixed and floating interest rate payments. Building on that, we have the credit default swap, CDS, which is a financial contract used to transfer credit risk, and the credit spread option, which allows investors to hedge against fluctuations in credit spreads. Moving on, we'll explore forward valuation, cash settled forward contracts, and deliverable forward contracts, which determine how these agreements are executed. Then we'll examine the working of a forward contract, the arbitrage opportunity. Next up, we'll dive into fixed income securities, investment instruments that provide a stable income stream. Finally, we'll discuss the investor and secondary market and understand bond pricing. Now that you guys are clear with the agenda, let's get started with the very first topic on our list.
Hello everyone and welcome to this video on investment banking. Now, what is investment banking? It is a specific branch of banking that helps businesses raise funds and provides them with financial advice and support. It provides a substantial financial advising, capital raising, government and financial institution services, financial and risk management services, and help to enterprises. An investment bank is a type of financial services firm that serves as a middleman in large and sophisticated financial transactions. When a new firm is ready to launch its initial public offering, or also known as IPO, or when a company combines with a rival, an investment bank is approached. For large institutional clients like pension funds, it also serves as a broker or financial advisor. Now let us move on to what does investment banks do. Let's begin with a simple example of a company named ABC. Suppose ABC wants to merge with another company. How will it know that the other company will be beneficial for it? Or how is it going to raise the desired funds? And who is going to handle the complete documentation and help in figuring out new investment plans? Well, the short answer to all these questions is an investment bank. Investment banks play a vital role in making a company go big by acting as a risk taker or say middleman. Typically, investment banking focuses on two main areas. The first one is the M&A advisory, and next we have underwriting. So M&A advisory stands for Mergers and Acquisitions Advisory. It is the process of assisting corporations and institutions in locating, evaluating, and completing company acquisitions. Underwriting is a procedure used by banks to get funds from investors for a client, mostly in the form of equity or debt securities. Now let us move on to the next topic, which is how do investment banks work? Investment banks are divided into two types, the sell side and the buy side. Now, the sell side shares of newly issued IPOs, provides market making services, places new bond issues, and assists customers with transactions. Coming to the buy side on the other hand trades securities such as shares and bonds in order to maximize profits. It collaborates with hedge funds, mutual funds, and pension funds. Now, let us take a look at the careers available in investment banking. Investment banking jobs are among the most desirable jobs in the financial industry. As an investment banker, you will be expected to assist the clients in raising funds and expanding their businesses. Though it is not that easy to get into the domain, once you make it through the journey, the results are really rewarding. The average salary ranges around $100,000. With years of experience, you can even earn up to $500,000 per annum. The main role that investment banking demands is to provide assistance to firms, governments, and wealthy individuals in expanding their businesses by acting as a medium that will handle the complete procedure of analyzing and evaluating the business and will also manage all the documentation work involved in the process. The world of investment banking is not for everyone to live in. This job profile comes with a very high competition and extremely tight working hours. But the financial perks offered are unparalleled. You will live a very fast-paced life and deal with exquisite clients while enjoying a lifestyle that others can only dream of.
Just a quick info guys, Intellipaat offers investment banking course training. Through this course, you will learn time management, project leadership, financial expertise, leadership abilities, valuation and much more from the top 1% of industry experts around the world. With this course, we have already helped thousands of professionals in successful career transitions. You can check out the testimonials on our Achievers channel, the link of which is given in the description below. Without a doubt, this course can set your career to new heights. So visit this course page link given in the description below and take the first step towards your career growth in the field of investment banking.
Investment banking is one of the most profitable fields in the financial industry. For the year 2021, investment banks alone contributed a whopping amount of $280 billion towards the United States economy. Not only that, but if we talk about the financial assets controlled by just the top 5 investment banking firms, you will be amazed to know that they value around almost $36 trillion, which is almost 30% greater than the gross GDP of the United States itself. These factual figures depict monumental success of investment banks, and if just the sound of the money gives you a tingling sensation, then investment banking is the domain worth exploring. So, what exactly is this investment banking? Why is it so lucrative? And how does it make these enormous amounts of bucks? Well, before we touch upon these monetary queries, first let's go back in time to see how it all began. From the early 19th century, commercial banks in the US performed the functions that we now associate with the investment banks. But during the period of the Civil War, everything just suddenly changed. The US federal government needed more money to finance their military initiatives. However, they had no bright idea about how to raise these substantially large amount of pennies. That's about the time a man named J. Cook, a Philadelphian financier, stepped up. In 1861, this guy laid the foundation for the first ever American investment bank aiming to help the federal government. That means the US government became the first ever client of the investment banking. Governments wanted money to fund their multiple projects, but why would someone invest their hard-earned money without any sort of security? Right? That's where the idea of releasing securities, or what we commonly call bonds, came into existence. Governments started issuing bonds to gather investments, build infrastructure, and more importantly, to support its growing economy. Initially, What investment banks did is they bought all the bonds from the government and sold them to the private investors for profit. Today, they function in pretty much the same way itself, just with the different sets of parties involved. Now, this might lead you towards another question. From where those billions of dollars are pouring into these businesses? Well, the business model is quite straightforward. Investment banks purchase the assets that hold monetary values, otherwise known as securities, and sell them to private investors for a certain amount of fee. This whole process is termed as underwriting. Now, why would these third parties want to take the help of a middleman like investment banks and spend money doing so? Why won't they deal all that by themselves? The perks of making this kind of a deal is that the middleman is responsible for the risk of distributing all the securities. If they are unable to locate new investors, they will be forced to keep those securities. To intuitively put this forward, investment bankers are the risk takers who would take all the risk for secure transactions between investors and clients. But risks are not only entitled to the investment banks. Commercial banks also take risks. However, there is a huge degree of difference between those risks. The commercial banks deal with the common individuals and small to mid-sized companies, giving out smaller sums of money like personal loans, business loans, vehicle loans, home loans, etc. These financial firms benefit from the interest they charge on the lump sum of the lent money. Whereas investment banks deal with the huge companies and high-risk startups, acting as a bridge between corporations and investors. In this process, they can earn huge amounts in fees as there is a adage, higher the risk, larger the profits. All of this sounds great and astounding, but let's be honest. Investment banking is not a fantasy simulation like the Disneyland. This industry has its flaws. You guys have heard about the financial crisis of 2008? If you haven't, it was one of the worst financial disaster ever to happen in the economic sector, which led to the Great Recession in modern times. It was called the subprime mortgage crisis 2008. Here's what happened. In 2001, the federal government increased the bank's liquidity, simply the amount of cash the bank can hold, while decreasing the federal fund rates. The federal fund rate is the interest that the governing Federal Reserve banks charge to other financial institutions for lended sum of money. This enabled the banks to give as many loans as possible without even doing thorough background checks. And of course, commercial banks could not give the loans endlessly. So, to make room for new borrowers, they sold their old loans to the investment banks. And investment banks sold those debts by packing them with new wraps to the wealthy investors, without disclosing how insecure those loans were. At the time, it did not seem risky. Borrowers, investors, commercial banks, investment banks all made profits. It was like a heavy rain of profits. But after every huge heavy rain, there comes tsunamis and floods. That's what exactly happened. Suddenly, the interest rates started rising, and people started losing their assets. This panic spread everywhere, and the US economy literally crumbled down on its knees due to this banking collapse. The big reason for this was the irresponsible trading done by the investment banks. But does it make the investment banks a villain? Will we be better off without them? The answer is no. The subprime mortgage crisis was one of the crises that happened in the history of banking. There are many market crashes that happened in the past, and many will happen in the future as well. But what is worth remembering is that without these very investment banks, the US government couldn't have built their first railroad projects, mines, highways, and IT companies. Many companies could not have received huge and risky investments to revolutionize the world with their technically sound products. Many technologies, visionary projects could not have seen the light of the day without any support from investment banks. So now, the only question is, what does the future hold for investment banking? It is crucial that you understand. The world will always need companies that could drive innovation. Those innovative companies will always require huge investments. And also, the people with the money will always look out for opportunities to invest and savor their future, which clearly depicts the need of our middleman, that is, investment banking in this world. And hence, you should believe that investment banking is here to stay and it will. More increasingly, if you are looking to build a career around this field, then as a beginner, you could be entitled to the salary of 140,000 US dollars in the United States of America, where in India, you can expect the average salary of around 12 lakh rupees, which could go also up to 70 lakh Indian rupees. And the best way to climb up the ladder of success and gather lucrative offers to learn the intricacies of investment banking operations.
Just a quick info, guys. Intellipaat offers investment banking course training. Through this course, you will learn time management, project leadership, financial expertise, leadership abilities, valuation, and much more from the top 1% of industry experts around the world. With this course, we have already helped thousands of professionals in successful career transitions. You can check out the testimonials on our Achievers channel, the link of which is given in the description below. Without a doubt, this course can set your career to new heights. So visit this course page link given in the description below and take the first step towards your career growth in the field of investment banking.
Investment banking is one of the most profitable fields in the financial industry. We are still 1 month away from saying goodbye to 2022, and by this time, the investment banking market has made a whopping amount of $155 billion in its global expansion. In 2021, it was estimated to be over $138 billion, implying that the investment banking sector grew by 12% in a single year, and that too during the early period of COVID aftermath. Now, all that does sound fancy, but for many people, the world of investment banking sounds like a foreign language. Don't you guys worry if the same holds true for you. This high stakes industry continues to baffle even banking scholars with its complexity. Nonetheless, with salaries starting at 113,000 US dollars a year, it's no surprise that so many people dream of becoming the next Wolf of Wall Street in the sector of investment banking. And today, we are here to help you take the first step towards this dream by discussing the fundamentals of investment banking. But before we actually get started with that, I'd like to request all of you guys to enable both the subscribe button and bell icon so that you never miss any update from Intellipaat YouTube channel. Through this session, we are going to touch upon queries such as what is investment banking? Why is it so lucrative? How do investment banks differ from commercial banks? How do they work? And what are the possible future career prospects in this field? I hope I have made myself clear with the blueprint that this session is going to follow. So, before we get into descriptive details of investment banking, let's first turn the clock and understand how this banking field got incarnated. From the early 19th century, commercial banks in the US performed the functions that we now associate with investment banks. But during the period of civil war, everything just suddenly changed. The US federal government needed more money to finance their military initiatives. However, they had no bright idea about how to raise that substantially large amount of money. That's about the time the man named J. Cook, the Philadelphian financier, stepped up. In 1861, this guy laid the foundation for the first ever American investment bank aiming to help the federal government. That means the US government became the first ever client of investment banking. Governments wanted money to fund their multiple projects. But why would someone invest their hard earned money without any sort of security, right? That's where the idea of releasing securities, or what we commonly call bonds, came into existence. Governments started issuing the bonds to gather investments, build infrastructure, and more importantly, to support its growing economy. Initially, what investment banks did is they bought all those bonds from the government and sold them to the private investors for profit. Today, they function in pretty much same way itself, just with different sets of parties involved. Now, this might lead towards another question, from where those billions of dollars are pouring into the business. Well, the business model is quite straightforward. Investment banks purchase the assets that hold monetary values, otherwise known as securities, and sell them to the private investors for a certain amount of fee. This whole process is termed as underwriting. Now, why would these third parties want to take the help of a middleman like investment banks and spend money doing so? Why won't they deal all by themselves? The perks of making this kind of deal is that the middleman is responsible for the risk of distributing all the securities. If they are unable to locate new investors, they'll be forced to keep those securities. To intuitively put this forward, investment bankers are the risk takers who take all the risk for secure transactions between investors and clients. But risks are not only entitled to the investment banks. Commercial banks also take risk. However, there is huge degree of difference between those risks. The commercial banks deal with the common individual and small to mid-sized companies, giving out smaller sums of money like personal loans, business loans, vehicle loans, home loans, etc. These financial firms benefit from the interest they charge on the lump sum of lent money. Whereas investment banks deal with huge companies and high risk startups, acting as a bridge between corporations and investors. In the process, they can earn huge amounts in fees as there is adage. Higher the risk, larger the profits. I hope that you guys have a clear picture of investment banking in your head. Moving forward, we'll understand how these investment banks function. Well, by now we made it clear that investment banks act as a bridge between the investors and the project owners who require money. Well, the other way to put this around is investment banks are the bridge between demand and offer. They are bridging the people who have capital and are eager to invest and the people who need financing for their own projects. In the initial days, government entities were the main clients of these investment banks. Governments took support from these banking institutions to build highways, railroads, to improve infrastructure, to fund military operation and whatnot. Now, what these governments used to do is they used to issue some bonds and approach investment bankers or middlemen to produce some sort of financial solution. The reason behind approaching these so called middlemen was pretty simple. The government did not know how to price their bonds, how to sell them in the market. They were not at all unbiased in the negotiation of proper terms, and individual investors did not think that their investments will be protected without having the higher bargaining power. These facts tell you how important our middleman or investment banker was. Now, from this point on, the investment bankers used to take on the business. Their main task was to negotiate great deals with government to sell a fraction of their bonds to their investors. And before even doing that, they used to visit the investors and create a list of those who were ready to purchase the bonds the government had. Just to be clear, that they could resell all the bonds issued and would not be stuck with any of those. Now, all this sounds quite easy, but wait, there is more to this. Actually, there are two types of scenarios both the investors and investment bankers can face. The government can default and stop repaying its debt, or it could try to renegotiate the terms. I mean, both of these scenarios are not good for investors, hence, use the middleman. Now, let me give you an example where this scenario happened for real. In 1842, eight American states defaulted because their economies relied heavily on the production of cotton, and the price that year was too low. These states could not repay their loans and refused to pay it. Now, this puts the capital of investors at substantial risk. The middleman who arranged this sale reacted in a decisive manner. All the attempts of these states to raise a new capital were unsuccessful. James Rothschild was the name of this famous middleman. This famous investment banker was quoted saying to a federal state representative that you may tell your government that you have seen the man who is at the head of financier of Europe and that he has told you that they cannot borrow a dollar, not a single dollar. As a result of these Rothschild's actions, the defaulted states agreed to a restructuring plan, which satisfied the investors and repaid them their capital. This scenario proves how important it is to have a reputed investment banker in deals like this. Now, this is a scenario of past. What about now? Well, the thing is, investment banks still do work the same. It's just they offer a variety of services now. They definitely still do raise capital, but besides that, they have specialized in areas like mergers and acquisitions, underwriting, private equity, and venture capital. These banks hire quite a number of employees every year in roles such as banking analyst, investment banking associates, portfolio managers, private wealth managers, market research analysts, investment strategists, investment consultants, and many more. And using these sets of people, they run the empire of money. Different teams work on different sets of deals in the particular demographic areas. And the presence of these top investment banks is of global level. They have rooting in almost every industry and every country possible. Also, these financial institutions have been around for centuries now. Hence, people do put immense amount of trust in their names. Now, just to give you an idea, here is the list of notorious investment banks across the globe. We have Barclays, JP Morgan, Citi, Credit Suisse, Goldman Sachs, Deutsche Bank, Merrill Lynch, and Morgan Stanley. Now, the youngest of these banks is 88 years old. And if we talk about their average age, it is significantly higher, that is 187 years. I hope these statistics help you contemplate the huge market experience these financial institutions bring to the table and how big of a deal they are. Now, moving forward, let's look into the career prospects that you can look out for in the field of investment banking. It is crucial that you understand the world will always need companies that could drive innovation. Those innovative companies will always require huge investments, and also the people with money will always look out for opportunities to invest and savor their future, which clearly depicts the need for our middleman, that is, investment banking in this world. And hence, you should believe that investment banking is here to stay and it will. More increasingly, if you are looking to build a career around this field, then as a beginner, you could be entitled to the salary of 113,000 US dollars in the United States of America, whereas in India, you can expect the average salary of 12 lakh rupees, which could also go up to 70 lakh Indian rupees. And the best way to climb the ladder of success and gather lucrative offers is to learn the intricacies of investment banking operations.
Just a quick info, guys. Intellipaat offers investment banking course training. Through this course, you will learn time management, project leadership, financial expertise, leadership abilities, valuation, and much more from the top 1% of industry experts around the world. With this course, we have already helped thousands of professionals in successful career transitions. You can check out the testimonials on our Achievers channel, the link of which is given in the description below. Without a doubt, this course can set your career to new heights. So visit this course page link given in the description below and take the first step towards your career growth in the field of investment banking.
So, what is investment banking? In general, an investment bank is a private company that provides financial and other services to corporations, individuals, and governments. It provides services such as obtaining financial resources through underwriting and acting as the client's agent in the issuance of securities. It may also assist corporations with mergers and acquisitions and other auxiliary sectors such as derivatives, equities, securities trading, market making, and FICC services. So, who is an investment banker? A highly trained professional who provides a variety of financial services to businesses, governments, and investors is known as an investment banker. They assist businesses in obtaining business loans, issuing stocks and bonds, setting security prices, raising stock capital, allocating resources, negotiating mergers, and managing investments. They serve as the intermediary between private and public companies and investors. They would provide financial advice and consultation on the types of securities to issue, such as stocks and bonds, when and how to issue them, and what price to set for each security. So, what does an investment banker do? An investment banker is responsible for a variety of financial processes related to various financial transactions and investment ventures. They usually work in groups of managing directors, vice presidents, associates, and analysts, with each group covering a different industry or market sector. They are typically responsible for the following tasks: gather relevant information for financial decision making by researching and analyzing various market reports and databases. Second, monitor the current investing environment, identify risks associated with specific projects, and advise clients on how to proceed. Every day, perform company valuations, financial modeling, and financial metric calculations to forecast company performance. Assist companies with the issuance of securities, the management of initial public offerings, and the determination of initial stock prices. Finally, ensure that legal rules and regulations established by financial regulatory agencies are followed. So let us look at the types of investment bankers. Investment bankers assist companies, governments, and other entities with large, complex financial transactions. According to their work, the industry is flooded with large and small investment bankers. An investment banker's professional career follows a fairly standard path. Some of them are as follows. First, investment banker analysts. They are professionals who work in industries such as finance, healthcare, manufacturing, and emerging markets. Their role is to speak with company executives and investors in order to build cases for or against investing in specific companies or industries. Second, investment banker associates. They act as a middleman, creating and formatting slides, arranging client meetings, and performing financial analysis. Then we have VP investment banker. They meet with directors and managing directors to determine what they want and translate it to actionable tasks. He or she also builds relationships with new potential clients, at least as the VP advances to the SVP director level. Lastly, director investment banker. They meet with new companies that may become clients in the future, listening to their concerns and answering their questions. They also meet with private equity and venture capital firms to discuss their portfolio companies and which ones may need to be sold, listed on the stock exchange, or raised capital. So, coming to the main part of this video, how to become an investment banker. After completing your 10 plus 2, first, earn a bachelor's degree. A 3 or 4 year bachelor's degree is required to obtain an entry level position with an investment bank. Bachelor of Commerce, Bachelor of Arts in Finance, Bachelor of Arts in Economics, and Bachelor of Business Administration in Finance are all available. While each program's curriculum varies, you may study mathematics, accounting, economics, financial management, corporate finance, investment, taxation, data analytics, and business administration. Second, earn your master's degree. For investment bankers, a 2-year Master of Business Administration in Financial Management is a sought after postgraduate degree. A Master of Science in Finance is also an option. The National Stock Exchange Academy offers 6 to 9-month postgraduate programs in investment banking and capital markets, banks and financial planning, business analytics, and management accounting. Third, obtain a doctorate. A PhD in finance and banking may require more than 55% postgraduate marks and a cutoff percentage in the UGC net. Asset pricing theory, corporate finance theory, research methods in finance, foundations of business research, and market microstructure may all be covered in the curriculum. The course lasts 3 years. Fourth, obtain a certification. A chartered financial analyst professional certification can help you advance your career. The CFA program provides intensive and practical investment and financial training. Economics, corporate finance, derivatives, equity investments, alternative investments, financial reporting and analysis, and quantitative methods can all be studied. After completing your bachelor's degree, you can apply for this program. The course can last anywhere from 1 to 4 years. Fifth, look for an internship. Investment banking internships can be found on online job sites as well as through campus placements, networking, and HR consultancies. Internships in investment banks can last anywhere between 2 months to 2 years. You can learn to improve your communication, presentation, and negotiation skills in addition to financial training. You may be offered a permanent position as an investment banker based on how well you perform during your internship. Finally, look for a job. You may receive a job offer immediately following your internship through a campus job interview or by applying to open positions with investment banks and financial advisory firms. Review your fundamental finance concepts, financial modeling, and private equity to prepare for your interview. It can also help to compile a list of frequently asked interview questions and practice answering them. So let us look at the skills required to become an investment banker. A good investment banker aspirant should have a strong analytical mind as well as the ability to work as a part of a team. They should also be able to think critically and be willing to learn new things. Some of the skills include arranging financing, equity financing, underwriting deals, analytical skills, negotiating mergers and acquisitions, structuring and closing principles. So, what are the benefits of career as an investment banker? Investment bankers, like any other profession, have a variety of perks and benefits. This is considered to be one of the most lucrative professions in the world. Some of the advantages of working as an investment banker are as follows. First, salary. Depending on experience, an investment banker can earn between 5 and 8 LPA. They can open their own organization and make executive decisions for the firm as they gain experience and knowledge. They can also work as a freelance investment banker for a variety of companies and organizations. Second, job security. Professional investment bankers can work from anywhere in the world thanks to the skills they gain through practice. If they have a perfect skill set in the relevant field, they can easily get a job anywhere in the world. Third, positive career impact. Investment bankers assist financial markets and the economy by connecting sellers and investors. As a result, their actions improve the market development and have an impact on business growth, which benefits the economy. Fourth, higher education. While working as a professional investment banker, they can pursue master's or PhD programs in a related field. Candidates should be able to conduct research in investment and related fields. They can also publish their thesis for those aspiring to be investment bankers. Finally, unique experience. Investment banking is a unique field of business management in which people can work according to their abilities and knowledge. They also gain a lot of experience because it's a continuous learning process where you learn a new strategy and technique every time. What is the importance of investment banking in India? Investment banks use trained bankers to execute transactions in order to maximize revenue. Investment banks serve as a link between large corporations and investors. An investment bank's primary role is to advise governments and businesses on how to meet their financial needs and obtain financing. The following are the importance of investment banking firms in India. First, role as an advisor. Raising capital funds is a time-consuming task for any organization, which is where the assistance of an investment bank comes in. An investment firm can assist in the sale of the company's stock by determining a fair price using sophisticated financial models. While selling shares, financial analysts consider the factors such as earning potential and the strength of the management team. Investment banks provide advice during merger and acquisition transactions by advising management on the value of the company and assisting in its restructuring. Second, underwriting stocks and bonds. Underwriting is the process by which investment banks take financial risk in exchange for a fee. It entails conducting research and determining the level of risk involved in the insurance industry. An investment bank purchases a predetermined number of bonds or stocks and resells them through an exchange. The investment bank is responsible for preparing the documentation that must be submitted to the Securities and Exchange Commission before the company can sell any shares. Financial statements, management information, current ownership, and future plans will all be included in the documentation. Third, other functions. In addition to advising and assisting companies in raising capital, investment banks perform research, trading, and sales, asset management, wealth management, and securitized products. So, how much do investment bankers make in a year? An investment banker's annual salary in the United States is $597,078. Your salary will depend on where you live, your level of experience, and other factors. The national average salary for an investment banker is 12,21,706 rupees in India. Investment bankers who have graduated from prestigious universities or work for large banks may have higher base salaries and good bonuses. So you must have realized by now that an investment banking career is no walk in the park. You must work hard to earn your place in this competitive industry. As a result, it wouldn't hurt to begin your learning journey with some professional assistance.
Just a quick info, guys. Intellipaat offers investment banking course training. Through this course, you will learn time management, project leadership, financial expertise, leadership abilities, valuation, and much more from the top 1% of industry experts around the world. With this course, we have already helped thousands of professionals in successful career transitions. You can check out the testimonials on our Achievers channel, the link of which is given in the description below. Without a doubt, this course can set your career to new heights. So visit this course page link given in the description below and take the first step towards your career growth in the field of investment banking.
See, we were talking about, I believe we were done with money market, am I right? I remember that we done with the capital market. See, this IPO event, we applied in primary market because in a primary market, company directly, issue securities to the. So I wanted to buy securities from a company, so I directly applied for an IPO here in the primary market. And once the now stock, in next week stock will list, and that stock will list here in the BSE market, NSE and BSE both. See, one thing is very important, guys. If you apply for an IPO before the, let's say, IPO event, so it means, let's say maybe, when the company was private limited, at that time, if you, entered in any business, then you can multiply huge profit. How? I'll tell you. Private equity funds, okay? I don't know whether you guys have heard about this or not, like KKR, Blackstone, right? They are private equity firms. Warburg, there are many more. So they actually invest in a companies at a very early stage. Very early stage. See, your startup starts from 1 crore, and that 1 crore valuation reach to the 20,000 crore or maybe even 1 lakh crore. And that 1 lakh crore value, actually they sell it out to the public. So it means IPO event is just like, to make a fool to the people. So through IPO events, companies is the, fool to the common people, and they raise very long-term capital, or you can say like very, long-term or perpetual capital for their long-term business objectives. So it means if company raise capital through equity, then company don't need to return that capital to the, let's say, shareholders back. That's how basically, this game works. All right. So my point is, now just imagine if anyone, if let's say even you also, let's say you have invested your 10,000 rupees when they say value of that startup was 1 crore. Just imagine what if your 1 crore reached to the, let's say, 1 lakh crore, then see how much value that you can generate. And duration would be like max to max 5 years or 10 years. Within 10 years, you can multifold your profit. And private equity firms or venture capitals, they basically generate, huge profit. Huge means huge. Again, in terms of risk would be high, but the universal law of the law of return is like more risk, more profit. The private equity funds, venture capital funds, they always entered in a business at a very initial stage. Let's talk about Flipkart. Flipkart was a startup, right? Flipkart was a startups, and not Blackstone, Tiger Group. Tiger Group, again, it was a P fund. It is a P fund. They took an exit with 28,000 crores, profit. So it means They booked the profit in Flipkart around 28,000 crore. So just imagine the profit percentage. So it's a bet actually. If you know the risky businesses and if you just invest in a systematic way, then you can multiply your money. See, if you haven't attended, then please go through the recorded one because we have recorded the session. But if you ask me to cover it from the basic, would be tough for everyone and everyone will get bored. So I don't want to break that rhythm. So it's a humble request. If anyone is new in this batch, request you to go through the recorded session. Already session is recorded one. All right. Yeah, it is uploaded there. Check with the coordinator, please, because every session is recorded one. So you can just text the coordinator. The recording is on already by default. Okay. All right. So this is how you can multiply your profit if you're really interested. So I'll walk you through one of the deal which I have invested. I don't know means how long this, again, it's a practical insight. So you should know it, as a working professional. I have invested in this ambition, rail. Let me just search it. Rail, sorry. Rail bus project. See this one. Can you see my screen? I'm on a different screen. I just wanted to. Okay. So see this. So this is the another project where I have invested not a huge amount because see, I'm also like, I'm not a rich person, right? But I invest like 2 lakhs, 3 lakhs, 5 lakhs, 4 lakhs. This is how I'm just building my portfolio. If you see, this is how their model is. It's just at a very initial stage.
Airbus is a startup company, creates a state-of-the-art, green and low-cost mass transportation system powered by solar energy. Step Forward ultra-light rail systems. Railbus solves an age-old problem facing millions of people in many cities that have a lack of infrastructure. Railbus is more than a solution for the transportation problems. It creates and supports sustainable development in any country. Today, transportation infrastructure in many cities is limited and inefficient. With low income and poor infrastructure, mobility is a major stumbling block for a country's economic development. Buses are.
So did you get this? So it means they're working on a system like, it's a very scalable system. I don't know how this will scale, but this is at a very initial stage, as I said. So this is how you can, tap the market opportunities. I have invested in this project. This also reduce carbon, support to the environment. It's a capsule. And again, you can save the time as well, right, through this infrastructure. And it's a very cost-effective one, 100% congestion-free elevated rail network. So it means you don't need to use any fossil fuels to operate this system at all. All right. So see, this is how the project is. So I have invested at, let's talk about some numbers because we are finance professionals. So along with that, we also talk about numbers as well, right? Numbers, it means in terms of growth, how much growth that we can expect. Let me see, investors column. I don't know why system is slow. Get a transition. Okay, so they have got memorandum. Government interested in adopting Railbus as a modern, affordable Dubai and sign and welcome to visit our showroom in Dubai and sign an MOU. So they have signed MOU with the government, Dubai government. So that's what I meant, got more traction on this project because they are not like India or any other, because in Dubai, they prioritize the infrastructure. So thought like, let's take a risk and invest. I'm not able to see that. I have invested, when the share price was like $1 or below the $1, I would say. But now the price, which is at more than $1, around $3 to $4. So it means, again, I have around 300% returns. But in 2027, the stocks we are anticipating, this project will like up and run and then they list their stocks on the stock exchange. At that time, maybe we'll get the value around $100 per shares. And at that time, maybe I can generate around 1 CR profit from all of this investing activities. So this is how means, see, again, it's a risky, right? When you invest in any business at a very initial level, it becomes more risky, guys. But yeah, so I'm at a very young age, so I thought like let's take a risk, because if you don't take a risk, then again eventually you cannot make a profit. Yes, infrastructure could cost a lot. That's what I said. It's a risky one, but if you want like see, the entire world is now focusing on carbon footprint. The reason is the world is now facing three big problems. One is the clean air, rising temperature, and clean food. Most of the underdeveloped countries, they don't have a clean food and even clean water as well. And the entire world is now shifting focus on all of this. You can go and check the data on, let's say, global investment trend monitor. You can go and check that, so where the world is investing. See, world is investing, foreign direct investment flows in the second quarter of, again, down. The investment was down, but the most of the investments, let me see the tracker first, so that where world is investing, that we can see. Data center, country profiles, infographics. Trade and merchandise. Let me see, there is one more tracker. This is not something. Global investment data tracker. We don't want China, we want map, we just, because world is investing in the clean water, clean energy, and clean air. So the world is focusing on that only, including India as well, because for us also the priority is food security, energy security, clean energy, health infrastructure. So we have lots of challenges, and our political system is like, again, very corrupt. The opposition leaders, they don't have a vision. Then ruling parties, half of the leaders, they don't know how to do next. Half of the leaders, they are good, but the support system is like weak. They're working very hard, but the people, like always, they create unrest from different corners of the country. Like you can say farmer protest, student protest, girl protest, that a number of things. But we should, as an investor, we should always, see the vision, like how we can, divert our money and put into the different, buckets. I'm not able to find that. Maybe in the next session I'll share you that. I had saved somewhere the links. I'm not able to recall the name at the moment. So there is a tracker which is a very interesting tracker. So that gives you more sense, like where to invest, how to invest, where and where the world is focusing now. So then let me just give a last try. Global investment. Sorry. World Trade, WTO, data sources. Because there is one tracker, but now I'm not able to see the name. So I'm not able to recall it eventually, because trade monitor report. Okay, anyways. So yeah, so you can review the different data, guys, metrics, data, and all other resources if you want to become a successful investor or even banker as well. As a banker, let's say if your target is to become the research analyst or financial modeling analyst or fund manager, fundraiser. See, for all of this role, then the requirement is how you're good at tapping new opportunities or understanding the market sentiments, or let's say understanding of different geopolitical issues, and see how you can capitalize them for your benefits and your investors' benefit. Because see, as a banker, see beyond the profit making and also, we should always look for an impact as well. If we talk about, let's say, poverty data, so we have like around 30% the poor people, and they are like under very grave poverty line. All right. So again, when we talk about, let's say, unemployment, data, which is shocking. See, to blame a government, it will not resolve your purpose or problem. As an investor, so as a good, investment banker, you can always route the money into the different, the opportunities, and see how you means your decision as an investment banker can, help governments, or maybe let's say society, to create a more and more, the job opportunities, and also like, scalable and sustainable model as well, by ensuring that, your model is not affecting on environment, social lives, as well as on, let's say, the, uh, the employments as well. But we should also ensure that how your companies, like investing companies, they're following due diligence reports and all. So let me tell you one example why it is, important is, let's take an example of, the Bhopal factory. What was happened in Bhopal factory? Anybody knows it? Anyone heard anything? Gas leak, right? So what the foreigners they did in this, in the gas leak, that we know it. So more than 15,000 people, they lost lives in Bhopal, Madhya Pradesh, due to gas leak, right? So we should always, means as a responsible investors, we should look beyond the returns. Returns cannot be a target, but yeah, of course, returns, which is again, it's a byproduct. But apart from that, see how you can, means from your expertise, like how you can do, some better deals for everyone, every stakeholders. That's how your role come into picture, and why we are discussing different markets and all. See, the purpose is not to just understand, let's say, the market and, crack you into. That is, of course, means initially, we means all are looking for a job. That could be your short-term goal, but for a long term, see, always broaden your view. All right. So just see how, see the longer picture at your lenses, and see how you can create a big, footprint. All right. Because you guys are now, of course, future, and young, you're young to see how you can, means leverage out all of this, financial products, maybe finance in the market. Because what I believe personally, finance is like an oxygen. If you have a control of oxygen with you, so it's on you where to, infuse the your oxygen, and where not to infuse. So you know it. So see that how you can leverage it out. So let's discuss about, further things. If we talk about, guys, the money market is one of the highly liquid market. Highly, it means very highly liquid market. RBI control the money market. Okay, who control the money market? RBI control the money market. So RBI take care of everything. So why, now your question would be like, sir, why RBI take care of everything? See, guys, cash is an oxygen of the economy, and always, we should have to have a system in place who can control that oxygen, because excessive oxygen is also not good for your health. So same applies for money market, for economy or country as well. If you see excess supply of a cash, all right, if you see excess supply of a cash, excess, it means very excess, what will happen? Can anyone guess? Let's say we have a high supply. Your spending capacity, come on, your spending capacity will go up, correct? So it will lead to an inflation. So how inflation? Let's take an example. Let's say the banks, right? If you apply for a banks, they are charging low interest rate. Let's say around 5%. So more people will apply for a loan, right? Let's say bank approved your 20 lakhs loan, personal loan. So you can spend this money on anything. Maybe you can spend on car, you can spend on mobile phones, clothes, garments, and also, like, you would pay the more, price than the market price. That's the, human tendency or behavior, I would say. You can read in the behavior, there is a theory called, like, stupid stupid something, stupid price something, theory that I'm not able to recall that exactly, because I means few years back when I was doing the study of the behavioral finance, at the time I gone through the one term like stupid price theory something. Stupid price, it means something where, let's say, the actual price is available market of for the product is 20, but you will ready to pay 21,000, 22,000, 23,000, 24,000. Because for you, when the supply of money is high, then the money, the money value will actually go down in your eye, and your spending capacity would be high. So that will lead to the inflation, I would say. Inflation, it means teji, that you can call in Hindi, teji, so that you can pay more and more fees, more and more money on a products. And again, that inflation is also not good. Now your question would be like, sir, look, why inflation is not good? Because I'm ready to pay, repay the debt, and it's my money because I took a loan. I can do anything, whatever that I want. See, question is not about you. See, just because of your stupid act, see, entire markets, prices that you have manipulated. If you buy the, let's say, mobile phone at 21,000, then from that point, mobile sellers will sell the mobile at 21,000 only. See, you are like, let's say you have received loan amount of 20 lakh. That doesn't mean everyone have applied for a loan, and they'll also pay the same amount. Right? As I said, we have a poverty line as well. So poor people, they can't afford it. Same applies to the essential goods as well. 90%, cases that most of the poor people, they can't afford your let's say oils, good oils, means the refined oils, they can't afford it. Right? Even branded clothes. 30% of your country's population, they can't afford the branded clothes. Right? But just because of you, if you just want to manipulate the price of a goods, so that doesn't make any sense at all. And that's what we need a system who can control the oxygen, who can control the supply. And vice versa. What if, let's say, there is a low supply? There is a very low supply of money in the market. Very low supply. What will happen in that case? Come on. Low supply, it means it will lead to the high interest rate. Right? High interest rate. People, they'll not apply for loans. Means apply for a loans. The number of people, they'll think about, it's a behavior. They'll think about, the interest cost is high, so why should I apply it? Instead of that, I'll wait until the rate, gets down. So it means the loan growth would be low. So in that case, what will happen? Supply of money would be again low, and that will lead to the inflation. So now your question would be like, sir, see, if we have a low supply, you are saying inflation. If we have a high supply, you are saying, sorry, my bad, very low, not inflation, recession, right? In terms of, let's say, low supply will have a, recession. In terms of high supply, you're saying, inflation, recession. So how to maintain a balance? See, balance of payment, which is a very critical part. Very critical part, it means very critical part. Because, see, to maintain a balance is a very important in terms of the, equal economic, you can say like, the means everyone, they can afford it, for affordability of durable things. See, ultimately, your paper has no value. Let me tell you something. You can just access the services through paper, because your note is your paper money, right? Let's say when you are on a bid and now you don't have a time, because you will means, let's say you don't have a time. You don't have a time, it means, let's say your age is at 70, 80, 90, whatever it is. So what will you do with that paper money? You tell me. Nothing, because that money also, it will not save you, right? Now, question would be like, why we wanted to build all of this, maybe business, empires, all of this. See, ultimate the purpose is we want to support to the system, right? Maybe let's say if you're an entrepreneur, then you can build product, you can build your business empire, you can create a more and more employment opportunities, you can support to your community system, and in return of that, you will get a good life, right? you'll get a good life. So that's the whole and sole purpose. Even if you are a rich person like Ambani, Adani, they have also same 24 hours of time and 70 to 80 years of life. Same applies to us as well. Correct. So this rule is applies to everyone. So ultimate purpose of doing all of this is means everyone want better life, right? Better life, it means clean energy, clean water, clean food, clean energy, and safety and security, I would say, like defense. That's all. That's the means ultimate purpose. Why we want to make a money? For that purpose only. And if we look at now, to that purpose, then your oxygen matter a lot. All right. So let's talk about how RBI control the, let's say, oxygen. I have prepared separate PPT for this. So let me walk you through. So today you can learn means that and apply to your businesses as well. How this policies works and all, we'll discuss that in details. Monetary policy. How RBI control this? CRR, SLR? Anyone, any idea? Okay. See, monetary policy, which is a very important measure, I would say, that RBI use it, guys. It's a very important one. Main functions of RBI, which you would say, like, the issuance of currency, because RBI actually print the currency, right? Before this, even finance ministry also had access of printing of the notes, 5 rupees notes. But now the 5 rupees currency which has been banned, and so only the RBI is responsible for printing and issuing new currencies. Okay. Now, if I ask you a question like how RBI print and issue the currency, see, they actually ask government to deposit gold. Okay. So basically, your government deposit gold with them. Let's say 1 or 10-gram gold price is 70,000 in the market, right? So RBI will print the notes up to 70,000 only. So government will have a choice to select the notes. That's all. Maybe let's say 100 rupees notes, 50 rupees notes, 200 rupees notes, whatever it is, 300 rupees notes. So government will just select the notes and submit the proposal with the bank, and then RBI will take care of issuance of currency. And your notes, which is backed with the gold. If there is no golds available in the system, and if you still print the money, so ultimately your paper worth would be like worthless, and that's when your inflation will trigger. So it means RBI basically control that part. They always ask government to submit the collateral before printing the money, and when the government submit the the gold, and then only RBI print the money in the market and issue it. Again, it's a responsibility of RBI to print that and distribute that across nation through the banking system. Then another one is regulator of payment settlement. See, your RBI is responsible for all international payment settlements. All means all. They control everything. For example, let's say US person want to invest in India in a stock market. See, dollar which is not allowed to invest in Indian market, correct? Let's say the ratio is like $1 is equal to 80 rupees. So, and this guy, let's say Mr. John, decided to invest 100 USD in Indian market. See, RBI works for them as a regulator of payment and settlement, or you can say like, the swap agent. Swap agent, it means it's a foreign currency exchange where this guy can deposit $100 with RBI. Then RBI's subsidiaries, or let's say the Asian banks, RBI's Asian banks, what they'll do, they'll let's say HDFC Bank or all other banks, they'll issue the 80 rupees to this person in Indian accounts, in INR accounts, to invest in stock market, and in return of that, this guy will deposit the 100 USD with the RBI. rate is, let's say if it is 80, so it means this John will receive around 8,000 rupees. Then 8,000 rupees, this guy will invest in stock market, generate some amount, and then again this at the time of maturity, this guy will again submit the same amounts with the any authorized agents, which is approved by the RBI, or maybe with the RBI system, this guy can deposit 8,000 plus return. If you see any returns as such, this guy will deposit with the this RBI, and then RBI will convert again this amount into dollars. So it means this dollar RBI will return to this along with the profits if it is there. So it means if you want to, let's say, if you want to make more money, foreign money, it is a very important that the foreigner should actually lose money with Indian system. If foreigner deposit, let's say $1 billion, so that $1 billion value should again burn through your stock markets activities and all. Then only we would be in profit. Otherwise, what will happen? What if, let's say, foreigner invested $1 billion in Indian economy, and within 5 years that 1 billion become 5 billion. At the time of exit, they'll directly deposit money with the RBI, and they'll ask RBI to return them a $5 billion. So RBI will have to settle that payment to them. Otherwise, if let's say if RBI is not able to settle the payment to them in USD, then we'll announce as a bankrupt that we don't have a foreign reserve to manage the trade and commerce. So it's a very critical game, guys. Are you getting my point? But yeah, so RBI take care of it, that part as well, like settlement of payment and regulate them accordingly. And if any functions, if you see, if RBI want to develop, so RBI will take care of it. Apart from this, RBI works as a banker's bank. So we'll discuss that little bit later because I have prepared something. So first, let me decode that few things, right? Regulator of a financial system. See, recently we have seen RBI sanction Paytm Bank, RBI sanction IIFL, RBI sanction, Kotak Bank as well for their online banking system. RBI also sanctioned to the Bank of Baroda. So it means it's a responsibility of RBI to monitor or review the system or infrastructure and ensure that they are following the due diligence and provided checklist to manage the cash operations. So that's how your regulators role come into picture. RBI work as a government's banks as well, because RBI works for a government, and they also manage the all governments, the initiatives as well. For example, let's say if Modi want to raise, let's say $100 billion, $100 billion, if this Modi want to raise, then Modi will call to the Shakti Kanta, say, look, bhai, I need, $1 billion, $100 billion amount to complete this project. Again, the governor of RBI will ask for, hey, can you please provide, any security as such so that we can sell it out in market and raise the funds. And that's when your T-bills come into picture. Then, the RBI governor will sell it out securities through their agents in the market and raise funds for the government. All right. And that's how we'll call it as it's a government's bank. And whatever governments has any, investments in any XYZ companies or any public pay, public unions and all, so that all comes under RBI. So RBI manage that part also. All right. Apart from this, the detection of fake currency means any counterfeit currency and all. If you see, it is a responsibility of RBI to implement that strong measures and ensure that there are no any fake currencies or counterfeit currencies in financial system. If it is there, again, it's a very difficult, guys. It should not be there. If it is there, see, ultimately, the final beneficiary would be common man. They lose their money. All right. And yes, managing foreign exchange, as I said, see, it is managing foreign exchange. It means that John example, you can just keep in mind. If any foreign investors want to invest in India, or any Indian investors, if that investors want to raise funds from the foreign investors, then it is a mandate to report to the RBI and open account under RBI supervision, so that RBI will allow to exchange your cash, means INR with USD or any other currencies and all through your foreign swaps. All right. So these are the functions of RBI. Now, if I talk about let's say how RBI manage, your show, how RBI manage your monetary policy, because this is the part of your monetary policy. How RBI manage it. Of course, I'll explain it, but before that, if you just go through it, how it works, because I have explained everything in just this chart only, about your monetary policy. Come on, anyone would like to give a try, guys? If yes, then text me in chat, so I'll allow you to speak. Don't miss such opportunities. Come on. Okay, so I'll explain, don't worry. Let's say for 5 minutes, let's talk about, means we'll not talk about that, slide. We'll talk about the different thing. Let's say how inflation and recession bank controls. So I'll explain through monetary policy now. It's a very practical thing, okay? Anyone can understand it. It's not a complex thing. And again, we can understand the relation of this with your businesses as well, like how it will affect on your business. Okay. Let's consider it. This Mr. X deposited money with bank, right? Which is your HDFC bank. So let's say Mr. X deposited around 10,000, okay, at 10%, return, because bank, let's say, promise to this guy that bank will offer, 10% return on deposit for per annum. Okay. So in this case, if we see the cost of deposit is 1,000 for per annum. So this one is a cost, because bank will have to pay from bank's pocket. Let's say bank received this amount, deposit 10,000. So bank decided to offer loan again of 10,000, right? Deposit received at 10%. So bank decided to offer this loan at, let's say, 12%. So bank only want to earn 2%, difference, which is a spread. Bank only is looking for a 2%, right, on this 10,000 rupees, correct? Let's say bank disburse this loan to Mr. B. So Mr. B promised, so that Mr. B will pay, the 10,000 plus, let's say, interest payment. How much would be 1,200, right? After 1 year. See, after 1 year, if you see the flow of money, this guy will return almost, right, 11,200 to whom? To the HDFC bank, and HDFC bank will transfer, right, almost 11,000. Why? Because 10,000 is deposited amount and 1,000 which is an interest payment. See, in this particular process, you will not see the intervention of RBI. I will not see the intervention of RBI. Correct? Because bank received 10,000 and HDFC directly, transfer this amount to the Mr. B, because ultimately the bank's business is to offer, accept deposit and offer loans to the customer. Let's take a now condition. What if, let's say, at the time of maturity, this guy now bankrupt? Because on a personal loan, credit card loan, because bank, never ask for a credit, never ask for a collateral. So how bank will recover that money? Just imagine. And if this guy announced default, then ultimately it will affect on this deposit. So eventually this guy's money would be under risk. This guy will lose the money. And in a banking, act, your bank is only responsible for up to certain limit. If you deposit, let's say 10 lakhs with a bank, and if a bank announces bankruptcy, then he will not receive 10 lakhs. He will receive only 5 lakhs. So it means your money is not safe then. Are you getting my point? So in this system, your money is not safe. That is a one thing. If your, let's say, borrower, if announced, bankruptcy or insolvency, in that case, ultimately your deposit holder will lose the money. Now let's talk about the other side. See, here if you see 100% amount received as a deposit and bank, directly transfer that 100% amount to the, let's say, lender B. And if you just, compare this cost, so cost is very low. What if, let's say, in a stock market, there is a potential of, let's say, 35% to 40% return for per annum. Then what I'll do, I'll raise the money from the bank at 12%. I'll invest that money in stock market, generate return of 40% on investments. So my total revenue would be 4,000, right, on investments. Out of it, I'll have to just pay 12%. So it means 1,200. I'll just pay it. So my net profit would be 2,800. So, but eventually this will lead to the inflation. Why? Because supply of money is high, right? The supply of money in market is 100%. If the supply of money available, in market is 100%, then in that case, this will lead to the inflation. Because my behavior would be like, I'll, buy more and more securities, or maybe I'll buy, let's say, anything that I wanted by paying more price. And I will behave like, reckless, means irresponsible towards the economy and country, because I'll only look for like, see the rich people, look at them. They buy anything what they want, and they're actually responsible for inflation because they pay more price by saying, look, my life is very standard, this and that, this is buy it. And again, you will have to follow the same price pattern. Correct. So to control this, so we need an intermediate, I would say intermediate, someone who can control it. Now your question would be like, sir, intermediary and all, is it something that, something new that we are doing? No. Let me tell you, my dear friend, in Muhammad Ghori Empire, so which was in 1200th century, right? The Ghiyasuddin Balban, which is from the history, this is again history case. That guy implemented this system, like tax collection system, which is now we have a GST. Then your payment system, like to accept the payments and to offer the services and all. And apart from that, means in 1200th century only, 12 or 1300th century, I believe, only the system was like to they appointed, means that guy appointed, that ruler appointed a committee to control the prices of foods and all durable, all essential, things like garments or daily day-to-day things. It could be commodities and all. Why? Because the intention was to ensure that everyone is getting food on time, and even clothes or all other important commodities. Are you getting my point? So anyways, so it means the system like intervention or intermediary system is not something new. So the system, it was already there. It was already there since from the very long back. Like maybe you can see even at the time of Mahabharata also we have seen this system, right? So there was a system, committee, and everything. They used to set the prices and all. So the system is not new. We are not learning anything new. It just matter like we are not aware about it. So RBI's role, which you can see kind of, the intermediate role, where they control the prices of a loan. Now your question would be like, sir, what will happen if RBI control that? How, means that will affect on the supply. See guys, what if, let's say, if RBI restrict HDFC Bank to not to offer entire amount as a loan to the Mr. B. Instead of that, do one thing, only offer 8,000. 8,000. So in that case, See, on 8,000, if still, let's say bank charge 12% return, you just calculate it. 12%, how much would be? 960. And total cost of a loan is 1,000. So basically, bank would be in loss of 60. And if you consider the other expenses and all, bank would be huge in a loss. So it means if RBI restrict this fund not to offer 100%, then eventually this interest cost will goes high. Then bank will charge somewhere around 15 to 17% interest payment on this amount. And then only bank will able to compensate it. All right. If bank charge, let's say 15% interest payment, then it goes around 1,200. And then here, then you can bank, if you see, the bank will compensate because bank was looking for 1,200 only because 200 profit at least bank wanted to secure. And if the interest rate, let's say, if goes from, let's say 12 to 15%, so eventually who is paying this interest cost? This Mr. B is paying interest cost. And the perception, or let's say again, the behavior would be, look, why should I pay high cost? So instead of that, what I'll do, I'll just wait for some time to get the interest, down, and then only I'll buy, maybe, or I'll take a loan and then I'll buy something. So this is how people they think it, and that's how your inflation will start, coming down. Okay. So let's see now how the bank actually practicality, like how bank control that. So let's discuss that. Let's say this guy deposited money with the bank, HDFC Bank, and let's say HDFC Bank received 1,000 rupees, right? So bank will, means RBI, this guy will send a notice to the HDFC Bank and ask bank to do one thing. 4% of 1,000, which is 45 rupees, transfer to the CRR account as an emergency fund, and SLR, which is statutory liquidity ratio, which is 18%, which is current ratio that I'm talking about. So total amount would be somewhere 180 on again this amount. So invest this amount in government securities like T-bills. So it means this guy will force banks to purchase government securities worth of rupees 180 rupees, because the government also want the fund eventually, right? Government also want the fund. So it means if anyone deposit 1,000 rupees, out of 1,000, 180 rupees will goes to the money market instruments where this government securities will buy and sell. Okay. And apart from that, 4% it will deposited in the emergency fund. If something happened, if let's say any lender announce bankruptcy, any lender announce anything as such, in that case, so that RBI can ask bank to use this emergency fund and repay at least the minimum amount to this particular guy. So minimum amount would be, let's say, as per the RBI rule, so up to 5 lakhs, all right, or the actual amount. Let's say in this case, if the actual amount is 1,000, then bank will ask, means RBI will ask to HDFC Bank to return this to the deposit holder, correct, which is 1,000 only, because in this case the amount is small, so entire amount will receive to the deposit holder. But the important point here is, guys, see how much amount is available for a business. Only 775. Only 775. If the low amount is available, bank will charge high interest rate. Bank will charge high interest rate. In this case, if you see, bank deposited 45 and 80 with the RBI now. So it means the HDFC Bank has available money, which is 775. If 775, if you offer this as a loan, so minimum rate of interest that you would expect, which is 12 to 15% in between. 12 to 15% in between. Let's calculate it. 775 into 15.15 divided by 100. So interest income would be somewhere to the bank around 116.25. And out of that, bank is responsible to pay somewhere, let's calculate 1000 into 6.5 divided by 65. 65. So 65 is the basically expense for the bank, and this one is income. But in reality, if bank charge 15%, nobody apply for a loan, right? The reason is, the interest cost is very high. See, if I'm taking loan of 50, think very practically, guys. If you are taking loan from a bank at 15%, so it means you will have to find an opportunity which can generate at least 20% return on investment. Then only as a borrower, so it will be your profit. Otherwise, you will be in loss. And see, the businessmen or entrepreneurs, they always calculate in that way. If I'm taking a loans from a bank at 15% rate, so at least I should have an opportunity to generate 20% return minimum that I'm talking about. Then only I'll take a loan from a bank. Otherwise, why should I take a loan from a bank? See, common people like poor people, they always take a loans for their standard of living, which is a brutal fact. So I don't want to criticize now for that. But see, there are two approaches. One is bread and butter wala approach, and another one is entrepreneur approach or investor approach. See, investor always look for an opportunity. If I have any opportunity which can help me to, let's say, multiply my 100 rupees into 500, right? Then of course I'll apply for a loan. I'll take a loan from a bank. I'll invest in that, and within a 1 year or 2 year, I'll multiply money from 100 to 500. And then after I'll sell it out, and then same, money, I'll settle the loan, whatever that I have taken from the bank, 100 rupees plus interest payment. Are you getting my point? So this is how, the investors, they think about it. But the point here is, guys, if RBI, let's say, increase, now let's talk about the fact. If RBI, let's say, increase this particular, this rate, CRR rate and SLR rate, so basically supply of money will reduce. Okay. Supply of money will reduce. And if this rate goes high, then ultimately stock market will goes down. Now your question would be like, sir, what is your logic behind it? See, if there is no supply, enough supply in the market, then eventually there won't be any supply, means full supply of money in stock market also. Why? The reason is, if bank increase, means RBI increase CRR and SLR, then cost of a loan would be high. Cost of loan would be high. So if a cost of loan is high, then why should I take a loan from a bank to invest in stock market then? So I'll not invest in stock market then. I'll not apply for a loans. So eventually, if the CRR goes high, SLR goes high, then cost of loan goes high. So it means stock market will goes down. And that's what every quarter, guys, we always evaluate. Means always we hear the meeting of RBI, because their committee, basically they review the interest rates, and accordingly they set it out. Let me tell you, if next quarter, let's say RBI reduce the CRR and SLR, your stock market will boom. Why? Because cost of loan will reduce. So more and more people will apply for a loans, and they'll invest in stock market. Let me tell you an interesting example. Very interesting one. You will surprise. In Japan, okay, Bank of Japan, means in a bank of, let's say, in Japan, the interest rate was 0 on loans. So there was no interest rate, in Japan, because Japan is one of the developed countries. So there was no interest rate. So it means the people, like, the investors, they used to, means US investors, basically, US investors, they are very smart. They used to borrow money from a bank. Okay. Borrow money from the Bank of Japan at 0 rate. And they have invested huge money, means Japanese in different markets, including India also. They invested in China market. They invested in Indian market. They invested in Russian market. They invested in everywhere. Why? Because see, the bank is offering facility to take a loan from from them at no cost, right? At no cost. Take a loan from the Bank of Japan, invest in any country, generate return, and return that amount as it is to them, even after 5 years also. And see, the Indian market facilitated thousands of foreign investors to multiply their wealth through this strategy only, including big private equity funds and hedge funds. They applied for a loan with the Bank of Japan. They took a loan from them and same money they invested in Indian markets to generate more and more returns. Are you getting my point? So investors also plan it out, same thing. What if now? So recently, why market crashed? So let's talk about that as well. Recently, what happened? Bank of Japan increased the rate on loan by 0 to 0.45. So this is a something I would say where it was the perception that now the Japanese people, they'll not lend money to anyone because their bank started offering interest rate 0.45%. So their people, they'll invest in now bank system. So they'll deposit money with the bank because the bank is offering now interest payment around 0.45%. So this is how now, if you see stock market now went down, still the stock market, I can say, sideways for many of the stocks because huge money, the foreign investors, they have drawn it. Because now the Bank of Japan, they have started, offering interest payment. So it means the Japanese people now, they'll deposit money with the bank only. They'll not look for they'll not offer that, their amounts. Or let's say Bank of Japan also, Bank of Japan will not now transfer. They'll transfer it. But again, eventually, if anyone is taking the loan, if anyone is taking loan, so that person will have to pay cost on a loan, right? If the cost on a loan goes high, then now you tell me, why should I look for a loan then, right? Let's say if my appetite was $1 billion, instead of that now it will come down around 5 million. So this will affect on the inflow of money. So that's the power of interest payment, guys. I hope you get this. And here also, if you see, so simply the logic is very simple. If CRR, SLR or CRR, it goes high, note it down somewhere. If CRR and SLR goes high, then eventually if this goes high, then stock market will come down because the CRR and SLR, if goes high, so it means it will increase the cost of a loan. One more important thing, SLR percentage, it is mandated to invest in money market securities, right? And CRR percent, which is mandated to keep it as a liquid, very high liquid, cash percentage. If something happens, so bank will utilize the money, means RBI will utilize that money from their emergency accounts to operate business activities or to manage business activities. So this is how your CRR or SLR works. So let's talk about some other details as well to see, means on the ground how it works and all. Difference between CRR and SLR. So yes, CRR, which is statutory liquidity ratio, which the banks are asked to have a reserve of liquid assets, which includes both gold and cash. So SLR will be invested in that. Interest is given on money, reserve as SLR. On SLR, basically bank will generate some amount of return, but it won't be like higher side. It would be somewhere around 5 to 6%. SLR policy manages the credit giving capability of a bank. Did you get this? So it means if the bank is offering higher loans, then RBI will tighten the SLR percentage for that particular bank and reduce the supply of money. SLR, the securities are kept with the banks only, but it is a mandate to invest in equities and which they need to maintain in liquid assets. See, the government securities, the banks will purchase it and they'll keep it with them only. Okay, as in a liquid form, because government securities are highly liquid instruments. And if we talk about, on other hand, cash reserve ratio, cash reserve is a required in CRR form. So it means required in cash reserve form only. Money has to be kept for a free with RBI. So CRR directly bank will deposit with RBI only. And then the CRR control the liquidity in the banking system. The banks directly maintain CRR with RBI. RBI, they'll not pay any interest payment on CRR. It's just an emergency fund. Okay, so bank will kept with the RBI. All right. So this is how your CRR works and SLR works. The new rates are SLR, which is 18%, standing deposit facility rate. We'll discuss that as well. CRR, we have discussed it, cash reserve ratio. Margin standing facility, we'll discuss that in shortly. We have prepared the notes for this. Repo rate, reverse repo rate, bank rate, we'll talk about little bit about it. Let's say note down somewhere, if any let's say, see, repo rate, it means it's your normal interest rate, okay? Normal interest rate. If government is selling securities, government selling securities to the public, then basically through RBI, right? Through RBI, government sell their securities to whom? To the public, with the commitment of that government will buy back the same securities, right? Let's say government, let's talk about T-bill. If let's say government is selling T-bills, let's say T-bill price is 100, but the government is selling the same T-bill at, let's say, 90 rupees. Correct. With the promise that the government will buy the same T-bill at 100 rupees. So here net profit would be 10 rupees. For whom? For investor. So this 10 rupees, we'll call it as a repo rate. It's just a simple one. Repo rate, it means you are paying interest payment, or maybe let's say you are paying discount, or you are paying, let's say, premium to someone to provide you loan. Or in short, if you sell any securities, your own securities, repo stands for repurchase option. If you are selling your own securities to the let's say anyone with the commitment of that you will buy the same securities back from the same person at a higher price in future, or maybe let's say in next 30 days, 20 days, 40 days, right? So that transaction will call it as a repo. That transaction will call it as a repo. A repo means repurchase option agreement in short. So buy the securities from the same party at a higher rate, means your own securities. And if we talk about reverse repo, it exactly worked in a the opposite direction. If let's say if government, or not a government, let's say anyone, if anyone is, let's talk about RBI. If RBI is looking for a, let's say loan, right? If RBI is looking for a loan from any, let's say any banks, then RBI will pay only 3.35%, the repo rate. So in that case, but instead of RBI, this example you can apply it anywhere. If any bank is, let's say looking for a, means any central bank, in a central authority, if any looking for a, let's say loan, then RBI also will pay some interest payment to the counterparties or banks or whosoever, like it funded to the bank, then bank will pay interest payment to it. So basically the reverse, it means RBI is paying interest payment because RBI needed loans. So when we say RBI needed loans, it means the RBI needed loans because of government only. If the government needed loans, then through RBI, government will raise that funds, right? And RBI will again raise the funds from the market or especially from the banks. And in that case, RBI only pay 3.35% interest payment to the bank. So that becomes reverse repo. And in terms of this repos basically it's a repurchase option agreements. If government is, let's say, selling securities to the public, right, with the commitment that government will pay interest payment, then that becomes your repo rate. Now, if we talk about bank rate is all about, see, the banks, like, they charge interest payment to each other. Let me erase this. Now, if we talk about bank rate, let's say Axis Bank charge interest rate to the another bank, which is HDFC Bank. See, one bank also charge interest rate to the another bank, but the rate would be around 6.75%. Now your question would be like, sir, look, Axis Bank and HDFC both are in banking business, so why they'll apply for a loan? See, guys, if you have even thousands of crores also, still you need a money, right? Still you need a money, and if you need a money, then what you can do, you can approach to the other bank. So it means if you are a bank and if you're looking for money, then you can approach to the other banks for fund, and then other banks will charge you interest payments. So that becomes your bank rate. So it means if any bank if charge interest rate to the other bank, so that becomes your bank rate. And if you talk about MSF, so margin standing facility, margin standing facility and bank rate both are same. But so this is the situation where, let's say, if any bank, let's HDFC Bank is now dried out all the accounts and facing liquidity issues, let's say facing liquidity issues, then that bank can approach to the RBI for loans. And if RBI offer loans to the HDFC Bank in that case, then RBI will charge around 6.75% interest into the HDFC Bank on a loan. So that becomes margin standing facility, and the standing deposit facility, which is something your normal deposit rate, where normal people deposit with a bank, right? So now let's talk about some conclusion around these rates, why we have discussed this. See, if you see, let's say if SLR goes up, market will go down. If standing deposit rate goes up, again market will go down, because if you see if this percentage increase, then people, means most of the people, they'll invest in deposit only instead of stock market. If CRR goes up, again stock market will go down. MSF, which is a margin standing facility, so it means it's for that individual entity. This will not affect on any other financial system, but it is something with the case by case, I would say RBI will deal around it. If any bank is looking a fund from RBI, then RBI will charge it. So it means that particular company's stocks may affect. If any, let's say bank let's say apply for a MSF facility, let's take example of HDFC Bank. If HDFC Bank apply for MSF, so it means it's a clear indication that bank is facing liquidity issue. So in future, you might see the huge crisis with that bank as well. So same example you can now understand with the Yes Bank. Yes Bank had applied for a margin facility with the bank, and then through SBI or all other banks, RBI intervene, and then they purchase the equities of Yes Bank, right? HDFC and all other banks, they invested in that bank and provided funding to the Yes Bank to survive. So that was the again case of your margin standing facilities. Repo rate, which is your government securities rate, T-bill. If you invest in T-bills, government will offer you 6.5 to 7% rate. Reverse repo rate, again, if RBI is asking for loans from the bank, then RBI will only pay 3.5% interest rates. And then bank rate, it means if any bank is offering interest rate to others, again if this rate is also increased, then eventually market, it will not affect on a market directly, but indirectly that you might see impact on the banking business, because the cost of bank transaction would high. All right, so this is how it will works. So any question around this, guys, you can ask. So let's understand the flow. When the RBI increase CRR, what will happen? Bank have a less money for a lending business, right? Then bank need to increase lending rates to maintain profit margin. So it means loan rate, it will increase. Then again increase in the interest rate market as well. Interest rate will increase. Customer borrow less money if the interest rate goes high. Interest rate rise, so it means money supply reduce in the system, and demand for goods goes down, and inflation is controlled to some extent. So this is how your flow works. Okay, and that's what I said. This is something in oxygen. So money management, it's an oxygen of your system, and RBI control that oxygen. Now your question would be, look, sir, I'm a businessman, and how can I see this benefit? See, demand and supply or inflation and recession, that matter a lot. Okay, that matter a lot. If the interest cost is high, so it means, let's say if you are, we have one that I believe Sahil, who is into real estate. Let's say if RBI increase CRR and SLR, in that case, what will happen? What will happen? Come on. Increase interest in a market. So it means loan interest will increase, right? And if the loan interest will increase, then home loan interest rate also it will go up. Then people like, who's gonna buy your plots or property or flats, they'll have to pay more interest to the the bank. So it means most of the people, it means out of 10, if we just come calculate the scenario, out of 10, 4 people they'll not apply for loans. They'll wait until that interest rate goes down in the market. Because 1% also that matter a lot for a longer term. Because every year, let's say if you pay 1 or 2% extra interest payment, at the end of the 15 years or 20 years, you will realize that you have paid almost 30 to 40 lakhs extra as interest payment. All right. So this applies to the every business, guys. So if you are an entrepreneur, or maybe let's say even the job holder, so it matters a lot. So you should track interest payments or interest rates or RBI updates. And apart from, let's say, now your question will be, look, sir, I'm not job holder, or let's say you are businessman, I'm like normal person, let's say a deposit holder and all. So in that case, see, if any banks, let's say, offering higher interest rates, then you can deposit your money and multiply it. So you can make more money, right? Now, another question would be like, sir, look, what if I just want to invest in the stock market? So how we can really see? Always keep an eye on stock market and even money market as well. If the money, if the money market, if let's say if the the cost of money is low, so it means interest rate of loan is low, then eventually stock market will grow, because the people like big investors, they'll take more and more loans from the banks at a lower cost, and they'll invest in stock market, and that's how stock market will even grow. And same applies to the businessmen as well. Businessmen, they'll raise money from the money market if the interest cost is low, and they'll invest in a project and multiply their wealth. Simple. So you can raise money from anyone, because money market interest rate would be based. If we have a good rapport with the non-banking financial partners, go and talk to them. Up to 5 crores, 10 crores, they'll not ask you for the document, means complex documentation and all. With a simple documentation, they'll provide you the money. Same money you can take it then from the 10% interest payment, invest in a project which has a huge potential, and multiply your money. Who's stopping you? So this is how you can, if you know the how CRR works, SLR works, or all other things, then you can manage well. And even in future, if you apply for a, let's say, banking license and all, so you should know it, means how margin facility works. Margin facility, it's kind of last lifeline for you. So you should not apply directly as a banker, because it's your reputation, reputational reputation kind of your reputational or trust issue as well, that investors will not trust you anymore in the market, that if you directly apply for a credit line, it's kind of a credit line that you are asking for RBI to give a loan to you. All right, so this is how your market works. Let's talk about some potential questions. So difference of repo, it is the rate at which RBI lends money to commercial banks, right? And it is the higher than the reverse repo rate, and it is used to control inflation and the, of course, deficiency of the fund, and it involves the sale of securities that would be purchased again in future by banks. Reverse repo, it is the rate at which RBI borrow money from the commercial banks, and it is lower than the repo rate. It is used to manage cash flow, and it functions like the transfer of money from one account to another. All right. So this again, this which we have already discussed. Then rate also we have discussed. Now your potential question should be like, what is MSF? MSF rate or marginal standing facility rate is an emergency scheme for banks to take a loan from the bank. That's what I said. It's an emergency. It means which indicates you don't have any money. When interbank liquidity is exhausted completely, this facility is used by banks in an emergency to borrow money with a higher interest rate than the repo rate. When banks are completely dried up of all borrowing assistance, it is the penalty rate at which banks can borrow money from RBI. It is a last resort line. Before that, you can approach to the other banks as well. If you are HDFC Bank, then you can access, or you can request to the IDFC or Axis or ICICI and see if they can support you. If not, then you can't do anything. They will have to approach to the RBI. Then final call would be with the RBI. Facts about the MSF: banks borrow from the RBI by placing government securities at a rate greater than the repo rate under the liquidity adjustment facility, LAF. So it means again RBI will not offer you free of cost. RBI will ask you to deposit the government securities. Okay. And again the bank will same bank will then buy same securities from the government that RBI bank as well at a higher rate. So that's what we'll call it as a higher rate. The MSF rate is placed 100 basis points or percentage point above the repo rate under the MSF, and banks can borrow funds up to 1% of their net demand and time liabilities. All right. So banks can borrow through MSF on all working days except Saturdays. So Saturday bank will not get this money. The minimum amount for which RBI receives application is ₹1 crore, and afterwards in multiple of 1 crore. MSF provides a safety wall against unexpected liquidity shocks to the banking system. So it's kind of a credit card, you can say. If we have a collateral, deposit that collateral with the bank, RBI, and raise that money, whatever that you're looking for at a higher interest rates. Simply. Okay. Then what is the difference between bank rate and MSF? We have already discussed, so I don't want to read line by line. So you can read this. Bank rate is a discount rate at which RBI grants long-term loans to the commercial banks. MSF rate is the rate at which the commercial banks borrow funds overnight from the central bank. So this is how you can differentiate. What is the MSF rate in India? MSF rate, which is 6.05. Again, this continuously changes. Okay, every quarter you can see change in the rate. What is a bank rate? Bank rate is rate at which the RBI provides the loan to the. Okay, we have discussed this one. So what is the bank rate in India? Repetitive, I can see. What does PLR stands for in a banking system? Prime lending rate, again, which is a higher rate, guys. It is the represent the interest rate at which the financial institution provides loans to their most credit-worthy customers, serving as a benchmark for a loan rates. See, prime lending, it means, see, the institutions, they offer some, you can say, the favorable treatment to the big players. Let's say RBI, not RBI, SBI can offer, good treatment to the Adani. Let's say Adani got a loan with 5% interest rates, and same bank is offering. It's not a true in practicality. I'm just giving an example, okay? And same bank, let's say, offer same loan with to the common people at 15% interest rate. So where do you see fairness? So in that case, bank has a rights of a prime lending rate. So it means they can apply the prime lending rate to the big people. It is represent the interest rate at which financial institutions provides loans to their most credit-worthy customers. So it means big customer eventually. Who set the prime lending rate in India? RBI said that in 2003 prime lending rate, and which directly correlates with the repo rate. The repo rate represent the interest rate at which the bank RBI provides loans to commercial banks. How often does the prime lending rate changes? Benchmark prime lending rate and base rate every quarter that they change it. Means RBI take care of that part. Is the prime lending rate applicable to all types of home loans in India? No. The prime lending rates does not apply to all loans in India. PLR applies mainly to loans offered by banks to their most credit-worthy customer. The definition of credit-worthy customer is if you have a solid, let's say, collateral, then only bank will offer prime lending rate to you. If you are a businessman, your credit record or track record is very solid. In that case, bank will apply that to you. Is the prime lending rate applicable to all types of loans or specific to a particular loans? The prime rate is the fundamental benchmark for various financial products, including credit cards, home loan, equity loans or lines of credit, auto loans. Means it is applies to most of the loans. You see how you can negotiate with the bank. All right. So interest rate, which would be somewhere like prime lending rate plus spread rate for a normal interest rate. Okay. So it means normal interest rate would be higher than the prime lending rate. Simple. If you see this calculation, the interest rate would be higher than the prime lending rate. Yeah. So this was all about your money market. All right. So this is how your bank basically control your money market. Any questions so far? I'll take your questions now, please. What happened to a person who borrowed the money? RBI take the control. See, for a borrower, there is no, there is no exemption. So you will have to deposit. See, bank will take the control, bank accounts will activate, RBI will operate that. And you will have to pay continuously money to that same bank account, or maybe RBI can sell it out that loans and everything to the third party as well. So third party will take care of it, or any other third party bank can also take care of it. So that doesn't mean then otherwise, see, the businessmen, they're very smart. Then they'll always target the debt burden banks and apply for a loans. They'll take a loans and they'll ask bank to announce bankrupt, right? And in that case, then they'll also get the exemption. So it's not allowed. Okay, all right. If you don't have any questions, then let's discuss ahead. Let's talk about T-bills. Because T-bills or certificate of deposit already we have discussed, but we have few new audiences as well. So I'll just brush up things for them. Who announced, see, treasury bills, it means, guys, it's a fixed income instruments where central government only issue the T-bills in the market and raise funds for their projects. T-bill is the highly liquid financial instruments, and as well as it is, very safe financial instruments as well. The duration of T-bill would be only Government of India issue this, GOI, then issue for 31 days, 92 days, or 184 days duration, or even 364 days also, max to max. So within a 1 year, it will liquidate it. T-bill always issue on discount. So government issue this and RBI manage this, entire show. Certificate of deposit, only banks are allowed to accept the certificate of deposit and minimum limit is like 5 lakhs. Call notice, again, it's for banks. So one banks, they approach to the other banks through call notice for overnight funding. And apart from that, commercial papers. So commercial papers, which is something, the big corporate houses, right? Reputed companies, they're allowed to raise funds through commercial papers. For example, let's say Nirav Modi scandal. How that scandal happened? That guy raised funds through commercial papers. So actually cheated a bank that, and he submitted a fake documents like let's say, I'm doing trades, I'm into this gold and, diamonds and all of that. He just submitted fake papers to the bank and raised funds from the bank. And finally, he announced it bankrupt that I don't have any trades or anything as such. Because as per the law, if you take let's say, if you have any, open land, and if you apply for a loan with the bank, and let's say you have deposited your collateral with the bank and raised 1 crore, right? The actual property value is, let's say, only 1 lakh, but you manage the, value, or you manage the law, or bank manager and everyone, and fabricated the evidences or valuations and raised 1 crore amount. And after that, let's say you decided to not to repay the debt of a loan to the bank, then bank will take the control of collateral. But even if the bank take the control of collateral, the collateral value is just 1 lakh. How bank will recover that money? Same thing happened with the PNB as well. PNB issued loans to the bank, but yes, again, so that loan was very different because there was so many people involved in that particular business, and they actually cheated. Means he actually cheated to the bank by submitting fake papers. But yeah, anyway, so only the popular or famous entities are allowed to raise funds through commercial papers. And minimum so nowadays I have seen like even startups companies or companies are also started like raising funds through commercial papers. Commercial papers, it means trade related documents. If you have any trade related documents, then you can raise funds from that. All right. So we are done with money market. Any questions? Let me know, guys. Come on. Okay. So if you don't have any questions, so let's go ahead with the other market. The other market is FX market, foreign exchange market. See, foreign exchange market, again, it's a very highly liquid market. Highly liquid, it means highly liquid market. Let's talk about some major currencies. The world's largest currency is USD. Then also you can say like GBP, Euro, JPY, and even Chinese currency as well. China's currency, right? These are the world's largest currencies or highly tradable currencies in the market. In FX market, if we see most of the currencies, they have pairs. USD, you can see USD with INR, USD with Ruby, USD with POK, USD with ED, USD with this and that, and SGD, right? So you can see pairs. Currencies always trades in pairs. Indian government recently listed our currency as well in the international market, that Indian government want to settle the payments, or eventually the intention was like US government wanted to support to the Russia to settle their international payments and all, because when this invasion started, like Ukraine and Russia invasion or the border escalation or war, let's say started at that time, entire the big countries, they have they banned the Russia from the USD, GBP and Euro currencies, or even other Canadian currencies and all. But India facilitated, like India purchased everything from the Russia and then also settled the payment in the USD. How? Because see, India listed their currency INR, right? India listed their currency INR and pair that currency with ruble. So it means INR and ruble trades. So where India will buy oil through their pair only, correct? And same India will help the Russian companies to trade that same oil in the international market with INR and GBP or USD or all other countries, because our currency was open to trades with other currencies, and still which is open. So that's how they actually been supported in this particular this pandemic. We have seen that this government also facilitated like buy more and more oil from the Russia and sell it out to the other countries and settle the payments, their INR. So that's how, guys, FX market works. Did you get this? So FX market is one of the largest market. At international level, it works in a very different way. And even if we talk about at a banking system level, So most of the your foreign currencies that banks actually book the spot contracts. Spot contracts, it means check the market price of currencies, your currency versus other currencies, and settle that particular contracts. For example, let's say you can go to this market, FX marketplace, like let's say this one, X. Here, see the different currencies rate. Let's say $1. If you want to convert dollar into INR, convert that. So we'll have to pay almost 83.887636 rupees to buy $1, right? To buy $1. So this market rates continuously changes. But if you want now, if you just see, we have also listed now, means your currency have a pair now in international markets. The most of the the investors, or even most of the, let's say the countries, they're ready to pair with us. And what we did, as I said, we have supported to the Russia as well in the past. But here you can see the rates. If the rates is, let's say, $1 for one, then you can book this rate. Basically, you can book this rate in your system as well, like the 83.8876 rupees, which will have to pay for $1, or dollar cost, you can select 83 rupees in India. Are you getting my point? So this is how actually we book the swap contracts. Swap contracts, or you can select spot contracts. Spot, it means check the rate at spot. What is the rate at this point in time? 83.66. And this will continuously, changes. Continuously, it means continuously it will changes. So now I don't have a login details, but you can log in and check this, because we used to refer this when I was working on a money market transactions or spot markets. We used to refer this and book the contracts in the system on the basis of this information. Right. So from FX perspective, few things are very important. One is the global currencies like USD, GBP, JPY, or Chinese currencies. They are at a very top, and most of the countries, even they prefer to trade in only top currencies. Okay. Then another one is the the big thing is here, if you see, Indian government also listed our currency, and now you can see the pair for your currency as well. Apart from this, FX market is a highly liquid market, and in terms of like investing part, it gives you more, you can say it gives you more, margin as well. If you want to, let's say, if you have only $100, and if you want to buy, lakhs of, let's say, Indian INR, you can buy it through options. Not exactly options, but you can say like, future contracts which are available in the FX market. So what is future and all? So we'll discuss that in derivatives, because for a derivatives market, we'll have a detailed discussion on derivative types, products, and also in that session, we'll cover this futures and all. But yeah, so FX market, in terms of FX market, you can say the RBI control it. Just let's summarize it. RBI control the FX market. FX market is a highly liquid market. Most of the contracts that we book at a spot price by referring market, which is XE, or there are many other markets as well. There are few big currencies or dominating currencies like USD, GBP, Euro, and JPY. Right, and even India also listed our currency as well. So this is how your FX market is all about. So if you have any question around FX market, so please go ahead and raise your questions. We'll have a session on derivatives, but we'll discuss about derivatives. And tomorrow we'll have a session on derivatives in details. Any question, guys? Come on. If you want me to allow you to talk, I'll allow you to talk. So we'll just summarize it, what we have discussed so far. right? We already discussed about your participants. We have discussed about capital market, primary market means in a previous session, secondary market, primary market, debt market, equity markets and all. So today we have covered money market portion, CRR, SLR, your repo rate or margin facility rates, bank rates that we have discussed. And additionally, we have also covered the treasury bill, certificate of deposit, call notice, commercial papers and all. All right. Then we have also covered about this FX market, the big currencies and all. If anyone want to see at the end, we'll have I'll walk you through a few practical examples about FX markets, money markets and all, where you can see the instruments, how you can buy it, how you can sell it. So at the end, we'll have one practical sessions for all of this, even for a derivative as well.
Just a quick info, guys. Intellipaat offers investment banking course training. Through this course, you will learn time management, project leadership, financial expertise, leadership abilities, valuation, and much more from the top 1% of industry experts around the world. With this course, we have already helped thousands of professionals in successful career transitions. You can check out the testimonials on our Achievers channel, the link of which is given in the description below. Without a doubt, this course can set your career to new heights. So visit this course page link given in the description below and take the first step towards your career growth in the field of investment banking.
So if we talk about, guys, derivatives, it means it's a contract of financial instruments. Okay, so we can sign a contract, we can buy any assets, but see, you don't need to actually buy any assets. Instead of buy, what you can do, you can just buy a rights of that particular assets and hold that assets rights with you, maybe for a month, for a week, for a year. And once you see, let's say the price, let's say, which is reached to the certain level, then you can sell it out, that same thing in the market, and generate some profit out of it. So this is how basically your derivatives works. In India, we don't have any derivative commission, but your stock exchange only, they manage the derivatives market and all. In a derivative market, you would see different contracts like option contract, then your future contracts, all right, and swaps as well. So we'll discuss that each contracts in details. All right, swaps, options, futures. But when we talk about derivatives in market, so it's simple that it's a contract of financial instruments market, and financial instruments, which can be your stocks, bonds, debentures, commodities, all other different instruments. Okay, so let's talk about the derivative market first in details, along with their instruments and all. In details, it means in detail. So we'll try to understand derivatives from the very scratch. See, derivatives, it means it's a contract of financial instruments. It's a contracts of financial instruments. Okay. So when we say financial and instrument, guys, see, we are talking about, again, equity, bonds, debentures, interest payment, cash, commodities, right? So that all comes under your financial instruments. And when we say contracts, see, contracts talks about the obligation. Contract talks about obligation. Obligation, it means buy obligations and sell obligations. If you want to buy or sell any assets, instead of buying assets, what you can do, you can just simply, buy the rights of that particular assets. See, assets, it could be anything, as I said, equity, bonds, debentures, interest, cash, commodities, anything. So to understand this process, how we can, let's say your question would be like, so look, how we can, buy the obligations. So let's take an example of, let's say, any stocks. Any stocks, it means any stocks. All right. So let's say the stock price which we have available is 10, 15, 20, 25, 30. This is a duration. Week 1, week 2, week 3, week 4, week 5, week 6. All right. Let's say there is one stock which is called Wipro. Stock name is Wipro. The price of Wipro, which is at, let's say this level, 10 rupees. All right. And here, let's say if you are, let's say trader or investor, right? Let's say your means forecasting for future would be like, let's say, see, there would be three situations, right? One, price of this particular stock, it may go up, right? Price of this stock, it would be same. And third would be price may the stocks, it may go down, maybe up to 5 or even 1, right? High, low, or you can say medium or at same level. Correct. Now, let's say if your, let's say, research says stock price will go up. Now my question is to you, what will you do with this particular stock? If your research says this particular stock price will go up, if your research says price will go up, then in that case, what will you do? You tell me. This is a Wipro stock. Will you buy or will you sell it out? Come on, guys, you can see. I need an answer from everyone in chat box. You can use chat box. Quick. Can you hear me now, guys? Okay. So my question was to you, let's say, if you have 100 rupees, then how many quantities you can buy of this particular stock? Let's say current market price is, this is a current market price. So how many stocks you can buy? 10. Okay. Let's say you have purchased 10 quantities, right? And after, means in a third week, let's say stock price reached at this level. You purchase at this one, you sell it out this one at this, this level, and the price of stock is at, in third week price, which is at 15, and you sold the same, 10 quantities at 15. So how much would be your profit? Come on, 5 rupees. And quantities you have purchases, how many? 10. So total profit would be 50 rupees. Am I right, guys? Right? So now my question is to you. Okay, this was just a simple example. Let's say if I want to multiply my profit, so how can I do it? With the same capital. I don't have any extra capital. My capital is 100 rupees, but with the 100 rupees capital, how can I multiply my profit? Come on. Any guesses from the audience? How can I multiply it? Come on, guys. How can I multiply my profit? See, this 50 rupees profit, it seems, very low. So how can I do it? Okay, one one guess I received is intraday trading. What else? Come on, come on. By keeping margin, okay. Wait for a dip and buy again. See, how can I wait for a dip again? Because see, I said I have 100 rupees cash only. See, I'm asking you how I can multiply or how I can, buy quantities in bulk with 100 rupees capital only. See, if I have 100 rupees and if you ask me, so sir, how would you do it? Then instead of, this buying dip and this and that, I'll simply look for a derivatives. So this 100 rupees, I'll, use as a margin. I'll use as a margin. And I'll use 100 rupees to, buy the financial instruments through contracts. So it means I'll just pay the fees. Let's say initial fees, 10 rupees, 20 rupees for XYZ quantities. I'll buy quantities in bulk, I'll hold and I'll multiply my profit. Now, how I'll do it? Let's talk about it. Instead of buying 10 quantities, what I would prefer, I will pay, let's say, 1 rupees margin, 1 rupees margin for each, shares. So margin is kind of an advance, in terms of, let's say, if you want to book any tickets or anything as such, what we do, we just book the, seats in advance by paying 10%, 5%, correct? So same way, I'll pay 1 rupees margin as an advance fees for each quantities, and in 100 rupees, I will buy 100 quantities. Right? And if same, let's say, thing happen like, share price from 10 to 15, it goes, then I'll book profit at 15. In this case, my profit would be 100 into 5. See this, 100 into 5, 500. See, on a capital of 100 rupees, I have multiplied my profit from 50 to 500. So it means almost 10x profit that I have generated from the same margin. Now your question would be, look, sir, what about risk? See, if the share price goes from, let's say, from 10 to 5, then I lose my entire capital. Means whatever fees, let's say, that I have paid 1 rupees per shares. So definitely means I'll have to pay 100 rupees as a fees. And if I pay 100 rupees to the parties, and let's say if my, let's say, stock price goes, down from 10 to 5, or maybe, below the 5, then I'll lose my entire capital, whatever that I have paid. So this is how, guys, derivatives, works. So derivatives, it's a contract of instrument. It means through, contract procedure, you can pay only minimum amount, like 1 rupees, 2 rupees, 10 rupees. You can pay very minimum amount, and you can, acquire quantities in bulk, like 1,000 quantities, 200 quantities, 300 quantities. So let me just log in my account. So I'll walk you through few things. It's my training account, okay? I use for, because we are into the stocks market training, and also let me access. How means we can leverage out, through the derivatives. I'll show that now, this to you. Let's talk about some, other things before touching to this, the derivatives. Let's talk about profit first. See, this is the profit, realized profit, okay? From 1st April only. Did you get this? The profit from 1st April only. In last April, May, June, July, right? And we have completed with August now. So you can see in last 4 months, we have generated 3,93,000 profit. And it is a realized profit. Realized, it means we have drawn this amount. Okay. Last trade was, let me see if I have the details for a last trade. Which one was the last trade? Yeah, this one. So I have booked profit of almost 23,000 profit that I have, sorry, purchase rate. So somewhere around 23 to 19,000 something that I have booked from this one. All right. So yeah, so 3,93,000. But what I want, I have booked losses as well. So it's not something that I have not booked any losses and all. So I have booked it. But how I have achieved this 4 lakhs, which is a realized profit from my portfolio. So, and how I have, let's say, means benefited of took a benefits of, let's say, leveraged, right? So we'll discuss that part because that is important from your training perspective. So now this realized profit. So let's talk about now capital, how much capital that I have invested. So here if you see, so I always leverage out the brokers margin. I have invested 1,95,000, but the position value which I have is 3,80,000, the current position. And yes, so I have lost in couple of positions, like because in last week there was the big there was something happened in the market, and most of the position reverse it out, but that's fine. So we have a loss. The Geo Finance I'm holding since I have already booked profit in Geo Finance, but this was like in a position that I took it at very high level, but that's fine. Again, it will reverse it out. So not to worry about it. But rest other, like all are good stocks or scrip. Just wait for some time, maybe 1 week or 2 weeks. After that, you will see that price will reverse, and then you can see this in profit as well. Apart from this, you can also understand this one. See, this is a demat account holding. So in demat, I have around 7 lakhs. So total portfolio, if we just talk about worth of portfolio. So we have a worth of portfolio which is at 14 lakhs something. So out of this 14 lakhs, around 3,93,000 that you can add as a realized profit that I have received. Okay. So now let's talk about the fund which is available in the account. Oops. I don't see fund which is available. Why? There was a fund, maybe due to the bank holiday, the fund is not here, but fund was there. Okay. Let's talk about now again the options, because we were talking about derivatives, right? If I have any open position, yes, I have open position of Reliance Industries, right? Purchase at 59. There was a profit as well around 4 to 5,000, but then after when the company announced bonus issues, I have seen some downfall in the price, but still I'm bullish on this one. So let's see, not to take a call at the moment. So now let's talk about, guys, why I have entered in this call option. Here if you see, I took a call option that I am anticipating that price may reach to the 3,100. Why and how? Let's see the now chart of Reliance. Where is it that? And in one lot you can see 250 quantities as well. See, yeah, let me open that in a big chart. Reliance Group. What is this? RIL Infrastructure, RIL Industries. Yeah. So price was actually reached to the this level, but then after, as I said, suddenly I have seen downfall. But maybe I'm anticipating that this is the support which that you can see where this stock price which is at support level. But in last couple of days, I have seen something you can say. So what was happening with the stock? Because stocks announce your demerger of Geo Finance business, right? And then it was trading in between this line only. See this. In the month of July, we have seen breakout in the price, right? And again, I have seen breakout here, but I don't know whether, nobody can predict that whether it is a false breakout or it will go up or it will go down. Again, it's when we take a risk, it means, if your probability says, let's say price will go up, then only you can enter in contracts, correct? So I thought, like, if you see, maybe this stock will, give a breakout. And if this, give breakouts, the next level would be somewhere around 3,100 to 3,200 in between. Or maybe even if, reach to this level, then it can also give a breakout as well. Correct. And that's what I entered in position. But now if we talk about, let's say this price, 3,100, right? 3,100. If you just multiply this price with the 200 quantities, okay? Let's say 3,100, which is a quantity which we have, and the price, sorry, my bad. Quantity which is 250 and price which is 3,100. So let's talk about amount. Into this one. So 7,75,000 rupees, which is required to buy this particular means, 250 quantities. But the fact was like, see, I hadn't, 7,75,000, but I wanted to enter in a contract to make some profit. I wanted to enter in a contract to make some profit. So what I did, I thought, like, if I instead of investing 7,75,000, what I'll do, I'll just simply, let's say if I calculate the 5% of this price, which is 78,000, not even that much, let's say 1%. It goes around 7,750. If I pay advance amount, as a fees, means contract fees, and hold rights, okay? Hold rights to buy this particular stock in future date. Then I'll get the rights of 250 quantities to buy them in future. Buy them in future at future price. Right? So if I pay, let's say 7,750 rupees now, I'll pay this one. Or if you see, I paid it, I'll show you that as well. I paid this amount to hold the rights of a buy almost 250 quantities. Correct? Now your question would be like, sir, why did you pay this? See, if price, let's say now the current market price, which is below 3,100, if this price moves from 3,100 to let's say, sorry, 3,050 to 3,100, then you might see, which is premium, which I have paid. Let's say this one, we'll call it as a premium. Premium, it means it's an advance fees which I have paid it. So this price will move from 3,050 to 3,100 if this happens. So here actually you can see gain of, let's say, 50 rupees, right? And in my option, even if you see 5 rupees, or let's say even 5 rupees, 6 rupees, or 10 rupees, right? Or even 20, whatever. See, the moment which is, there are other factors as well, but in an option you can see different price movement. Or let's say in a premium change from, so if you now just calculate this one, premium for per shares, first calculate this 250 divided by 7,700. Oops. 250 divided by this. What happened with this? 7,000 that I have paid it. Let me calculate. 250 divided by 7,750. So it means I have paid something, this price for per equity, right? Price divided by quantity, which is 31 rupees. See, 31 rupees, which I have paid as a fees to hold the rights of one quantity, right? What if, let's say, premium of my shares, let's say price moves from 3050 to 3100. See, difference you would see, which is 50. But what if the premium which is paid, changes from 31 to, let's say, 50, means 20 rupees appreciation or 19 rupees appreciation that you can see. Correct. So quantities which would be same again to 50. There won't be any change in quantity. Now let's talk about price, right? Let's talk about price, means difference or how much profit that I can make it on my same investments. See the difference here, you would see because positive change from 50 to 30, 31 to 50. So there would be change, which is something 19 rupees. And if I talk about my profit, 250 into 19. So 4,750 rupees profit. And which is a descent, right? I have paid only 7,000. I have paid only 7,000, guys. 7,000 or this one, this much of amount to generate profit of this one. And within a 1 day, let's say if I get this amount of profit, so my profit percentage would be around 50%. Correct? Around 50% profit that I can generate. What if, let's say, if I add this quantity in a lots, because I'll have to multiply it. If I, let's say, let's say I have now 21,000 rupees in my pocket, or 20, not 20 exactly. So multiply by 4. Let's say I have 31,000 in my pocket. And if I buy, let's say 4 lots, would be for 1,000, quantities. Actual amount, if I buy, let's say actual quantities, then I need a more money. I need a more money, like, let's say 31 lakhs. So how can I, get this 31 lakhs? Right? So how can I get this? Correct. But instead of that, if I, let's say, simply buy options or contracts, derivative contracts, through derivative contracts, I'll just pay, 31,000 to acquire the rights of this 1,000 quantities. So it means I can buy them in future. And if price moves from, let's say, 305 to, 31, 100. So in that case, same, premium, let's say changes from 31 to 50, then I'll make a profit of around 19,000. Again, see the percentage, it would be somewhere around 60 to 70, 75%, right? So this is how, guys, derivatives actually, again, let's talk about risk. What if, let's say, price, let's say this was your actual price. It's just assumption. And this was your, let's say, market price. If, let's say, your market, you means actually purchase quantities at this price, or let's say contract at this price, and your price reverse it out from 31,000 to 305. So you would see loss of 50. And same way, you would see change in the premium as well from 31 to maybe around, let's say 11 rupees. So in that case, you would see loss of 20,000. So it means whatever premium that you have paid, let's say 31,000 premium, which you have paid it, right? 31,000, this premium value would be around only 11,000. Remaining would be loss. So it means through derivative options, if you just buy and sell, the contracts, that could be, very risky, because only 2%, traders, they are making money out of it. And 90% people, 98% people, they are losing money in this particular segments. Now your question would be like, sir, why and how they are losing? Because of risk only, guys. The reason is, if I talk about, the options contracts, because all are contracts, okay? Contracts. Option contracts offer weekly expiry. Option contracts offer weekly expiry. And in a weekly expiry, what happened? Let's say Monday, Tuesday, Wednesday, Thursday, Friday, Saturday, and again Saturday, Sunday. See how your option market works. Let's say 31 rupees is the price, right? 31 rupees is the cost that we are paying for 7 days, right? And here, let's say on Sunday, your contracts will expire. This is what the contract is about. So it means you're not buying quantities. Understand this. You're not buying quantities. You're just buying legal rights so that you can buy that particular shares or you can sell that particular shares in between Monday to Friday. Means it could be any day, right? It could be any day. You can sell that out at any point in time. So basically, you're looking for a rights. You're not looking for a quantities. You're looking for a rights of a buy that particular contract. All right. So now, if I talk about, guys, the options, how your options works. Let's say, if I talk about now premium, the days are 7, right? Days are 7. Okay. 31 rupees divided by 7. So per day, you're paying, fees. This is something your fees. Cost is it's a fees and quantities. Total quantities like, let's say 1,000, but you're paying 4 rupees, 4.42 rupees fees for per day. And this calculate days and nights as well. Let's say you purchase, any option contract on Monday. So at the end of the market day, already this, 4.42 rupees will deducted from your total premium. Same for a Tuesday. You can see like this. 8.8 total means, on second days, your total premium that you will lose around 8.5. On this date, total premium that you will lose around 26, not 26. So you can just sum it out. 13.28. Right. On third day, again, you will lose money around somewhere. This. Let's calculate it. Let me calculate so that you can understand how premium works. 22 means every day we are just paying, taxes. And here, if you see, your premium will zero out. On expiry, your premium will zero out. Why is it zero out? Because, guys, see this premium, it means it's a cost that you have paid for the next, 7 days. Once the 7 days over, then whatever premium that you have paid, that will expire. So it means your premium value would be zero. And that's the risk. If, let's say, if that particular stock price failed to perform in your favor, then your premium every day you will lose your premium. Continuously, you will lose your premium. And even though if your, let's say, stock perform well, still you will lose your premium. The reason is it's a cost which you have paid it. If your stock moves in your favor, then only you can generate some profit. Then only you can generate some profit. And that's the risk which is, you can see lies with your options contracts like put and call options. If you want to buy any contracts, so first understand it, like how your, the premium, how that your premium works. Premium is nothing but premium is a fees which we are paying to the central counterparty to hold the rights of assets, right? Maybe for a buy and sell. In both the cases, you can buy the rights. So if we talk about, let's say, call option talks about buy certain assets, buy certain debts, and you can again sell that assets at any point in time. because as a buyer, it will not have any obligations. But if I talk about again writers of the call options, writers definitely will have certain obligations. Writers, they cannot take an exit until their counterparty take an exit. So it means they will have to pay higher the amounts to hold the rights, because option sellers, they are something writers, and they always, their risk would be something where maximum capital and minimum, let's say, profit. But if we talk about option holders, like call option holders or put option holders, their profit percentage would be unlimited, right? Their profit percentage would be unlimited, but losses would be limited. The reason is we are paying fees every day to hold the rights of the contracts, and that's what your losses would be limited as a holder. But the losses would be something that you, as I said, you have paid a fees to hold the rights of that particular asset. So it means every day you will have to pay fees, and every day you would see change in your premium. So it means if you are, let's say, 100% sure that, even let's say not 100, but up to 70, 60, 70%, if you are sure that price of this particular contracts or stocks will work in your favor, then only you can buy that particular options. Otherwise, that doesn't make any sense to hold that particular options for a trading purpose. The another reason is why we buy and sell the securities through options, because the options help us to multiply or maximize our profit. But on other hand, we cannot ignore the risk. See, if we see the more profit, you can also see the more risk as well. So if you're looking for a more profit, then you can lose your more capital as well. So this is how your option premium works, guys. Now your question would be like, sir, this is an investment banking session, and why we are talking about trading? See, I'm not talking about trading. Now let me tell you something, that what we do in a banking. Let's say if we join any, let's say, reconciliation process, maybe if you join any, let's say, trade processing process, or any other, the accounting process and all. So in that case, you will have to do the accounting of option contracts. So it means you will have to calculate the exposure by multiplying, the quantities versus price of options. Then again, you will have to calculate the, value of options, like, let's say, in terms of the value, it means the premium. If you see the changes in premium, then, that change you will have to multiply with the quantities. And that exposure which we needed for reconciliations, processing, and, to update or record that particular options in the books of account. The reason is investment banks maintain the investment books of records, because most of the investment banks, they are brokers, so they maintain the investment books of records. And if we are, let's say, if we are not sure about this premium and all, so how we can calculate the exposure of options? Let's talk about now accounting. Hedge funds or other mutual funds or individual traders, they trades in derivatives, right? If you don't know, let's say, how your derivative contract looks like, how or when your derivative contracts expires, when or how your derivatives options works, then how you can advise to your traders, or how you can manage their accounts. All right, so it is a very important from the operation perspective as well. Then apart from that, if you don't know, let's say, if any banks hire you to manage hedging, it means buying or selling different contracts to hedge your products. And if you don't know how to hedge your option contracts, or let's say assets through option contracts, then how will you means manage your clients? So that's what your derivatives chapter is very, very crucial. So I have received a couple of questions. Let me address them. Don't write in caps. Again, this is not a professional way, guys. Pravalika, I have explained this profit margin, correct? So is this amount of profit? It may be someone sold or what exact. So someone who have sold, that may be only margin money. Anyways, so margin money is nothing but, guys, margin money, it means it's your own money that you have paid it, right, to the broker, or maybe let's say to the parties, and you have also taken loans as well. If you see, let's talk about that as well. Let's talk about this particular transaction. open positions. See, bro, see, current value of a position is 3,80,000, but I have paid around 1,95,000, right, to hold the assets of 3,80,000. But who paid the remaining amount? Broker paid the remaining amount because I'm paying interest payment to them. Let me just see if I have the data for last 1 month. See this, I'm paying interest payment on amount. Every day broker is charging interest payment to me. So total loan amount that I have is 5,25,000, 96,000 out of this. And I'm paying interest payment to the broker every day. So every day broker is charging 139 rupees. I'm paying interest payment to them. Why? Because ultimately, if I want to, let's say, multiply my, portfolio returns, then I'll have to ask for a leverage, right? So I have taken leverage from broker and I'm paying interest payment to them. 100 rupees is nothing. If I have a plan to generate, let's say, 1,000 rupees or 2,000 rupees on capital of, let's say, 5 lakhs, then which is a decent, right? Even if I generate, let's say, 1,000, still I would be in profit because my interest cost is only 39 rupees per day. Sorry, 130 rupees per day. See how much interest payment that I have paid in the month of August, from 1st August to in 31st of August. You can see I have paid interest payment of only 2,000. So my interest payment cost is only 2,000. So on other hand, let's talk about my profit in the month of August only. I'm sure the statement would be available. So I'll walk you through. Select custom. 1st of August. Okay. So August to, till date, if I calculate, I have not generated much because August month was tough. Okay, the profit is in the month of August, the profit percentage was tough due to some trades which are in now red, right? But if I now let's go back to the another month back and see in the month of July how it was the July month. In the July month only I booked the profit of 2 lakhs. And let's go back and check the interest cost which I have paid it. In the month of, let's say, July, right? We check for July, 1st of July to only 31st of July. See the interest cost, how much that I have paid it. 3,500 interest cost. If you can just debit from the 1,99,000. So still I have made a profit of 1 lakh. How much? 1 lakh 90,000. Let's take a gross. I have made a profit of 1,90,000. See this. So this is how you can, you can means if you are really keen to, let's say, manage your leverage, then you can multiply your profit, and that's what derivatives actually helps. Now, if we just go back, to the derivatives, let's say if I want to buy any options, so how option works? First, understand that. All right. So total capital gain that I have, speculative income, so losses also I have it, but I have book profit of 4,12,000. So to stocks, let's say again Reliance stocks or any other. Let's take example of any other stocks as well. That's fine. If I talk about Wipro, if I want to buy, let's say Wipro stocks. This is a place. Select Wipro. buy Wipro. Let's say this one is a Wipro, right? If I select now one quantity, how much capital I needed? 538. But same stock, if I ask my broker to pay, some loan to me, right? Let's say, let's check for a capital as well, how much capital that I have in my pocket at the moment. See, available limit is 74,000. So I have almost 74,000 in my pocket. See, if I want to purchase quantities within this capital, my total quantities would be, let's say, 100, 53, 150. So it means I can buy only max to max 140, correct? Even not 150, 139. But see, 139, which is again very less quantities in market, right? Even if I want to generate, let's say 74,000 profit, it will take at least 1 year to get the 70,000 rupees profit. So now you tell me how I can multiply my profit if I want to buy large quantities. If I want to buy large quantities, how I can multiply my profit? I have two options. One, that I'll ask for a broker to provide me loan, and through loans I'll buy more and more quantities. That is one way. Second, I'll look for a derivatives. So it means I can buy one, the call option, right? And through call option, we can buy multiple, or let's say quantities in bulk, and I can multiply my profit. Another one is I can also buy future contracts. Through future contracts also, I can buy more and more quantities by paying, margin like 10%, 20% margin or advance amount that I can pay, and I can buy more and more quantities as well. But if I talk about, let's say we'll talk about one by one. If I talk about margin, right? If I talk about margin, and if I pay 74,000, right? So let's see how we can multiply our quantities now. See, with this fund, I'm able to only buy 139. But if I convert this into margin to funding, let's see how much quantities that we can buy it. See, for one quantity, how much we need to pay? Let's say if I buy 500 quantities now, and the price is, let's say, even if, okay, stock market is this one. Current limit is 74,000, market price, right? If I consider market price is 139, or if you can also submit in a limit price as well to see how much the quantities that we can buy it. Okay. I'll not place a trade, but see how much quantities that we can buy it out, right? So I can buy more than 500 quantities with the same, sorry, it is asking for an initial 30% of margin, okay? And rest margin broker is ready to pay to me. So now calculate the 35% of this one, this value 2,69,000. If I calculate 35%, so I required almost 94,000. But if I don't have a 94,000, then so I'll go back and I'll buy almost 400 quantities. See now, the 400 quantities instead of 400, buy 380. See, so in the same margin, 74,000, I can buy the quantities of 71. Sorry, I can buy the quantities of 380. Now let's talk about total cost. See, total cost which is required. Go to here. Total cost is required 2,04,000, but I have only 74,000. I'll pay 74,000 to the broker. and rest amount broker will arrange it from the money market on interest payment. So broker will fund around 1,30,000 to me, and that's how I'll multiply my quantities. Now, see, if you're buying more quantities, so it means it would be a more risk as well. If price goes down, I'll be in loss. With other position also, you can see I'm in loss, right? Now here, if you see, I'm in a loss of 44,000. So basically, I'm paying interest payment also. So it means interest payment and loss, that would be my actual loss. I'm paying interest payment as well as I have a loss of 44,000. So that would be again my loss. But if let's say if I'm in a profit, then that would be my profit only. Correct. That would be my profit only. Or interest payments, of course, you can debit the interest payment as well. But if I, let's say, if I purchase 400 quantities and if, price moves from 540 to, let's say, 600, so there would be profit of 64 per quantities. And we can easily multiply profit from 380 quantities to, let's say, 60. See the profit percentage around 22,000. Correct. But if we talk about original trades, we were able to buy only 139 quantities. And even if I calculate the profit of that, see the profit would be around only 8,340. So it's a game of risk, guys, or it's a game of, let's say, leverage. If you have, let's say, if you know or if you understand the power of leverage, so you can, whatever amount that you have, like, let's say, even if you have a small amount, you can convert that amount into margin, and through margin, then you can access the 2 lakhs, 3 lakhs, extra limit from the broker, and then you can, manage your trading business. Again, it's very risky, but as I said, derivatives are the power. Derivatives are like very powerful, the tools which the traders actually they leverage it out and buy more and more quantities in bulk, and they generate the profit. See, on other hand, as I said, more than 98% people they are not able to generate any revenue from the derivatives. Why? Because of risk only. And see, anyways, I'm not buying and selling in derivatives because I'm buying and selling in derivatives only, with a very minimum quantities, only for hedging purpose. If we talk about loss of derivatives contracts, so far, like how much I have made losses from the derivatives, let's talk about that as well. So you can understand that derivatives is not so good, but again, it's for hedging and all. So 24,000 losses that I have made from the derivatives so far in entire year, means from April to August so far. But most of the the losses that you can see, I have made it because of market fluctuations only. Because see, if you want to make a profit, see, profit generation is not easy, guys. To protect my position, you will have to always buy some options. It could be stocks options, it could be your indices options and all. So sometime there would be losses, sometime there would be profit. So here if you see on 22nd July, I made a loss of around 26,000. But on other hand, see on 5th of June, if you see, I made a profit of 74,000. In one day, I made a profit of 74,000. But again, on 3rd of June, I made a loss of 32,000. So it was election day. In one day only that we were carrying carrying some overnight positions, and we had a huge loss, 32,000. But very next day, we played some, around some different options and made a profit of 74,000. Right. But now I'm not, I'm not interested in derivatives at all. So I personally don't do anything, but only if I have a portfolio of, let's say, 1 crore, then I'll have to play with the derivatives. The reason is, to protect my portfolio, to protect my, I would say, the positions against the market fluctuations. So I'll have to play around sometime, options and all, but with a very minimum risk. It's not something that I'm buying, let's say, the options with 1 lakhs or 2 lakhs. No. See, derivatives market is a very risky market. Within a moment that you can see, huge losses in a portfolio. But see, even if I talk about now, your question would be, look, sir, I can still see, the loss of 40,000. See, this loss is nothing. Okay, this loss is nothing. The reason is I have made a profit of 4 lakhs on it. So it means I can still bear the loss of 5%. And after that, maybe I can exit or I'll take an exit from the few positions because I'm continuously monitoring, situations of all of this. All right. And most of the stocks, they are like good, scripts, I would say. Let's talk about, stocks as well. See the Geo Finance, maybe, which is down at, this point in time, but you can see, jump in price as well. Let's wait for another 5 to 6 months. Right. Then this ES Bank or Polyplex Corporation, Raymond, KPIT, all are good stocks. Just hold for some time, you would see like big boom. Now your question would be like, sir, what did you check to before buying this KPIT stocks? See, KPIT fundamental wise, which is a very good stocks, and also if you see the the chart of KPIT, still you would see the breakout kind of zone for KPIT. See, it was continuous. It was like this is a V pattern. Okay, I was expecting some breakout at this level, right? And that's what I made a position here. Or even if it is go down, that's fine. Again, it will go up. If you just see the history of these stocks, it's a very good stock. See this. It was at 43 rupees in 2020, and now which is trading at 1800. This is a very, very good script, I would say, because dealing in multiple segments and companies continuously growing or scaling every quarter, every quarter we have seen a good growth in numbers, and we might see breakout here, right? We might see big breakout over here. So let's wait. But now if your question would be like, so what if this goes down? See, I have a calculation in my mind. I'll take an exit at maybe you can say around 1700, 1750. I'll take an exit from this particular stocks if this continuously goes down. But you might see around 5 to 6%, maybe if this, let's say, breakouts continues, then you might see, big price movement in this particular stocks, then my position would be in profit, right? Same applies to the Raymond as well. So why I have purchased Raymond? See the history of this particular stocks. See, before the pandemic, the stocks, it was reached to the 120, around 214 rupees something. And within a 2 years of time span, see, continuously the stocks achieved, high, and it was reached to the 3,500. Right. But again, I have seen corrections, but if you see still the stocks which is in trend. Sorry. See this. So continuously, which is in trend, and I don't see anything as such here. So I thought like, let's purchase at here. But if this break down this line, then I like take an exit from this particular stock as well. So this is how your calculate means, means while taking any positions with the options, right, or stocks. Now, if you ask me, sir, on the basis of this research, will you take a call option in this particular Raymond? Yes, I'll take it. But I'll also monitor, the situation. See, the point here is if this stocks, let's say, come down like this, let's say, so now if you see, let's say, the downside, say downside, if this, break this line, means trend line, then I'll take an exit. Because eventually there is no point to hold this particular stocks, because then you might see, it will come down around 1300 as well. You would be in huge loss. There is no point to then, hold this particular stocks. So I'm keeping an eye on this particular movement. And if this breaks out, then you can see again another level like 3,400 level. Then in that case, I will definitely buy call option. But if this breaks, this level, and if this come down like this, then I'll look for a put option. Then I'll buy a put option in this particular stocks, right? I'll select the price, maybe let's say 2000 level here, and I'll buy this particular, put option, which is basically sell. I'll sell it at 2000. I'll hold the put option. Then you might see down to level which is around 1500 as well. And if this, let's say if this goes up, then immediate support you can see, or resistance I would say you can see, which is at 2600 level. So this is how this trading game works, guys. If you have some research, then accordingly you can buy or hold options. You can buy options, you can hold options, and you can make some good amount of profit. But again, option business, it's a very risky business. In last 4 years, I have not generated a single penny from options. Though I lost around 7 to 8 lakhs in the year of 2018. I have recovered that amount in 2023. Then after I thought like let's not play around any options. And even till today also, I am not an active buyer of options, or even I'm not a seller. I'm actively doing in only this unlisted bonds, or you can see equities like through positioning and all. But I'm not buying and selling any stocks in your options in a derivative market. Why? Because of risk only. I don't want to take a risk, that level of risk. I'm not dreaming to become a rich in just one day or one night. No, I don't want to. I'm looking for a consistent return, or compounding return as well. I want to compound my returns, whatever that I'm earning. But again, if anyone want to do, your question would be like, sir, if I want to become a rich, let's say in one day, or if even I'm ready to become like zero to hero or hero to zero, then derivative market is for you. You can buy options, you can sell options, you can hold options, you can again write options. So how we can do that, I'll walk you through that part as well. All right. But yes, before that, as I said, you will have to do some research as well and find out that how this particular stock is performing and whether we should enter in this particular stocks and or not. Second stocks, if I talk about I purchase, which is Polyplex Corporation, this one. See, this stocks, it was at 280 rupees in the pandemic. And if you see the highest in 1 year, 1 or 2 years, it was reached to the 2,800. But suddenly again, it was started, consolidation from 2,800 to it was reached to the again 700. I was just, waiting for this, V, if you see, this is a V pattern basically. I was waiting for this. I wanted to take a position at very bottom, but again, it's a risky because what if, let's say, if, from this level also, if this goes down, then it would be very tough. I was waiting for this pattern. And now it seems like, this is at a very good level. So I thought like, let's take a position here. Right, I was waiting for a candles 1, 2, and this is a very strong support. So I thought like let's take a position. So I have purchased quantities in this particular Polyplex Corporation, and I'm sure it will reach to the immediately. You can see it may reach to the around 1800 levels as well. This level that you can expect very soon. You can expect this level. First level would be this, and second would be this. See, if you have this kind of research, then only you can buy options. If you don't have a research in place, and if you don't know the, let's say, chart, if you don't know, let's say, how to buy, when to buy, where to buy, or how to leverage out your money or whatever you have, then this market is not for you. All right. So I did some research and I thought like, let's take a position in this. So I took it. So now let's go back to the options and how you can buy it. See, options, you can buy index as well, like NSE, BSE. So let's check some charts for NSE as well, and then we'll talk about some how we can write and how we can buy it. So NSE, which is an index, National Stock Exchange, which is an index. My bad. Bank Nifty, we have a Bank Nifty as well. Bank Nifty represent your financial means total financial sector or reputed companies from the banking sector, I would say. Then we have a NSE, or we have a different index as well, Nifty 50. So this, I'm talking about Nifty 50. This includes top 50 companies of India, right? So nowadays to predict, this Nifty, it's very difficult. But if we talk about, let's say, trend, every time we have seen, some good movement in this particular Nifty. See, on election date, what happened with Nifty? If you see, market open at this price and close at this. When market, felt like now Modi, it will not be in power, then most of the big investors, they sold out the position. Huge position, they just, sell it out, and then market, it was like free here, free flow, or you can say like, the free ride. So it was for market, and then, market crashed by 1400 points. But very next day, the investors, they were very bullish about this, and they thought like this government can also, means Modi can form a government with the alliances. Then again, the market open at this level, and if you see within 2 days, entire market recovered. Not only recovered, see the movement, guys. Just because of the Modi only, the market from 2,300 to reach to the 2,500. So 2,000 movements in market we have seen, because this is all about the confidence. But now if you ask me, sir, what will you do with this situation? So at the moment it is very difficult to predict, because again market gave a breakout. See the previous, the market high was 25,000, and yesterday only, or day before yesterday, I would say, market already crossed that. So you might see another high, and market can reach out to the 26,000 very soon, maybe in next week, that you can see market will touch to the 26,000 mark, or maybe market will go down as well. Maybe it can come down at 24,000, or maybe below that. So it depends. So we can't predict that. But on the basis of this only, if you ask me, sir, what would be your, let's say, next move, then I look for, guys, see the market, which I can see market will reach to the 26,000. Then I look for a call option. I'll simply go to the my broking account, select this one, look for option chain, right? This is your option chain. So you can analyze some data as well, right? So look for a data. It means how the trend is. Basically trend, it should be your friend. If the trend says the most of the trends, let's say if they're looking for a buy, then I look for a buy only. Why should I look for a sell, right? So to see that open interest, which is the highest open interest which you can see, for which option, 29 lakhs, 36 lakhs for 25,500. Okay, this is the open interest. Okay, so it means still you can people, they are bullish. This is a call details. Okay, then yeah, 40 lakhs for 25,800. So it means market is bullish. So the buyers, right, they are anticipating that market will reach to the 25,800 maybe next week. And that's what here, if you see 40 lakhs, which is the quantities which are there, or trades, I would say, which are outstanding. So it means most of the trades which the index, they have received for 40 lakhs. And on other hand, if we talk about, let's say, put option, let's talk about the bid. Okay, bid ask quantity change. Let's talk about the open interest. See, the open interest is very low for this price, right? But open interest, so you might see that where again the bear, I would say, so sell, it means they are bearers, so they're not happy with the market boom. They always make the profit by pulling market down. So let's talk about that. See, bull people, they are thinking about market will come down at 25,000. And here, if you see, the most of the open trades which we have in to this price, 25,200. But the current market, if we talk about, which is at which is at 25,200 only. So it means it's a possibility that market will, reach to the 20, maybe, it will cross 2,200 levels, or maybe it will go up only. The reason is more and more open interest that we have at 25,800. Now, on the basis of this data, right, on the basis of this data, see guys, this is the game of demand and supply. So more and more demand that you can see to this price, okay, and more volume also that you can see. See the volume percentage, 2,79,000. Same for this price as well, 44 lakhs, and see the, the volume, 2,87,000. Even for this 25,600 also, you can see highest level of volume. So I would prefer this, maybe 25,600, maybe 20, 700, 800. Or if I have a huge capital, then I'll also, look for this one as well. 24,800 call price, or maybe 25,000, let's say 25,000, this one as well. Now your question would be like, sir, why this one? The reason is, if I, let's say, buy in the money, see here in the option, you can select in the money, out the money, and at the money. We'll discuss that as well, what is at the money and what is out the money. But if I buy, let's say this one, guys, this one, the moment of my option price would be high. But if I buy, let's say this one, 5,300, because the current market price of the Nifty is 25,000, to 30, or let's say 50 even. See, if I buy any option below this price, would be my out the money option. Sorry, in the money options for call option. And if I buy any, let's say, options with the above, price of the market price, so that would be my out the money options. So in the out the money options, most of the poor people, they lose entire their money in out the money options only, because out the money options, price of the out the money options should be very low. See this. Let's talk about some, premium. If I want to buy this one, it's the last price of, let's say 20, let's talk about 25,000. Okay. Premium that I'll have to pay around, see this, 340 for per quantity. But if I buy, let's say this one, 25,000, let's say even 300 also, I'll pay only 125. So you can see the difference in a premium of almost 50%. So if I want to buy more quantities, then I look for out the money. If I want to buy, let's say, quality of, quantities, then I look for in the money, right? So if you pay more fees, then you can see more speed. If you pay less fees, then you can see less, or I would say low, speed in this, your options. So that's what we always prefer to buy in the money options, even if it is a buy options or even if it is a call options. In both the cases, you can buy in the money options if you want to book, or let's say if you want to earn some money. But yes, in the money options would be costly one. So it means you will have to pay more fees to buy that. So that's what we means, most of the time we prefer the in the money options only. All right. So this is how your options, looks like, but let's see if I can, how we can buy that. Let's say, look at that. If I buy this one, 25,000 call option, this would be my in the money. If I buy, let's say this one, this would be my out the money, because I'll have to pay low, premium. First, we'll try to buy in the money, 25,000. Right. Then, see total price that I'll have to pay. See, 348 for per quantity. Total quantities would be 175 or 170 as well. But how much amount that we required? 8,780, which is margin required to buy that particular call option, and the strike price would be 25,000 strike price. Okay. So let's analyze this one, the profit possibility. Profit possibility would be, see, my expiry payoff, you can see loss. But if this, let's say if the assumption is, if this, goes in my favor, if this trade goes in my favor, my next profit would be 60,000. Another would be 1,23,000. See, the maximum profit that I can make it from this trade is 6,28,000. But if we talk about the loss, on other hand, my maximum loss would be only 8,000. My maximum loss would be 8,000. So I can simply buy this particular, option. Or if you want to again perform analysis, you can download that and save, and even you can perform some analysis as well if you want. How this strategy works and all. I don't want to buy it now. Again, it's a, it's a non-business day, so all right. So you can just open. Let me just open. This is all about your options: payoff, 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 delta, theta, whatever it is. It's a Greeks, so you don't need to go through it all. But so in terms of, the strategy, if we talk about, see, in one go, what you can do, you can buy call, call, call. You can buy also, put as well. So buy put, buy call, buy put. So through this strategy, and you can buy more and more quantities basically, right? And you can increase your profit, but eventually it would be costly as well. As I said, see, this business, this particular, derivatives, it's a very costly deal. So we cannot predict easily. Even if I buy this one, right? And let's say if I enter into this particular contract, I need a 8,000 only. But we cannot predict about, the profit and losses, because it's unpredictable. See, YouTubers or people, influencers, they'll talk about, look, I made this, I made that. See, you can check there, the P&Ls. Most of the, people like who are doing tradings and also they are in loss only. Real data nobody publish. So I'm not a trader, so I'm just trainer. So, or that is also like investment banking trainer. So I'm just, helping you to understand that how it works. All right. So yeah, these are the things about derivative options. So we'll take a break here for 10 to 15 minutes. We'll connect at 9:45. All right. And then we'll discuss about then how we can place the trades, what are the, things are important from the, the banking perspective. Then what about futures, swaps, options? So we'll discuss that in details then. All right. So further topics that will cover it out. So I'll walk you through a couple of, the examples, like how we can place the derivatives and all. And then we have a different, the slides prepared for different contracts. So, and yeah, so we'll discuss in details about it, because derivatives is a complex one. So we'll pay more time on this one. And then rest is like easy to understand, or I would say it's a simple one. So let's start with this. Where is my account? Yeah, here. See, now if I want to buy, any options, simply what you can do, go to the your broker account. If you have any broker account, you can go to your accounts. Let's say if I talk about Nifty, select the strike price. Strike price, it means the price which you are looking for. Okay, let's say this one. All options have a weekly expiry, because every week, options will expire. Then to option chain, I'll select this. I'm looking for this one. So I'll buy it now. Click on buy. Required margin is 8,000, but I have only 300, which is in my pocket at the moment. So I can't buy this one. But yeah, so in this way, you can also follow the same thing and buy options. Okay. See, same options, if I sell it, see, this is a call option. If you read this one, this portion, on 5th September, this option will expire. And this one is a strike price. Okay, this portion is called European because in options we have two types of options. One is European options and another one is American options. So difference between call and American and European is you call. See, American options are like they have a weekly expiry. Sorry, this European have a weekly expiry, so it means they are more standard. But if I talk about American one, so expiry of options, like before the expiry also you can exercise that, and it's very bit difficult to the stock exchange to deal with all of these options. So most of the stock exchanges, they have only the European options available for a trades. So see, it means called European. When we say buy, see, I'm looking to buy this particular option because my, let's say, research says, this price will go up. And that's what I'm looking for a buy. See, options that you can buy in lots, one lots for 25 quantities. So 25 quantities into price, right? Let's say if I'm looking for a 25 quantities, 25 into price, if we just multiply this, that would be a price. In terms of price, you can select two different prices. Current market of this option is 348.4. So total margin which is required 8,000, but I don't have 8,000 in a balance available. You can select limit price as well as market price. Limit price, it means, guys, your price, right? You can select any price between 0 to 10 to between 1,200. You can select any price. As a buyer, we always try to buy any product at a lower price than the market price. And in terms of selling, always we try to sell in a product at a higher price than the market price. Okay. Then you can select market price as well. If you select market price, it means if the market price is 348, then your trade will execute at this price. You can also select stop loss as well. Stop loss, it means basically if you, let's say, limit your price, maybe let's say if you buy it and if the price goes, let's say, down, so you can select maybe, let's say, 300, right? So if your premium goes below the 300, then basically, this will execute your contract at that price. So this is how you can limit your stop losses as well. Okay, but here it says like you can limit the price between 345 to 1,200 for a stop loss. So select the stop loss accordingly. Then apart from this, if you see sell options, if you want to sell, see, for a same price, if you want to sell is all about, guys, writing options. Okay, writing, it means, see, your option holders, they are paying premium, but they're paying premium to whom? Understand this one. Let's say you're option buyer, then, and let's say I'm option seller, then, so you guys are paying premium to me only. Okay, because I'm an option seller, so that premium, it would be my profit. But what if, let's say, that option works in your favor, then whatever profit that you would see in your options, so that profit I'll pay it to you from my pocket. So this is how it works. So option sellers, basically, they are very big traders. They have a huge capacity. Now if we talk about the capital which is required, see how much capital is required for option. See, for option selling we required 75,000, right? If you want to write this option, then required around 75,000. And but for the same option, if you just want to buy it, required 8,000. So it means almost 10x extra capital we required to buy option trades in the market. So this is how you can understand it. So this is a call option. You can buy calls. You can even sell calls. But if you sell calls, that would be your option, writing part. And if you just buy it, that would be your holding options, right? So before the 5th of September, means if you just let's say if you entered in this option today, see before the or on or before the 5th of September, you can buy this option as many times. So that depends on you. As much as many means you can buy today, you can sell tomorrow, you can buy or you can buy tomorrow, you can again sell tomorrow. You can do these activities continuously. It depends on you how you want to execute it. All right. So the important is always before the buying, so always see your capital and try to manage that capital in an effective way. Stop loss is basically you're stopping the losses, right? If the market goes down, then the system will automatically book the particular loss or profit, whatever it is, if you set it. And in that way, it will help you to restrict your basically losses, means unlimited losses. That's how your limit price works in your favor. Okay. Then if we talk about, and then again, simply you can buy it out. But see, this price, if you compare with the market, we have seen that, the index price, which is at 25,000. All right. And the option we are looking at, which is 25,000. This, the option would be your in the money option. In the money, it means your call option price, which is, below the market price. And that's what we are paying higher premium. For all, in the money options, we always pay higher premium. Now, if I select, let's say, if I select a different option, let's say this one, current price is 5,000. Here is your current price, this red portion, 25,235. So this is your current price. If I select, let's say, this one, 25,300, here, if you see, I'll pay only, 3,000 premium. So if you select out the money, you will have to pay very low premium. All right. Now your question would be, look, sir, if I buy this one, so what would be my maximum loss? See, your maximum loss would be total premium that you have paid to buy this particular option. If I buy this one, my maximum loss would be this one as an option holder. And what about, sir, profit? Profit, see, again, it's so it means you can say it's an unlimited profit. So it depends on the market. If you see big movement in market, then there will be big profit. If there is no movement in market, then you will not see profit. So it depends on the speed only. Premium works with speed. More speed, more premium change, more profit. Low speed, higher premium, more losses. If there is no profit, let's say if there is no speed in the the market, then it is very difficult to enter in this particular options. So I would not suggest to enter in this particular market. Then if there is no speed, then you should not invest, because this market works with speed only. Okay. And what about the writing part? Writing part, it means, see, for a writer, the maximum loss would be 70, or maybe more than that as well, depends on the again market. But the profit, if we talk about for a writer, is only the premium the buyer is paying. Only for a 63,000, 67,000 capital, option writer will earn only 3,000 profit, max to max 3,000. So it means option writers, for them, the profit scope is very limited, but the capital which is required is very high. And that's what it is. Not like, this deal is not for common people, so that we cannot pay, higher capital. Are you getting my point? So we only pay limited capital. We will have a limited capital. So with a limited capital, you can just hold the option contracts. So this is how you can hold it, option contracts. Now your another question would be like, sir, look, what about, put options? Put options also, you can see, these are the put options. You can buy put options at any price. If we talk about current market price, so the current market price is 25,235. If you buy, let's say, this option even, to 25,200. If you see the premium, which is a very low, right? 17,000, 1,700 that you will have to pay it. But same in a put option, if you just write, if you just sell it out, see, we required 71,000. So writing is a costly part. Okay. But this option becomes again out the money. The reason is your current market price is higher than your your own target price, which is your strike price. All right. And in that case, you should not look for this, because see, most of the common people, why they select out the money, the reason is, guys, premium, so that you can buy more and more quantities. You can buy more and more quantities. So in a 14,000 rupees, you can buy 200 quantities. If you have, let's say, 20,000, then you can buy almost 400 quantities. Correct. But if you select any, let's say, any other out the money option, in the money options, in the money would be this one. Current market price is 25,235. So in the money would be for option trades, which is 25,250. So if you just buy this one, see how much the required is. So premium which is required is 2,100, right? So you can see the increase in premium. So it means for in the money options, or in the money put or in the money call, in both the cases, we'll have to pay higher premium. And for out the money put and call options, we'll have to pay again lower premium. But for a trading purpose, you should only look for in the money options. Okay, I'm just summarizing it. For option writers, we need a more capital, right? Only the professional traders, they look for option writing. Otherwise, most of the traders, they only do the option trading only, not writing. Common people, again, they only look for a writing, not for a trading. Writing is something, it is only for a professional people, so they easily manage it. All right. So again, so you can buy these stocks also through options, right? And we have a different indices, which is Nifty, Bank Nifty, Fin Nifty, Mid Nifty. Now your question would be like, sir, what is Nifty? See, Nifty represent the value of top 50 companies like TCS, HDFC. There are different companies. Bank Nifty represent the top, the banks in India. If you see movements in the banks, for example, let's say if you go to the NSE site, let's talk about indices. Since Nifty 50 represent the top 50 companies in India, or their market caps, I would say. Okay. So 25,000, it means, which is something 25 lakhs crores. So just click on this. See this. All are the top 50 companies from different sectors. If you see the change in this companies stock price, then you would see change in indices. So basically, indices represent your top companies. Okay. So your indices represent top companies. If you see, let's say, if HDFC Bank, Tata Motors, or all other companies, if they, if the price decrease of those stocks in the market, then again your Nifty will, Nifty means index will decrease. Index is representing to the top companies from different sector: TCS, Sun Pharma, Power Grid, Bajaj Finance, Hero MotoCorp, NTPC, all other companies. So it is very important that if the top companies, let's say, grows, then your index will grow. If the top companies, let's say, if they if let's assume it, if they don't if they haven't performed well for a particular year, then you would see downfall in index as well. So basically, Nifty index is linked with your top 50 companies growth. If the top 50 companies they grows, then your index will grow. If top 50 companies, let's say, degrowth, if you see in their stocks or in their business, then you would see again Nifty that index will also, the price of index will also grow, or index value also it will, reduce, because index value is based on, as I said, the top 50 companies from different sector. All right. So let me take a questions. If you have any questions, you can text in the chat box. So I'll take it. After expiry, your option will, this particular contract will dissolve, option will dispose, benefits will transfer to the buyers and sellers accounts accordingly. So that is what we'll call it as a payoff. So in options, your stock exchange will process the payoffs. Depends on the, the profit and loss. As a buyer, if you have a profit, then you will receive profit. As a seller, let's say there is a loss, then stock exchange will book the losses in the seller's book. After expiry, simply it will, book the losses and profit in the counterparty's account accordingly. Any other question, guys? So this is how your option works. So now, if you don't have any questions, so let's talk about what is option exactly. So we'll cover the options part. So here you can note it down, please. Okay. So options options has two types. If we talk about options, it means it's a contract of financial instruments, which derives the value of actual, securities, bonds, options, currencies, and all. So anyone can buy it. It is allowed to anyone. If you have a more capital, then you can write the options. If you have a low capital, then you can hold the options. Option holders, they pay the premium. Option writers, they pay the margin. All right. Total loss of option holder would be like, initial paid premium. And for option writers, initial paid premium by the holder should be the maximum profit of option writers. Option writers, they're like, highly professional traders, and option holders, they're like novice, or maybe you can say, or anyone can do it. Option holding or writing can be done for a leveraging, or let's say, making more and more profit. And it's a common thing, if you see more profit, then you will have a more losses as well. Through options, you can also hedge your portfolio as well. If you have a stocks, and if you want to, let's say, ahead of any events like negative events or anything as such, if you are planning to just, just protect your portfolio from the market uncertainties, then what you can do, you can simply buy or put the buy or sell the options, and that's how you can hedge your positions. Okay, so this is how your option works. So now let's talk about some technical things in the PPT. So option has two types. One is American option, another one is European option. European option is more popular one, and on every stock exchange you can see like European options are only listed on a stock exchange, because European options can only be exercised on the expiration date, and American options may be exercised at any time up to the expiration date. And that's what, if you if you just exercise the option multiple times, then it would be difficult for standardization, and again to maintaining the data and all. So always stock exchange wants something very standard. All right. So this is how actually options works. If we talk about now, let's say, option types. Option has two types, one which is call option, another one is put option. So if we talk about call option, guys, see, we always pay premium. See, call option, it means you can buy the call. Long, it means buy. Short, it means again sell. So you can buy the call option, you can sell the call option. Option buyer will call it as a holder. And if we talk about sell, then we'll talk it about, the writing of options. So option seller would be, writers, right? So for a writing, we need a more and more capital. And for a holding, with a minimum capital also, you can do it. So if we talk about, let's say, holding has a right to buy at a given price, but not obligated. So it means as a buyer, you don't have any obligations. So you can buy it anytime, you can, sell it at any time. So that's how it works. And if we talk about, let's say, selling required to sell at a given price if a long exercise rights to buy. So it means he will give the exact price to sell it out, then only you can sell it out that that price only. All right. And this will happen at expiry. So basically writers, they will have to wait until the options expires. All right. Then see, option holders, they enter in options at any point in time. They just buy it at any point in time. So they don't have any obligation as such. So that's how you can understand the options part. So if we talk about now put options, in terms of put options, option holders again in a put option also. So you can take a long positions in put. So it means you can simply buy it out. But if you again sell it out options, you will have to pay margin. That works in the same way. See, option selling and option this buying, basically call option buying and put option selling, that works in the same direction, because here is also target is like if we just buy the call option, so it means we are anticipating that price will go up. If we sell the short, or if we just write the put option, it means again we are anticipating that price will go up. If we talk about, let's say, option shorting, in that case, again here we are thinking that the market will go down, and that's what we want to short the call option. And if we talk about this normal holding option, again here the target is like market will go down. So this is how you can relate. But yeah, so if we talk about put option, has the right to sell at a given price but not obligated, so you don't have any obligations, so you can sell it out at any price and you can take an exit. But if we talk about writing, again writing is a critical, so required to buy at a given price if a long exercise right to sell at expiry only. So until expiry you will have to hold your positions. Before expiration they may have a different values, right? American and European options are both identical at expiration. So yeah, so this is how your option things works. This was just a summary. Now in terms of, let's say, interview preparation, you should know these types of options: call, put, what is call, what is put. What about the premium? Premium is the advance money that option holders pays it. Then how much should be the maximum loss of option holders? Maximum loss should be your premium, whatever premium that we have paid, right? Then obligation on holder of options. See, there is no obligations. Basically, they can buy and sell at any point in time. Okay. And yeah, so apart from this, they may give you any example as well. Look, if I buy options at this price, then what would be my profit, what would be my loss? In that case, you can carry pen and paper, or maybe you can quickly do the calculations, ask them price, quantity, and price movement, and accordingly you can calculate it. We have also means we initially we have calculated in Excel, correct? So you can follow the same thing. So let me know if you have any questions around these options. I'm open to accept your questions about options. But yeah, we're done with the options part. Come on, guys. Any questions so far? Is it tough? Is it easy? You can text in the chat. Okay. See, at expiry, just, don't worry about it. We'll have to maybe then see one practical example, because I don't have at the moment, but we'll have to wait for expiry. See, at expiry, it's just simple, let's say if you are in a profit, then you will receive profit, right? If you are in a loss, then you will have to book the loss. So it means stock exchange will book the losses in your accounts. For example, let's say we have that option to this one. Go to our portfolio. Let's see here. Open trade. What if, let's say, on 26th of September, the price of this, this option, let's say, come down to 1 rupees, right? then my maximum loss would be whatever amount that I have paid, correct? So I have paid, let's say, 250 into 60. Just calculate it, how much amount that I have paid it. 250 into 259. Around 14,000 that I have paid it. So see, if the price of this option, let's say, trades under 3,100, then I lose my entire money. If market price, let's say, cross this 3,100 before the maturity, maybe let's say 3,000 like this 50, or maybe 3,000, let's say, or 3,200 like this. In that case, this option would be in profit, because premium, level that you can see somewhere like this. Okay, let's take an assumption. Here, entire premium would be 0. Again, here also 0. If let's say 3,000 price, if let's say again, if you see, which is at same level like 3050, my entire premium would be like 0, because that's what, every day I am paying charges. All right. But what if, let's say, before the expiry or in next week, price touch to the 3,150? In that case, so you might see the options price from 59 to, let's say, 100. In that case, and if I, let's say, take an exit here, let's calculate it payout. I have paid 59 and current market price, which is 100. So if you just calculate the 250 into 100, so total amount that I'll receive 25,000, but my actual profit is something different, because 250 into 59, which I have paid it as a premium, that I'll have to calculate it. Okay. This one, because I have paid this, right? This was my premium. And this is a gross payoff received. So if I calculate net payoff, my net payoff would be 10,250. So my net, this is what, you can calculate profit as well. So on expiry date, stock exchange, calculate the same thing. Stock exchange, calculate this. See, in the books of, let's say, you're a holder, and there is a writer as well. In the books of writer, holder, first talk about writers. Holder paid a premium 750 for 250 quantities. All right. Then current market price, or let's say settlement price, which is at something 25,000 for the same 250 quantities. All right. So initially this guy had paid, let's say, premium to whom? To the writer. So for the same 250 quantities, let's say writer received right. But on this expiration date, if this particular contract is in let's say in your favor as a writer, we are assuming it you're a writer. So in the books of this one, writer will compensate in a way that writer will have to pay total 25,000 against 250 quantities to whom? So basically writer will pay 25 and this guy will receive 25. So net, if you just calculate net payout, if you just calculate net, it means only net. Your calculation looks like this. So this is the loss of writer for 250 quantities. And this is the profit. Profit of this, holder on expiration date. So this is how calculation works, guys. All right. So now let me know if you have any questions around this one. Any question? Come on. Yes, no. Options we cannot carry. It is mandated to see, if you want to roll it forward, then you can take an exit from the previous one and you can, sit on the next week's options. So you cannot directly carry in a forex market. You can do this in a forex market. You can carry that. Okay, so you should acknowledge it, because see, if you are a fresher, Sanjeev, it's I understand this one. It's a very complex topic. Okay, but we can't do anything on this much. But at a fresher level, as I said, only few things are important. One is types of options. As I said, see, the types of means you can read the definition part, right? Then what is European options? What is this, American options, the total premium which we pay out. Basic information is needed. And side by side, if you can open, demat account and trading account, you can, just play with around some dummy trades, then you can learn that as well. The derivatives is not for a theoretical trainings. It is for a purely for, practical sessions and all. If you need any support kind of that, text me, I'll help you for that, for a dummy accounts and all. So do one thing, open the account, means access, log in the account along with me if you want, if you have a this one, and place the trades for a derivatives, right? Theoretically, if you ask me the definition, derivatives, it means it's a contract of financial instruments. That's all. We sign the contracts for financial instruments, could be for your equities, bonds, debentures, or any other things. That would be your derivatives. Derivatives, it's a possibility, guys. It's a possibility. It means it's a possibility. It's like a cricket satta. We pay the premium, we take an entry in satta, and on expiry, what happened with us? If you have a good points, then you get your money back. Or even, you can earn 20, 30, 40 rupees extra. So same thing you can see with this as well.
Trading is like satta.
Trading is a satta.
Trading is a satta.
Yes. It's like your IPO game. So sorry, that IPL game. In IPL, what is happening, guys? How you are sure about, let's say that, Rohit Sharma will play well or Virat Kohli will play well? We cannot guarantee it, correct? So same way in a stock market also, if you have a less capital, right? But if you're ready to take a more risk, then you can leverage out your, let's say, the small capital through derivatives, take an entry in contracts, be a member of that, club. If your stocks, let's say, price goes up, then your premium will go up, then you will, you can earn some money. This is how it works. There is no rocket science. It's, if let's say your, this IPL satta, then same logic you can apply it here as well. See, how you make a money from cricket satta? Your team should perform well, correct? Then you can make a profit. So same logic you can apply it here as well. If, let's say, index perform well, or let's say if your index, let's say stock perform well, and if you have a buy position or long position, then you can make a profit. And if doesn't perform well, then of course you will have to lose your entire money. What if, let's say, you entered in a satta option of your IPL team and your IPL team doesn't perform well? Then what will happen with your money? You will lose your money. Whatever you have paid, it will, you will lose it. Am I right? See, this is a satta game, pure satta game. Option is a satta game. Few traders will tell you the story that, look, you will have to do lots of research, this and that. But look, boss, we cannot predict, the market direction, right? We cannot. See, what happened sometime, let's say, I got to know that, this Modi government is doing something in shipping, then I'll maybe bet on shipping companies, and if that goes up, then I'll tell to the world, look, I did this, my the scripts now being well, performing well. Dude, you haven't done anything. You just purchase and invested amount. So everything that the company is doing, even if you talk about research, that wasn't your research. Even if you don't research, nothing will happen. Company will perform in the same way. See, the game is it's a zero-sum game. It's all about, if you're, let's say, risk taker, just take a risk, invest money, and wait for some time, your money will grow. That's all. And if we talk about options is all about, with a lower margin or with a less amount, I would say you can buy more and more quantities. And options will have a weekly expiry. So it means every week your options will expire, and new options your stock exchange will form it out. Every week, the exchange will create a new options in the system. Okay. Let's talk about now the derivatives in details. That was like options. Options was a critical part. So I thought let's discuss option first. Now we'll discuss the other instruments that comes under your derivatives. We'll now discuss from the beginning, because difficult part always we discuss first. All right. See, if we talk about derivatives, it means contract of financial instruments, as I said, and that derives the value from the stocks, bonds, commodities, interest, FX rates, market indices, and weather. And if we talk about types of derivatives, we have a types of derivatives like forward, future, swaps, options, and credit derivatives. किसको barter system पता है? किसको पता है? Come on. Barter system. Have you heard about barter system? हाँ ना? हाँ राइट. बार्टर में क्या होता था? गुड्स के बदले में गुड्स दिया जाता था. करेक्ट. अगर तुम्हारे पास राइस है तो वीट आप ले सकते हो. वीट के बदले में दिस, इसके बदले में दिस, और दोनों की डिमांड पूरी हो जाती है. राइट. वैसा हमारे पास क्या था? बार्टर सिस्टम था. क्या था? बार्टर सिस्टम था. जो पुराना बार्टर सिस्टम है वो आज का स्वैप है. जो पुराना बार्टर सिस्टम है वो आज का क्या है? स्वैप है. स्वैप मतलब आप करेंसी को स्वैप कर सकते हो, आप कमोडिटीज को स्वैप कर सकते हो, आप रिस्क को स्वैप कर सकते हो. अगर आपकी कोई रिस्क है तो आप कुछ भी स्वैप कर सकते हो. कुछ भी मतलब कुछ भी. जैसे आप जहां पर जॉब करते हो ना, आप आपकी मेहनत को स्वैप कर रहे हो. कैसे? आप कंपनी को ये कह रहे हो कि मैं 8 घंटे डेली काम करने के लिए रेडी हूं, मुझे 8 घंटे का पगार 5,000 रुपए पर डे दे दो. सो 22 दिन का मुझे पगार दे दो. 22 दिन का पगार कितना हो जाएगा? एक करीब करीब 1 लाख हो जाएगा. नहीं, 50,000. हाँ, 1,10,000 हो जाएगा. सो कंपनीज क्या कर रही है? आपको पैसा दे रही है आपके एफर्ट्स के बदले में. जैसे फॉर एग्जाम्पल मान के चलो आपके पास एक प्रॉपर्टी है. राइट. आपके पास एक प्रॉपर्टी है. उस प्रॉपर्टी का रेंट आपको कभी 4,000 आता है, कभी 3,000 आता है, कभी 2,000 आता है. आप पूरे तंग हो गए हो इस चीज से कि यार फ्लक्चुएशंस इतने हैं कि मैं अपनी फाइनेंशियल प्लानिंग कैसे करूं. देन आपको मैं मिला रास्ते पे और आपने मुझे आपका प्रॉब्लम शेयर किया और कहा, अरे शिव सर क्या बोलूं, रेंट जो मिलता है ना, कभी 3,000 मिल रहा है, कभी 2 मिल रहा है, कभी 1 मिल रहा है, कभी मतलब बहुत सारे वेरिएशंस है. तो मैंने कहा ठीक है भाई, मेरे पास एक बंदा है, वो रेडी है कि तुम्हें 2,000 रुपए पर महीना फिक्स्ड ये रेंट देने के लिए, फिक्स्ड रेंट देने के लिए. अगर तुम्हें उसके साथ कॉन्ट्रैक्ट करना है तो कर लो और आपकी प्रॉपर्टी के राइट्स इसको दे दो. लेकिन इस प्रॉपर्टी के थ्रू जितना भी इनकम होगा, चाहे वो 5,000 हो या 10,000 हो, वो पूरा का पूरा वो बंदा लेगा. उसके बदले में सिर्फ वो तुम्हें 2 महीना पर महीना देगा. अभी उसमें अगर प्रॉपर्टी आपकी चली भी नहीं गई या फिर वैकेंट रही, रेंट नहीं आया, तो भी वही बंदा जिम्मेदार है, वो पूरा देख लेगा. अगर रेंट भी नहीं भी आता है तो वो अपने पॉकेट से रेंट देगा, लेकिन वो आपको फिक्स्ड रेंट देने के लिए रेडी है. तो वो क्या है गाइस? स्वैप नहीं तो क्या है? स्वैप ही है ना। देखो, डेरिवेटिव्स कोई अलग टर्म नहीं है। हम अपने जीवन में, पर्सनल लाइफ में हजारों लोगों को कमिटमेंट करते रहते हैं, राइट? इसके लिए कमिटमेंट करेंगे, उसके लिए कमिटमेंट करेंगे, करते हैं ना। जैसे मान के चलो आपने आपके दोस्त को पैसे मांगे, राइट? आप क्या कहोगे दोस्त को कि भाई देख, पैसे तो देता हूं मैं, लेकिन इसकी गारंटी क्या है? रिस्क तो मेरी भी होगी। दोस्त ने आपको लालच दी, ठीक है, अगर तुम मुझे पैसे देते हो तो मैं 10,000 के लिए मैं आपको 12,000 रिटर्न करता हूं। क्या वो वर्बल डेरिवेटिव्स नहीं है? डेरिवेटिव्स मतलब क्या? डेरिवेटिव मतलब डिराइव करना। डिराइव करना मतलब जो भी है ऐसे कुछ पॉसिबिलिटीज को मान के चल के ट्रेड्स करना, उसको डेरिवेटिव्स कहते हैं। जैसे ऑप्शन के सट्टा में मैंने कहा कौन सा प्लेयर खेलेगा, उन सबको एक टीम में लेके आके पैसे लगाओ, वो क्या है? पॉसिबिलिटी है। पॉसिबिलिटी ऑफ अंडरलेइंग थिंग्स। अंडरलेइंग थिंग्स मतलब क्या? कोई भी गुड्स हो सकता है, कोई भी कमोडिटीज हो सकता है, कुछ भी हो सकता है। कुछ भी मतलब कुछ भी हो सकता है। अब सवाल, अब ये क्वेश्चन होगा कि सर लुक, ये तो तुमने बहुत बेसिक चीज बताई भाई, ये तो हमको पता है, कुछ और स्टॉक मार्केट से रिलेटेड बताओ। चलो उसके बारे में बात करते हैं। अगर स्वैप, मैंने जैसे कहा कि भाई ये तो आपका ये कॉन्ट्रैक्ट है, क्या बोलते हैं उसका, ये तो आपका बार्टर सिस्टम वाला कॉन्ट्रैक्ट है। पहले इसको इवोल्यूशन समझते हैं, फिर मैं उसी के ऊपर जाता हूं। देखो, जो आपका बार्टर था आज का स्वैप है, एंड जो आज का स्वैप है उसको थोड़ा सा मॉडिफाई करके एडवांस लेवल पे हम लेके जाते हैं तो वो फॉरवर्ड हो जाता है, राइट? फॉरवर्ड में भी हम वही कर रहे हैं, लेकिन थोड़ा सा एडवांस लेवल पे आपको एडवांसमेंट दिखेगा। एंड फॉरवर्ड का जो एडवांस भाई है, जिसको मंथली एक्सपायरी होती है, एवरी मंथ एक्सपायर होते हैं, वो है फ्यूचर्स। फ्यूचर्स में आपको ज्यादा मार्जिन देना पड़ता है। वो दिखते कैसे, काम कैसे होता है, वो भी हम देखेंगे। एंड उसी फ्यूचर का जो बहुत एडवांस वाला जो भाई है ना, वो है ऑप्शंस, जहां पर आपको दो दो ऑप्शंस मिलते हैं, आप बाय करो, सेल करो विथ वीकली एक्सपायरी। स्वैप एंड फॉरवर्ड में कोई भी हम इनिशियली पैसा नहीं देते हैं, एंड ये गांव का हर एक बच्चा करता है, गांव का हर एक आदमी करता है, हर एक किसान करता है, स्वैप हर एक जन करता है। ये कैसे करता है स्वैप, फॉरवर्ड स्वैप और फ्यूचर स्वैप्स, मैं आपको बताऊंगा। दूसरा, रही बात फ्यूचर और ऑप्शंस की, इसमें भी गाइस अगर हम स्टॉक मार्केट को थोड़ा सा हटा दे, नंबर्स को अगर थोड़ा सा बाजू में कर दे, तो ये भी हर कोई करता है। पॉसिबिलिटी के साथ कौन नहीं खेलता, मुझे बताओ? सब खेलते हैं। जैसे किसान की अगर मैं बात करूं, चलो किसान की बात करते हैं पहले, और ये समझते हैं कि किसान कैसे इन चीजों को मतलब करता है, बट जिसका डेटा हमें दिखता नहीं है, तो उसको क्या डेरिवेटिव्स कहते हैं। लेट्स टॉक अबाउट कमोडिटीज। आप किसान है, इसमें से कोई है किसान? यस नो? किसान हो आप? अगर नहीं भी हो तो बन जाओ थोड़े समय के लिए। तो मान के चलिए आपके पास राइस है, या राइस का बहुत, लेट्स से राइस का अभी क्रॉप है आपके पास, ठीक है? आपके पास क्या है? क्रॉप है राइस का, और वो छोटा है, बहुत छोटा है। लेकिन राइस की जो अभी प्राइस मार्केट में है, जो प्राइस अभी चल रही है, वो मान के चलिए 20,000 रुपए क्विंटल चल रही है, फॉर पर क्विंटल। एंड ये 20,000 प्राइस बहुत हाई लेवल पे है, बहुत क्या है, हाई लेवल पे है। अब ये किसान का जो डर है उसको समझिए। किसान का जो डर है ये है, उसका क्रॉप तो अभी छोटा है, बट जब इसका क्रॉप रेडी हो जाएगा, मार्केट में जब इसका राइस आएगा, क्या पता प्राइस 20,000 से 10,000 पे आए, फॉर पर लेट्स से 1 क्विंटल। नाउ ये क्वेश्चन वुड बी लाइक, सर ऐसे कैसे पॉसिबल है? भाई है ना पॉसिबल, क्योंकि अभी इसका क्रॉप छोटा है, मतलब सप्लाई मार्केट में कम है, डिमांड ज्यादा है, क्योंकि खाने वाले लोग अपने जैसे बहुत है, इसलिए प्राइस क्या हुई है? अप हुई है। जब इसका प्रोडक्शन रेडी होगा, क्रॉप यानी कि बन के जब राइस जब मार्केट में आएगा, तो सप्लाई क्या होगा? कम ऑन, हाई होगा। और डिमांड क्या होगा? डिमांड लो होगा। अगर डिमांड लो होगा या फिर कांस्टेंट भी रहेगा तो प्राइस ड्रॉप होगा। इसमें नुकसान किसका है भाई? इसमें नुकसान किसका है? किसान का है कि नहीं है? अगर किसान के पास रेडी होता प्रोडक्ट तो उसने 20,000 से बेचा होता कि नहीं बेचा होता? बेचा होता, है ना? आप नहीं बेचते क्या? बेचते ना? कम ऑन, अभी तो हिंदी में भी अगर समझ में नहीं आ रहा है तो मैं कुछ नहीं कर सकता। ये बेसिक इकोनॉमिक्स है गाइस, एंड मुझे एक्नॉलेजमेंट चाहिए। मैंने कहा अगर मुझे आप मुझसे अगर आप ज्यादा एक्सपेक्ट कर रहे हो तो मुझे रिस्पॉन्स चाहिए चैट बॉक्स में। तो यहां पे अगर देखोगे किसान का नुकसान कितना होता है पर क्विंटल? 10,000 रुपए। मान के चलो किसान का जो प्रोडक्शन बना वो 10 क्विंटल का बना, राइट? 10 क्विंटल का बना। सो 10 क्विंटल इंटू अगर आप 10,000 करोगे, सो ऑलमोस्ट किसान का जो लॉस है गाइस वो 1 लाख रुपए का है। 1 लाख रुपीज का नुकसान हो जाएगा। अब मेरा क्वेश्चन आपको यह है कि चलो मुझे अगर ये लॉस नहीं चाहिए भविष्य में, मुझे अगर लॉस नहीं चाहिए तो मैं इसको बेहतर तरीके से कैसे मैनेज कर सकता हूं? यहां से कोई है ज्ञानी कि जो मुझे ये बताए कि हाँ सर ये करके हम इसको कंट्रोल कर सकते हैं? कम ऑन। काफी सारी हमने चीजें डिस्कस करी है, बट अगर मुझे ये लॉस नहीं चाहिए, मुझे अगर ये लॉस नहीं लेना है, मुझे 20,000 ही प्राइस चाहिए 6 महीने बाद भी। सी मार्केट तो मेरे हाथ में नहीं है ना, करेक्ट? मार्केट में क्या ट्रेंड होगा ये मेरे हाथ में है क्या? प्राइस 20 से 40 भी हो सकता है और 20 से 10 भी हो सकता है। ये मेरे हाथ में है क्या एज ए किसान? है गाइस? यस नो? मार्केट कोई कंट्रोल कर सकता है? नहीं कर सकता है, राइट? नहीं कर सकता है। बट अगर मुझे ये प्राइस चाहिए, 20,000 का प्राइस चाहिए, तो मैं क्या करूंगा? इस 20,000 के प्राइस को, मेरे पास बहुत सारे ऑप्शंस हैं, अभी एक एक करके ऑप्शंस में पिटारा खोलूंगा। ठीक है? पहला ऑप्शन मेरे पास है। पहला ऑप्शन क्या है? अगर मान के चलो मेरा क्रॉप अभी बहुत छोटा है, बहुत स्मॉल है। क्या है? बहुत स्मॉल है, राइस। अभी इसका अंडरलाइंग एसेट क्या है? राइस है। हम किसके प्राइस की बात कर रहे हैं? राइस के प्राइस की बात कर रहे हैं मार्केट में। ये प्राइस कहां पे है? मार्केट में है, राइट? हम मार्केट के प्राइस की बात कर रहे हैं, लेकिन बेस क्या है हमारा? राइस है, राइट? अब देखो, अगर इसका ड्यूरेशन 6 महीने से ज्यादा रहेगा या फिर 1 महीने से भी अगर ज्यादा होता है मान के चलो, तो मुझे कौन सा कॉन्ट्रैक्ट साइन करना पड़ेगा? क्योंकि ऑप्शंस तो वीकली एक्सपायर होते हैं, फ्यूचर्स मंथली एक्सपायर होते हैं। तो मेरे पास क्या ऑप्शन बचता है? मेरे पास बाहुबली का ऑप्शन बचता है, जो है फॉरवर्ड कॉन्ट्रैक्ट्स। क्या है? फॉरवर्ड कॉन्ट्रैक्ट्स। नाउ योर क्वेश्चन वुड बी लाइक, सर व्हाट इज दिस फॉरवर्ड कॉन्ट्रैक्ट? सी फॉरवर्ड इज नथिंग बट इट्स अगेन अनदर वर्जन ऑफ फ्यूचर कॉन्ट्रैक्ट्स। मैंने कहा है फॉरवर्ड मतलब आगे। फॉरवर्ड मतलब क्या? आगे। हम सेटल कब करेंगे? आगे, भविष्य में। कब करेंगे? कभी भी करेंगे, क्योंकि उसका कोई पैटर्न ही नहीं है। हाँ, लेकिन ये जरूर होगा कि आपको इसमें डिफाइन करना पड़ेगा 2 महीना, 3 महीना, 4 महीना, 5 महीना। तो लेट से कि आपने फॉरवर्ड क्या किया? 5 महीने के लिए साइन किया। आपने क्या किया? एक बंदा है यहां पर, ये भाई साहब डीलर है मान लो, मान के चलिए ये राइस का डीलर है या फिर और किसी चीज का डीलर हो सकता है या फिर कंपनी हो सकता है। और ये भाई साहब कौन है? ये किसान है। ये अपने राइस को लेकर बहुत चिंतित है। इनको लग रहा है कि ये जो प्राइस है ना, बहुत ही डिसेंट प्राइस है। इनके एक्सपेक्टेशन मेट हो गए। ये बहुत हैप्पी है इस प्राइस से, और ये इनको डर भी है कि प्राइस नीचे ना गिरे, नीचे ना गिरे। अब इस भाई साहब की बात करते हैं। ये भाई साहब कंपनी के मालिक हैं। इनको क्या लग रहा है कि अगर मान के चलो राइस की प्राइस अगर आगे बढ़ जाती है, क्या? अगर आगे बढ़ जाती है तो इनको नुकसान होगा। अब सवाल है कि सर इनको नुकसान कैसे होगा? हो सकता है कि इनको राइस का ऐसा कुछ बनाते होंगे या फिर राइस की रिलेटेड ऐसी कुछ चीजें बनाते होंगे, या फिर हो सकता है कि उनके लिए राइस एक रॉ मटेरियल है, तो उनके रॉ मटेरियल की कॉस्ट बढ़ेगी एंड उनके धंधे पे बहुत तगड़ा असर होगा। एंड ये भाई साहब भी 20,000 प्राइस को लेकर बहुत खुश है। देखो दोनों खुश है अपने अपने प्राइस को, लेकिन एक की चिंता क्या है, नीचे गिरना, दूसरे की चिंता क्या है, ऊपर जाना। एंड ये भाई साहब मिले हैं मुझे, मैं यहां पर हूं। इसने भी कहा कि भाई शिव भाई देखो ना जरा कि कुछ करो, अगर प्राइस गिरा बहुत अच्छा है, गिरा तो मेरा नुकसान हो जाएगा। ये भी भाई साहब आया मेरे पास, बोला कि देखो शिव भाई अगर प्राइस ऊपर गया तो मेरा रॉ मटेरियल का कॉस्ट बहुत बढ़ेगा एंड आई वुड बी इन ट्रबल। तो मैंने कहा भाई रुक जाओ, मेरे पास सोल्यूशन है, बहुत डिसेंट वाला सोल्यूशन है। हम क्या करते हैं, एक फॉरवर्ड कॉन्ट्रैक्ट साइन करते हैं। आप इसमें लिख दो कि ये प्राइस के साथ आपको सेल करना है, यानी कि ये भाई साहब क्या करेंगे, इसको सेल करेंगे इस प्राइस को, एंड ये भाई साहब क्या करेंगे, इसी प्राइस को बाय करेंगे। यानी कि कंपनी वाला बाय कर रहा है, किसान सेल कर रहा है 20,000 को। ये हुआ कॉन्ट्रैक्ट, जब इनिशिएट हुआ, कॉन्ट्रैक्ट इनिशिएट हुआ, मैंने ब्रोकर का काम किया, मैंने हेल्प किया दोनों को एक जगह पे आने के लिए, डिसाइड करने के लिए। एंड किसान ने प्राइस 20,000 सेल करी है पर क्विंटल, एंड लेट्स से दिस गाय कंपनी ओनर बाय द 20,000। वाई? क्योंकि उसको डर है कि प्राइस ऊपर जाएगा तो नुकसान होगा, इसलिए उसने उस प्राइस को बाय किया है। एंड सेल वाले को यह डर था कि प्राइस नीचे ना गिर जाए, इसलिए उसने सेल किया हुआ है 20,000 प्राइस को। अब लेट से 6 महीने बाद क्या हुआ, 6 महीने बाद क्या हुआ, प्राइस जो 20,000 था वो प्राइस क्या हुआ, नीचे आया 10,000 पे। सो करंट मार्केट प्राइस इज 10,000 एंड यहां पर क्या हुआ, कॉन्ट्रैक्ट हमने सेटल किया। क्योंकि मेरे पास आए, मैंने बोला भाई देखो अब तो 6 महीने हो गए, ये डेट हो गई, अब हम इसको सेटल करते हैं। सी फॉरवर्ड कॉन्ट्रैक्ट्स में इनिशियली हम कुछ भी पे नहीं करते हैं, तो इनिशियली कुछ पे ही नहीं करते हैं तो कैलकुलेशन काय का करेंगे, कहीं का नहीं करेंगे, बस एग्रीमेंट साइन करेंगे, राइट। एग्रीमेंट हम साइन करेंगे ये बोल के कि देखो प्राइस अगर नीचे गया तो मैं तुम्हारा जो भी नुकसान होगा देता हूं, एंड अगर प्राइस ऊपर गया तो जो भी तुम्हारा फायदा होगा तो मैं तुम्हें वो दे देता हूं। तो दिस इज व्हाट ये टर्म्स के साथ आपने कॉन्ट्रैक्ट साइन किया। अब कैलकुलेट करो बेनिफिट की। ये कंपनी के ओनर है जिसने बाय किया था, राइट। ये किसान भाई साहब है, इन्होंने सेल किया था। अब देखो जब 20,000 प्राइस थी तो उसको उसने सेल किया था, एंड जब मार्केट में अभी 10,000 प्राइस है तो इसमें वो क्या करेगा, वो बाय करेगा। बाय करेगा मतलब टू कवर सेल करना मतलब मैंने बेचा है तो मुझे कभी ना कभी उसको खरीदना भी पड़ेगा ना, इसको बोलते रिवर्स पोजीशन करना। अब सवाल ये होगा कि सर रिवर्स पोजीशन हम क्यों करेंगे, रिवर्स पोजीशन इसलिए करेंगे ताकि ये ट्रेड क्लोज करने के लिए, नहीं तो आपको आपका प्रॉफिट ही नहीं मिलेगा अगर आप क्लोज नहीं करोगे तो आपने बाय किया 20,000 को, आपको सेल करना, सेल किया आपने 20,000 को, आपको बाय करना पड़ेगा 10,000 को। तो इसका मतलब क्या हुआ, राइट, आपका प्रॉफिट कितना हो जाएगा, 10,000 का प्रॉफिट हो जाएगा। मान के चलो आपके पास 10 क्विंटल है तो 10 इंटू अगर आप 10,000 करते हो तो आपका नेट नेट प्रॉफिट कितना होगा, 1 लाख का होगा। क्वेश्चन है कि सर ये प्रॉफिट मुझे देगा कौन, भाई ये भाई साहब है ना, इन्होंने बाय किया था 20,000 को, राइट। इनको लगा कि ये प्राइस 20,000 का 30,000 का हो जाएगा, तब जाके इनको वही फायदा होगा, लेकिन वैसे हुआ नहीं। तो 20,000 जो भी प्राइस थी उसमें से नीचे आई है, तो इन्होंने क्या किया था, बाय किया था इस प्राइस पे, बाय इस प्राइस पे किया था, तो ये भाई साहब क्या करेंगे, सेल करेंगे 10,000 को। अब आप जरा सोचिए प्रैक्टिकली, आपने कोई चीज 20,000 को खरीदी है एंड आप बेच रहे हो 10,000 को, तो आपका नुकसान कितना हो जाएगा, जरा सोचिए। आपका नुकसान होगा 10,000 का, अगर क्वांटिटीज 10 है, सो 10 इंटू क्विंटल्स अगर 10 है, 10 इंटू आप करिए इतना, तो लॉस कितना हो गया आपका, 1 लाख का लॉस हो गया। तो ये लॉस जो आपका है कंपनी का ओनर, ये जो लॉस मतलब ये देने वाला है पैसा, किसको देने वाला है, किसान को, किसान लेने वाला है। फायदा किसका हुआ, कम ऑन, फायदा किसका हुआ गाइस, किसान का फायदा हुआ। कितना हुआ, 1 लाख का फायदा हुआ। अब इन रियलिटी में ये कैसे काम करता है वो मैं बताता हूं। किसान इसको नहीं बेचता है कुछ भी। हाँ, इनके बीच अगर कॉन्ट्रैक्ट है वैसा तो ही ये बेचेगा इस प्राइस को, क्योंकि इसको इसको इवेंचुअली खरीदना ही पड़ेगा, राइट। तो ये इवेंचुअली वैसे होगा, लेकिन ऑन द ग्राउंड ये सिर्फ एक दूसरे को पैसा देते हैं, कोई गुड्स एक दूसरे से खरीदेगा नहीं। किसान क्या करेगा, एक्चुअली मार्केट में, ओपन मार्केट में जाके ही खरीदे बेचेगा ये माल जो भी है, या फिर खरीदेगा। बट ऑन द ग्राउंड इन द सिस्टम लाइक ब्रोकिंग सिस्टम, ये सिर्फ जो प्राइस का जो डिफरेंस है ना वही सेटल करेंगे। ये क्या करेंगे, वही सेटल करेंगे। तो ये होगा तुम्हारा फॉरवर्ड कॉन्ट्रैक्ट्स। यानी कि फॉरवर्ड कॉन्ट्रैक्ट्स का मतलब क्या है, फॉरवर्ड मतलब हम भविष्य में जाके सेटल करेंगे जब हमारी कमोडिटी रेडी होगी, या फिर हम दोनों काउंटर पार्टी जब रेडी है टू सेटल द कॉन्ट्रैक्ट्स तब जाके सेटल करेंगे। उसको कहते हैं फॉरवर्ड कॉन्ट्रैक्ट्स, उसको कहते हैं फॉरवर्ड कॉन्ट्रैक्ट्स। अब मैं जाता हूं फ्यूचर की तरफ। अगर मान के चलो यही ड्यूरेशन, आपको ये श्योरिटी है कि आपका क्रॉप 1 महीने में रेडी होने वाला है, लेकिन अभी प्राइस बहुत अच्छी है, आपको लग रहा है कि यार ये प्राइस डाउन हो सकता है, तो आपको फॉरवर्ड की बजाय फ्यूचर में जाना पड़ेगा, फ्यूचर में आपको सेल करना पड़ेगा। यानी कि फ्यूचर मतलब वो लिस्टेड है स्टॉक एक्सचेंज पे, इसलिए उसको हम फ्यूचर कह रहे हैं, क्योंकि फॉरवर्ड्स लिस्टेड नहीं है। उसके लिए आपको, जैसे मैंने कहा ना कि गांव में जाके देखना पड़ेगा, अगर कोई ऐसा डीलर है तो उनके साथ जाके कॉन्ट्रैक्ट करना पड़ेगा, वो फॉरवर्ड है। वही कॉन्ट्रैक्ट अगर आपको अवेलेबल है नेशनल स्टॉक एक्सचेंज पे या फिर बीएसई पे, तो वो हो जाता है आपका लिस्टेड कॉन्ट्रैक्ट्स, तो उसको हम कहेंगे फ्यूचर। लेकिन फ्यूचर हो या फॉरवर्ड हो, दोनों एक ही तरीके से काम करते हैं। नाउ ये क्वेश्चन होगा कि सर फ्यूचर और फॉरवर्ड में बिग डिफरेंस क्या है। फ्यूचर एंड फॉरवर्ड में जो डिफरेंस है वो सिर्फ मार्जिन का है। फॉरवर्ड कॉन्ट्रैक्ट में हम बिगिनिंग में कुछ भी नहीं पे करते हैं, लेकिन फ्यूचर में टू कंट्रोल द रिस्क हम इनिशियली कुछ ना कुछ अमाउंट पे करनी पड़ेगी। इस किसान को भी पे करनी पड़ेगी एंड इस भाई साहब को भी पे करनी पड़ेगी, उसको कहते हैं मार्जिन। सो इट मींस फ्यूचर में हम मार्जिन पे करते हैं, उतना ही डिफरेंस है। एंड उसके अलावा तुम्हारा फ्यूचर जो है बस लिस्टेड है स्टॉक एक्सचेंज पे एंड मंथली एक्सपायरी है। फॉरवर्ड की एक्सपायरी का कोई ठिकाना नहीं होता है। अगर आपको 6 महीने का चाहिए तो 6 महीने का साइन करो, 1 महीने का चाहिए तो 1 महीने का करो, 1 दिन का चाहिए तो 1 दिन का करो, 1 घंटे का चाहिए तो 1 घंटे का करो। दिस इज हाउ थिंग्स वर्क्स। नाउ लेट मी नो क्या क्वेश्चन है आपका फॉरवर्ड में और फ्यूचर में। सेम तरीके से काम करता है। कम ऑन, एनी क्वेश्चन भाई, आंसर तो करो। अब जाते हैं फ्यूचर की भी मैंने बात करी कि फ्यूचर के लिए स्टॉक एक्सचेंज पे ही जाके आपको बाय सेल करना पड़ेगा, लेकिन ये आपके ऊपर है। सेम एग्जांपल अगर मैं अभी ऑप्शंस के साथ लगाऊं, सेम एग्जांपल अगर मान के चलो आपके पास सिर्फ 1 वीक का ही समय है और आपको लग रहा है कि अभी बेहतर प्राइस है, 1 वीक में प्राइस गिर जाएगा, 1 वीक का ही डिफरेंस अगर है, तो आपको फॉरवर्ड और फ्यूचर में क्यों जाना है? क्योंकि फॉरवर्ड में तो भाई लीगल कॉस्ट और बाकी सारे डॉक्यूमेंट्स वगैरह होंगे तो बहुत ज्यादा खर्चा आएगा, और उसके लिए आपको मार्केट में जाके पर्सनली ढूंढना पड़ेगा, बहुत समय लगेगा, तो मैं फॉरवर्ड तो नहीं करूंगा, राइट। फिर उसके बाद फ्यूचर की बात करते हैं। फ्यूचर में मुझे अगर मार्केट में प्राइस 20,000 है तो मतलब मुझे मिनिमम 10% तो मार्जिन देना पड़ेगा। यानी कि 2,000 इंटू 10 क्विंटल की अगर मैं बात करूं तो मुझे 20,000 का तो मार्जिन देना पड़ेगा। मान के चलो मेरे पास तो 20,000 है ही नहीं है, तो मैं फ्यूचर कैसे साइन कर लूं? तो मेरे पास ऑप्शन क्या बचता है? देखो, मेरे पास समय कम है, पैसा भी कम है, तो मैं किस में जाऊंगा? फिर मैं ऑप्शन में जाऊंगा। सेम एग्जांपल एज इट इज जाके बस आपको ऑप्शन में फिट करना है, दैट्स ऑल। क्यों? क्योंकि मेरे पास पैसा कम है, मेरे पास समय भी कम है, क्योंकि मुझे 7 दिन का ही सोच रहा हूं मैं। और जब मैं 7 दिन का सोच रहा हूं तो इसका मतलब क्या है कि मैं सिर्फ ऑप्शन का प्रीमियम पे करने वाला हूं। तो इसका मतलब क्या हुआ? अगर मैं आपको यह कहूं बस आपको 2,000 रुपए, 20,000 की जगह आपको बस 2,000 रुपए देना है, दैट्स ऑल। 2,000 रुपए आपको खर्च करने हैं। 2,000 रुपए आपको खर्च इसलिए करने हैं ताकि आपको 1,00,000 रुपए का प्रॉफिट हो सकता है। तो क्या आप 2,000 रुपए खर्च नहीं करोगे? कम ऑन। Yes, it's not like a insurance, but you can treat like a insurance. You can treat like a insurance. अगर मैं आपको ये कह रहा हूं, देखो अगर गड़बड़ हो गई, मार्केट नीचे गिर गया, तो आपको 1 लाख रुपए तक का प्रॉफिट हो सकता है। बट उसके लिए आपको क्या करना है, सिर्फ 2,000 रुपए का इंश्योरेंस लेना है, प्रीमियम। तो क्या आप नहीं लोगे? अगर आप मुझे पूछोगे तो मैं लूंगा, अगर मैं ज्यादा कंसर्न हूं तो मैं लूंगा भाई। क्यों नहीं लूंगा? 7 दिन के लिए 2,000 रुपए ठीक है ना, खर्च कर लो। तो मैं पे कर लूंगा 2,000 रुपए एंड वेट कर लूंगा। अगर सच में मार्केट गिर जाता है तो मुझे मेरा प्रीमियम भी मिल जाएगा और प्रॉफिट जो है वो भी मिल जाएगा, तो मैं तो प्रॉफिट में रहूंगा। अब सवाल ये आता है कि सर व्हाट इफ मैंने 2,000 रुपए पे करे और मार्केट में क्या हुआ, मार्केट में प्राइस गिरने की जगह प्राइस मान के चलो अभी ये 30,000 पे गया। देखो प्राइस 30 पे जाए या 3 लाख पे जाए, अगर मैंने ऑप्शन लिया है ना, मेरा नुकसान तो सिर्फ 2,000 रुपए का है, दैट्स ऑल। मुझे कोई लेना देना नहीं है। मुझे कितना पे करना है? 2,000। आई पे 2,000। माई मैक्सिमम लॉस वुड बी ओनली 2,000, क्योंकि मैंने तो इंश्योरेंस लिया हुआ है, मैंने तो प्रीमियम लिया हुआ है भाई। 2,000 ही रुपए मैंने पे करे हैं। मेरा मैक्सिमम नुकसान 2,000 का है। प्राइस 40,000 लाख का भी हो जाए, मुझे कोई लेना देना नहीं उस चीज से। मेरा नुकसान कितना होगा? 2,000 रुपए का होगा। तो उसको कहते हैं ऑप्शंस। ऑप्शन क्यों जरूरी है? अगर आपका मतलब जो आपका रिस्क कैपेसिटी जो यानी कि पैसा जो है बहुत कम है आपके पास, और आपके पास आप 7-8 दिन के ही लिए सोच रहे हो, तो ऑप्शन इज द बेस्ट थिंग कि भाई आप ले लो। अगर सच में प्राइस गिर जाता है तो आपका फायदा होगा, अगर प्राइस नहीं गिरता है तो आपका नुकसान होगा। ये तय होता है और आपका लॉस भी तय होता है। आपका लॉस प्री डिफाइंड होता है। ये किसान अगर लेता है मान के चलो और मार्केट नहीं गिरता है, मार्केट अगर ऊपर जाता है, तो इस भाई साहब का लॉस अगर ऑप्शंस में 2,000 रुपए का होगा ही होगा, क्योंकि इंश्योरेंस की तरह है। जरा आप जरा सोचो, आंखें बंद कर लो 1 मिनट के लिए, सोचो क्या हम ये क्या हम ये स्टॉक मार्केट की जगह नॉर्मल इस पे नहीं करते हैं? करते हैं। आपके जो डीलर होते हैं जो गुड्स लेते हैं किसान का, वो भी तो वही करते हैं ना। किसान बहुत बार आपने गुड्स ले जाके किसान के इसके डीलर के पास रखता है। अभी मेरे डैड ने ही किया। हमारे पास टर्मरिक का प्रोडक्शन आता है, 40 क्विंटल का कुछ टर्मरिक था। उन्होंने ये सोच के, हम माय डैड वाज एक्सपेक्टिंग कि प्राइस यानी कि लास्ट ईयर 30,000 की कुछ आया था पर क्विंटल के लिए। उन्होंने ये सोचा कि प्राइस इस साल भी वैसा ही जाएगा, और इस साल मार्केट का प्राइस कुछ 18,000 चल रहा था जब हमारा वो हल्दी निकला था खेती के बाहर, टर्मरिक, राइट। और मैंने डैड को बोला भी था, डैड विच इज अ वेरी रिस्की, अगर 18,000 आया है, लास्ट ईयर कुछ अलग सर्कमस्टांसेस थे, अभी कुछ अलग है, जस्ट सेल इट आउट यार, डोंट होल्ड इट। उन्होंने कहा नहीं नहीं, विल वेट, डोंट वरी, देखेंगे प्राइस ऊपर जाएगा। प्राइस ऊपर नहीं गया, प्राइस एक्चुअली नीचे आया, और उनको अभी 13,000 या 12,000 का कुछ प्राइस मिला है। यानी कि तब अगर वो बेचते तो उनको 18,000 का प्राइस मिल रहा था, अब उन्होंने बेचा है तो उनको सिर्फ 12,000 का मिला है। तो मेरे डैड का इसमें नुकसान कितने का हुआ? कम ऑन, कितने का हुआ? 6,000 का हुआ पर क्विंटल, राइट। अभी उन्होंने 12,000 पर क्विंटल से बेचा है। अगर वो 6 महीने पहले बेचते तो 18,000 रुपए का भाव लगता उनको मार्केट से। अब अगर मान के चलो, अगर आप एक स्मार्ट फार्मर हो, तो आपने क्या किया होता इस चीज को? मैंने तो भाई इमीडिएटली जाके जो भी डीलर है ना, डीलर, उसको मिलके कॉन्ट्रैक्ट साइन करता है कि भाई देख, अभी जो मार्केट में प्राइस चल रहा है 18 का चल रहा है, और मुझे इस प्राइस से बेचना है, लेकिन मेरी कंडीशन ये है, राइट, अगर अगर मान के चलो प्राइस गिरी तो मुझे 18,000 ही आप दे दोगे। मुझे नहीं पता कि अगर कल जीरो भी हो जाती है तो भी मुझे कोई फर्क नहीं पड़ता, मुझे तो बस 18,000 तुमसे चाहिए। हाँ, अगर मान के चलो प्राइस अगर ऊपर जाती है तो मैं उसके लिए जिम्मेदार नहीं हूं, मैं डायरेक्टली आपको 18,000 से सेल कर देता हूं, आप 50,000 को बेच दीजिए मार्केट में जाके, मुझे कोई लेना देना नहीं, मैं अपने गुड्स छोड़ दूंगा। लेकिन उसके बदले में अभी वो सामने वाला ऐसे कॉन्ट्रैक्ट साइन क्यों करेगा भाई? वो नहीं करेगा। तो मुझे उसके लिए प्रीमियम देना पड़ेगा उसको, भाई देख एक काम कर, मैं तुझे 5,000 रुपए दे देता हूं, इसके बदले में मुझे इंश्योरेंस दे दे। अगर प्राइस गिरी 18,000 के नीचे तो मुझे कोई लेना देना नहीं है, मुझे बस 18,000 से आपको बेचना है, मैं 18,000 से बेच के निकल जाऊंगा। अगर बड़ी प्राइस तो उसके लिए तो भाई देखो, बड़ी तो भाई उसका तो डीलर का प्रॉफिट है वो, करेक्ट। तो दिस इज हाउ कैलकुलेशन वर्क्स गाइस। ये हर जगह पर होता है। हाँ, बस फर्क इतना है कि कि स्टॉक मार्केट में ना फलाना ढिमकाना करके एक्सपायरी ये वो बहुत सारी टेक्निकल चीजें डाल दी है और कॉम्प्लेक्स बनाया है ताकि वो थोड़ा सा टेक्निकली लगे, साउंड लगे. दैट्स व्हाट. ऑलराइट.
Just a quick info, guys. Intellipaat offers investment banking course training. Through this course, you will learn time management, project leadership, financial expertise, leadership abilities, valuation, and much more from the top 1% of industry experts around the world. With this course, we have already helped thousands of professionals in successful career transitions. You can check out the testimonials on our Achievers channel, the link of which is given in the description below. Without a doubt, this course can set your career to new heights. So visit this course page link given in the description below and take the first step towards your career growth in the field of investment banking.
Yes, no. You can text in chat, okay? This swap is a very beautiful instrument, I would say, because widely used for cash flow exchange. All right. So let's discuss about first swaps. Swaps comes under your the derivatives. So when we say swaps, it means, guys, it's an exchange, okay? Swaps means exchange. So what we can exchange? We can exchange anything. We can exchange anything. Anything means anything. Now a question would be like, what do you mean exactly anything? So you can exchange your risk, right? You can exchange return. You can exchange commodities. You can exchange currencies. So you can exchange anything means anything. All right. So to understand the swaps contract, so I would like to go in basic first, so that we can have a detailed discussion. Side by side, I would request you to please note it down. Okay. So because most of the time we also use this blackboard and all. So you can note it down from your side. See, if we talk about swaps, as we know, swaps means it's exchange of anything. You can exchange anything means anything. So let's say you are in US, okay, or let's say you are in India, and there is one more person which is in US, and this guy in India, okay, B. See, this guy is looking for INR. Why, sir, INR? Let's say this guy is looking for 8,000 INR, 8,000 rupees in India, looking for cash in India. Okay. Now your question would be like, so if this guy is looking for a cash in India, why this guy is not applying for a loan in India? See, as a foreign investor, let's say if you're a buyer, let's say if you're an investor and if you want to raise loans in India, or if you want to apply for loans in India, you can't. All right. Same way as Indians, if you go to US and apply for loans, you cannot apply unless and until you don't have any job, or maybe if you don't have any assets in US, because loan is the business kind of if you don't have assets, you can't apply for loans. And as a foreign investor, which is strictly prohibited to apply for loans in India, or same in every country. I have seen across all jurisdictions, they have a similar sort of regulations. All right. So it means you can't apply for loans in India directly. Okay. So same applies to the person who is in India, but this guy is looking for, let's say, looking for 100 USD, 100 USD looking for USD in US. Now let's talk about their background. Let's say this guy is merchant, okay, and this guy is, let's say, again, businessman. See, common people, they don't sign any swap contract as such, because it is beyond their I would say it is not something for them. The reason is, as a common people, we don't swipe anything, we don't exchange anything at international level. So the swaps or forwards, basically it is not for you. But businessmen's companies or any international companies and all, See, they always sign a forward contract. So why they sign a forward contract? The reason is very simple, guys. Let's say, what if you have any deal which you want to settle in US and you're a businessman, but that guy is asking to settle the deal in USD only. So how will you settle it? As I said, you can't apply for even loans as well in US. So it means, so what you can do, you can ask someone to swipe currency with you, right? So, and same way, if the same person is also looking for your currency in India, then you can hand over your currency to that particular counterpart in India, and same person will arrange the USD currency for you in US. It's kind of a hawala, right? In hawala, what happened? So other parties, they always provide the cash at a different locations, correct? So this forward is the standard or more organized example of hawala, I would say, because here we sign documents and we know the counterparty that who is going to receive, who is going to pay. That's what we can't say this officially as a hawala, but this forward contract is kind of the another, I would say, the legal version of hawala only, because in hawala counterparty name should be like unknown until you settle the funds. All right, if you want to, let's say, transfer 1,000 crores from Maharashtra to, let's say, Delhi. All right, so until you let's say reach to the Delhi, the counterparty name would be like unknown. Counterparty, it means that is that the party who is, or beneficiary name who is going to receive that payment, right? So you can just send the payment through maybe different ways, and that party will accept the payments, and it is their job. But see, eventually in forward contracts, we sign the all legal papers, we signed everything. So that would be your basically legal agreement, proper legal agreement. So let's go ahead further. Let's say this guy is looking for a currency. The duration is 1 year. Again, this duration is 1 year. Let's say the cycle is for 12 months. On January 1st, the cycle of this contract is January to December. On 1st of December, both the parties, they, let's say, reach out to the broker, and broker, let's say, facilitated them to arrange this particular money and everything, and they decided to exchange it. Okay. So here the important point is, at the time of initiation, what will happen? There are two aspects. One is, if this businessman, let's say, if he or she has their own money, they can exchange it. But what if this guy, let's say, has no USD money as well, but he's holding an assets? All right. So in case of that, then this guy will apply for a USD loan, correct? USD loan. If you just convert 8,000 into this 100 USD, then you will have to check the FX rate. FX rate. And let's say the FX rate, we are just assuming it for a 1 USD, the rate is like 80 rupees. And same for a currency, if you just calculate for 80 rupees, the dollar value is 1 USD. Okay. So this is your rate. So now the important is, this guy can apply for a loan with the bank, let's say Bank of America. And Bank of America can charge interest payment, 1%, 2%, 3%, whatever it is. Same condition applies to this party as well. This party can apply for a loan, let's say with 10%. And the bank name is HDFC. Let's say this guy applied for a loan, HDFC disbursed how much? 8,000 rupees. This guy is ready to pay 10% interest for per annum. And this guy is also ready to pay, let's say, 7% interest payment for per annum. This is a contract. Okay. So when the contract initiated, what happened? Bank transfer money, which is 100 USD to this holder A, and then A will transfer 100 USD, right? 100 USD to B, and this guy, let's say, the B will transfer again 8,000 rupees to this guy A, and then your contract will be initiated. Contract will be initiated. Now look for a exchange, guys. What they have exchanged against 100 USD, right? 8,000 rupees, which has been exchanged at the rate of 1:80. All right. But anyways, this rate doesn't affect on your, the exchange. All right. This never affect. The reason is whatsoever it is, because ultimately parties are responsible for a notional amount. Notional amount, it means this principal amount. In this case, if we talk about the principal amount is 8,100. Okay. Because for Indian investor, principal amount is 8,000 rupees. And for a US, let's say, investor, the principal amount is 100 rupees. All right. See this, see the contract, contract period is 1 year. And here they have exchanged it. Okay. So when they exchange it, you can see like this, minus 100 plus, 100 in the books of this A. Will create a separate book, USD party. So minus 100 USD plus 8,000 rupees. All right. In the book of this foreigner. And if we talk about, let's say, India, so this guy will maintain like 100 USD minus 8,000, because this paid it, received it, right, for a 1 year. Let's say this is at the time of initiation. See what will happen now at the time of settlement. At the time of settlement, let's assume it. The FX rate, it was like 1:80 at the time of initiation, but at the time of settlement, so let's say rate gone up like 1:83. 1:83. Now, at the time of settlement, what will happen? This guy again will pay 100 USD. Correct? Will pay 100 USD and will receive 8,000 rupees. Because this, even if the rate changes, it won't affect on the actual amount, right? And in the books of this foreigner, this guy will receive 100 USD and this guy will pay again 8,000 INR. See, this was just the settlement between parties, right? But what about the bank settlement? Bank settlement. Now this guy will transfer money to the bank, right? How much money will receive to the bank? 8,000 directly, right? 8,000. Along with that, here if you see, it was a loan taken from the bank, right? And 8% interest payment, which is 800. Bank will receive this. Okay. And same for here as well. This guy will transfer 100 USD plus 7% in an interest payment. It was there, right? So plus 7. So total $107 will receive to this bank. And then finally, they'll announce contract settlement. So this is how in a reality, when we settle the contracts, this type of framework you can see. We'll call it as a reverse positioning as well, because eventually, if you see, we have only transfer cash and we have received also cash. There is no interest involved in this particular transactions. No party is asking to pay interest payment. It's just a plain, change the currency. It's just to change the currency for 1 year, and same, other party also will. So it means, guys, let's say your friend has USD and you have a INR. So you and your friend can exchange, you can exchange your INR to your friends, and your friends will exchange his dollar to you. So you can, exchange that for maybe 1 year, and after that, as it is, you can transfer money back to each other, right? So this is how your currency swap works. Now your question would be, look, sir, why currency swap is important? See, if you are a businessman, let's talk about, some facts, which is a very important one. Let's say you have decided to settle your business in US. How will you apply for a loan? You tell me. Just think for a while. Or let's say you have some vendor in US. So how will you manage that transaction? Or let's say vice versa. You are like, let's say you are foreigner, right? And you have decided to establish your, let's say, you have decided to establish your own business in India. So how will you start? What do you think? USD will work in India? No, right? What about your INR? Will INR work in India? Will INR, work in US? No, it will not. Means you can't buy anything. See, your paper currency has a limitations. Okay, your paper currency has limitations, so you can't buy everything in US or even anything also. Same with the dollars as well. If you have a dollar, so pay the dollar to the auto driver, pay the dollar to the, let's say, restaurant owner, pay the driver to the builders. See, if they are aware about it, if they're educated, maybe they'll accept the payment in dollar and they'll deposit the dollar with the bank. But ultimately, you need a rupees only, because paper currency has a limitations. Okay, every currency has a limitations. Now, if you ask me, sir, is there anything, that let's say currency has no limitation? Yes, the Bitcoin has no limitations, or even most of the cryptocurrencies, they don't have any limitation as such. It trades anywhere or any corner of the world, or everywhere in the world, I would say, cryptocurrencies. And that's what most of the real estate businessmen or the other businessmen in India also. I have seen a couple of the people, they reach out to me. They wanted payment in USDC, which is a crypto coin. They wanted payment in Bitcoin. So why Bitcoin? Because they can easily swipe their currencies in any country, anywhere in the world. Because through traditional system, it is very difficult to exchange the currencies, find the agent, like, kind of this swiping and all. And what if, let's say, if you don't have an agent, then who will swipe it? Of course, in that case, then, you can approach to the Reserve Bank of India or Central Bank of US as well. So they can exchange the currencies, because central banks, they work as a swap agent. So you can exchange, any foreign currencies with them directly. That's the another story. All right. But easily, if you want, and again, if you directly approach to the central bank, their process would be difficult, right? They'll ask you several papers, your KYC documents, your business documents, your transaction documents, and they will have limitations. At a time, only you can deal in $2 lakhs. What if I want to deal in millions of, or let's say billions of dollars? So how I can deal with that? Now you tell me. So it will not, right? It will difficult for you to deal, correct? Let's say, let's take an example of Tesla want to start their manufacturing unit in India, but they don't have a cash available in India, right? They have a cash available in dollar. So how they'll exchange it? And to understand that, the swap, currency swap is the example where they directly, through their connections, they reach out to the people, and what they, do. Let's take Adani. If Adani has a good rapport in Indian market, Adani can apply for loans in India and ask government to pay, let's say, 10,000 crores. Okay. And same 10,000 crores, Adani can transfer to the Tesla owner, which is Elon Musk. Then Elon Musk can also do the same thing in US. Elon Musk can arrange the, let's say, same the dollars with the worth of rupees 10,000 crores. It could be around, let's say, 800 crores somewhere. So that 800 crores dollars that Elon Musk can transfer to the Adani in US. So both can, they can maybe access that currency, reinvest it, invest it, depends on the businessman's, the business goals or objectives. Then accordingly, they can execute the contract. Because if you just invite bank to be a member of it or member of your transactions, then you can see lots of scrutiny checks, and it will take again longer time than the expected, and then as a businessman it is very difficult. So that's what your currency swaps, which is one of the widely used tools. Even your Indian government, state governments, I have seen lots of cases where they sign swap contracts. If you talk about, let's say, Japan and the India for a monorail project, India and Japan both have signed the swap currency swaps, where this Japan government will disburse the funding to the government with no interest rate cost. Now your question would be like, sir, why is there no interest rate cost? The reason is, guys, there was zero interest rate in Japan. Not even governments, but the most of the US investors, what they did, they just signed the currency swaps with Japanese government or Japanese banks. They apply for loans in Japan. They took a loans from the Japan and invest in Indian market on return, and again withdraw that amount and return that as it is money back to the bank, because there was a zero interest rate in Japan. There was a zero interest rate. So most of the investors, they did this. I have seen because I worked with hedge funds, so I know it. Trillions of Japanese, and they just applied for loans, took a loans from a bank and invested in Indian market, or Indian, or I would say in different markets. Even few businessmen also, which I know it, they did the same thing through their, one of my investors from Kerala, what he did, he has good connections in Taiwan and even Japan as well. Through Japanese, he asked them to apply for a loan with a bank like Bank of Japan, and settle that Japanese loan in India through a foreign exchange route, and they did it. Only he had to pay transaction cost to the government of India and received fund. And now that same fund, this guy invested in real estate, right? So now let's say if I use 10 billion Japanese in India for 10 years, still, see, you just need to pay $10 billion back to the in a Bank of Japan. So you don't need to pay any interest payment at all. So it means there is no cost involved in the loan. You just need to transfer as it is, Japanese into them. And it's a better deal, right? So this is how you can sign the swap contracts. So that's what I said. The swap contract is not a tool for common people. But let me tell you something interesting. Let's say if you have your brother or someone in, let's say US, UK, and if they're working, when they deposit money with the bank, means let's say every month they transfer some amount to their parents, right? So what they do, they deposit the amount in US bank, then US bank settle that payment with the Indian bank, and then Indian bank finally send you the notification that money has been debited. I'm working with one of the international fund, and they settle my salary in USD every month. But again, I can't accept salary in USD, correct? So I ask them to deposit that salary with my bank, and my bank convert, dollars into INR, and then finally I receive INR in my account. But again, that also comes under your swap contracts only, currency swaps, because here we are swiping a currency with other currencies. So any questions so far, guys? This was the example of currency swaps. Come on, any question? I'll give you 10 seconds to think over. You can text in chat. If there are no questions, then say it simply no questions. That's fine. I'm not forcing you to ask any questions, but if you have, you can ask. And if there are no questions, you say it, no questions are all good. All right. So this was the example of currency swaps. So now let's talk about interest rate swaps. Okay. Interest rate swaps. So it means here we are talking about interest. So now your question would be like, sir, how we can exchange, the interest rate, or how you can swap that interest rate? Yes, you can do it. If you are smart, If you know how to manage your interest payments and all, you can easily deal with that. But first understand this, guys, why derivatives come into picture. Okay, derivatives come into picture because of differences in price and differences in, let's say, rates, or differences in the risk parameter. And that's why we always look for a something which can help us to maybe generate some return or to make some money out of it. How? Let's say we have a stock. Okay, we have a stock. You have buy it at 100. Again, same stock, you have sell it at, let's say, 100. Right? So there is no opportunity to make money, correct? No profit, no profit, no loss. No loss. So in that case, we cannot expect any derivatives. Even if you try to derive the value, but eventually there is no change in the price. Right? There is no change in the price. Same example, if I talk about, let's say, in other way, we have buy it at 100, and if, let's say, sell it out the same security at 1110. So here you can see the opportunity of profit of 10 rupees. And that's how your derivatives come into picture. Because this, if you just buy it at 10 and you can sell it out, 100, and if you just sell it out same security, maybe at 110 or maybe more than that, you will get some benefit. And that's when derivatives come into picture. Because derivatives help you to buy the same stocks in bulk or quantities. You can pay just minimum amount, hold, let's say, quantities in large, and you can make more money. Right? So it means if there are no differences in price, then you don't need to even trade in that particular securities. Not only buy and sell, but even you don't need to look for any derivatives opportunity as well. Because derivatives is all about differences in price. Derivatives is all about differences in price. Or even if I ask this question to you, why we buy securities? Why we buy? Right? Let's say there is a business. If we invest 1 crore today, then after 10 years also you'll get only 1 crore. Will you invest? Come on, will you invest? I'm sure no. Let's say there is a business. If you invest 1 crore, after 10 years, your money will be, let's say, 10 crores. Will you invest? Of course, you will invest. Why? Because you are seeing an opportunity to multiply your wealth. Correct? Am I right? So you're seeing an opportunity, and that's when your derivatives come into picture. If you have any opportunity like this where you can multiply your money, then instead of 1 crore, why don't you buy, let's say, same assets with worth of rupees 100 crore? Buy it and wait for 10 years then. If 10 years becomes, let's say, your 1,000 crores, then you can make more and more money. So this is how your derivatives come into picture. So same logic applies to the now interest rate as well. So let's discuss about it. How businessmen, or let's say even common people also, they can, but again, this interest rate swap is not available for common people. It is available for businessmen only. So how businessmen, they can, let's say, take advantage of this particular interest rate swaps? Let's discuss. If we talk about, let me just start it out, interest rate swaps, A businessman, B businessman, but here the again condition is both are from same country. For interest rate swaps, so condition is both are from same country. All right. Let's say both people, they have taken a loan. Both are businessmen. They have taken a loan of 1 lakh rupees. This guy, condition is like this guy is paying fixed interest rate, which is 10% per annum. And this guy is paying, let's say, variable interest rate, which is 12%. See, variable interest rate is linked with the RBI. When RBI announce interest rates, This rate continuously it will change. Fixed, it means it's a fixed for, let's say the loan maturity is 1 year, right? So for entire 1 year, interest payment would be 10%. But if we talk about variables, every quarter, rate changes because RBI and their team, they connect and announce new interest rate. So new interest rate will be applied in case, when you have, let's say, loan obligations under variable interest payments. Correct. So let's take an example. We have, let's say, A and B. A is a businessman, which is a builder, right? Applied for a loan and loan received with 10% in a fixed interest rate. And if we talk about this, let's say A guy is again businessman and paying interest rate on loan, which is around 12%. See, if you want to sign any derivatives contract, first the condition is you should have something, assumption in your mind. If you don't have any assumption in your mind, then you are not a fit for a derivative contract. Assumption, it could be this guy B is worried about fixed interest payment, which is a 10%. If you compare this 10% with the variable one, of course, this guy, let's say this guy is at a better position, correct? Because variable wala person is paying almost 12%, it means 2% extra. 2% extra interest payment that the variable interest payment guy is paying to the bank. All right, on this amount. So this amount, we'll call it as a notional amount or principal amount in interest rate swaps. Let's go ahead. So if we talk about now, let's say, if the first assumption is they don't sign swap contract, interest rate swaps contracts, how the condition would be at the end of the, let's say, year, because the loan maturity is 1 year. If we just calculate the benefit, this guy, let's say, had taken loans from ICICI Bank, and this one is from Axis. See, the payout this guy will pay to the bank is 1 lakh into 12. So 12,000 for interest payment and principal amount, which is 1 lakh. So this guy will pay it, right, without swap contract. And same if I talk about this B1, B will pay 1 lakh into 10% divided by 100, which is 10,000 plus 1 lakh principal amount. So this amounts will receive to the bank, ICICI Bank, at the end of the maturity. All right. This was just a plain one where they don't have signed any, let's say, exchange contract. But if they sign exchange contract, what will happen? See, this interest payment, let's say assumption is now, the second assumption is they have already initiated the contracts because this guy was worried about, variable and this A was worried about fixed. The reason is eventually this guy was looking for a variable and this was looking for a fixed. Now your question would be like, sir, if the interest rate is high like this, why this guy will look for a variable? See, the assumption would be maybe what if, let's say, now we have an inflation, that's what the interest rate are higher side. But maybe next quarter, interest rate can also reduce. See, RBI can announce, reduction in interest rate as well. So at that time, interest rate will reduce and then reduce interest rate. What if, let's say, if that interest rate reduce and which come down at, let's say, 10% or maybe 9%. What if this happened? Then ultimately, this guy would be in profit, right? Because this is a fixed one and to pay the interest payment throughout the year like fixed, which is something, difficult, correct? And that's when this guy is looking for a fixed interest payment. And again, let me tell you something. If the fixed interest rate is 10% and again, variable interest rate is also 10%. So it means in that case, you don't need to sign any swap contracts. If the both interest rates are in the same line, variable and fixed, then we cannot find any opportunity to make some, arbitrage or benefits. So to make some profit or make some, let's say, revenue out of it, there should be, differences in interest payments or interest rates, like fixed and variable, then only we can look for interest rate swaps. Otherwise, we don't sign any interest rate swaps. Are you clear on this? We don't sign it. There is no difference. So here in this case, we have a difference. And as I said, this guy is looking for a variable, this guy is looking for a fixed, and they decided to enter in the contract. So this one is your duration 1 year. Here what happened? Contract initiated B A. Initially they don't pay anything, no payment required. Just sign the contract on paper. So they just sign the contract on paper. They don't need to pay anything, any value to anyone. It's just a plain contract that they'll sign, because the contract duration is 1 year. And in contract, they include the term, which is notional amount, fixed leg, F leg, then your duration 1 year, right? They'll include everything. Okay. And they'll appoint one broker as well. So broker will track the flow and everything. So now the one more important thing is here. See, throughout the quarter, every quarter, you might see change in interest payment. One is fixed and one is variable, right? Let's say fixed is 10%, 10%, 10%, 10% for every quarter. And let's say this variable was like 12% for first quarter, then 10% for second quarter, 9% for third quarter, and 8% for fourth quarter. So if you see this 12%, it means here you can see 2% opportunity, here no opportunity, here again 1% opportunity, and here 2% opportunity to gain some or to earn some money. So here see, this guy means B will actually pay fixed interest payment to whom? To A, and A will pay variable interest payment to B throughout the quarter. So every quarter they can calculate the interest payment and exchange with each other. So if we talk about V, chart it out so you'll not get confused. Let B and A. B is paying fixed, but looking for variable. A is paying variable, looking for fixed. All right. Fixed, variable. Okay. Quarter 1, quarter 2, quarter 3, quarter 4. See, this variable originally, this variable is from this guy. And this fixed one is from this one. Originally, the B is paying fixed only, and this A is paying variable. But this guy is looking for a fixed one. And this guy is looking for, B is looking for variable one. So after initiation of a contract, you can just change the side. You can just change the side, because this guy is expecting variable. It means pay variable interest to this guy and pay fixed interest to this guy. Simple. So every, let's see the amount. What was the amount? 1 lakh. So interest payment would be 10,000, 10,000, 10,000, 10,000. So all 10,000, 10,000, 10,000. So 40,000 payout it will receive to A. Okay. And if we calculate the variable, it was 12%, then 10%, 9%, and 8%. Every year there was a change in interest payment, and here only 10. It was fixed. It means only 10, 10, 10. Originally it was a fixed, right? 10, 10, 10, 10, 10. So now if we talk about the calculate the interest payment, here you can say 12,000, 10,000, 9,000, and 8,000. So just total it out. 22, 22, and 8, 30. right? 30 plus 9, 39,000. So there is a difference of 39. See, variable interest, this guy was paying, correct? Already this guy was paying, but after the contract, this variable goes to this one. 39 will goes to the B, and this guy will pay fixed one. So this fixed one goes to the this one, which is 40,000. So instead of sending 40,000 and 39,000, so see, with this example, if you just think 40,000, it might seem easy that we are transferring this 40,000 and 39,000. But if we talk about, let's say, 1 billion, 2 billion, or 1 million, 2 million, 3 million, so that comes with a cost, because banks also charges fees to each transactions if you initiate a payment or if you process a payment. So it's not easy to transfer a payment. So it's a very difficult one. Okay. So instead of transferring full amount, so parties only settle the differences. Parties only settle the differences. So if we talk about this guy, variable guy is responsible for 39,000, which is a pay for him, and 40,000, which is a receive for him, right? So 40,000 will receive, 39,000 will pay. Instead of that, if we just, let's say, settle 1,000 rupees in the books of A, then it would be easy, right? Instead of transferring all the, let's say, interest payment from one account to another, it would be difficult, correct? But instead of that, if I only settled 1,000, would be easy. And 1,000, which is a receivable for him, so which is a benefit. So it's a benefit actually. And same if I talk about, let's say, this guy's payable amount is 40 and receive amount, which is 39. So receive is less, pay is more. So it means for B, it's a loss of 1,000. So total, this B will transfer 1,000 to A. So in this particular business, who lost the money? Of course, B lost the money by 1,000 rupees, and he made a profit out of these transactions of 1,000 rupees. And that 1,000 rupees, A can use to mitigate the risk, which is the interest payment risk. The reason is A was paying 12% interest payment. If we just see this, A was paying 12% variable interest payment, but due to effective hedging, that A made some profit out of this particular swap transactions, which is around 1,000, and that 1,000 A can use to repay the debt of a bank. All right. So just tweak this example in a way. Let's say this transaction size was 100 crore. Now, if you say 100 crore, and if you just calculate all of this interest payments and all, so you can see the difference of 1 CR interest payment. See this 1 CR interest payment. And 1 CR is a very decent amount. All right. With a small amount, if you just think, it might seem okay, which is not interesting. Just we are making 1% or 0.5% interest payment. But if you just increase the value, then you would see difference in millions. And for a big investors or businessmen, even 0.05% interest rate also it matter a lot. If I apply for a loans, let's say with a bank for 100 crores, and the bank, let's say there are two banks. One bank is ready with 10% interest payment, and another one bank is ready with, let's say, 9% interest payment. Of course, I'll go with the 9%, but I'll check other terms as well, because interest rate cannot be a, let's say, only one thing that I can look for. I can also look for a flexibility as well, like which bank is giving me more flexible options to repay. So I'll look for that option also. But even if you talk about, the interest rate, let's say, the one bank is offering 9%, another bank is offering 10%. So now here, if you see the difference there is a difference of 1%, right? Even if I think about 1% interest payment on 100 crore amount, so it would be around somewhere 1 crore. So why should I pay 1 crore extra to the bank now, you tell me? So interest payments, this interest rate swap is nothing but it's, the look for an opportunity, right? As a businessman, you should always look for an opportunity. how opportunities that you have. 100 crore amount, HDFC, Axis. So let's say Axis is charging 9% and this HDFC is charging 10%. So now which one you would prefer? Of course, this one. Why? Because the interest rate is lower than the HDFC, which is 9%. But annually, how much that you can save? Let's calculate it. 9%, 100 crore into. So 9 crore. Total interest payment would be 9 crore. And here, 100 crore into 10% divided by 100 would be around 10 crore. Right. So if you apply for a loan with HDFC Bank, then you will have to pay almost 1 crore extra every year. Correct. And if you just apply for a loans with Axis Bank, then you can save 1 crore at least, the minimum 1 crore that you can save. See, as a businessman, interest rate factor is a very crucial and critical to manage, leverage. See, I always believe that you should not even pay 0.01% interest payment, means interest cost, higher or extra. Because it is a very, to generate an income, it's not an easy process, guys. For a businessman, it's not like a nokari. For a nokari or job, it's just a 10 hours job, all right, or 8 hours job. If you join anywhere, you are just entitled for, ABCD tasks, just manage it and go to your home and sit, relax, right? But for a businessman, it's not an easy process. It's not an easy process to pay the salary of thousands of people on time, to manage the clients, to always look for, expansion of a business, to think about business, 24/7. And businessmen, they're like, even they don't take any leaves and all. So you always look for a sick leave, look for this leave, that leave, papa ki shadi, mummy ki shadi, falana damkana. You will have thousands of things. But for a businessman, no. See, I have not taken single leaves in the last 5 years, to be very honest, because on a weekend I have a session with you. I have other my businesses as well. I'm into also like fund management, real estate. I have other my private clients as well. I'm working with them as a consultant. I'm working with them as a partner. I'm working with them on a different products. We have recently launched one, the fund administration platform in US. So I have a lots of things. I'm managing the investments portfolios as well, and I'm working with startups companies as well as a consultant. So it's very difficult for me to take a leaves for even 1 day or 1 week at the moment. But as a let's say job holder, it is very easy for you to apply for a leaves. I enjoy weekend, even you can apply for a 2 weeks leaves, 3 weeks leaves, and you can enjoy it. It's a very difficult, so that you can understand it. Then to generate the money also, it is a very difficult. So while selecting, the interest rates or interest cost, so always see which one is benefited for you and look for an opportunity. If anyone is offering more, let's say, flexibility with lower interest payments, so you should only look for a lower interest payment, because this affects on your profitability of the business. Did you get this? Any question with this, guys? Interest rate swaps? Yeah, so they appoint the intermediate person. So you don't need to appoint your banker, but you can appoint someone. See, both can make, there are platforms, okay? So there are platforms, swap platforms, exchange platforms. So both can register and submit their quotations, and they can appoint broker as well. So broker will take care of it, everything. Broker maintains swap accounts. So for example, let's take example of Citibank. Citibank work as a swap agent. So you can approach to the Citibank to swap your current, swap your interest rates. You can also check with Morgan Stanley as well, because Morgan Stanley also works, as a swap agent in international markets. I have also seen that Goldman Sachs, JP Morgan, then Wells Fargo, they work as a swap agent. In Indian market, your HDFC Bank work as a swap agent. Then your Axis also work as a swap agent. So you can check with them if you guys are really interested to settle. But with the same banks, you can't do this. So you will have to appoint a bank, or you will have to register yourself that you are looking for interest rate swaps. But as a common man, I don't think so. You would be able to find any someone like good party. But if you have a, let's say, if you now your question would be, look, sir, as a common man, if I want to hedge, then how can I do this? See, if you want to hedge your interest rates, then in that case, you can look for a forward contract with any parties if they're really interested. Okay. And then you can look for, but to swap this, instead of that, the common or popular instrument would be, maybe you can, invest in a, any other instrument like mutual funds or maybe real estate or anywhere to generate more return so that you can, offset it. Because at the individual level, I don't think so any of the instruments will work, and even, they'll not entertain. Because let's say even if you apply for, let's say, 20 lakhs rupees loan, the profit from the contract would be very less, so it would be very difficult in that case. And so always they look for a big contract size. I'm thinking about to build the platform for currency swaps or loan swaps, interest rate swaps, then rent swaps. I'm thinking that I had a meeting with my investors. If I get a funding, then I'll work on it, because the cost of investment, which is cost of development, would be around almost 10 crores. Even if I just consider development cost to build a product and to work on it, and again to marketize that product in the market, so it's almost 5 years journey. One year it will take for a feasibility test, then 1 year again it will take to marketing, promotion, right, at an international level, and then after we can onboard clients. But yeah, so once you onboard the clients, then you can make a huge money. Then you can have a multi-billion-dollar company then. But yeah, so this is how your swaps works. Any questions around this interest rate swaps? So I'll take one more example for IRS, which is total, or you can say TRS, total revenue swaps, how it works. And then maybe we can go through the PPT. On a PPT, you can see more technical terms as well. Which one, Sahil? This interest rate swap. Which one you want me to explain again? Okay. So let's talk about now total revenue swaps, how TRS works. Total revenue swaps. Let's say you have a few properties, okay? A, B, C. Yearly income of this property is 50,000, 20,000, 30,000. All right, it's a rental income. So rental income, we can call it as a revenue as well, okay? It's a revenue from the properties. So total revenue that you have is 1 lakh. But the point here is this 1 lakh is not a fixed, so which is a flexible or variable, I would say. So how it is variable? See, what if, let's say, due to COVID, you don't have any tenants, then property would be vacant. Let's say, you are not able to get the strong tenant. So it means the retail people, they are just, signing 1 month, 2 months contract. So it means continuously you are seeing, after 1 or 2 months, your property is vacant, right? Your property vacancy rate is high. If the property vacancy rate is high, then it would be very difficult for a businessman to, do some financial planning with this. Are you getting my point? So if let's say 1 year you have received 1 lakh, but next year you have received only 50,000. Maybe let's say third year you have received 60,000. Maybe fourth year you have received again 30, 40, 60, 70. Right. So this is how yours is getting interest payments from the properties. All right. So it's a very difficult in that case. But what if, let's say, if you can swap interest rate, let's say, this rental income with someone, all right, who is ready to pay you fixed fixed, let's say, income, or you can say interest payment. So you can exchange anything. So here is the example of revenue. So it means you can exchange your revenue. All right. Let's say this guy is interested to exchange with the interest payment. All right. This guy is ready to pay you 30,000 interest payment for per year, which is a fixed. So ready to sign agreement with you. Every month you will receive fixed interest payment. So you don't need to worry about, even if the property is vacant for a year, whole year, that's fine. So you don't need to worry about that. Your responsibility is like just to hand over whatever, revenue it will receive to you as a rent. You can transfer that rent to this guy, and that guy will pay you 30,000, which is a fixed, interest payment to you every year, because it's yearly contract. So let's take an assumption now, since both you guys are ready to sign and you have signed contract. Contract now has been initiated for 5 years. Rent and interest payment. See, interest payment is fixed every year. 30,000, 30,000, 30,000, 30,000. Interest rate is fixed for entire schedule. Okay. Now, if we talk about, let's say, rent for a first year, the rent generated from the property is 1 lakh. Right? So if you see in this particular, at the end of the, let's say, first year, this guy, the rent owner will pay 70,000 to whom? To this guy. Because if you don't want to pay 70,000, then eventually this rent owner will transfer 1 lakh, and this, or see, even if the rent owner don't want to transfer and to maintain all of this, so both can appoint broker. So simple. If you just appoint a broker will settle that. Broker will take care of that everything. So broker will take care of this settlement of broker will collect the rent, which is 1 lakh. Again, interest payment from the party, which is 30,000. So net, this broker will settle this 70K in the interest holder who is paying interest payment. So they'll settle it out. All right. So this is how actually a contract works. Let's say in another month, this property was vacant for almost for a year, and rental income generated, which is only 20,000. So in this case, this guy will pay, interest holder will pay, 30,000 to rent holder directly, 30,000 to the rent holder. Let's say for an entire year, again, the property was vacant. See, it's not the problem of this rent owner then, because if the property is, even if it is vacant, still this guy will pay, fixed interest payment. Again, it will receive. If you talk about the loss, here you can see a loss of 20,000, because the rent the generated, which is only 20. So you can see the loss, which is 10,000. Here you can see the loss of 30,000, because no let's say rental income generated. So here, let's say 50,000 rental income generated. And in that case, you can see this guy will pay, rent owner will pay 20,000, and this guy will again receive 20,000. All right. Let's say again the property was vacant. loss. Property was vacant. So now you tell me what you have understood from this schedule. The one party exchanged or wanted to exchange their rental income with other party at a fixed rate, and the other party was looking for a rental income with a fixed amount. So they just exchanged that with each other. So this is how you actually TRS, total revenue swaps, works. So at settlement, every year we'll have settlement, and every year the broker will settle the fixed amount of that amount or variable amount of the differences in the both parties' accounts. So they just settle it. Any question, guys? If you don't have any questions, then yeah, I'll walk you through PPT and some technical words then. One more example of what? Interest rate, this or rental income. Which one? If you have any example, if you want me to explain, tell me, so I'll take that one. So basically, let's take example. You are interested to, you're interested in commercial properties rent, but you don't have a huge money to build properties. Why you wanted to build commercial properties? Because your purpose was to generate some rental income, right? But you don't have your own capital like 1 crore, 2 crore, 10 crores. You don't have your capital. Let's say your budget is only 50 lakhs. So within that 50 lakhs, what you can do, you can find some commercial properties and identify their problems. Maybe let's say irregularities in interest, that rental income. See, as a businessman, if I have a irregularities in income, so which is a bottleneck situation for me, because I won't be able to take any investment decisions then. Let's say if I have invested 10 crores to generate maybe 10 lakhs interest payment for per month, rental income for per month. What if, let's say, in 1 month I'm getting 10 lakhs, but in other months I'm getting only 5 lakhs, 6 lakhs, 4 lakhs. So this is variation in rental income, which is a big problem for a businessman or to anyone. If you are an investor also, if you invest, let's say if you have invested huge money like 10 crore, 20 crores, and if there are variations in rental income, then which is not a good, because they want something fixed, which they can maybe reinvest, or they can plan something different. All right. But as a, let's say, arbitrer, it means arbitrer always look for an opportunity. See, they don't hold any assets, but if they have a capacity to at least enter into obligations, so that they can. So one person is looking for a fixed, whether it is a rental income or any income, that's fine, looking for a fixed. And the other guy who don't want to hold any assets because the capacity of this guy is very low, but ready to at least invest, let's say 50 lakhs. But that 50 lakhs, you don't need to invest in one go. So what you can do, you can find the properties, like commercial properties, find their problems. If they have problems with the properties, like let's say irregularities in rental income, you simply ask them, first evaluate the market and everything, right? If their variable, let's say rental income is, let's say 1 lakh variable, then you can apply maybe your vacancy rate or all other means there are different ratios. Just apply to it. Your discounted amount would be somewhere, means considering all possibilities and all, like the property was vacant for 3 months in a year. So in that way, you can apply the logic and compute the interest payment, or maybe you can commit, let's say 50,000 that you will pay, which is a fixed interest payment to the this property owner, and then property owner will provide you whatever rental income will be generated from the property, so that entire rental income it will receive to you only. Even if you generate, let's say 10 lakhs per month, right? So you will receive that entire income. So in return of that, you are going to pay only 50,000, which is a fixed for every month. So every month you can pay fixed 50,000 and whatever rental income will generate from that property, it is yours. Whatever means whatever. Even if let's say there is no income, but still you will have to pay 50,000, which is a fixed amount to that property owner. And this is how you can sign a contracts with property owners, or maybe you can say the people like who are looking for fixed returns. You can sign a contracts with them. All right, guys. So this is how your swaps work. So let's now talk about technical some words, how your swap contracts works. This is so if we talk about the swap contracts, at the time of initiation we don't pay anything, no payment at initiation, and you can see periodic settlements, maybe quarterly, yearly, even daily as well. So it depends on the nature of the contract. So accordingly, just we continuously settle the contracts and process that out. But the very important is to find someone which is a who can actually exchange with you. It's very difficult, and that's what we appoint broker. That's what we appoint someone who can help us to exchange. Okay, so in a theoretical term, if you just ask me, sir, what is swap contract? It's an agreement between two parties to exchange a series of future cash flows on a periodic settlement dates over a certain period, maybe 1 year, 2 year, 3 years, depends on your contracts. A swap contract can be decomposed into a series of off-market forward contracts as well. All right. So off-market, it means if the security is not available in the let's say market, like stocks, currencies, all are like available in the market. But what if, let's say, the rental price you can't see in the market, right? So it means that would be with the parties, like that the parties, it means who is the owner of that property. You can only reach out to him and get the price. All right. So this is how, means there are two types of contracts. One is on market forward contract and off market forward contracts. Off market, it means it is for a real estate or commodities and all, where the price of the securities which is not available at all. So you can sign a contracts with those commodities or that particular, let's say, real estate products and all. Apart from that, you can sign contracts, swap contracts with listed securities as well, like stocks, bonds, and debentures, whatever instruments that you have. Right. If we talk about types of swaps, we have a plain vanilla swap, which is your normal that rental swaps. You can consider it as a plain vanilla swaps. Interest rate swaps. Interest rate swaps are just exchange of interest flows that we have already discussed. Then settlement date. So how actually it settles? So on settlement date, whatever it is, but this is something for a different, but you can see settlement date as well in the swap contracts as well. All right. So you can appoint broker. Broker will actually settle the contracts on a periodic basis, like as I said, daily, weekly, monthly, yearly, even at the time of maturity also. So depends on the contract. So you can sign the contracts from 1 day to 100 years. So there are no limitations. Plain vanilla swaps. Plain vanilla swap, you can just simply exchange the interest rates. If you just see interest rate in which one party pay a fixed rate and another party pays a floating rate, both payments are in the same currency. So this is how you can just settle it out. So we have already discussed this one, right? But there should be something, a base to compute benefit, and then you can exchange interest rates continuously. Means every quarter you can just exchange until that expiry reached. Then there is a one more contract, which is a credit default swap. Credit default swap is nothing but, let's say, it's like an insurance contract against the default, a type of credit derivatives in which the buyer makes a series of regular payments to the credit protection in a seller. And if the underlying issuer defaults, the CDS buyer receives a payout that can compensate him and her for the financial loss from the default. So this I would say, CDS, it's like your insurance. And CDS, the LIC of India is allowed to sell the CDS, as well as in US, not Bank of, AIG, America's insurance group, AIG, which is allowed to sell the protections in the US. So it means in every country, the insurance companies are only allowed to sell the protections. Okay, if we have, let's say, Project A, with the worth of rupees 1 lakh. The value of project is 1 lakh. But you are worried about, if something happened, so it would be your loss. So how you can protect that project A? Let's say project A is a very critical or crucial for you. If something happened to the project A, it will lose, your asset. So how you can protect to your asset? Come on, how you can protect your assets? Any guess, guys, from audience? You have a project A assets worth of rupees 1 lakhs. How you can protect your assets? Come on. No guesses. CDS. So we cannot say, buying insurance in this derivative space. We'll call it as a CDS. So we can buy CDS if the project value is, let's say, 1 lakh. Maybe you can pay 100 rupees or 50 rupees, whatever it is, for per month. To whom you can pay this, regular premiums to the LIC of India. All right. And if something happens, so you don't need to worry about it. I have got you covered. So it means if something happened to project A, so this company will compensate that, losses with you. So let's take a hypothetical example. So what happened? You invested in project A. It was a very crucial for you, but due to XYZ reason, now project A collapsed, right? And you have incurred some losses of around 80,000 loss. So you don't need to worry about at all. Just submit the project details and everything to this guy. It's like an insurance, as I said. So this guy will process you your payout, which is 80K, right? You have a loss in your investment 80K, but on other hand, this guy will process you 80K along, and you will have a remaining amount of also in project like 20,000. So 80 plus 20, still you have a value of 1 lakh. So you don't need to worry about at all. But yeah, your loss would be like the premium which you have paid it, because premium which is non-refundable. All right, premium which is not refundable. If you pay premium, the premium which is non-refundable, so your entire premium, that will be your loss. If something happened, then only you would be in profit. If something, let's say, doesn't happen at all in future, then that whatever premium you have paid, which is irreversible, so it means it will not receive any penny to you. So it is your loss. So while selecting CDS, always look for a risk. If you really have a risk in your project, then you can look for a CDS. If you don't have a, let's say, risk in your project, then don't buy any insurance contract as such, because it is not worth to buy it. So again, let me just summarize it. If you're a businessman and if you're dealing in real estate, or if you're dealing in any fixed income securities and all, so you should look for a CDS. As an investor, if you have invested in, let's say, fixed income securities like bonds, then debentures, then in that case, you can try to buy some protection like credit default swaps, because if something happened, then at least, see, if you buy a premium, definitely that will affect on the profitability, because premium, which is a loss for you, correct? But it will also help you to protect your investments in case of default event or against any bankruptcy and all. So smart investors, they always buy protection. So if you want, you can do it. Okay. In India, LIC, because LIC is the government company. The government companies are only allowed to sell the protections. In US, the AIG group, America's insurance group. In UK insurance company, which is allowed to sell this out. Only government approved or government entities are allowed to sell the protection. in case of event. The rest, they are not. Private insurance companies, they are not allowed because it is very risky for them. See, if we can go and check the 2008's Great Recession, you can see, just because of CDS only, that entire world was in, you can say, entire world was in this Great Recession because the AIG group aggressively sold out insurance protections in the market. And then on other hand, companies like Lehman Brothers, or there are other companies as well, so who sold the securities in the market without even worrying about that, what if the default event happened and all, because they thought like, I have purchased insurance, now I can do anything whatever I want. It's like, let's say you have purchased a new car, and again you purchase a insurance as well, and you decided to drive your car roughly on a highway. Just imagine that if you drive your car with the 140 or 50 60 speed, so there are two ways. One, maybe your car can ram to any other other cars, or maybe other vehicles, or maybe you'll collapse it. But something happened to you, of course your insurance company is there. So this is how actually change the mindset, means actually that CDS changed the mindset of the big companies, and they sold out securities and loans in the market very excessively, and that led to the 2008 global recession. And the final result was the Lehman Brothers collapsed. Now we don't have a Lehman Brothers in the market. That bank collapsed. Same example, if you see recently, your Credit Suisse collapsed, right? Too big to fail. So this is how it happens. All right. So let's go ahead. So this we have discussed it, but in a technical way, how it works. So you can read this: a type of credit derivatives in which the underlying is the credit spread or bond. So if you have investments in bond, you can just buy this out. The spread is the bond yield spread relative to a benchmark. A bondholder typically pays a premium. It's like a call and put option, guys. Okay, it's like a derivatives that put and call options to be compensated if the bond's credit quality decreases and the bondholders chooses the strike level of the option. So when bonds credit quality decreases, its yield again spread will increase, and at expiration of the call option, if the yield spread is above the strike, then bondholder will collect the payoff based on the difference, and this payoff compensate the bondholder for the drop in the market price of the bond. So in short, this credit default swap, it's like your call option and put option. Simple. All right. Because in a call option and put options, what we do, we pay the premium, right? We pay the premium to get the rights, buy rights or sell rights of an assets. So same way here, in exchange of risk, we just purchase the this protection and pay the premium to the company, means LIC company. All right. So if we talk about interest rate swaps, swaps in which underlying is an interest rate only. In a credit derivatives, a type of contingent claim derivatives that pays a compensation to the holder in the event of downgrade or default by the underlying borrower or issuer. In a credit default swaps, what we do, we pay the premium, and if something happened with the assets, so insurance company will pay your claim. Okay. So in case of forward contracts, an agreement between two parties in which the long agrees to buy from the short and underlying assets at a fixed settlement date for which the price which is established at the start of the contract, and most forward contracts are custom contracts. See, if we talk about future and forward contracts, future contracts which are listed one on a stock exchange. But if we talk about forward contracts, they are not listed one. Okay, the contracts, they are not listed one. It's just a contracts which you can sign through your you can sign through, I would say, this in a papers and execute the contract. But the base would be your future contracts only. For a pricing and all, we always refer the price of a forward future contracts to calculate the value of forward contracts in the market. This is a forward contracts valuation. It's a very simple one. So you don't look at this ES, EFT, that creates lots of confusion. So we'll walk you through simple thing. See, first talk about the settlement of the forward contracts. How we settle the contracts, settled. We can settle the contracts in even physical assets as well as in a cash differences. But if you settle the cash, if you settle the let's say forward contract in a cash only or a differences, I would say, in that case, that contract you can call it as a non-deliverable forward contract. So it means you are not going to deliver any assets to anyone. It's just to settle the contracts in cash difference. And that's what most of the people, they prefer it. So you don't need to, let's say, even if you sign, let's say, 100 crore contract, your liability would be only 1 crore or 50 lakhs or around somewhere max to max 1 or 2 crores. Your liability won't be like 100 crore or 200 crore. So that's what they sign it. So it means if you have a 2 crores, then you can sign the forward contracts of let's say 100 crores. See the profitability and ratio and everything. And if you're ready to take a risk of 1 crore, then you can sign a contract of 100 crore even. So that's how you can leverage out derivatives, as per your risk taking capacity. And in case of deliverable contracts, see the most of the oil companies, gold companies, right? And even in a stock market also like bonds or equities or even dollars, we always ask for a delivery as well. Delivery, it means, let's say if I have purchased, let's say XYZ, bond at X price, and let's say after 6 months, if that price changes, still I'll pay the price which I have, let's say, agreed 5 months back or 1 year back. Only I'll pay that price, not the current market price. Okay. So this is how your forward contracts works. So read this one. So on the settlement date for a forward contracts, the difference between the contract price and the spot price is calculated. If the spot price, it means current market price. If the spot price is higher than the contract price, then short has to pay the long. So it means seller has to pay the buyer the difference amount. And conversely, if the spot price is lower, then the long has to pay, means buyer, again, buyer has to pay. Longer it means guys, buyer, okay, has to pay the short, the difference. So let's look for that. So this portion, if you see this one is the part of deliverable. So here in the deliverable, actually part is they're delivering product to buyer. The price is 50, but in the market price is 45. Spot price, it means guys, it's a, here if you see, actual market price of the security is 45, but the contract was signed for a 50. So that's what this guy is delivering, the assets, selling the assets. And this guy is actually buying assets by paying 50. So eventually, who is in profit? Of course, seller is in profit of 5. Yeah, if we talk about the future price, the agreed upon price of the future contracts, the long is required to pay this price to the short for the underlying assets at the price on settlement date. So always see, in terms of valuation of a forward contracts, we compare the price of a market, securities or market contracts, I would say, because see, in terms of equities and all are the listed securities, right? So you can easily check the prices of securities in the market. So same prices you can refer to compute the value of forward contracts. So what about forward rate agreement? Forward rate agreement, which is a contract to borrow and lend money at a certain rate at a sum in a future date, usually require one party to make a fixed interest payment and the other party to make a floating rate payment. So determined at contract expiration. LIBOR is now ceased, so we don't have a LIBOR. LIBOR stands for London interbank offered rate, but now they have a different rate, which is SOFAR something, SOFR and SONARS. So they have a different rate, sterling overnight risk-free rate, right? And future contracts, again, it's an agreement between two parties in which long agrees to buy. I believe we have discussed that. But in the future contracts, you can see the central parties which take care of everything. In stock exchange, work as a central counterparty and take care of that settlement of contracts and everything. So this is how you can differentiate between your future contracts, futures, options, and even credit derivatives. In a credit derivatives, options and futures, see stock exchange like NSE, and BSE plays very crucial role because they work as a clearing agent. All right, they'll have a standard contract, central location, deal with clearing house, standard contracts, and which is highly regulated one. And if I talk about, let's say, over the counter, forward and swaps both comes under OTC, over the market. So it means it's a customized contract. Buyer and seller, they can directly sign contracts. Buyer and seller, they can directly sign. They don't require any exchange at all. No central location. Deal with anyone. And custom contract, it means you can see different terms and condition with different contracts. All right. Then it is an unregulated market. So this market is basically highly unregulated. So there are no regulations at all. So you can see, anyone can buy with anyone. So you can define terms as per your own, comfort zone. So that's how you can sign different terms. All right. So forward and future, if we just differentiate both the contracts, as I said, see this, future contract is the advanced version of forward contracts only. But the reason is here, the future contract is listed on a stock exchange, so price and everything which could be easily available, and you can buy and sell. But if we talk about forward contracts, it's non-standard contract. It means you can only sell it out with your parties only. If you have purchased from A, you can only sell it out to A. So you cannot sell it out to B or C because there are no central counterparties. Central counterparties, it means marketplace like NSE and BSE, because NSE and BSE both are marketplaces. So which you can buy and sell your securities easily. Okay. So here direct between buyer and seller. So it means they can directly deal with each other. But in case of future contracts, so they don't exchange directly to each other. Basically, they directly buy and sell securities, buy and sell their contracts to the NSE and BSE. NSE and BSE, it means BSE stands for Bombay Stock Exchange, NSE stands for National Stock Exchange. So they buy and sell to the NSE and BSE only. So they don't directly buy and sell to each other. So that's how you can differentiate. Okay. This we have already discussed. Yeah. So let's take example of forward contract as well, how it looks like and the possibilities of forward contracts. See here, if you see, let's say you're at a farmer side, okay, and the price of rice, whatever, let's say, so it's a beverages company, all right. So the price of coffee beans, which is 500 rupees per kg. The beans price is 500 rupees per kg. If you enter in contracts, like let's say, 3 months from now, you have decided to just enter in contracts for the next 3 months. And after 3 months, you want to execute this contract. Okay. So simply you can find someone who is ready to sign contracts with you, sign a contract. Define the quantities, let's say 10,000 kgs, and hold for 3 months. So up to 3 months, so this would be your current market price, so which is basically spot price. Means after 3 months, let's say, the price which is at 480. So here you can see the difference of 2 rupees, right? Difference of 2 rupees. So net, the exchange of cash flow would be 10,000 quantity into 2 rupees, which is 20,000 rupees, right? So this could be your loss, profit, or maybe no loss, no profit. So now you should, let's say, take a first side. Let's say if you are a buyer, or if you wanted to buy this out because your research was like this price may go up, like maybe 505 or 5010. Right, this was your expectation, but eventually what happened? Price dropped by 2 rupees. So it means as a buyer, if price drops, guys, that would be a loss. And as a seller, if price drops in the market, then again that would be a profit. As a seller, if price increase of any products in the market, then that would be a loss. So simply the equation is, it's a very simple. Now let's take a hypothetical situation here. If we talk about the flow, there would be 3 possibilities, guys, right? One is current market price after 3 months we are talking about. Contract price was 500 and current market price after, oops, 480, right? So change in price, my bad, 480. So difference was 20. So we calculated wrongly. Nobody highlighted even. 20 into 10,000 quantity. So it's 2 lakhs. The difference is 2 lakhs. So now there would be possibilities, let's say. The first possibility is after 3 months, what will happen? Current market price, which is 480, and contract price is 500. Okay. If you are a buyer, then you are in a loss of 20 rupees per trade. If you are a seller, right, you are in a profit of 20 rupees. Correct? This is the first case. Second probability would be current market price, right? Current market price, let's say, which is at 520 and contract price, which is at 500. So it means if this is the case, then as a buyer, you can make a profit of 20 rupees per kg. Seller will lose the money, which is 20 rupees per kg. And the third probability is there is no profit, there is no loss. So it means current market price after the 3 months, which is same like 500, and the contract price of the contract is also same, which is 500. So contract price is 500 and current market price after 3 months, let's say, which is the same like 500. So zero potential profit or loss to both the parties. So it means this is the case where no loss, no profit. And if there is no, let's say, possibility of, the difference in price, then you should not sign any derivative contracts. It is just a wastage of time. See, even if you made a losses, that's fine. This is how the market works. Profit, loss, profit, loss. But if there is no opportunity to make a gain, then you should not sign any derivative contracts. Did you get this? I hope you got the clarity about forward contracts or even the derivative contracts, like how it works. It is a game of probability. Derivative market, entire market, it works on probability. If there is no possibility of, let's say, gain, then we should not sign any contract as such. So this is all about option, but options we have already discussed. No, don't want to. Call option, right to buy, put option, right to sell, and a call option again, right to buy, right to sell. So you can buy, sell. So this, if you see the premium, this would be a premium. We'll call it as a premium, but this portion we have already discussed. So I don't want to discuss the same thing again. Here. So there is one more term which is arbitrage. Okay. Have you heard about arbitrage, guys? Come on. Have you heard? Yes, no. What is that? Who take the risk? See, arbitrage, it's an opportunity to make some profit. Let's say there is a Wipro stock or any company, you can say, or KPIT. KPIT stock price, which is in market, is 1,000 rupees per quantity. Okay. And in a future market, future, it means in future, maybe in 1 week or 2 weeks, price of shares will rise, and that would be somewhere around 110, maybe in 1 week. All right. So what you can do, you can buy shares today at 1,000. You can sell tomorrow at 110, and you can make a profit of around 10 rupees. So this profit, you can see that it's an arbitrage opportunity. And this opportunity you can see between two stock exchanges as well. Sometime what happened, let's say same company stocks trading at, let's say, X price on BSE and Y price on NSE. Maybe you can understand in a way that, let's say, Wipro shares trading on a BSE market at 100 rupees and on NSE, which is 102. So you can see the difference of 2. So it means you can buy shares from BSE market and you can sell in NSE at 2 rupees different price. So this is all about arbitrage opportunity. Okay. So arbitrage, always look for an opportunities. If there is no opportunity, then arbitrage, they don't place any trades as such. So they always look for an opportunities. All right. Let me see. Yeah. So here you can see the swap contracts again through presentation in a better way. If you have a swap contracts, so every quarter or every month, every year, you can settle this. The difference is only this guy is like, I have to pay 50, I have to pay 40. But the important is party with the greater liability makes net payment to other party. So instead of paying 50, so just pay simply 10 plus 40, it would be 50 only. So nobody pays the entire amount. Okay. So exchange a series of payment on a periodic settlement dates over a certain period. See this. Let's take an example how your forward contracts works. Forward and future both are same contracts. The difference is, guys, future contract is listed on a stock exchange and forward contract is not listed. Okay. But entire framework like price and everything that we always consider from the future contracts only. Let's say here contract initiated, the price of security which was at 50, maybe USD, rupees, whatever currency that you want to take it. So I'll buy the assets from you at 50 on settlement date. So it means here the security it will purchase out, or maybe difference of securities it will settle. Again, short it means seller. Seller is agree with, okay, I'll sell the assets to you at 50 on settlement date. So both can sign a contract. So on settlement date, let's say there is no change in price, contract price and future price. Future price both is same. So it means there is no difference. If there is no difference, no parties pay anything to each other. So this was just wastage of time for both the parties, because on settlement date, the price of security, it was same. See, sometime what you can see, let's say maybe the security price, let's say, changes like this. Maybe from 50 to 40, like this. But at the time of settlement, price reached to this. Let's say someday price reached to 60, 48, maybe 38, but on settlement date, price reached to only 50. So we'll consider that price only for a settlement of a contract. All right. We'll consider this future price only to settle this out. So this is how your forward contracts actually works. All right. Now, if I talk about here, you can see the another example, let's say, of forward contracts. Contract initiated at, if you see this price, contract price 50. All right. And at the time of settlement, on settlement date, because settlement date would be a future date. So on settlement date, let's say on settlement date, price reached to at 60. Maybe let's say price started from this level, security prices, and reached to here somewhere, because this price will consider it for a settlement. So here you can see the difference of 10. As I said, as a buyer, if price goes up, that would be a profit. As a seller, if price goes down, then that would be a profit. So in this case, price goes up, it means buyer made a profit of 10 rupees. Buyer made a profit of 10 rupees. All right. Then if we talk about the another example, let's say how seller will make a profit. I have it. Let's see. Contract initiated at same price, 50, but at the time of settlement, right, price reached to at 45. So here you can see the loss of loss. It means as a buyer, it is a loss of $5, and seller made a profit of $5. The reason is price come down at 45 from 50. So this is how you can, understand this contracts. It's a very interesting one as well. Okay. Any question so far? No, in our options, the time factor works. But here In forward future, there is no decay, there is nothing kind of things. You just simply settle the payment. Only your time decay is applied to the options, because option is like, the it's a premium that you are paying. Okay, so once you reach to the expiry, then your premium, it will zero out. But in future swaps, even in forwards, there is no time decay. Time decay is just apply factor in only and only in your options. So you can here you tell me who is in profit. This is for you. Another example of forward contracts, just tell me who is in profit. Come on. Only one guess. Come on, guys. How much? You said long. So how much profit? Okay. Yeah. So almost done. But there is a one factor in future, so which is a margin. So margin works with your price, guys. Margin is nothing but margin. It means whatever amount that you have paid. Let's discuss about margin. So in a future contracts, we actually pay some margin. So we should discuss that. Let's say if you have decided to buy assets, any XYZ assets, and that asset price is 100, means as per current market price data, price is 100. Okay. So at the moment, let's say 10% is required. 10% is required. 10%, it means your contribution to buy these assets. Means if you want to buy 100 rupees worth of rupees assets, so you just need to pay at least 10, right? Or 10% of these assets. So let's say, which is a day's price. All right. So if you see, let's say stock price, it was at this price. Okay. And then you just paid 10% of this price. What if, let's say, this price, you are like buyer in this case. Okay. You bought the stocks by paying only 10%, because 90% it was paid by your broker only to acquire these assets. Now, this price moves, let's say, from 100 to 90. So now you tell me, if the price, let's say, come down from 100 to 90, right? So if you just calculate 100 plus loss, you will have to add like this, because 100 was the actual price of the assets, and there is a loss of again 10, right? Loss of 10. So it means 110. On 110, you will have to calculate 10%. So just calculate it. So you need a margin of rupees 11 in your account. Why? The reason is, see, broker and you paid means 100 rupees, right? Broker paid 90 and you paid 10. So your 10, it means you paid actually 10%. See, your 10%, it should be always, that balance maintained in your account. Due to price changes, if you see, affects in the quality quality of assets, or if the price, let's say, changes continuously, then you will have to continuously add margin to the accounts to ensure that your 10% percentage which is maintained. So it should continuously update. Continuously, it means continuously. So it is a very mandate. Okay, and it happens. So if we just see the example here, same thing you can relate. So the difference is, let's say, long positions you have taken, which is at 100, right? If the price moves from an initially margin that you have paid is 20, margin maintenance, it means if the margin goes the below the 10, then your position will be square off. So it means you need to refill the margin again. So it is a mandate thing for everyone. See, price changes. If you see, price changes from this 90, it was not 90, I believe it was 100, 110. If the price changes from 110 to 76, so here is the loss of 41, right? And same, if the initial margin was again 40, then your 40 margin would be at 0 directly. The reason is you paid only 40, but same day there was a loss of 40. So your margin and loss, which is equivalent. So it means so you lose the control of that collateral or assets. So if you want again the control of that asset, so you will have to pay again 10%. So this is how you actually margin games works. In a margin is nothing but you are just paying 10%, 20%, whatever it is required to hold the rights of that assets. But make sure that as a buyer, if that asset is in profit, then only you can make a money. If your asset, let's say, which is in a loss, then you cannot make any penny from this particular contract. So you lose your money as well as margin as well. See, broker, the point here is it's a game of money market. Okay. Broker reach out to the banks. The banks like who are dealing in this liquid assets or who are dealing in this very, the money market segments. So those banks quickly provide funding to that counterparties. It's a money market fund only because it's a broker sponsored entities. They enter in this contract. So basically, broker reach out to them quickly through their private network and ask them to look. We have a securities, and if you are ready to pay, then pay it. So we'll take the control. So it means broker take the control of that collaterals, and banks provide funding. So in this particular transaction, see, it's a win-win for everyone. Broker make the commission, banks receive the interest payment because on loan, it's a loan only, guys. It's a loan amount that we have, means we are taking loans from the bank, and bank pays interest payment. In last session only I showed you, right? So bank pays or charge interest payment to us, correct? So the interest payment, they charge interest payment. It's not for one day. It's for see the duration of the contract. See, the short transaction contract should be at 1 year. Within that 1 year, you can execute it. But future contracts has an expiry of monthly. So every month, your future contracts will expire and settle in your account. And if something happened like plus minus, broker always keep an eye and they directly execute the contracts. They don't wait actually, for your permission and all. They directly execute the contract. It's a risky as well. One of my friend last month only, he got a call from the broker to purchase the HAL, which is future, and he purchased it even. I told him do not buy because already stock is at a very high level, so don't buy it. If you want, you can buy it in a spread. Maybe you can carry any put option of HAL. So he said, no, I'll just buy it. I got a call, so I have a surety. And then now he's in loss of 5 lakhs because he purchased the future contract at the time when the price was 5,500 or 600 something. And now current price, which is at 4,400 something or 500 or 600 something. So almost 30% loss, which he has in the one lot, you can say. So it's a very difficult. I mean, it's not easy to manage the margin and all. If you have a sure shot only, then you can make a money. Otherwise, you cannot. Yeah, there are people, who actually hedge their futures as well. So it means, options we need, low amount, which is premium. So you can pay that premium. I advise him at the time only. So if you are looking for a buy option, then do not buy directly. So make sure that you are buying the other position in swaps so that you can hedge. But they never listen sometimes, so we can't do anything in that case. Now he's in loss, so he was saying, now what can I do? I told him, now you can't do anything, just book the losses if you can and wait for another opportunity. This happened, right? Derivatives as well. So let me know if you have any questions. Again, you can see repetitive stuff, so I don't want to reach out to the coordinator, and coordinator will reach out to me. For a real estate, in India, see, Indian market is very unorganized market. They don't do anything. But in US, UK, they have more options. They do it. In Indian market, only your properties, if you apply for home loans, in that case only, you can purchase a home loan insurance. But in most of the cases, I have seen in Indian market, we don't have much of options, which is still Indian regulators. They need to figure it out, like how they can make a system which is easy for everyone to protect the different asset classes and all. So in India, we don't have that level of scope at the moment. Prashant, theoretically, yes, but practically, again, Indian government, they have lots of regulations, like up to only 5 crore that you can, means except foreign funding, not more than that. At individual level, how will you take it now? You tell me. If you have a strong contracts, then you can do it. See, there are people, how they do it, I know it, the process and all. So if you see the first important thing is, if you want to raise funds from foreign banks, you should have to have a strong contacts in foreign. Okay. And then you can ask same people to registered entity in India through FPI route, foreign portfolio investors, and then invest anywhere in India. So this is how they invest. So there are routes, but directly as an Indian to raise funds from the Japanese bank, then everyone would have done the same thing. Because see, this might be new for you guys, but this is not new for a finance professionals. They know it. There are many other economies as well where the interest rate is zero. Why Indian stock market or even lending market is growing? Because in the US the yield was negative. In Japan, there was no yield anything as such, and that's what the most of the investors from Japan and even in the US, they invested huge money in India, right? And that's what stock market. If you see, in COVID the index was 8,000, and in last 5 to 6 years, right? See the index growth from 8,000 to 25,000. It's a 3x return, correct? See, India has a huge money. Huge money, it means huge money. See the IPO applications. Recently, one company applied for IPO with 11 crores in a requirement, and they got the applications for 4,000 crores investments. So if you have any business model, then you can register your business and raise funds through equity. So that's the best option. Foreign funding is a good if you have a friends or maybe someone that who trust on you, then it is good for you to raise funds. Otherwise, it's not easy. USD you cannot accept in your account, Sanjeev. Okay. So you will have to open, which is Nostro accounts with a foreign bank, any foreign bank. It could be JP Morgan, Goldman Sachs, Bank of America. They are the foreign banks. So you will have to open accounts with them. So they manage your USD and your Indian banks manage your INR. Okay. But your interest payments and all, you can settle INR interest payment, we settled in INR only. USD interest payment, we settled in USD only. Yeah, you can open. So basically, Indian banks will have the relationship with foreign banks. It could be any foreign banks. So in case of my case, Axis Bank has a relationship with JP Morgan. So basically, JP Morgan provided the accounts for USD currency to the Axis Bank. So my clients, they deposit money with the Axis Bank, but in a USD account, because Axis Bank has a USD account, Euro account, or different accounts. And then Axis, it is a responsibility of Axis banks to convert that USD as per the market rate into INR, and that INR payment they'll settle in my account. Okay. So are you a businessman, Sanjeev, or what's the case? If you have your business, or if you have any foreign friends who are ready to invest in your business, then you don't need to open any Nostro accounts. Just simply ask bank to share the SWIFT code. Once the bank will share the SWIFT code with you for a USD currency, share that SWIFT code and bank account number with your foreign clients. they can settle the payments in any means USD or any other currencies as well.
Just a quick info, guys. Intellipaat offers investment banking course training. Through this course, you will learn time management, project leadership, financial expertise, leadership abilities, valuation, and much more from the top 1% of industry experts around the world. With this course, we have already helped thousands of professionals in successful career transitions. You can check out the testimonials on our Achievers channel, the link of which is given in the description below. Without a doubt, this course can set your career to new heights. So visit this course page link given in the description below and take the first step towards your career growth in the field of investment banking.
Fixed income securities. I don't have as I said, the board and PPT with me, but I will ensure that, we'll have a very meaningful conversation on fixed income, whether you are from, let's say, experienced background or not, but this session will help to everyone. Everyone means everyone. So I'm gonna decode the fixed income securities from very, very basic. Very basic, it means very basic. So anyone can understand it in a very well manner. All right. So let's start with the discussion. If we talk about, guys, fixed income securities, fixed it means we are talking about, the benefit, economic benefit, which will receive to us or to the investor. So if we invest in XYZ securities, investors will receive fixed amount of benefit. All right. But now let's talk about first, what is fixed income securities, or what are fixed income securities? All right. So can anyone try? What are fixed income securities? Come on. Or what do you know about securities, fixed income securities? Fixed income, it means the securities which offer fixed interest payment on investments. So those securities will consider as a fixed income securities in finance, right? So it can be anything. It means, when we say fixed income securities, you can say, government securities, bonds, private securities, even, your fixed deposit, then recurring deposit, or let's say, debentures or asset backed securities or mortgage backed securities, all of that instruments will consider as a fixed income securities. All of that instruments will consider as a fixed income securities. Are you clear on this? So I'll explain that with examples. Means every product I'll explain that with example. So don't worry about it. Okay. So fixed income, it means any securities if that security offering or offer interest payment on investment, so that becomes your fixed income securities. So before that, I would like to the decode the process of how we convert the security, means your assets into securities, so which we'll call it as a asset securitization. Otherwise, why bondholders or let's say or investors, they'll invest in your business? If the business has no assets, then no one will invest. Okay. So bond investment, it's like a pure borrowing, guys. The company is directly borrowing funds from the investor. So you can say it's a direct borrowing process. You can say it's a direct borrowing process. So how that process works? So let's take an example. Okay. Let's say, let me try something different for you. Let's say you are here. Insert. Let's say you're at this level and you have a property. So your property, it could be anything. Anything means anything. So I'm assuming that you have your property. Okay. This is your property. So when we say property, so you can assume this is your, let's say, business property or business assets. So you can assume it, this is your business property or business assets. Okay. Now, see, for every asset, we have a process to evaluate or calculate, or you can say, the measure the price of that particular assets. It could be any price, depends on, several factors, right? Let's say depends on the the quality of these assets, depends on the situation of this particular assets, depends on the income generation capacity of this particular assets. All right. If your asset is very strong, then your asset's value would be high. If your asset is not at a very strong position, then your asset quality or price would be, of course, low, because depends, everything is depends on your asset quality. So we are assuming here this guy is the board of director and holding the assets or business assets. So now when we say business assets include technology, right, trademark, business office location, or any IP, intellectual property rights, or even if the business is holding any physical assets which includes lands, office space, or any assets, I would say even investments in any products and all investments as such. All right. So basically this is a very simple calculation. Total assets, total liabilities, that you can say whatever the business is having at the moment. So we are assuming it business is holding 10 lakh with liability of 2 lakhs. So just debit the 2 lakhs from uh, the total assets value, whatever that you have. So net capital, if you see, capital of the business would be somewhere around total assets minus total liabilities, around 8 lakhs. All right. So this is the capital of the business. Now there are approaches how you want to, or how you want to, let's say, consider or calculate value of the business. This is a very plain example. Okay. Plain means very simple. So don't apply your any other logic to understand this. My intention here, is to help you guys to understand like how we can convert the business assets into different tranches or bonds to raise additional capital. So I'm just helping you guys to understand that process. Okay. So let's say company can hire accountant or valuer. Now your question would be like, sir, who can be a valuer? If you're good at the understanding of a business, if you understand business, if you understand math, if you understand, let's say, different financial instruments, their upside risk, downside risk, counterparty risk, default risk, if you understand that, or potential of, let's say, financial instruments, then on the basis of that you can evaluate business. All right. You can evaluate business. Are you clear on this? So now here, even CA can also perform the evaluation of the business, or any individual evaluator, or let's say who have completed, certified any course from any institute and all, reputed institute and all. So that person can also work as a valuer of the business. Then CFA, or any other person like who is pro into risk and all, that person can also work as a valuer. Or see, it could be individual or firm, so that depends. But yes, it is important to hire someone who can help you to compute the value of your business. So once the value is set, once the value is set, then that same value you can transfer it to someone else, maybe let's say investors, through securitization process and raise capital. All right. So now we are assuming this here in this case, the total value of the business after the deduction of liabilities, which is comes at, let's say, 8 lakhs, and we are considering only the net value. So it means it's a cost based approach. Cost based approach, it means, or you can say book based approach. So whatever value that we have in the book, it means balance sheet. So on the basis of that, we'll compute the value of our product, or we'll compute the value of our business. That's all. All right. So now if I ask you question, guys, on the basis of this, three basic, information, assets, liabilities, and capital, what is the size of your balance sheets? So you cannot say, look, my balance sheet size is, 10 lakh. No, your actual balance sheet size is only 8 lakhs. And on the basis of that, 8 lakhs, we can look for how we can raise additional capital from the other investors who are willing to take a risk. All right, willing to take a risk. Now, how that process works? So now let's talk about it. Let's say we have appointed valuer, and that valuer also provided certificate of valuation, and that valuation comes at, let's say, 8 lakhs. So as I said, it's just book basis valuation. So we haven't added any opportunity cost, or maybe let's say future expected benefits and all. We have just added the information on the basis of balance sheet of a company. So that becomes your cost basis valuation or book basis valuation. So in the books of a company, we have an assets, liabilities, and even capital. So we are assuming that our business value is 8 lakhs rupees for per 8 lakhs rupees, at the moment. And on the basis of 8 lakhs, we have decided, see, 8 lakhs becomes your capacity. Capital becomes your capacity basically. And if you have a capacity of 8 lakhs, then you can look for, additional capital from the different, sources to raise it. Now your question would be, sir, look, why, if I have 8 lakhs rupees in my account, why should I raise, capital? See, why companies raise capital, there are few aspects. Let's say you're a businessman and you have decided to scale your business to the next level. You have an option. One, you can raise your capital from your equity, shares, means you can dilute your stake and raise capital from the outside sources. And if you don't want to raise that capital from the outside the sources or dilute your equity, then what you can do, on the basis of your equity value, you can raise capital from the market sources. It could be your investors, banks, and all other financial institutions. Correct. So you can raise from them. So here we have decided to raise capital from the, let's say, public, or maybe from the banks or any other who is, willing to take a risk in your business. So you have assets value, total assets value. Now, if I say capital becomes, total net assets, see that net assets, what I can do, that net assets, I'll convert into the, let's say, agreement. All right. So we'll convert into that portion into the agreement. So now when we say agreements, and what will convert into agreement will convert, the assets, total assets value will convert into the, the assets. So that asset should be your power of attorney basically. Power of attorney, it means that gives the rights to whom? To the holder of bond, or holder of, the proof of ownership in your business. So that person will receive the ownership basically. It's like a home loan, guys. In a home loan, what happened if you apply for a home loan? So we actually sign a, contracts and provide a collateral to the bank. All right. So bank will provide funding to you, and you can you can access that funding maybe for a 5 years, 10 years, 20 years. But the it is a legal obligation would be, on the party like you to repay that loan, principal plus interest payment to the bank without any miss. And if you miss, of course bank will have a, rights, which is a sell rights, so that they can easily sell your assets, or which is, property in the market, and recover their money. Did you get this? So in the same way, you can see that in the same way here also same thing happened, where if you, let's say as a businessman, if you fail to repay the payment of a bond holder, so they will have a legal rights. This POA, it means it's a guy's legal rights, goes to the investor to sell the assets of the business upon default events. So if something happened, then investors will have a rights to directly sell your assets and recover their money. Now your question would be, look, sir, why, why if this is an obligation, then why should I raise funds through this? See, every time you can't raise, the capital, every time you can't raise capital through equity due to certain obligations. So it's a very important, that to understand it, why you will do this. If let's say if you can raise capital through equity, and if it is an easy process, then you can raise it continuously, that's fine. But if it is not, then it means you can't. So you will have to eventually transfer the rights of your assets to someone who can help you to raise funds. So it's a very general process that I'm talking to you guys. It's not something, no sir, this is not the case. No, it's a very simple process. And if you can raise through equity, right, if you can raise through equity, then you don't need to sign any kind of documents and all right. So if you want to understand the difference between equity and bonds, I'll just simplify it through very simple example, because you should know it. Let's say you have your property. Okay, you have your property. When we say property, you can assume it even it's a business property as well, that's fine. You have your property. See, if you and this property value is, let's say value is 10,000, total value is 10,000, and now you're looking for a fund. So you're the person who is holding this entire assets, value of assets. But if you decided to, let's say, allow other two people to join your business as a partner or as a owner, and let's say you have decided to this transfer ownership, 50,000 you have decided, 5,000 you have decided to keep with you, 3,000 or let's say 2,500 you have decided to transfer to one partner, and 2,500 you have decided to transfer another partner. All right. So now just imagine this is your 1 BHK or 2 BHK flat, and you have decided to allow other partners to stay in the same flat by paying you the value of your assets. Now just imagine for a moment, what if it was your own flat and now other people also they'll take a position in your property and they'll hold it. So how will you, now you tell me, how will you survive? This is what the exactly equity works. Equity, it means you guys are transferring your personal ownership to the other people. You are inviting them to be a part of your business. If you want to take any decision as such in future, so you are depends on them. So without their consent, you cannot take any decision. So it means equity is like to share a private space with other people, to share a private space with other people. Now your question would be, look sir, if I share my private space, then of course I'll have to face some problems. I'll have to take care of lots of things. Yes, you will have to take care of lots of things, maybe cleaning, the other maintenance and everything. So same way in a business also, your accounting come into picture, audit come into picture, utilization of a fund come into picture, management decision, everything, means everything would be depends on your other two partners. Why? The reason is they are holding the ownership rights and they can take decisions as per their understanding. And here the business promoters or businesses can face lots of problems when they dilute the equity. Now on other hand, if I don't want, let's say, if I don't want the intervention of other two people, there's two people, I don't want their intervention in my business day-to-day operations, let's say, right? Then what could be the better option? Instead of giving them the let's say giving them, you can say, position in this particular property like this, so what you can do, find a better solution. Now allow them allow them to take a position with the same value, right? Same value, by paying that money to you, but they'll not hold your property. Actually they'll not hold your property, but they have a legal rights, right? They have a legal rights. If you fail to make their payments on time, then only they can take your private space. Otherwise they'll not grab your private space. So it means you will get a freedom to do your business on your way, or maybe as per your whatever vision that you have. right? So in that case, your bond investments or loan investment becomes, promising, or fund become very promising if you raise funds. Did you get this? And that's what, if you don't want to share your private space, then what you can do, instead of sharing private space, just, legally sign the papers and share that paper with, investors, and tell them, look, boss, I need your fund, right, on fixed income, agreement terms. If I don't share, let's say, fixed income to you on investments, then you can take the control of my assets. But if I share, let's say, fixed income percentage with you, then that's fine. So it would be my asset only. So I'll ensure that continuous repayment of your funds, or let's say investments, throughout that particular cycle. So what you need to do, you just need to sign agreement with me. That's all. So sign this agreement, and will include everything: fund, term, let's say coupon rate, means which is interest payment, duration, different, rights. If I want to include, I can include that. So we can incorporate all the technical terms, or economic terms, or business terms, I would say, which can define that, it's a legal agreement. And if something happened, it will protect the rights of investors, and also it will protect the rights of businessmen. So I hope now you get the, clarity of the difference between equity and bonds. Equity, it means sharing a private space with others, as they'll get the ownership rights. And debentures or bonds, it means we are directly raising, loans from the investors by collateralizing the assets. The bondholders will get the rights, or let's say bondholders will get the control of the assets upon the default events or insolvency events of a, let's say, business. All right, if the business is not capable, or let's say bankrupt, to provide, or let's say, uh, repay the whatever capital it was raised, in that case only they'll take the control of your assets. Otherwise, this would be, your space only. It would be an entire space yours. You can enjoy that. If you raise bond investments, your space looks like this. You have, your equity worth of rupees, this one. But again, you will have to also maintain that on same equity you have raised fund of, 5,000. So that becomes your liability, right? So it means against this assets you have a liability of 5,000. So this is how you can relate, means what is equity and what is bonds. Okay, this was just a basic one. Now let's continue our example, because here we are talking about the bonds. All right. So let's say now let's continue with the bond example. Power of PO, it means power of attorney, and that same documents will call it as a sell rights. Sell rights of assets. So basically here, this guy, businessman, is giving sell rights to the investors to sell the assets if this guy, let's say, not able to fulfill the obligation. So when we say obligation, it means, guys, this is a legal document, okay? When we say legal, it means this document has a vettage. This document has a vettage, all right? If you're holding these documents, then businessmen, they can't do anything. All right. So let's say here businessman decided to, split the assets, because we have assets value, which is, the asset value is 80,000 net assets value. So sorry, 8 lakh, not 8,000, right? 8 lakhs. So this is the assets. But again, the question is like, if you have a, let's say, equity, this is your equity, right? If you have an equity of 80,000, and if you raise, let's say, borrowing cap, borrow fund of 8 lakhs, then here you can say, your equity and that borrowing, the ratio would be 1:1, and which is not a good equation, I would say. All right. So this equation is not good at all. So it's a very important that to understand it, like how much capital that you can raise. See, as per this, equation, of course, your capacity is to raise, maximum capital of 8 lakhs, because you have that, the assets value. Your asset value is 8 lakhs. So you can raise maximum capital or let's say borrowing fund from the investors up to 8 lakhs. But there are businesses who also, raised more, let's say, loan capital through loans and bonds than the equity. Let's say if their equity is 8 lakhs, they can raise up to 1 lakhs 20,000, 12 lakhs, I would say. If this is the equation, if you raise the 12 lakhs fund, so it means your business is in risk. At any point in time, you can see this business will announce bankruptcy. Why? Because if you see the debt coverage ratio, it means you don't have enough assets to repay your debts. If let's say, to understand this in a very simple way, let's say your salary is uh, you're earning 10,000 and you have taken personal loan of 20,000. So in this case, if you see that actually personal loan is in risk, the reason is, your actual salary is 10,000 and you have taken loan of 20,000. So it means your liabilities are double than your capital. So did you get this? If your capital is small, or let's say income is small, and if you apply for loans with a higher amounts at any point in time, you would face lots of challenges. It means lots of challenges. But on a contrary, if you have, let's say, taken this personal loan to invest in bonds, where that bonds is paying 15% or 20% interest payment, in that case, might be that feels like, to you, that you are in a safe. The reason is you are earning interest payment on that loan amount as well. Let's say you are paying 10% interest payment to the bank, and you are getting 20% interest payment from the investments. So basically you would be in a profit of 10%. If this is the case, then even if you have a higher liability, which is fine, right? Which is fine. Now your question would be like, sir, why? The reason is you have assets, guys. You have assets to cover the liabilities. But what if you don't have assets to cover the liabilities, then what makes sense? So it is a very difficult, right? So we are assuming this, on the basis of this example, company decided to borrow only 2 lakhs, all right? Decided to borrow 2 lakhs. So this looks like, after the means raising capital, it looks like this. It was total, company's equity or assets, right? It was totally company's assets. But after the raising capital, equity value 8 lakhs and bonds 2 lakhs. So company has raised 2 lakhs, fund, or they have decided to, let's say, raise 2 lakhs on value of rupees, let's say, 8 lakhs. So in this case, you can see it's a very decent. The reason is company has more assets to repay the debt, right? To repay the debt. And in this case, you can say still, which is a fine. It's a stable, very stable. It's a very stable. It means very stable in this case. If you have more assets, so company can sell out their assets and repay the debt if something happened. Even if, see, we cannot, let's say, trust on business that every time you would be able to generate more and more revenue. There are thousands of cases which I have seen where they have raised huge debt, but their business model was faulty, and now they are in a big big trouble. So let's take an example. Byju's raised 2000 crores from the hedge fund. What happened with Byju's? Anyone heard about this, guys, from the group? What happened with Byju's? Of course, Byju's is now filed bankruptcy. The reason is their revenue model was different. And if you are raising, let's say, 2000, see, if you have, let's say, universities or colleges or campus, physical campus, that we can treat as an assets. So still, which is fine. But if your entire business model is based on online teaching, so it means basically you don't have any assets to cover that, the debts and all. And the entire business model was depends on the online, students and revenue. So how long you can, let's say, survive? How long? You cannot. right? So same applies to the other businesses as well. If you don't, on the other hand, let's talk about DMart. See, DMart always they purchase a land if they want to, let's say, scale their business or maybe open, new, let's say, their units, the retail shop. If they want to open anywhere in the any city, they directly purchase a land instead of applying for loans or to take a loans, then collateralize it. They don't believe on that. They directly buy the land. They believe that if they buy land, even if let's say their business doesn't work out, they can directly sell it out that assets to anyone. Maybe they can rent out that property to anyone. And let me tell you something, DMart can generate huge value for investors in coming time. Why? The reason is they are, instead of buying assets through loans, they are directly buying assets through profits, right? So it means profits that they are reinvesting, and the other parties, they are directly buying properties at a prominent location like Pune, Mumbai, Delhi, Noida, right? Or at a very growing cities, I would say. And if they're buying land, so it means how land prices has been increasing every year on year basis. So we have seen that, right? I had purchased a property few years back. Now my property price, which has been, let's say, multiplied like 5x. I invested only 5 lakhs. That same price, which is at now, means property price, which is at 25 lakhs. So same if we just apply the logic. So DMart would be means my top priority from investing perspective. If I think if I want to invest anything in stock market. Anyways, so let's talk about now this process, equity value and bond value. But your balance sheets looks like this, that equity like 8 lakhs, or bonds like 2 lakhs, and bonds will treat as a liability. And hereafter business have, let's say, raised funds through bonds investments only. See guys, to invest this liability is again decision of the promoter, how that basically promoter want to utilize that money. But let me tell you something, even if as a businessman, let's say, if you raise funds from the any investor, always calculate cost of a fund, cost of a fund, always evaluate business model, right? This is a very important one. Always see your cash flows. Now your question would be like, sir, why all of this important? Because this investment comes with cost. Let's say cost is 10% per annum. 10% per annum. 10% per annum. Okay. So every year, business will have to pay 2 lakhs into 10% divided by 100. So which is 20,000, and that would be interest cost. Interest cost. And what if, let's say, if you don't have a business model, or if you don't have a, let's say, because eventually this interest cost, it will affect on your profitability also. So how, let's say you have generated profit of 1 lakh, right? Business generate PAT, profit after tax, which is 1 lakh, right? So from this 1 lakh, we'll have to adjust interest payment, 20,000, and net profit would be, you calculate it. So 80,000, right? And every year you will have to pay this because it's a liability. Now, what if, let's take a hypothetical situation. So when we say cash flow, it means your business model was strong. You had utilized, assumption is you had utilized that funds for a, let's say, acquisition of new assets, and you had a very strong cash flow. So you have generated profit, which is 1 lakh. But what if, let's say, unfortunately for a particular year, your cash flow was dropped, let's say, like very significantly, and now come down at 10,000. So your profit would be also same, which is 10,000, but you have a liability of 20,000, which is your interest cost. Now you tell me, how will you pay this? Additional, 10,000. How will you pay this? Just think for a while. I'll take a pause here for 10 seconds. And I'll give that opportunity to you to think now. Let's say, see, on the basis of business model, you raised bonds or capital through bonds, right? Which is 2 lakhs. You invested in assets, but unfortunately, due to your maybe faulty business model or XYZ things, now you are not able to generate a cash which can at least you can repay the interest, let's say interest payment or interest liability. So now you tell me, how will you manage this, the negative 10,000 liability? How will you manage this? I'll take a pause. You can text. So this is, guys, something which is trouble. You will have two options. One, you can, whatever the payment is pending, which is 10,000, you will have to sell the assets. Sell the asset, it means reduce this equity. So you will have to continuously reduce your equity. Sell assets, maybe convert interest payment into stocks. So basically, you will have to dilute your ownership. So again, so they can take a, they can continuously, take a control of your assets, and it looks like this. Then your actual assets will reduce, and it looks like equity value then 7,90,000, and their total bonds holders control would be around 2,10,000. And if you continuously, let's say, if you continuously make a losses, then one day they'll take the entire control of your business. Why? Because their liability, it will be, compounding and compounding through interest payments, and they'll take the control of your business fully. So eventually equity holders will remove from the business. So if you don't want to lose the ground or control of your business, then make sure that you have enough equity in place, or cash in place, or a sound business model, I would say, which can protect your equity in your business by repaying debt and interest payment to the bond holder or loan holders on time. All right. I hope you get this. It's a very important one. See, I don't want to only give a theoretical gyan which can help you to, crack the interview. This is just a, see, it's just in an entire syllabus I can cover in two hours. Okay, important things. And we can have like, Q&A discussion, and that portion we can cover it out. But this will not help at all. You should know it, in details, very in details. It means very in details. So then only you can grow in corporate or even in your own business also. If you don't know the, let's say, plus minus of fundings, how to raise, when to raise, means, how to utilize that fundings and all, then again, this, it will not help you at all. All right. So here, so one thing is very important. So we should track the cash flows. If there is a problem in cash flows, then definitely you can see big problem we had for a business. All right. So let's go ahead. So we are assuming this, the business is generating more cash and all. So in that case, of course, it's a good for a business. So means you can say that, company have managed the debt very well, and they're generating more revenue for their, the business. So, or let's say for their shareholders and all, you can say. But now the one more question is here again remains same. Sir, how this, 2 lakhs we can convert into bonds? How we can convert this, 2 lakhs into bonds? See, there are ways. So that process, we'll call it as a conversion of assets into notes. Conversion of assets into notes. So how we can convert that? Again, it's a legal process. It's not something very different and all. It's just a legal process, which is securitize, right? Securitize of assets. So it means, in short, we are talking about how we can convert the your assets into the small tranches or assets. So securitize of asset, it means just convert the assets into securities, right? To convert the assets into securities. So that process, we'll call it as a conversion of assets into notes. So if you have assets of, let's say, 8 lakhs. So, but you have decided to, maximum conversion of, let's say, assets only 2 lakhs of rupees value. So in India, I would say previously it was like minimum investment, minimum the note size, it was 1 lakh, 1 lakh. But now that they have reduced from 1 lakh to 10,000. So minimum size of one bond, it would be 10,000 rupees, right? 10,000 rupees. Now, if you want to, let's say, split the 2 lakhs into the let's say number of tranches, so how many tranches that you can create, or how many, let's say, bonds you can create. So you can create a bonds of, the calculation would be 2 lakhs, which is the total amount you have decided to raise. So 2 lakhs divided by 10,000, the amount which you want to raise, 10,000. So max to max, you can create 20 quantities. So that quantities you can call it as a bonds. Maybe you can call it as, again, let's say, notes, tranches, right? Even indentures. These are the legal names or terminologies, but all represent the same, right? All represent the same. Now your question would be like, sir, how it looks like? It's just the piece of paper, right? It's a piece of paper which represent the value of, let's say, the assets or company or details. It looks like your currency, like notes, your notes, 100 rupees notes, 200 rupees notes, or 2000 rupees notes. That is also a bonds, right? And your bonds also looks like same like notes, I would say 100 rupees notes. So basically companies will convert that assets into 100 rupees notes. Now your question would be like, sir, who will help companies to convert this? Depositories will help, depositories, or I would say even brokers, they'll help to convert, right? Convert this assets into different tranches or notes. They'll help. So again, in India we have NSDL and CDSL, right? And CDSL. So you can appoint them, or maybe you can appoint broker like ICICI and all. So see, means depends on you. So how you want to take it forward, that your proposal. So you can discuss with the broker or maybe with the NSDL and CDSL, deposit the amount, because security deposit also will have to pay to the NSDL and CDSL. They'll ask for a detailed proposal and legal formalities and all. So you can disclose all your finances, everything, means everything. And then after, they'll provide you the proposal, and they'll also convert this value into the digital tranches, digital proof of payment or digital proof of ownership, right? Digital proof of ownership, and each, let's say, tranches will have a value of 10,000, and this becomes face value of your securities. This value becomes face value of your securities. So this face value, you can actually uh, put it on a paper, right? Put it on a paper means legal paper. So that legal paper becomes your bond. It looks like a certificate. It looks like a certificate, and which represent the face value of a bond, let's say 10,000 rupees. And along with that, it also represent the coupon amount. Coupon amount, it means interest amount. As I said, it's a fixed income instruments, right? All right. It represent the like this 10% interest payment per annum. And maybe maturity like 5 years, 10 years, 20 years. So depends for how many years that you want to sign this particular bond. Or bond, it means, of course, it's an agreement, right? So for how many years that you want to sign the bonds with them, so look for it, maybe 5 years, 10 years, 20 years, depends on the business objectives. That business promoters, they'll arrange the documentation and everything, and finally you can convert that into the tranches through depositories, because depositories will issue it all of that. And you can see, so maximum tranches, as I said, you can create 20. So we'll create a 20 now. So I'm creating that legal documents. How many is? 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, and 20. These are the now bonds which we have created, right? So all bonds See, all bonds, they have a value, guys. All bonds, they have a value. So it's a very important to understand this. All bonds will represent the assets of a company. All right. All bonds will represent the assets of a company. Why, sir, assets? Because, see, understand this one. Business has assets, and that's what, that same business collateralized, their assets into tranches. And now, through legal process, we have converted assets like business assets into the tranches. And if anyone hold this, tranches, so that person will receive the ownership rights. Right. Now your question would be like, look, sir, can I purchase it, this rights? Yes, you can purchase it. See your appetite. If let's say you are this one, and if you have decided, if you have let's say 40,000, then you can pay 40,000, right? Pay 40,000. Why, sir, 40,000? Because each in a tranche have a value of 10,000, right? 4 into 10,000 would be 40,000. You can pay 40,000 and buy bonds of 4 quantities. So you can hold that. So you will get the rights of these bonds. Same, let's say your friend decided to, let's say, invest your friend decided to invest again 5 bonds. Your friends will receive, your friends will have to pay means invest 50,000, right? And buy bonds 5. So your friends will receive 5 bonds. Let's say the LIC of India decided to buy, because that LIC of India is a big investor, right? They have decided to invest big amount of investments. Let's say this one, 6. So they can pay 60,000 and buy bonds of 6 quantities. All right. So for them, we'll have to create different one. I hope this is very much clear to you guys. I thought like to explain through this one will help you. So I'm just doing my best. Let's say insurance company, right? Then apart from that, mutual fund also decided. Mutual fund, it means asset management company, guys. That companies also decided to invest, because mutual fund also will have a big appetite. So they have also decided to invest big amount, right? So they'll pay 50,000 and buy bonds 5. See, one thing is again very crucial in this process is all, they are the, participants. All are, if you see, all are investors. Okay. All are investors. So all they now eligible or entitled, I would say, all are eligible or entitled, right? They're holding the business, assets in your business, and they all are eligible for fixed income instruments. Fixed income on their investments. So let's say if the 10% is decided, for per annum, then this person will receive 10% divided by, you can write down calculations also, please, 4,000. So this person's income would be, fixed income would be 4,000 for per year. Means every year, this person will receive 4,000 income from whom? From a company. Why? Because they have paid this amount, paid to whom? To the company, right? To the company. So company, they have received. So all this money company has already received, right? If the company received this amount, then basically your company is, responsible to generate more and more, let's say, cash flow or profit, so that they can, company can pay continuously interest payment to every, investors. All right, every investors. Why it is negative? Let it be 4,000. Again, for this participant also will receive 5,000. For this company also means this investor also will receive 10%. For annum it means 60,000. And for same person also it will receive 50,000. Sorry, my bad, 6,000. Here 5,000. 5,000. 10%. See, all they'll receive, their income percentage, because it's a income sharing, it's income sharing investments. So whenever company will earn profit, or even if company don't earn profit, it's not something, really matter to the investors, because they have invested in companies and they all are holding the, assets of a company. Because these documents, guys, these documents represent the ownership in companies, now assets. So instead of ownership, you can say this particular documents provide rights to the investors to sell out that assets. If company, let's say, if company, not able to repay the debt, if company is not able to repay the debt, then investors, they can directly sell it out, the company's assets. So they can directly sell it out. And that's what it becomes very important to manage the debts, or to manage all important, I would say all important, the your debt related like obligations and all. So it is a responsibility of, you can say, the promoters or companies managements to track out all of this very, in a very transparent way, and to make sure that if you have raised any funds through loans or bonds, to make sure that you have enough assets which can protect your assets, or I would say which can, protect your investments. And if you don't have that, then it would be very difficult for you to manage that payments. Then eventually they can directly take the control of your assets. The reason is this particular, bonds or tranches, directly they are interlinked. If you just ask me to, can you just interlink now? If you just, interlink that everything, it looks like this. Let's say your investments means entire your tranches, because this is something your face value of a bonds, right? And which represent. So if anyone holds 4, it means that person will have a rights of your company's assets for 4, 4, let's say, tranches with a value of 40,000. So that same person can directly sell it out your, company's assets to anyone in the open market. Open market means open market. So it's a very strict process, I would say. And if you see, this process actually created through, securitization. So securitization, it's a legal form, guys. Securitization, it's a very legal form. So this is what something it is created through legal process. And if it is created through legal process, so we should ensure that, you cannot even challenge anywhere, because it is created through NSDL and CDSL. Let's say we have created through NSDL. So we cannot challenge anywhere. All right. So I hope you get this. So can you see my screen, right? So all of tranches created through NSDL or through legal documentation. And if you see the link of all of this, instruments, see here you can see the link. Let me draw that as well, so that you can means relate that one. And then after I'll open this for Q&A with this particular portion. Let's say, see, we have set, securitization, right? So through securitization, basically it provides the direct, here you can see the connection. Say this. Through securitization, we have created multiple, securities. We have created multiple securities, and sell it out that securities in the open market. So here, if we just simply understand this process, company sold securities in the market to raise funds, right? Company simply sold the securities in the market to raise funds. All are the securities, correct? And if we talk about investors, they have simply purchased securities from company, right, by investing cash. So it means company will investors will transfer cash to the company, and company will transfer securities to the investors. So when we say securities, guys, your investment is secure by assets. Did you get this? See, the meaning of security is that security define you have a security of investments, or you have a security of assets, or let's say you have the securities which covers the assets of a company or business. So if something happened, that you can legally claim in the court, right? So the same paper you can legally claim in the court, and that paper, that paper has a value or legal weightage. That paper has a legal weightage in the market. So this is how your actually bond creation process works. Now, another question would be like, sir, look, we haven't this discussed for equity. So can we say same process we can apply it to the equity also? Yes. Same process that you can apply it to the equity also. In case of equity as well, you can see the same process that we follow and process it out or convert the your capitals into equities, and then equities that we can sell it out in the markets and raise that from the investors. All right. Now I'll take your questions, whatever questions that you have, and then we'll discuss further part. I'll give this opportunity to you to ask questions. Come on, guys. Any questions? See, in a power of attorney, as I said, power of attorney, it's a company's legal document. So entities name that we can, right? Companies, that entities who are the authorized person of a company, their names that you can see, it will be included in the process because they would be the signer of this particular documents. But on the name of company only we can issue the documents instead of individual person, because individual person can be replaced or let's say can be resigned, right? CEO or board of directors even, so it'd be difficult. So basically on behalf of company can appoint someone to sign the documents, but we can include the entity name, legal entity name, and a signer. So any other question, Srisha? This is what the practical insight, it means the process what we have discussed that comes under practical in industry, right? So nobody decodes the process of like how to create securities and all. If you want to do business, your own business, then only this process will help. Otherwise in industry, the entire thing should be like your just data entry work. Data entry, it means buy at a trade date, sell at before the any event date, that stuff come into picture. So which is something which is a data oriented stuff, so which you can say it's a static data process. But once you have created securities, now we have created a securities, so your static part come into picture. So anyways, so let's get into that part, deep dive. See, now if we talk about, guys, securities, so first question that it will come in your mind, sir, how we can buy that securities? Can directly, let's say, investors meet to the this guy where sitting in the office, let's say this guy sitting in the office of Mumbai, right? Because their head office in Mumbai, the company name is ABC Corporation. So sir, can we directly reach out to this guy? Of course you can reach out to this guy, right? But now let me ask you a simple question. Look, my expertise as a businessman to raise funds and to invest in different variety of, let's say, maybe technology sources, hire a team, build team, do etc etc. So my the expertise, not which is something into the talking to the investors or do sit with them, no, because that's what I'll hire CA, I'll hire CS who can take care of that investor communication part. I'll hire CFA or other person who can take care of investors communication and all. Now your question would be, look sir, what sort of job that I can, if I get opportunity to work, then what sort of work that I'll deal with. See, if that businessman hire you as a, let's say, a budgeting manager for a budgeting, or let's say performing some analysis with their debts and all, then your job would be like, to track companies, data, let's say total outstanding, their interest payments, calculate interest payments and liabilities, prepare a model that how companies utilizing their debts. Maybe you'll have to prepare a, let's say, short analysis, I would say, with your equities or business operations models and everything, and to see how that in a company or management they are utilizing the debt capital, whether it is profitable or not, whether it is, let's say, means how they're managing their interest payment, whether debt is covered or not, whether interest rate is covered or not. That sort of activities which you can see which comes under the budgeting or analysis, right? Apart from this, they can hire you as a corporate, corporate secretary, or let's say manager, where your main responsibility would be to take care of KYC part, to take care of, let's say, compliances, policies, regulatory, let's say, policies, or to highlight, let's say, different, the regulatory reportings and all to the, because to that particular, let's say, board of directors and all. So why? The reason is, once you raise capital through external sources, so it's become very essential, or I would say important, to file policies and address, or inform to the regulatory bodies that, like, who are the investors, their KYC, their documents, their repayment schedule, amortization schedule, outstanding payment schedule, so that everything come into picture. Everything means everything. So if you are a CA, then that would be your roles and responsibilities. And along with that, of course, frequently, communicate to the investors, send the different, updates. Maybe let's say if company launch any product, you can send that update to the investors. Make sure that your investors, they're feeling comfortable with your business. So that would be the responsibility of company secretary. All right. Apart from that, they can hire FRM or let's say, CFA guy as well, who is very, well versed with all of this funding, investing, advising, consulting and all. And their roles vary, I would say, depends on their, the expertise which the management is looking for. So I don't think so, something that I would say, no, this would be the fixed. No. So depends on their, expertise, right? Maybe if they're expert into, let's say, guiding companies to the listing of securities, or let's say, managing different conversations, or understanding, or helping them to understand, the debt, or let's say loans, or which, or equities, which one is profitable and all. So that comes under your CFA, FRM, or I would say, the valuation parts or risk part. So it depends on your role basically. So there is nothing like fixed. All right. So now let's talk about, let's say, company decided to means, split this particular bonds, but the main question is how that, we can buy the securities from a company. One thing which I said, if you just remember earlier, this guy who is sitting in, let's say, Mumbai, he will have to go to his office, discuss the terms and condition, and then that guy, directly transfer. See, there are two ways of this, securities. One is physical form, and another one is digital form. So digital form securities is just a, deed or physical certificate, I would say, or paper, this paper, and this would be in your demat account. Means that promoter's demat account, or company's demat account, I would say. So which one you want? If the company is okay with the physical form, or investor is also okay with the physical form or certificates, then you can exchange that, securities at office of that particular guy and exchange it out. So that's the process. If not, then pay the amount through your bank account. So that person, like, this guy will transfer you the physical securities, whatever securities that you have purchased. This guy will transfer securities from his, demat accounts to your demat account, right? So that would be your basically settlement, you can call. Settlement, it means you can pay your cash. Let's say this guy will pay cash of 40,000 and this guy will receive 4 shares, and this comes under your settlement. So it means actually securities will settled in your demat account. So here, if you just technically, means from a, investment banking perspective or trade processing or settlement perspective, if you ask me, what will happen on trade date or settlement date? Investors will, pay cash, and receipt of securities or bonds, I would say. Same applies to all other. And in the book of, let's say, this guy, this guy will receive cash against to deliver shares. And if this happened, let's say on XYZ date, it could be any date, guys. There is nothing kind of fixed. It could be any date. If this happened, let's say today, and if both the parties they are okay with, let's say okay with settle this out, then that date you can call it out as a maybe trade date or settlement date. On trade date, maybe you can buy it out or negotiate terms and all. And if let's say actually your banker, let's say transfer payment to that guy's account, and that guy's let's say maybe personal PA, secretary, or whosoever, if transfer securities from his or her accounts to your accounts, so that process will call it as a this process will call it as a trade process or settlement process. But here is the catch. See, every time it is not possible to reach out to that guy, negotiate on terms, and let's say execute the trades. See, here with the example, we have only created a 20, let's say, tranches. But in reality, what if, let's say, this amount is your 2,000 crore amount? So we have decided to reach 2,000 crore amounts. Now, 2,000 crores divided by 10,000, if you just, divide it, there would be somewhere 200 crores or maybe 20 crores something, equity, 20 crores something bonds. Now you tell me, if let's say more than 20 lakhs people, if they subscribe my bonds, so it's not easy for me to deal with all that, 20 lakhs investors. Did you get this? Is it easy process? No. Then how can I run my business then if I only get engaged with the investors to talk with them and negotiate with them? So it's a very difficult process. Now let's talk about, sir, solution. What could be the then probable solution to deal with all of this mess? So how we can deal with this? Yes, to deal with all of that in a process, that's what your depository will help you. Sir, how my depository will help? So your depository will help to convert first physical forms into dematerialized way, and that's what we pay huge depository fees to the depositories. So you can appoint any depositories, NSDL or CDSL. So depends on your, let's say, depends on your facilities or functionalities. You can select one depository. So that depository will convert all these physical forms into dematerialized form, right? Dematerialized form. So it means here, if you want to convert this, let's say to convert securities into digital, appoint NSDL, select NSDL. So we have selected, let's say, NSDL. Right? See the flow. So NSDL, basically it will convert all of the securities into digital form, and same securities, it would be available in your, let's say, portfolio or in demat account. So all securities, basically it will available to all the investors in demat account. All right. So the first assumption is we have converted all of the securities into demat, and then only we have transfer it out, or company, let's say, transfer it out to the investors. Right. Now, the most important is, see if the securities are available in market, and what if the securities terms, let's say all securities were issued, let's say issued in the market or with to the investors, I would say for a 5 years terms. 5-year terms. So it means before the 5 years, this guy cannot reach out to the company, right? To this guy, hey, can you repay my debt? No. Why? The reason is this is the the power of attorney document. So if you have a power of attorney and which let's say already stated that you cannot reach out to the company before the 5 years if you are getting your income continuously. If the let's say if there is a failure in interest payment, then only this guy can reach out. Otherwise, you don't need to reach out to the guy who is sitting in office, because let him do the business so that he can generate more cash flow and send it money to you. All right. So this is a very plain process. But what if, let's take a hypothetical example. What if this guy is now looking for a sell off investments? This guy is looking for a sell off investments. The condition is, see, this guy cannot reach out to the company and sell the securities before the, let's say, 5 years, or assume it, the security, it was issued for by 2030. So it means the security will redeem in 2030 by company. So now you tell me, let's guess how this guy can sell off his investments and what are the ways. So I'll give you 10 seconds to text in the chat box your understanding how this guy can sell out the securities. Come on, quick. I'll give this opportunity to you to think, or you have a 10 to 15 seconds of time to think and text in chat box how this guy can sell. The condition is this guy cannot reach out to the company owner. Why? Because the agreement was signed for 5 years. So you don't have any rights to reach out to them. So it means you can't. Any guess, guys? So here in this case, if this guy want to sell the security, in this case, see, the process is there are marketplaces available in market. There are marketplaces available in this, world. Marketplace. Now, if we talk about, let's say, marketplace. So how many marketplaces that we have? Come on. Come on, guys. How many marketplaces we have? BSE, NSE, right? Bangalore Stock Exchange, Ahmedabad Stock Exchange, right? Kolkata. There are many more, right? There are many more. So these are the marketplaces. So marketplaces is nothing but here you can see more and more, buyer or seller, I would say. So exchange is a platform. Okay. Exchange is a platform. It's like, let's say, vegetable market. When you visit to any vegetable market, what happened there? See, farmers, they directly, exchange commodities to you or vegetables to you in exchange of cash, correct? So it means at that marketplace, you can find a potential buyer or potential seller who want to buy and sell securities with each other, correct? Who want to buy and sell securities with each other. So basically, all these investors, they reach out to the marketplace as well as they also reach out to the broker. Because see, here we are talking about bonds. So it means most of the bonds, they would, the bonds would be listed on, let's say, marketplace, or in some cases you can see bond is listed, not listed on marketplace, but that bond is listed on listed with a broker as well, because most of the brokers, they have their private marketplace system as well. All right. So here you can say exchange and broker. Let's say ICICI broker. I'll take just domestic level example. ICICI broker. So this bonds basically listed on a marketplace of ICICI, right? So here the one thing which is very important, guys. Now your question would be, sir, why marketplace or why broker? See, if this guy is not able to sell the security in the market, let's say as and when that he needs a cash payment, then so it means that security has no liquidity available in the market. So it means in 90% cases that no one will buy that security. So it means businesses will struggle to raise funds. Did you get this? It's a very important that, and that's what NSE, BSE, Ahmedabad Stock Exchange, Kolkata Stock Exchange, Bangalore, Pune, all other the exchanges which are available in the country, they ensure that, the securities has enough liquidity available in market. So when we say liquidity, it means the buyer and seller who can exchange the securities with each other, right? Who can exchange the security with each other through stock exchange or maybe your broker platform. So as I said, broker also they will have their private platform. Broker also will have a private platform. So now if let's say this guy want to, let's say if this guy want to sell the securities, then simply this guy will reach out to the marketplace, right? Now you again another question would be like, sir, how this guy means directly reach out? See, there are ways, guys. Maybe through, let's say, if the security is available in digital wallet, then simply you can open accounts with broker, and through broker you can access the marketplace and place your order. Why? Because this guy want to sell the securities now. See, in the here only, in the first place, that market becomes your primary market. See, here in a primary market, you can directly contact with actual means original issuer, means company, right? This guy had a directly connect with company, right? So we have seen that we have directly purchased securities from this guy, correct? This guy means this original guy or owner was, let's say, board of director of ABC Corporation. We have directly purchased securities from that guy. So it was an original trade. So it means this guy had purchased securities directly from the board of directors. But due to his personal financial, let's say, condition, this guy is now looking for a sell of securities in the market. So if this guy want to sell the securities in the market, right? See, as I said, before the 2030, this guy cannot go back to the company and ask for a liquidation. So it means this guy can simply go to the marketplace, list his security here with the quotation. So now quotation would be, let's say, see, the NSE will provide trading system. NSE will provide, it's a marketplace, right? So it provides trading system, like, let's say, buy orders, your sell orders with quantity details. Let's say this guy want to sell entire four quantity with price, or here sell order with price, let's say 10,000. And if there is no order available in the trading system, because it's a trading system, right? See, in trading system of NSE, let's say there is no buy order in place, then this order still remains open until we get the quotation from the investors, other investors. Now your question would be like, sir, who would be the investors? Of course, the other people who are interested, maybe other people, I would say, they would be the buyer of securities, even the insurance companies, family businesses, or anyone means anyone who is really interested. So it can be other mutual funds or hedge funds also. They would be the buyer of this particular products. Let's say Z, this person is Z, E, they are the different one. See, again, they'll also check their several conditions. It's not something that now decided and quickly they'll buy it out. No. See, buying and selling, it just the decision of investor, I would say, and that is depends on the several factors. It's not something that let's say security is ready for a sell and they'll quickly come and buy your securities. This doesn't happen very quickly in bond market. Okay, this doesn't happen. So it will take time. This process will take time, and it's a lengthy process. But due to the marketplaces, guys, trust me, due to the marketplaces, maybe someone, right? They'll see, ultimately every person want to do some investments in some form. Maybe it could be equity, bonds, debentures. It could be something, I would say. They want to invest. They are looking for investments, not only bonds, but it could be in business as well, right? See, recently I have invested in retail shop. So there was a guy from a Gujarati family who wanted to, do business. I thought like, let's take a risk. Instead of investing in equities, what I'll do, I'll, invest 1 lakh or 2 lakh rupees capital with him. That guy will do business, generate more money. And it's a partnership. If that guy generate more money, then that guy will directly share profit with me, right? So I took a risk. So that part also comes under investments. It's not something only to invest in bonds or equities back that becomes, the investment. No, there are people who also, invest in real estate as well. So they raise funds from their partners or people, let's say maybe from their contacts who know them very well. They raise funds from them, invest in assets, maybe hold assets for maybe 1 year, 2 year, multiply the money, sell it out, same assets in the markets to other people who are willing to, let's say, buy that particular assets and generate more money, right? So same way from the, let's say, crowd, I would say open crowd, if anyone is anyone is really interested to earn, you know to earn 10% interest payment for per annum, if anyone is really, as I said, to anyone is really interested to earn interest payment which is 10% for per annum from the market, then that guy will send the quotation to the marketplace. So it means again same, open the, you know um, accounts with trading system, I would say, right? Let me insert. So they'll directly, that guy also will visit, or I would say open maybe accounts with NSE or marketplace or broker. All right. So same process applies to the buyer who is going to buy securities from the market. Correct. And they all can send quotation to the marketplace. So now here in this case, maybe see the condition or situation, it could be different. Maybe this guy is looking for only, let's say one quantity, right? It could be this guy is really interested in one quantity only. Maybe this guy is looking for only one quantity. This LIC is looking for one quantity. This also, they are looking for one quantity. So depends. It depends on their requirement, right? Depends on their requirement. If it is, let's say, trading system of marketplace, so they only receive orders, one order, another order, another order, another order with price. So here they can quote price, but if it is a bond, then you will not see much of change in the, the price, right? You will not see that. So they'll just send the quickly orders to the system. And if this orders, let's say, match, right, then simply your system will basically quickly, match this particular details and confirm to the, this guy, look, your order has been, matched, and we'll execute it. We'll execute this particular trade, right? And this trade, it will confirm to everyone, to the even buyers as well, because they would be new buyers, and it will confirm to them, look, we have confirmed your orders against the sell orders which we had received with the price of 10,000. So what you can do, you can pay 10,000 and hold or acquire this particular securities. All right. So this is how it's, actually works. So now just try to understand the flow. Instead of, four, what we'll do, we'll just consider that, the one, because it will help us to quickly calculate. Otherwise, we'll have to do everything for everyone. So let's say there's two people who are interested to buy it. Okay. Two. This guy is looking for a two, and this guy is looking for a two quantities and ready to pay for a two quantities. Let's say ready to pay 10,000. 10,000 into 10,000 into 2 would be 20,000. 10,000. All right. Now, both will send quotation to the marketplace. So send the quotation to the marketplace, NSE, trading system. They'll send it, right? Same, this guy also will send it, quotation to the marketplace. Correct? Instead of this, I'll do here, would be easy for calculation so that you can understand the direction. Right, both are interested in two quantities. And if NSE, let's say their trading desk, if they receive orders, along with that, if it is in a bond trades, so KYC is also mandate. So it means information of detailed information of all three, including funding details. Funding details, it means cash which is 20,000, it should available. Okay. So 20,000 cash, it should available in the account. So basically, the bank confirmation is also important for a 20,000 cash availability. If there is no confirmation, then this trade, it will not be executed. As simple as that. In a practicality also, we actually block the funds. We have a fund blocking system. So in the buyer's book, we actually block the cash. We block the cash and we notify to the, this guy, means to A to block the securities, and this four quantities, it will block or restricted, I would say, block or restricted. Who will do this? See, there is a mechanism, I would say, see, this marketplace has a network, very strong network with depositories. Let's say this is your depository. Now here is the depository, but we'll create another depository here with a depository, NSDL and even CDSL. But in this case, we have only NSDL. So whatever trades will executed in the market, this one. Yeah. All right. So we have NSDL and CDSL, but we have a trades with CDSL only. So NSE system, your NSE system send the alert, all right? Exchange and the alert to depository to block the securities, right? Because let's say this A investor has account, oops, A investor has account, A investor has accounts with CDSL. So quantities would be available here, right? So immediately stock exchange send the notice to this exchange. Immediately means immediately. They send this and ask to you know hold, or I would say restrict. So that process will call it as a block the securities. So it means securities still it will be reflected in your accounts as A, but you cannot again sell it out securities to the others. So that process will call it as a hold, or let's say restriction, or maybe block, right? So the securities, it was available, status was security available at the time of selling. And when this guy, let's say, send the order to the marketplace, and if the order, let's say, confirm, and here if we see, we have a two orders, let's say received from E and Z, their orders will basically confirmed. So I'll just change the status of green. So order confirmed. And if this order is confirmed, so it is a very essential to quickly, block this security. Quickly block this security. And it is a responsibility of NSDL and CDSL to block the security in the books of buyer, original seller. So original seller is in this case, you're this one. A is the original seller, and quickly they'll block it out. So once the security is blocked, let's say this guy, now E and Z, they have accounts with another, let's say CDSL, E and Z. E and Z. They have accounts with another CDSL, means depository, which is CDSL. All right, that's fine. If it is again with the another or any other third party, which is still fine, right? It's not a big deal to transfer the securities, but the important is block the funds, and this will blocked on trade date, guys. On trade date, if the trade is confirmed, so your securities will block in your account. All right. Now let's talk about some other facts also. In the books of these two guys, the fund will block. Let's say they have accounts with ICICI or Axis. So it is the responsibility of bank to quickly block the fund, right? Block the fund, this cash amount, right? If the cash amount, let's say available in saving account or CASA, whatever it is, if the amount is available, let's say balance was available 20, you can still see the balance of 20, but bank will put a restriction or maybe block. That's all. So bank will restrict that fund. So hereafter, you can't access this fund. It is your money only, but on a trade date, bank will directly restrict this fund in your account. Same applies to this guy as well. Balance will now, it will be restricted. And if the balance is restricted, so you can't do, means as a buyer of securities, because all are the buyer, right? All are the buyer because they want to buy securities from the open market, and all are the buyer. All parties are buyer. All right. So fund will block in your accounts. Now your question would be, sir, what if let's say fund is now blocked, which is 2020 40, then security is also blocked. So how then we can execute this trade? So for execution of trade, see, every stock exchange, they have already appointed clearing corporation, or I would say your stock exchange itself work as a clearing corporation. Now your question would be like, sir, what do you mean exactly clearing corporation? See, clearing corporation, it means ultimately clearing of trades. See, actually just look at this one. This guy is looking for a securities, means bonds in account, correct? Bonds in demat account, am I right? This guy is looking for, let's say this guy is looking for cash payment which is 40,000 in his bank account, am I right? Correct? This guy is looking for a cash. So looking for a cash, so it means we'll have to transfer cash in his accounts, and we'll have to transfer securities in his accounts. So who will take care of that responsibility? Because to in see, on a trading date, we are just confirming the trades. Look, we have buy this, or let's say this person buy the securities, or this person sell it out the securities. We are just confirming the trades. We are not actually transferring securities from one accounts to another accounts. We're not doing that. We are just confirming the instructions. Look, we have buy this. Look, we have sell this. We are just doing this. But actually, transfer of the actual securities, which is a very important one, because actual securities which are available here, this person is holding, and to transfer this securities. So who will take care of this part then? It is, if the order is received to the stock exchange, then it is the responsibility of the exchange to transfer the securities from his accounts to these two people, and also ensure that the cash from these two people's accounts to his accounts. The reason is this guy is looking for a cash. All right. And then at the end, what happened? Then let's see. Order is confirmed. This order, once it is confirmed, as I said, order will send out to the depositories. Depositories will restrict the securities. So it means this guy can't sell it out securities to the other people. Then again, this exchange will send it out the notice to the banks, or maybe any intermediate person, or it could be on broker as well, if it is there, to notify to the bank to hold the fund in the bank account, or to restrict the fund in the bank account, so that this guy cannot utilize this fund again to buy the another securities. Why, guys? This is again important. If let's say if you commit that you have decided to buy X securities, and again if the cash is available in your account, then again you can buy another securities, but at the time of actual settlement, so you might short with the cash, and it's a risk. So to avoid that risk, it is very essential to hold or to block the fund in a bank account. It's an important task or process. All right, so it's important and essential task, I would say. So once it is done, then actually what happened, let's now understand this one. In the books of this guy, let's say on a settlement date, on trade date, what happened? We have just blocked the securities and all. So on settlement date or at the time of settlement date, see, depositories will change the position of the securities from this accounts to this account on settlement. And this will, at the same time, this will happen. So there won't be any gap in the time. So banks and depositories, they worked at the same time and they execute this particular trade. Securities will be reflected in the demat account of this guy. If it is a physical one, then you don't see the role of depositories and all. Simply you can, hand over the securities and execute the trades in case of physical, settlement. But in case of, see, through depositories or stock exchange or marketplace, you would see the same flow for every securities. So on trade date, we have seen this, but on settlement date, securities transfer, securities settled in the books of buyer. So you can say here buyer, but for a depository, that doesn't matter at all, buyer, seller. They just transfer the securities from one accounts to another accounts. So it's like transfer of, shares, I would say. They'll just simply transfer it. So your depository will transfer it. If it is a, let's say, another depository, so maybe this depository can connect with the CDSL and ask for a details of, the beneficiary, and then they can directly transfer it out. So this is how maybe you can see little bit change in the process, but there won't be any big change at all. Okay. Then the another important one is, so at the same time, this guy, let's say this one, with the bank, bank, what will happen with the bank? Now, another condition is, see, now we have settled the security, but as I said, cash and everything, it should again settle, at the same time. But see, cash, we cannot settle in depository account, correct? So we need a bank account to settle the cash. Then bank will transfer. Let's say now we'll have to create another flow. Let's say this one is your seller of a securities, seller of a shares or securities, right? So we have a buyer of securities, this one is buyer, this one is seller. And we'll take again hypothetical example. So this guy also has accounts with, the Axis Bank. Maybe it could be with the other banks as well, which is fine. So there is no big change in the process, but it's a hypothetical example. In reality, you might see different banks that happened. All right. So if it is Axis Bank, then the process would be again. So this cash payment, restricted cash payment, it will be debited from the accounts of, this buyer, and same cash payment, it will be credited to this guy, right? So from A, and another, payment, same transactions that you can see, which is for a 20,000. The reason is 20 Axis Bank will pay it and 20 ICICI Bank will pay it. So bank will pay it. It means bank is not paying from their pockets. They are just, bank is a custodian. So bank is, maintaining the accounts of their clients. So banks are there to update, the accounts of their clients or transactions of their clients, I would say. So bank will process it out. So same, other bank like ICICI Bank also will, process the payments from their, customers' accounts to your accounts, and fund will receive to the original seller of securities. And finally, this guy will confirm the receipt of payment. And then again, this guy will say it's a settlement, settlement has been done or payment has been received, unannounced settlement of shares or settlement of securities, I would say. Maybe bank can send the official, let's say, confirmation to whom? To the parties. So there is a process. It means, through one, see, in an international market, you can see message types 102, message types 202, which is, message types. It means, see, once you receive something in a bank account, we received a message, correct? Your salary has been credited, cash has been credited, cash has been debited, salary has been debited. We received messages, correct? So in an international, let's say, or in a trading, system, we have a swift messaging system where we received, different message types, MT102, 202 for a fund movements or fund transfer, so that we actually treat as a confirmation that, security has been debited or security has been credited. Or if you don't want this confirmation, that's fine. Then you will have to every time, manually check that out. So manually, every time you will have to check your payment in the books of your accounts. To avoid that, we always check the payment confirmation through message types. So that message types also bank can trigger and send it out to you so that you can confirm it out. And then finally, bank will confirm it. This particular trade has been settled in your account. And this, activity, entire activity, guys, comes under secondary market. This activity comes under secondary marketplace. If you have any question now, difference between primary market and secondary market, go on. Secondary marketplace. So in secondary market, buyer and seller, where they don't have means linked with, or they don't know each other even. So both would be like anonymous buyers and sellers. They come together, they quote the price and buy and sell the securities in the open marketplace. So that becomes your secondary marketplace. In a primary marketplace, you know your buyer, you know your seller, you know your, everyone. But in secondary market, you don't know anyone who is buying, who is selling, right? So it is a responsibility of, stock exchange or marketplace or market exchanges, I would say, to help you to exchange your securities. And this is how you can see the participants or different participants and all, they come into picture, they help, they help you to execute the securities and all right. Yeah. So this was the entire process of bond creation to settlement or buying and selling of securities, in the secondary market. Two important questions that you might, have in your mind. So why this secondary market? Why primary market? See, secondary market is the arrangement, guys, for a, seller who want to sell the securities. What if, let's say now, let's think about it. You have purchased the securities of Ola company by, let's say, investing your entire, the investments. You had a 10 lakhs rupees you've invested, and that Ola company sold securities to you and you're holding shares, right? As a common equity, see, common equity is the perpetual capital. So you cannot reach out to the Ola company and, redeem your shares, correct? What if your mom is, let's say, serious, or maybe your family member is serious and you are looking for a now cash? Let's take a hypothetical situation. You need a cash immediately, right away. Right away means right away, and you are not now able to sell that securities back to the company, and no buyer is also available in the market. So now you tell me what makes sense to invest in that particular securities then. Because condition is, as an equity holder, you cannot reach out to the company because you are the owner of security. Means how will you go back to the company and ask for, let's say, take back? So company will not take back it. And in an open market, let's say there is no buyer. So how will you convert that securities into cash? And if you're not able to convert your securities into cash, so it means that security has no value in the market. So it's a big fraud then. All right. So to ensure that enough liquidity, and let's say people like who are willing to, exchange the securities with each other. So those would be like, let's say, maybe, the educated, well, professional, maybe traders or buyers or investors or institutions who are really interested or who have excess of cash and who are looking for, let's say, investment into all of those, instruments. They'll definitely come to the marketplace like NSE and BSE. They'll submit or quote their, the price, and they'll buy it out. So it means the business owners, they don't need to worry about repayment of securities and all. So basically businesses will focus on, their products and services, and marketplace will ensure the liquidity of, let's say, buying and selling of securities with, let's say, different buyer and seller like common people. So basically, in short, IPO is kind of a fraud, I would say, big fraud. You can go and watch my video on YouTube. So it's a fraud where, we are actually helping, businessmen like Adani, Ambani to raise capital from us, because we have a huge capital as a public, so that they'll raise capital from us with the condition that they'll not repay that capital to you. But if you need your capital back, then they are asking you to go to the marketplace, right? To go to the marketplace. And if you want to buy and sell securities, or if you want to sell your securities, sell the securities to the others. And of course, the people like, again, us, who are ready to buy the securities from the market, they are fool, because they know it, share price will go up, down, you know, they'll just buy it out, hold the securities. If price goes up, they'll say, look, my research was very good, now I made a profit. And they'll again sell it out, the same securities, to the others. So it means it's a game, guys. So business has nothing to do with the secondary market. Business will only, that this guy is happy now. See, for 5 years, he got a capital from you. 5 years, he'll just enjoy your capital, right? He'll just enjoy it out. And after 5 years, he'll see if he is able to repay your capital or not. And for in case of equity, this guy has received a capital of for a lifetime. Lifetime means lifetime, permanent capital. This guy will not repay that capital. Let's say Ola company raised 4,000 crore. So that Ola company, they'll not repay that 4,000 crores to anyone. They will simply, access the capital, use it, expand the business. If it is, even if business, let's say, goes in dumb, that's fine. They'll just schedule one audit and ensure that in a process has been followed, and that's fine. See, the one big question is, always we have seen criticism like, Ambani supported to the, Modi supported to the Adani to become a rich. Is that true? The brutal fact is, common people like us who have invested in Adani's company shares. So it means we have done this. We have invested, and that's what Adani is now become rich. Adani is not rich because of Modi. Adani is rich because of public who don't know how to invest and where to invest. Anyways, this session is not for investing guidance. The session was for like understanding of operational things, flow, then creation of bonds, or even securities, I would say. So this is the complete model which we have designed. And if anyone is, let's say, person here who is not looking for a job, but who is looking for how that a person can, implement this model in his business, of course, see, follow the same steps. Maybe you can appoint legal advisor if you need. You can, reach out to us as well, like, as a consultant, and perform the valuation of your business. And then again, we can, fill the form on NSE and BSE side that, we are looking for maybe shares or debentures or bonds, whatever it is. They'll provide approval to us. We'll pay their deposit fees. Then we'll activate our demat accounts with depositories. We'll appoint one broker who, will take care of everything. And we'll also, appoint registrar as well, who can take care of KYC, or let's say accounting and all of investors and all who invest in our business, or let's say equities or bonds, and they'll take care of everything. If you have a minimum of 25 lakhs rupees, then you can list your securities in the market, and then your shares are on a marketplace. Simple. So recently I have seen that one Yama something or Yazaki something, they have raised capital, capital from the stock market, which is 11 crore, the IPO size was, but the application received for a 3,000 crores. And that shows like how people, they are immature to invest in stock market. They don't have even office set, good office space. They have just two warehouse or house, that mechanical, that garage, something that you can say. And they have raised 11 crores from the public. But anyways, it's not the session, as I said, the session is not for to discuss any arguments and all, but this is the process that we actually perform in day out of as an investment banker, I would say, in a settlement process, in a trade processing process, or in a fixed income process. And the same process we also follow if you join any company or consulting firm like ENY or KPMG and all. So we follow the same process to support the businesses to list their securities on a different stock exchange. So if you have understood this session, then trust me, you can work with investment banks like BNY, NT, JP Morgan, Goldman Sachs, Wells Fargo. You can also work with consulting firms as well, because consulting firms actually business, the developer models like this, and they share these models with businesses. so that business owners, they can understand it and follow the same process to list their securities. And that's how consulting firms, they make more money. So you should know the flow of stock exchange, let's say, the understanding of stock exchange, then brokers, the company, issuers, bank, how this process happens. So you should know in details. Then only you can work as an investment banker. And this was the detailed discussion on operations, factor of investment banks, I would say. So now I'll take your questions as well. So main board and some SME stocks exchanges also. Primary and secondary, I have explained it, primary and secondary. Okay. Any charges will applicable on doing this? Yes, of course, huge fees will have to pay it. Minimum capital, which minimum, cost, it will incur around 25 lakhs. If it is a small, it is a very small business. And if it is a big business, then on the basis of your IPO size, or let's say funding size, banks will charge huge fees to you. Huge means huge, banks or investment banks and all. Yes, Nikhil, agree with you. Interest rate also it will bite. But when you transfer the securities, ultimately we are transferring the ownership right, interest ownership rights as well. So new buyer will receive the interest payment. So company will settle the interest payment to the new buyer. Then after everything, it will be transfer. So for if Srisha, if you want to invest in US, see for every market, process remains same. If you want to invest in USA market, then open account with JP Morgan, Goldman Sachs, or any, there are local brokers as well. So I have personally open account with eToro, so that through eToro, I have entered in US market as well. So I'm buying and selling securities in their market as well. So if you want to open accounts, so you can text me, I'll guide you to open accounts with that market as well. There are other brokers as well, right? But few brokers, they are like discounted brokers. So I always prefer to invest in, the discounted brokers. So that's how I manage my trading side. See, if there is no, Nikhil, good question. If there is no required amount available to buy the security, so that trade would be fail actually. And that's what your failed trade come into picture. Okay, Securities Exchange Commission. Say, don't use the Security Exchange Commission. Commission is the regulatory body. How to analyze SEC stocks means, what do you mean? Security Exchange Commission stocks. Commission is the regulatory body. See, on investment banking, there are sites, but most of the sites are paid. Actually, there is one, the custodian side, I would say they have a lots of, stuff, but which is again paid. See, entire investment banking, you cannot target. I would say, be specific, like what you are looking for, and then accordingly we can maybe, I can suggest you something. Maybe in investment banking, let's say if you're looking for a valuation, then you can look for a pitch deck or sites basically. Then you can also look for valuation sites. There are different sites, so that you can refer. If you're looking for a startups things and all, maybe you can look for a startups startups valuation sites. So first target the domain. Now, so I'm like, I have spent almost more than 10 plus years in this particular space. So, you can see like maybe I'm at a very different stage at the moment. But if you target multiple things or entire investment banking, I don't think so it will help, because I started initially, I just focus on stock market, right? Then I focused on money market or bond market. Recently, I have started again, to working on this crypto market or tokenization and all. So you cannot focus on entire things. See, Nikhil, capital market is a general term. Okay, in a capital market also, you should be very specific with the products. What products that you are looking for? Is it, let's say, CLO? Then you can go through the CLO and CDO framework of LSTA market and LMA market. They have a website, so they provide detailed and comprehensive information about it. If it is a money market, then I believe the, because I have referred RBI sites, so you can also refer the same. Their sources, you can refer it out. To invest in a startups, there is a site which is, I personally referred that site, but I don't think so it is a very legit. It means, see, first see your risk appetite and all, but still if you are interested to invest, so I'll suggest one site, which is a Taik website. So TYKE. I have invested in a couple of startups through these websites, but I haven't, redeemed my investment so far. So I'm not sure about their investments. But if anyone is really interested in, unlisted securities and all, so I'm a broker of unlisted securities. You can reach out to me as well. So I'll help you to buy securities from the open market. Same for bonds as well. If anyone is really interested to purchase bonds, private bonds or government bonds, you can reach out to me. I'll help you for that. So before investing in, all of these companies, I would say always do your research. So do not. So sir said it means everything would be fair. No, because still things are like very different in the market. So always review. I would say your means do your research and all, and then only take the investment decisions. Without money, you can't do trade. You can just do a paper trading with any broker. So you can open your accounts with broker and do it. That's fine. Just open account with maybe any broker, Zerodha and all, and do a paper trading. That you can do. So you can do a basic stock market as well if you're really interested in stock market. You can also, Srisha, look for fixed income securities as well. See, I haven't completed any certification, so so it's a request that first see the your interest. Are you really interested in bonds? Then do the fixed income securities as well. If you are really interested in, let's say, investment advising and all or research, then they have a special course for research as well. So you can do it. So to be very honest with you guys, I haven't completed any certification so far. Any means any, but I studied for NISM as well. I studied for CFA, FRM, even the other investment banking bulletins, and also every day I refer this. So I haven't completed any course so far. So I don't have any idea, but you can refer their modules. See, your theoretical GAN is theoretical GAN again. Whatever process that I have explained, you cannot see that process anywhere. Anywhere means anywhere. Even on paper also you can see, the very theoretical information. But now just see this. I haven't even, seen so much. I haven't read any book so much, but I have still see how I have visualized all of this and discuss that with you guys. So it's a very difficult that, right? But I did it just because I always look at things in a very different way. I don't refer any that pre-designed courses and all. So maybe see if how to read in between the lines, then always all the times you can see a different approach as well. If someone, let's say, already recorded something, maybe books or whatever it is, and if you want to read and want to become experts, then you cannot gain the expertise from their books. You can just gain the information and load it in your brain. So that doesn't mean it will really add values in your life. No. What about your thesis? What about your research? See, their books can be a baseline. Their books or notes can be a baseline. To read a lots of newspaper or books, that doesn't mean it will help you to become experts. No. This is this is what I believe. So I don't want to push that on your head, but see, always you should have to have a different approach. This is what I believe. Maybe your belief or your system can be different. So identify that system and see and figure it out things. I believe on less reading, more execution, less information, more action. This is what I means actually manage my day-to-day things as well. All right.
Just a quick info, guys. Intellipaat offers investment banking course training. Through this course, you will learn time management, project leadership, financial expertise, leadership abilities, valuation, and much more from the top 1% of industry experts around the world. With this course, we have already helped thousands of professionals in successful career transitions. You can check out the testimonials on our Achievers channel, the link of which is given in the description below. Without a doubt, this course can set your career to new heights. So visit this course page link given in the description below and take the first step towards your career growth in the field of investment banking.
Our main focus would be on different types of the fixed income securities like bonds, ABS, MBS, or all other different securities. So we'll try to decode that in details. So let's see how it goes. See, if we talk about, let's say, see, same example, first if assumption is, if we have understood this process, like how we create a securities, how the issuers actually redeem that particular securities, or maybe how create securities and all. If you have understood entire this process, then you can easily understand the different aspects of fixed income securities also. All right. So let's talk about all other factors. Let me start with that. So let's say same. I'll continue same example. ABC Corporation. Okay. First, let me chart out the terms. What was the terms? Terms of financial instruments. Terms were like face value, right? Then your interest rate. Then maturity, right? Options. This one is very important one. And frequency of payment. Frequency of payment. So there are the basically terms. Okay. Terms of a bonds. And as we know, as per our example, if I continue the same example as per our example, so we'll refer the data of this one, right? This one. Face value was, I believe it's 10,000, right? Then interest payment, it was 10% for per annum. Let's say maturity date 2030. Options redemption. So we'll take a simple example first. Redemption. Frequency of a payment, which is annually per annum. So interest payment, it will process out every year. All right. So basically every year will process payments to the borrower. So this is how your investment terms are. Okay. Now, first try to understand this, the process, how it's actually happened. If I now talk about, the schedule. So let's say this is for 5 years, right? So 2025, 26, 27, 28, 29, 30. So here your bond will mature. Okay. This is your schedule. So we have a 2 legs. One is principal face, then issue price, or this one is, you can say it's a face value, and another one is interest payment. Interest payout. Right. See, interest payout, again, another assumption is this is a fixed one. So this is a fixed one for entire cycle for next 5 years. At the time of issuance of a bond, right? At the time of issuance of a bond, if let's say company, let's say investor is here, okay? So we'll create a same, means at the time we'll create a same 2 sides. So that company, here we'll maintain the data for investor. Okay. So one side that we have investor, and second side that we have a company. So here I'll help you to get clarification of many terms in one chart, right? See, if the company issues, the bonds, face value of a bond is 10,000, and same price if company issues at, the same price, which is 10,000. So that becomes your par situation. Bonds issued at par. Why? The reason is the issue price and your face value of a bond. So face value basically it's a redemption value, right? Face value becomes your redemption value. If company issues this at the same price, right? Same price means issue price and face value. So that becomes the bonds issued at a par value. This is the first condition. Second, again, the same bonds, let's say face value of a bond is 10,000 and actual bond issues in the market is 9,500. So this is the case of bond issued at a discount. Bond issue at discount. Now your question would be like, sir, why sometime bond will means company issue bonds on discount? See, this investing is a game of guys demand and supply. Okay, what if let's say you have decided to issue bonds in the market, but there are no enough investors or demands to your bonds in the market? So then ultimately it will affect on the bond price, right? It will affect on the bond price. So it means company will reduce the actual issue price and offer some discount to attract the attention of investors on your bonds. So that's how companies they basically plan the fixed income securities event in such a way, right? So see, they always try to make it grand. Grand it means they'll spend amount, they'll ensure the marketing and everything so that they can invite more and more people to avoid discount on assets. Because if any company is offering discount on assets, so it means it's not a good for that particular company, guys. It's not a good for that particular company. The reason is whatever difference that you can see, which is another 500 rupees different, it's a liability eventually, and that company will have to adjust it. See, in this case, the amount is small, which is 10,000. 10,000 minus 9,500, the difference would be 500. So it might seem okay, this 500 difference is very small, but if you look at, let's say, the company wanted to issue the bonds worth of rupees 1,000 crores, but due to market demand or XYZ other factors, company was not able to sell out bonds in the market. And definitely company will plan something and offer a discount on the original issue price. And once company, let's say, announce discount on original issue price, then that's actually a liability for the company. So it means company is not sure about the demands of the bonds in the market, and that's what company decided to announce discount. And discount is not a good for a company. Now your question would be like, sir, if I think from an investor perspective, of course this discount is good for us. Yes, agreed. Discount is good for investors because he will receive this at the time of redemption he will receive full amount, but at the time of investments you're paying 9,500. So every year your benefit would be, if we talk about amortization, one more term is, sorry, accretion. I'll have to check the spelling, but at the moment I'll just write it accretion. So if you calculate the interest payment, just calculate the interest payment for per annum. An interest payment company will have to process on face value, not issue price, right? 10% divided by 100. So every year company will have to pay 1,000 as an interest payment and even accretion as well. Accretion, it means difference between original in a face value and issue price. So in this case, there is no difference. So company don't need to pay it. But if in case of, let's say, discount, in case of discount, so along with interest payment, company will have to pay 500 divided by 5. So 100 extra, 100 rupees extra to the investor. So it means every year investor will receive Accretion is the income for investor. Okay, investor will receive 100 rupees as an accretion, 1000 rupees as an interest payment, and face value, which is again the actual investment's price. But in reality, investor only invested 9,500. So here, investor is in profit with this, second scenario. If you just look at to this, so investor is in profit. But if I talk about the company's perspective, the discount is not a good. The reason is we are paying higher liabilities. Correct? So I hope you get this. So one condition we have discussed about issue at par, another one is issue at discount. But I explained that, see, discount, which is not a good for company, if any company issues, the discount on their bonds capital. Then apart from this, there is a one more type that you can see, which is issue on premium. Now, when we say premium, it means here, guys, it's something, the actual price of a bond is 10,000, but due to high demand, so investors, let's say in an IPO event, what happened? If the company is really good, then more investors, they submit their interest or applications. So on the basis of interest or applications, company process subscriptions or allotment, I would say, and then you receive your equities or whatever securities that you have purchased through IPOs. Then you receive your benefit. Am I right? So same way, if you just plan it out, your fixed income issue process. All right. For example, let's say 10,000, which is the actual price of redemption price or face value of a bond. But in the market, due to high demand or high, let's say, the request where company have received from the investors. So in that context, the actual issue price, it could be, let's say, 11,000 or maybe let's say 10,000, whatever. It's just a hypothetical example, right? So in this case, if we talk about the benefit of, see here in this case, see, by default company will have to pay interest payment on this amount only, not the issue price. See, company or even investors, we both calculate interest payment on face value. Okay, so don't get confused. So always we calculate interest payment on a face value, not the issue price. Okay, so now if you look at this particular third scenario, issue on a premium. So this is the case where investors paid higher expenses, right, which is around 1,000 extra than the market price. And if we think in a very different way or a very practical way, if you see, investor is not generating single penny of interest payment for a first year. Why? The reason is, here if you see, face value of interest payment was 10,000 and we have purchased, means as investors, we have purchased at 10,000. So actual investment value was 10,000 and we have paid only 10,000. So it means it was a win-win situation. And the interest payment for 2025, we have generated around 1,000. In the second case, of course, it was an additional benefit of 100. The reason is there was a discount on bond price. But in the third case, if you see, we have paid 11,000, so which is 1,000 extra to acquire the assets worth of rupees 10,000. Worth of rupees 10,000. So it means we have paid extra amount, and that is something, it's a loss of investor, which is 1,000. You can say loss, or maybe it's not a benefit actually. loss on investment, and which is 10. And now if you just calculated the benefit, the interest payment which will treat as a income, right, for investor. So it's income. If you have an income of 1,000 and also you have a loss on investments of 1,000, so it means in terms of income, in the third scenario, investors, they are not able to generate any sort of income. Now, your question would be like, look, sir, see, in equity, still we can understand, in the secondary market that we can pay higher amount and we can purchase securities. But in a bond market, how can we pay, higher premium? See, guys, in every market, there are big players. There are big investors like insurance companies, right? Fund businesses, family businesses, mutual funds. They have a huge appetite. And when they buy or enter in any securities, that automatically security prices will go up. Automatically share price will, or stocks or bonds prices will increase. And that's what you can say in in a market, if you have a high demand, basic equation is high demand, high price. It will lead to the, high demand, stable supply, increase in price. It's a basic equation. Then low demand, stable supply, decrease in price. Instead of stable, you can also see that high supply, because this is a game of demand and supply, because your price is purely based on your demand and supply. High demand, high supply, high price. Low demand, high supply, again low price. High demand, stable supply, or let's say if the supply is very low or even constant, in that case also you can see increase in price. And same thing happened with here as well. So at the time of security issuance event, the company receives lots of the applications, and if there is, let's say, high demand, so interest that they have received, ultimately it will affect on price, then company can increase the price. All right. But so let me just tell you some other background as well, in which case company can charge higher fees than the actual face value. If bonds are highly rated, like AAA or let's say AAA or AA or A plus, in that case only it's a possibility that company will receive premium on bonds. Otherwise, in 99.99% cases, investors, they don't pay premium on bond investments. They always try to prefer invest at a par or maybe invest on or at a discount. Invest at a par or maybe invest on or at discount. This is the basic one. And in 90% cases, this happens. But in an exception where, as I said, if the bonds are triple rated, now your question would be like, sir, what is this rating? And where, where we can see the linkage of the rating in this fixed income. See, guys, in a fixed income, with a fixed income instrument, every year or every quarter, I would say, the valuers of the company, they perform the valuation. So we have seen this here, right? So the valuer, this guy performed the value of company's balance sheet and everything in details, and assign the rating accordingly, whether companies are stable or not, whether companies in the strong position or not to repay the debt and all. So they basically check everything. Everything means everything, and accordingly they assign ratings. So once they assign ratings, if the rating is triple A or A plus or AA, so it means it's a clear indication that they have a strong business growth, revenue, profit, and everything. So their entire debt is covered, and they are at a very sound position. So it means they can repay their debt at any point in time. So their capacity is okay. So when we talk about this discount, so if company, let's say company's rating is below the B rating, right? Below the B, maybe C or B, I would say, or even D. In that case, it's a clear indication that companies, the asset quality is not at a good position, and that's what investors, they're asking for more and more discount on investment, or I would say discount on assets. So this is something which is a difficult zone, I would say. If the any bond is rated, A plus or triple A plus, here definitely you can see low interest rate, low interest rate. Here you might see high interest rate, but the risk of investing would be very high, right? Very high means very high. Let's take an example of Byju's. Byju's was struggling to raise funds from the market. Am I right? Now, if Byju's want to raise funds from the open market, no investor will purchase securities at face value or par. No means no. 90% cases, investors will ask for a discount from Byju's on their asset. But on the other hand, what if, let's say, if government of India announce bonds, I'm sure in 90% cases, investors will not ask for a discount. Instead of that, they'll pay the premium as well. Premium, it means higher amount than the face value. Why? Because they have more trust on Indian government and even stability also. So their investment should be safe and secure. All right. So yeah, this is it. And if we talk about, let's say, par, which is again, which is kind of, let's say, companies which is at a stable or win-win situation, I would say. In that case, investors, if they feel that the valuation of the bonds is fair, in that case, face value and issue price would be in the same line. And here, the rating of the bonds also that you can expect is maybe BB plus or even A plus. It depends on the rating agencies, their level or bandwidth, how they rate the particular securities and all in that market. Now, your another question would be like, look, sir, who assigned this rating? See, in a market, the prime brokers like JP Morgan, Goldman Sachs, then in India like CRISIL, right? Again, the prime brokers like UBS, CLSA. So they always do some sell side analysis of securities and publish the reports in the market, because all are broker or banks always they work at sell side and they publish the reports. And the mutual funds, insurance companies, and provident funds, they also perform the reports and assign rating to that assets. All right. And all insurance companies, provident funds, retail investors, mutual funds, universities, they come at buy side. They also perform the report, and on the basis of that, they assign rating to it. But if you are new to this industry, again, you will have a questions like how it works. See, guys, if you know, at the time of, let's say, credit card application process or a home loan process or personal loan process, the credit agencies like different, we have a credit agencies where they check the CIBIL score, right? And if the CIBIL score is above the 700 or 650, then we consider that that person is at a stable. If the CIBIL score is more than 900, we assume that that person is very strong. And if the CIBIL score is below the 500, so it means that person which is at a very critical level. So how that particular CIBIL score that companies derive, and how they come to at 700 point, 500 points? Because see, for a CIBIL score, it is the study of individuals' incomes and expenses and other obligations on the basis of your personal obligations like pay in and payout for a particular month. So they actually calculate the capacity. For example, let's say if your income is a salary, individual in a person's salary is 1 lakh, and total expenses, including means everything, which are 50,000. Your net income is 50 in this case, correct? And if this income, let's say, if you are able to saving in maybe stocks, bonds, whatever it is. So it means you are at a very strong position. Why? You are able to save your 50% of your income. So on the basis of this data, if I assign rating, of course I'll assign rating like more than 900. Why? Even if you apply for a loans of 20,000 per month, still you can manage that, right? You can adjust the loan amount, which is, let's say, 20,000. Still, it will have a total net income. 30,000. So it means you have a positive cash flow. This is the clear-cut example of positive cash flow, and that's when I can rate highest side rating. But what if, let's say, your total income is 50,000 and total liability that you have along with expenses and all. See, so instead of net income, you have a loss. So every month, your balance sheet is like, or personal balance sheet or account is like, you need a more money. In that case, your CIBIL score would be somewhere around 300 to default. Why? Because you don't have any additional income to cover your liabilities and your credit capacity is a very low. So on the basis of basically income and expenses, the credit agencies, they derive the rate and update in the system. So in the same way, at a corporate level, we means as a let's say different institutions like prime brokers or research agencies, they collect some input or data, and on the basis of that, they assign rating to the fixed income securities. All right. So now look, let's discuss few points from the investing perspective. As an investor, if you want to invest money in fixed income instruments, so you should invest in A-rated bonds because the risk of a default would be very low in an A-rated bonds. But if you're not, let's say, if your priority is more interest payment, right? If your priority is more interest payment, not the safety, then in that case, you can invest B-rated bonds or C-rated bonds. So the possibility of recovery of face value would be very low, but you may earn interest payment, which would be very high as compared to the bonds which will issued on premium. And in case of par, so this is something win-win situation, I would say. And if anyone is looking for like with a moderate kind of risk, but decent interest payment, then you should invest with the bonds with a par value. Now, your most important question would be, sir, where can we check this? So let me try to log in my account if I can quickly to walk you through. Let me log. Let me know if you can see my screen. So I have logged in my broker accounts. Okay. So here, see, if we talk about the private bonds, see, there's two deals now we have at the moment. One is government, deals, government gold bonds, okay, with the interest payment of 2.5% per annum, and the another one is the National Highway Authority bonds with interest payment of 7.69% per annum. Okay, so interest payment frequency, if you see, so both the bonds, they have one is means this national highway bonds have a yearly maturity, yearly interest payment frequency, but for a government bonds, you can see half yearly interest payment frequency. So if you want to buy, simply click on buy. You can select the market, buy, sell. Now I want to buy it, so I'll select buy. Quantity, let's say 1. You can select the price, whatever price that you want to select. Then see the terms and condition. If you see, the face value of a bond is 1,000, maturity amount. So it means at maturity, you will receive, only 1,000. So basically, this is the case where you can say it's a par value of a bonds. Face value and maturity, both price are same. Okay. But eventually in the market, guys, the bonds is trading at 1110, right? Means 1,110 rupees. So here, basically, you can see, the interest payment is included in the bond price. The interest payment is included in the bond price. That's what the bond price seems like different. But actual issue price and maturity price, if the both are same, so it means there was no discount which was offered by the government of India. It was just a plain like face value and maturity price. But the current market price, which you can say different, the reason is every day interest payment which adds into the bond price, and that would be your updated price for a market. The reason is, see, with all tradable bonds, market always calculate interest payment and add it in the bond price, and that's how the bond price and actual means face value of a bond price or maturity price, that looks different. So it means the interest payment is included in the bond price. There are other platforms as well, like Bloomberg and all. Bloomberg bond interest screenshot. Let me just see if I have example to look over. So here also, if we see the principal amount, see face value of a bond is different, or which is we have separately recorded it. Bloomberg provide that information for all fixed income securities, and the accrued interest of a bonds for 11 days. You can see differently we have calculated, but the total value, if you see, which is around 10 lakh, 10 lakh 292.22, and this is something your tradable price. So if you want to buy a bonds at this price, so instead of 9,88,000, you will have to buy a bonds at 10,292. Did you get this? Why? The reason is, so eventually the the accrued interest payment, it will be adjusted in the bond price. And when if someone buys that bond, so buyer will have to pay interest payment. Buyer will have to pay interest payment along with the principal value. And again, understand this one, another term. So that, if you see, if as a buyer, if you're paying interest payment to buy a particular bond from the another buyer, so it means, so that bonds become, or that bonds price become, I would say, dirty price. Dirty price. Why? Think from a buyer perspective, we are paying interest payment to the seller along with principal value of an asset. So it means as a buyer feels that it's a dirty. So that buyer is paying interest payment in advance, because buyer will have to wait to get the payments of the interest payments actually from the issuer, because actually issuer pays interest payment, right? But issuer will pay the interest payment at the end of the year. But in between, if you trades in a bonds and sell it out that bonds to someone, right? So someone will pay interest payment to you, correct? So that price become dirty price. That price becomes dirty price. All right. And if you buy the bonds without paying interest payment to the other parties, so that becomes your clean price. So for example, let's say, to understand this one, how dirty price and clean price works, and what is the benefit of that, we'll discuss that as well. So ultimately, along with the term, let's say this is the ABC Corp, issue bonds with 10% interest payment for per annum with 10,000. and total interest payment would be 1,000 for 364 days. Okay. So original buyer is, this company is the issuer, issue bonds to A. This person is, let's say, A. This one is B. So originally, let's say, this person invested and purchased the securities originally. So let's say invested in securities, invested in bonds. Take a hypothetical in a situation where this person invested this benefits, but after 180 days, now this guy is searching or looking for selling of securities. After 180 days, this guy is looking for selling of securities in the market. Now, see, this guy definitely, see, the company will process the payments. Let's say interest pay frequency is yearly. So it means company will process the interest payment at the end of the year. Company will not process interest payment in between the year. Correct. But this guy is looking for a sell of securities after 180 days. Then who will pay the interest payment to this guy? Who will pay? If this guy approached to the company for interest payment, then company will not, entertain. The reason is, as per the agreement we have discussed yesterday only, that it's a legal document. Bond investment, it means it's a legal document. So you cannot go back to the company and ask for a reversal or ask for a early payment. You can't do this. You don't have any other options. Correct. So it means you have decided to go to the marketplace. Let's say here, go to the marketplace, send a request to the market, right? And wait for a buyers. See, if you get a buyers, right? If you get a buyers from the market, and if you directly, let's say this person is interested to invest in your to buy the particular shares, bonds from you. So this guy, if this guy is ready to buy your securities, but the point is there are two ways. One, if this person buys securities at price of, let's say, only 10,000, then this person would be in profit actually. Why? The reason is, if you just see, as per is, the investments calculation and all, so actual bond price would be 10,000 as a principal amount, right? And interest payment of 180 days would be somewhere around 500, right? Interest receivable 500. So actual bond price is 10,500. But same bond, 10,000, 500 bond, buyer is ready to buy at only 10,000. So it means buyer is not ready to pay interest payment to A. And if this is the case, then we'll call it as a clean price trade. Clean price trade. Why clean price? Because buyer is, see, from the open market, buyer is not ready to pay additional interest payment on price. But eventually, if you see, this guy holded bonds for 6 months or 180 days. So it means, as per the legal agreement, this person is entitled for a 180 days interest payment. All right, 180 days interest payment. But reason is, this company will process an interest payment yearly. So if this person, let's say B, is ready to buy bonds at interest plus this one 500 at a dirty price to pay this amount. In this case, for a B, this price should be dirty price. But eventually, if you just think from a finance perspective, because in a finance, time has a value. Time has a value. If you just calculate your finances as per the time, then you can relate that. So here, so this buyer would be in loss. The reason is buyer is paying additional 500 interest payment to the let's say seller, but this person like buyer, new buyer will have to wait at least for additional 180 days to get the interest payment from the company, because after this 1 year, so it means of course after 180 days for this person, company will process interest payment, company will pay interest payment this guy, because now the original buyer of bonds is now this guy B, because see continuously name of B will reflect once the B execute trades in the system. So company will now process interest payment to B, and B will receive entire interest payment, which is 1,000 rupees. So 500, which is already paid to this guy, and 500, which is the actual interest payment where this guy is already holding, bonds with him. So now I hope you got this. See, dirty price, which is not a good for a buyer, but this is a good for a seller. Why? Because seller has received interest payment, accrued interest payment from the new buyer. All right. And the clean price, which is not a good for a seller. The reason is then seller will have to wait until this company process interest payment. Then company will split payment to both. So A will have to wait. And in a finance, guys, wait is not good. Okay, wait is not good. Let's say if you hold in a XYZ investments for a 10 years and still you are in a loss. So it means you are in a double loss actually. You are in a double loss. So sometime it is a good to book losses, take the exit and reinvest that money somewhere so that you can again, at least you can take the advantage of time and new opportunity. So same logic you can apply it here as well. So in a finance or even in a fixed income securities, if you are a seller, of course you will try to see how you can get the entire money. Means fixed, let's say the capital which you had invested, as well as the accrued interest which your investment incurred or accrued from particular XYZ investments. So always we look for that. And as a buyer, if you look at from the buyer side, we always try to buy the assets at a lower price. So it means we always try to avoid additional cost. But yes, if sometime if you are not able to, let's say, avoid cost, so that's become your dirty price of a securities. The difference between dirty price and clean prices with interest payment and without interest payment. If you see the interest payment is included in the price, so that becomes your dirty price. If you see if the interest payment is not accrued interest payment that I'm talking about, if the accrued interest payment is not included in the price, then that becomes your clean price. So I hope you get this clarity now. What is accrued price? What is dirty price and what is clean price? So in practicality also means, while dealing with the fixed income securities and investment banks, we always evaluate the certain trades on the basis of dirty price and clean price. So this applies to you as well, guys, to go and check the Bloomberg or the broker system to see what is the price quotations that they are charging to you or to asking you to pay. So if I take this example, let's say, see this is the example of dirty price. Why dirty price? Can anyone tell me? The actual see now if I want to buy the particular this particular bond, then I will have to pay this price. 1110. So it means I'll have to pay 110 rupees extra to acquire this particular asset. So why should I do this? So why should I pay this? Right? Because actual price of this bond is different, correct? But as per the market, the price is different. So it means in this price, your accrued interest is included. And that's what we'll have to pay a higher price, right? Then let me take a few other examples if I have. Government bonds. If you guys want to invest in government bonds now, with ICICI Direct, we have a facility. You can go to the FD and bond section, select the government bonds, and invest accordingly. Recently, government launched series for gold bonds. So you can look for gold bonds, and here you can continuously check the government securities as well. Few bonds, there is no. So apart from that, you can see other bonds as well, private bonds and all. Tata Capital NCDs. This is a deposit scheme. To this IIFL Home Finance Limited. Again, they have a scheme which is offering 12% interest payment for per annum. And interest payout is monthly. So if you have a huge amount like 1 CR, 2 CR, 20 CR, and if you don't have other any investment plan at the moment, let's say for next 12 months or 1 year, then you can invest your fund in such a schemes with a monthly payout. But see the maturity as well. So because your fund again, it will lock for maybe 1 year, 2 year, 3 year, 4 years, depends on the investment scheme, but you see this. Kerala infrastructure, all are E-rated bonds. Structured products not available at the moment. See the corporate bond list. Akara Cap, UP Power Corporation issued bonds. Let me take a decent example to see how it looks like. India Bulls Housing Finance with the coupon rate. If you see coupon rate, it means interest payment. Coupon rate with 10%. Maturity of bonds 26th March 2031. Bonds yield, which is 40%, it says. Right. Offer rate and all, which is not provided. Face value details also not provided. So, coupon payment, again, this company will process interest payment in a monthly, which is a good scheme. The reason is if you get a monthly interest payment, so you can reinvest that. Get the information of the bonds. Every company, they also publish their investment prospectus as well. The details is not available. Much of information is not available. With the corporate bonds, you can see call option and put option also. We'll discuss that as well, like what is call option and put option with fixed income securities. It's like a derivatives only, but it works a little different way. So these are the securities, guys, with the different payouts and different, the coupon rates and all, and ratings. Rating is important, right? If anyone is really interested to invest in a bonds, you can. To ICICI Securities, you can invest. Here the price is given, which is maturity rate and face value. Maturity, it means redemption price, right? And issue price, it means that the time of buying securities from the company will sell the securities to you, at certain price. So that price will call it as an issue price. Face value, it means the actual price of the instrument. Broker to add that out. If anyone is interested to buy these bonds, you can buy several bonds and see. So you can generate minimum 10 to 11% return. 11% which is decent. Okay. If you have a 1 CR capital, then you can earn almost 11 to 12 lakhs interest income per annum. So it means around 1 lakh per month. So every month you can earn 1 lakh. If you have a 5 crore, then you can invest in bonds with a portfolio, let's say, 1 crore that you can invest in highest interest rates bonds. You can 1 crore, You can invest in moderate, then lowest. So this is how you can diversify your bond portfolio, so that you can continuously with the risk mitigation, you can generate at least 4 to 5 lakhs per annum, sorry, per month, and which is a decent. So it means annually, if you generate 50 to 60 lakhs, so that 50 to 60 lakhs you can reinvest it, right? See, even if you do your business, so ultimate goal is to make money. So you can evaluate that certain factors, like if you invest 5 crores in the business, then how much money that you can generate. If you have any better idea which can help you to generate, let's say, more than 10%, then you can invest in your business. And if you feel that, let's say, even if I invest 5 crores in the business, my return, it will not exceed 10%, then instead of doing business, I would say invest in bonds or a different fixed income, securities. The reason is that will give you monthly interest payments, and monthly interest payment, which is fine, so that you can reinvest your money, which is monthly interest payment, in different businesses and diversify your portfolio. Okay. So this is how your clean price and dirty price works. So let me know if you have any questions around clean price and dirty price, and also par issue at a discount and issue on premium. So I'll take a pause over here for 10 seconds and to give you opportunity to ask questions. Please go ahead if you have any questions. If you don't have a question, just text you don't have a question. So I'll jump on other types. Fixed income security price would be remain same, but due to the interest payment adjustments and all, so that price means you can add the interest payment, accrued interest payment in the price, and that would be your actual price of the that particular bond instruments. See, after paying interest payment price, okay, let me explain that as well. It's a very good point that you have raised. I'll explain that. I'll have to draw the chart for that matter. Let's say bond price, interest payment. First, we'll calculate month wise. Okay, in January, actually in a Feb, means after the January only we'll calculate the interest payment. Let's say in the month of Feb, the actual price and interest payment, it would be at somewhere 100. Not 100, I believe. This one into 10% divided by 100. This one. So 81, 3.33. Up to 3 decimals, you can consider the price. So for a Feb, your interest payment would be this. For March, price would be 10,083, which is your bond price. It looks in the market. And again, if you add the interest payment for a March, or let's say Feb, in the month of March, that would be, then in the month of April, price of a bond should be this. The interest payment for per month, for March month, you can add it. Even if you calculate like this, 83 plus 1,000, it goes around 10 to 4. So if you just add this again, it would be that only. Let's say here in the month of, let's say, April, on the 1st April, it was a quarterly payment, let's say, system, and the company paid that interest payment. Means from a company side, company paid that interest payment. So in the month of maybe beginning of the April, you would see the bond price in the market if company process all the accrued interest payment. So it means company, let's say, paid this interest payment, accrued interest payment, to the trader. So net, the price which you can see looks like this, clean price. Why clean price? Because the accrued interest for January, Feb, and March, which has been paid out. Which has been paid out. So if I put this into the chart, January, February. Let me put it in this one. January, February. In April, this total interest payment, it was, so if you just calculate, it will tie with your calculations. Put this into the chart, so it means it will looks like your market chart only. But in the month of April, all this due interest payment, which is 83 for all 3 months, if company process that out here, maybe beginning of the April month, you can see this scenario where the price is 10249, and in the first week of April only, company can schedule a payments, right? Schedule a payment and process that, let's say, due interest payment. And if that process, the due interest payment processed, the chart of that particular bonds looks like this. Say this, it will come to at the same base level. All right, and again for a means April month interest payment, it will be generated like 83. For a May, you can see calculations like this, and if I add this, say this. So this is how your chart looks like. And in a stock market screen also, if you just see and calculate things on a proper pen and with in your notebook, so you can relate with the same calculation with the market screen as well. Because whatever the changes that you are seeing in the bond price, those changes are there because of interest payment. Okay. See, in a stock market, what happened? You will see the changes because of capital gain, right? You will see the changes because of capital gain. But here you will see the changes because of interest payment. But that doesn't mean, the bond is actually offering any capital gain and all. Now your question would be like, sir, is it true that, bond will offer capital gain? Yes, bond can also offer capital gain, but that would be very in a fraction of amount, or maybe due to if something happened in the market with that particular company, in that case you might see big change in the bond price. For example, let's say suddenly Hindenburg leaked the report of Adani Group, and Adani bond prices dropped in the international market, and we have we have heard that argument like George Soros and his company took a short position in the bond market, and they made a huge profit in Adani Group. So that happened. If any special event happened, or maybe due to demand and supply, if you see fluctuations in the bond price, so that would be because of only maybe due to company's financial health, or maybe because of high demand or high supply of a bond, which is, let's say, pushing price to be very volatile in the market. But that doesn't mean the bond is offering capital appreciation. See, bond never offer capital appreciation. And even if you see, let's say, capital appreciation, see, that doesn't affect on the bond's main terms, because bonds main terms are like the maturity price. Let's say the maturity price is issue price and face value is 10,000. Then original bond, the price which is 10, it means at the time of let's say in a maturity only company will process you this amount, which is 10,000. So even if you see the capital gain, let's say actual bond market in a trading in market is at 10083, but the maturity value of a bond is this one. So it will receive only this amount from the company. So company will not offer any capital gain on the bonds from company sides. And if you see capital gain in the market with XYZ bonds, so that, see, it means just because of demand and supply gain, or pressure of demand and supply gain, there is a friction which is created in the price, and that's what you are seeing change in price. Did you get this? So, but from a company side, they never pay any capital gain or they never settle any capital gain to any of the investors. So, company is only responsible for the maturity value which is provided on the paper. Company is not responsible for any of the prices like capital appreciation in the bond value or bond value, let's say, drop or increase, whatever it is, whatever happened in the market. So are you clear on this now? कंपनी सिर्फ मैच्योरिटी वैल्यू ही रिटर्न करती है इन्वेस्टर्स को. अगर प्राइस कितनी भी बढ़ जाए बॉन्ड की, 10,000 भी हो जाए, अगर ऐसी भी प्राइस हो जाए, लेट्स से दिस वन भी अगर प्राइस हो जाए 20,000, company is not responsible for this price, means 20,000. Company is only responsible for this price. Now your question would be like, so who will pay then my remaining amount? The remaining amount, nobody is responsible for this. It's just a price created through friction. It means you can try to sell the bonds in market, then instead of to the company try to sell the bonds in market, if you get the price of 20,000, that's fine. If not, then mandate, that, on maturity date, company you'll have to surrender the securities and company will only process 10,000. And if there is any interest payment and all. Issue discount मतलब ओरिजिनल प्राइस कंपनी के प्रोस्पेक्टस के हिसाब से 10,000 है, बट कंपनी को अपने बॉन्ड्स को 9,500 में बेचना पड़ रहा है मजबूरी के कारण, उसको कहते हैं इशू ऑन डिस्काउंट. दैट्स ऑल. मजबूरी अब कुछ भी हो सकती है. जैसे बायजूस का मैंने एग्जांपल दिया, बायजूस की हालत खराब है, उनके पास पैसा ही नहीं है, तो अपनी एसेट्स को, बॉन्ड्स मतलब एसेट्स को बेचना होता है मार्केट में, और कुछ नहीं है. अपने एसेट को बेचो कोलैटरल के तौर पर और पैसा मार्केट से ले लो, और जिसको भी आप बेच रहे हो ना, वो डिस्काउंट मांग रहा है और ज्यादा, ये कह के कि तुम्हारी 10,000 वैल्यू नहीं है, एक्चुअली वैल्यू तो 9,500 है, तो विल गिव यू ओनली 9,500. उस तरह का गेम है. तो इट मीन्स कंपनी को अपनी 10,000 रुपए की एसेट्स 9,500 में गिरवी रखनी पड़ रही है, तो उस प्रोसेस को कहेंगे इशू ऑन डिस्काउंट. तो काइंड ऑफ गेम यू कैन से लाइक अंडर वैल्यूड एंड ओवर वैल्यूड. ये कंडीशन है ओवर वैल्यूड की. जब इन्वेस्टर्स को लगे कि ओवर वैल्यूड है, तो इन्वेस्टर्स कम पैसा पे करेगा, ये होगा अंडर वैल्यूड का. प्रीमियम कब बनेगा? व्हेन योर एसेट इज एक्चुअली अंडर वैल्यूड. उस तरह से. तो फॉर एग्जांपल, I'll speak in Hindi for 1 minute. मान के चलो आपका कोई प्रॉपर्टी है अच्छे लोकेशन पे पुणे के, जिसकी एक्चुअल प्राइस है 50 लाख. एक्चुअल प्राइस कितनी है? 50 लाख. बट इन्वेस्टर्स आपको 60 लाख देने के लिए रेडी है. क्यों? उसको बहुत पसंद आया, लोकेशन अच्छा है, हर चीज अच्छी है. तो वो क्या हुआ? इश्यू ऑन प्रीमियम. सो इट मीन्स इन्वेस्टर इज रेडी टू पे मोर प्रीमियम. बट ऑन अदर हैंड, आपकी एक्चुअल प्रॉपर्टी की वैल्यू है 50 लाख, बट ड्यू टू, मान के चलो गवर्नमेंट के प्रोजेक्ट आने वाले थे, डिले हो गए, रोड होने वाला था, नहीं हुआ, उसकी वजह से क्या हुआ? प्रॉपर्टी की एक्चुअल प्राइस तो 50 लाख है, लेकिन बाकी के सब कारणों से प्रॉपर्टी की प्राइस गिर गई है फ्रॉम 50 टू 40 लाख. तो इस केस में क्या होगा कि अगर आपको पैसे की जरूरत है तो आपको 40 लाख में भी बेचना ही पड़ेगा इवेंचुअली. यू कांट डू एनीथिंग, राइट? तो जितना मिल रहा है उतना आप लेने का सोचोगे, पर एक्चुअली में आपका लॉस हो जाएगा. क्यों? क्योंकि एक्चुअल प्राइस इट वाज 50, बट यू आर रेडी टू सेल इट आउट योर एसेट्स एट 40. तो 10,000 जो 10 लाख का जो डिफरेंस होगा हियर इन दिस केस वुड बी योर एक्चुअल discount that you have offered discount on actual price of securities. उस तरह का लॉजिक. Did you get this now? Okay, so we'll talk about now different types of bonds, guys. Okay, so what are the different types and how the types work? So we'll discuss about that in details. Okay, so first type is that I would like to discuss, apart from all of this, we have other different types and those are very interesting ones, so we'll discuss that. So the first one is redemption at maturity. The first type is redemption. See, if I take the example of same bonds, the terms and all again still remain same, but at the time of issue issue this bonds in the market, issue or offer, I would say, bonds in the market, at that time company will define redemption terms. Redemption at maturity, it means after the 5 years, bonds will mature here, right? Bonds maturity. Bonds will mature at same price. There is no change in this. Okay. But when we say redemption, see this particular maturity or at this maturity level, I would say company will simply redeem this value, redeem this value, and investors will receive this particular cash. So initially means at the time of investing, it looks like this. Investor paid this amount. Investor purchased this bonds at this price, which is 10,000, and company has received it. Means in the books of company, you can see positive cash flow. In the books of investor, you can see negative cash flow initially. Right? When you purchase it, of course, cash will out. And at the time of let's say every year, company will pay interest payment. And here also company will process interest payment plus principal. Means total interest payment, accrued interest payment for that particular year, and interest payment. Or maybe let's say 1, 2, 3, 4, 5. So here only company can pay interest payment also. And in the books of investors, of course, will treat as an income. The investor will receive income from this particular bond investment, which is 1,000 every year. See, to this investments, okay, investor will treat as a future expected cash flows. Future expected cash flows. Cash flows, it means, because see, in the books of investors, continuously it will receive the investor cash flows on the invested amount, and at the end, investor will receive this redemption value as well. Redemption value in cash. So this is how we'll call it as a redemption at maturity. It means this bond simply will redeem at maturity. This bond will simply redeem at maturity. But sometime you can see the provision where company is not ready to pay full amount. Means at maturity, company is not ready to pay full this amount. So every company hold some rights in terms of redemption. Because see, redemption is purely based on, guys, cash flows which are available in the books of a company at the time of, let's say, repayment of the final debt. What if company is looking for a let's say what I can say, company is looking for some liquidity issues. In that case, company won't be able to pay that entire amounts in one go. Am I right? So company will schedule something. There was a Nikhil, there was a break of 15 minutes. You didn't join late. After the break, if you joined, so we have started now the types of securities, which is the first type is redemption at maturity. So bond companies can issue with the different types of bonds. The first types that we're discussing as a redemption at maturity. So the bonds will redeem at maturity. Bonds will redeem at maturity in cash, right? And investors will receive cash. Okay. But as I said, if company is facing any liquidity issue, so this amount company can redeem in parts. Parts, it means 1 parts, 2 parts, 3 parts, 4 parts, 10 parts, 20 parts. There are depends on the company's financial plan. If company redeem or repay full amount, we'll call it as a redemption value in cash at full. The language would be redemption value in cash at full. तो इसका मतलब क्या है? कंपनी ने पूरा का पूरा पैसा इन्वेस्टर्स का एक ही बार में रीपे किया है. So that process or that value, we'll call it as a redemption value in cash at full. But what if, let's say, at the time of maturity price is this, but company is ready at half. So it means company is ready to redeem only 5,000 at the moment. Why? Maybe due to some, let's say, other circumstances, like companies looking for some, positive cash in the books, or they're looking for additional funds or cash. There could be different scenarios, guys. Okay. It's a very means the practical thing that if the company they don't have a available, let's say, cash, means uh, working capital, or I would say liquid cash in the company's books, then company will hold the, even they can hold the redemption at maturity process as well, or they can extend that redemption. So we have seen all of these cases or scenarios. If we talk about, let's say, this one, if we talk about the process of what I would say, Future Bazaar. What happened with Future Bazaar? Future Bazaar went on a bankrupt because they don't have, as they had no cash in their books of accounts to repay the debt of bondholders, right? Same thing happened with the Byju's as well. Byju's was also facing issue with the debt payment. Same happened with the Reliance Group, that Sony Erection and all other companies. They were facing issues with the payment, right? So at the time of maturity, and that's what, when we say risk, it means at the time of maturity, what if company is not able to repay your debt? Then your money would be in risk, right? On other hand, now your question would be, look, sir, you told that, we can sell the company's assets as well. But see, means alone you cannot sell it out. So there would be legal process. So it means company can appoint arbiter, or maybe company can appoint, the government's that directors, and then they'll evaluate it, they'll communicate with you, they'll sell the assets, they'll process it out. So it will take time. It's a time consuming process. It will not happen in overnight that let's say company went on a bankruptcy and now you're directly invited, let's say, potential buyer to purchase the assets. So you can't do this. So there would be a legal process. So that's what, when we say risk, it means at the time of maturity, if company is facing some liquidity issue, then company can hold or extend the redemption process as well. And so there would be stages like full redemption. Full redemption, it means maturity value is 10,000. And if investor receives, let's say, 10,000, so that becomes your full redemption. And if maturity value is, let's say, 10,000, but company decided to redeem only 5,000. And if investor receives only 5,000, so that becomes partial redemption. Partial redemptions. And remaining amount also company can process it maybe after 1 month, 2 months, 3 months, full or remaining redemption. And company can again redeem or paid out the remaining amount to the investors. So that's become full final. So when we say final, it means this particular investments, it will close out. Started in 2025 and it will close in 2030 with repayment of principal amount. So at the end, it looks like this negative cash flows in the books of company, because cash will out from the company's books of accounts or bank balance, and investors will receive that cash amount. This cash investor will receive it. So that becomes your redemption at maturity. So let me know if you have any questions around this one. What is redemption at maturity? Okay. So now same example, if I replicate, let me see if I can copy and paste it. So let's say another scheme would be terms, face value, interest rate 10%, maturity 10, options, let's say, which is call option after 2.5 or maybe 2 years from date of issuance. So what is this provision which is all about the call? Is right. So let's discuss about the another type. The another type of a bond is callable bonds. The first one is redemption at maturity. That means redeemable bonds. All right, second types that we are discussing now. Type second, which is callable bonds. All right, callable bonds. So in terms of callable bonds, what happened? Let's say if I talk about first 2 years, it means this one. Right. So this is something, the block period. Block period, it means highlight in red. Okay. So bond issued in 2025, right? Year 2025. So in first 24 months, company cannot call these bonds. Okay. Company cannot call these bonds. Callable, it means company will call it out. So my bad, price should be different. Right? Company can call these bonds at any point in time here. So this period would be like callable period. Callable period. So now your question would be like, so what do you mean callable period? Callable, it means buy back bonds at any point in time. At any point in time, but after the blocking period, right? In Hindi, if you want to understand this in better way, so callable bonds means nothing but कंपनी को राइट मिलता है अपने ही बॉन्ड्स फिर से खरीदो अपने ही इन्वेस्टर से. Simple. Why company will do this? That we'll discuss now. Why company want to buy the bonds from the investor bank, right? Why company want to do this? Can anyone guess? Company will buy the bonds, back from the investor when, let's say, if we talk about these terms, we are assuming this was the, the market interest in 2025. Let's say in 2027, assume it, right? It's a 2027. In 2027, the market interest is 7% for per annum, right? 7% for per annum. And your competitor, if you are ABC Corporation, let's say there is a XYZ Corporation company, they have issued fresh bonds in the market at 7%, and still investors, they have subscribed it. Then now you tell me for a same, same bonds, you are paying 10% interest payment, and for a same bonds, your competitor, they are paying 7% interest payment in 2027. So now you tell me who is paying higher cost on capital? ज़्यादा पैसे कौन पे कर रहा है? Of course, you are, as a company, you are paying higher cost, right? Your competitor issued bonds in 2027 with 7% interest payment. So it means for per 10,000 rupees bonds, this is the, let's say, investment scheme of ABC Corp, right? In 2025. But after 2 years, your competitor XYZ Corp, they are paying for the same amounts, they are paying only 10% interest payment. Sorry, 7% interest payment. And still investors, they have, let's say, subscribed it. Now you tell me, why as a company, why you want to pay 3% extra than the market, right? 3% extra than the market. Now with a small amount, you would feel that looks are only the difference is 3%, and if you compare with the ABC Corp, here the difference is only 300 for per annum. So 300 is nothing, right? 300 rupees is nothing. Okay, hold on. What if I say this amount is 1,000 crore? Let's say 1,000 crore amount. 1,000 crore. Now calculate the interest payment. So this difference would be somewhere around 300 crore. right? If the difference is 300 crore, so don't you think that you are paying higher interest payment on same loan amount, right? Again, to understand this example in a better way, let's say HDFC Bank is offering 10% interest payment to you, right? Let's say you have taken loan from HDFC Bank at 10% in 2022, and in Axis, let's say Axis Bank is offering 7% interest payment in 2024, and you have an option. Let's say there was a closing period, let's say a cooling period of you can say 2 years, since 2000 January 2024. So before that you can't close the loan, but after that you can close the HDFC's loan. So if you are a very smart investor, right, or let's say financial planner, what will you do? If you ask me, simply what I'll do, I'll close the loan of HDFC Bank, right? HDFC Bank. How I'll close it? I'll apply loans with the Axis Bank at 7% interest payment. I'll ask HDFC Bank to issue the DD with the HDFC Bank name, right? Whatever amount is outstanding, let's say 5%, 10%, and Axis Bank will transfer outstanding amount. Let's say outstanding amount is 1 lakh or 10 lakh, whatever it is. So 10 lakh. So this 10 lakhs, Axis Bank will transfer it 10 lakhs to the HDFC Bank, and I'll pay only 7% interest payment to the bank every year, means Axis Bank. So now let's calculate the liability and you are saving 7% divided by 100. Oops. 70,000, and here you are paying interest payment. See that you're saving, means how much amount that you can save it once you change your way. Almost you can save 30,000 yearly. What if this amount is, let's say it was 1 crore that you had taken a loan of 1 crore, just add 1 0 and see the impact. So annually you can save how much? You can save almost 3 lakhs. What if I add 1 0 and see that you're saving? Because bigger the loan, you can see bigger the saving. You're saving. There is. Your saving would be almost 30 lakhs per annum. Now the question is, again, sir, would it be easy to do this? Of course, no, because you will have to convince to the Axis Bank. You will have to pay the processing fees, right? Processing fees, then loan application fees, GST, stamp duty. You will have to pay to the Axis Bank, and you will have to bear the foreclosing charges, right? Charges in HDFC Bank. But let's say all of that expenses, if we just calculate, total cost is 5 lakhs that you have incurred to close the loans and open the new account with Axis Bank, take the loans, and then again close your previous loan. Let's say now you have close this account and activate this one. So still your saving would be around 25 lakhs, which is a decent, guys. And at a business level, there would be huge saving. 25 lakhs still you can save it if you just smartly manage your liabilities. Now same example आप replicate कर सकते हो companies के decision. आपका competitor 7% interest payment से securities issue कर रहा है, and आप already 10% से issue कर चुके हो, and you are paying higher interest rate to your investors. So don't you think that if you have an opportunity, you have opportunity to close your previous accounts, so it means this account, and issue the new bonds at a 7% interest payment. So don't you think that it would be a smart decision if your size of the loan is, let's say, 1,000 crores, and through this process, if you are able to, let's say, save almost 300 crores annually, don't you think that you should quickly take a decision and redeem the previous bonds and issue the new bonds in the market at a different interest payment rates? Yes, no, guys. You will do this, correct? Come on. You will do this or not? If you get opportunity to redeem the bonds here, let's say redeem the bonds and issue the bonds at 7%, will you do this or not? Come on. If you ask me, I'll do this because I'm a businessman. I know the pin, to pay the extra costs to the investors. Because if my other competitor is, let's say, already issued bonds at a 7% coupon rate, then I'll also try to do the same thing. So it means I'll close my, I'll repay the amount, and I'll reissue the bonds at a 7% interest payment. But the biggest question is, what if you don't have a liquidity? Then how will you, restructure your loans? Because this is a part of something you can say restructuring of a debts. So how will you restructure your debts? And here your investment banks come into picture because you need a temporary liquidity, correct, to issue the bonds. To redeem the bonds. So it means you will have to repay the loans, correct? Repay the loans. So how it looks like? So here, let's say you have decided to, let's say company had an option. Company decided to close that previous bonds. So we'll close out this one and how it looks like. See this. If the company has a liquidity, which is good because company will, repay whatever principal payment is, and even interest payment is pending, then you will have to pay interest payment and as well as principal payment. Company will repay this one 10,000. If the interest payment is also, let's say it was due, then we'll pay interest payment as well, repay this and close out. Previous investors will receive the same thing, which is investors will receive 10,000 plus interest cost or interest receivables. Investors will receive this, and finally company will close this bonds. Close this bonds. Why? Because company had a rights to buy company's bonds back from the investors. But the question is, why company will do it? The reason is other competitor, which is let's say XYZ corporation, that guy means that company already raised enough funds. This company already raised funds with the lowest interest rates, and that's when you can also restructure your debts and reissue the bonds. Here you can reissue bonds at 7% interest payment. 7% interest payment. And again, if you can sell out all the bonds, so issue price and all everything, you can keep it as it is if you want, or maybe you can reduce or increase. See, if the interest payment is, let's say, low, then company can issue the more bonds as well in the market. So it means company can increase this particular original capital base also. The reason is, see, lower the interest payment, higher the amount, and if higher the interest payment, then company can always raise the lower the principal amount. So it's a you can say like the inverse relationship between interest payment and raising capacity. Okay, and interest payment, the interest liability would be hereafter at the 7%. Company will pay only 700. So every year company will pay only 700. This is how company will save the amount, guys. But in terms of the issuance process, let's say here was a investor, which was the investor name was, let's say, A. But here it might equation change. Instead of A, there could be different investor where, let's say, B, or a different investor now, because see, the interest rate is the 700 and there is a change in income of almost 30%. Maybe the existing investors, they'll not continue. They'll say, look, we'll look for a better one. So we don't want to continue with your investment scheme now because the 7% interest payment is low. Or maybe The existing investors, they can look for a better option, right? Are you getting my point? So this is how, guys, it works. Like your callable bonds, it means company hold the rights. In terms of callable bonds, company hold the rights. Note down this one. Company hold the rights to buy back bonds at buyback bonds after agreed period. One thing that we have missed, your company will repay the call price amount. So this would be the price, because investor will ask for a premium as well. And always investors will ask for a premium. Otherwise, why investors will buy back it, right? Why investors will buy back it. So this is the another game. So company will have to pay additional price as well. So that would be the different price than the actual, issue price. Because if company want to call the bonds before the maturity, it means company will pay the premium to the bond holders, and of course that is some sort of benefits as well, which will receive to the basically investors. But investors will lose 300 rupees, every month if they continue with the same investment schemes. So which is a loss for them. So company would be in profit, but investors would be in loss. So this is how your callable bonds works, on the ground. If you work as a consultant, or if you work as a fixed income analyst, or if you worked as, let's say, CA, CF, or FRM, analyst with any company, and if you're a part of capital raising process, so you will have to prepare, the graphical representation or a model like this to explain to your board of directors, so that, accordingly that they can take an investment decision. And even if you're, let's say, if you're a businessman, you're running your own firm or institution, so you should know this, the nut and bolts of debt financing, like, because debt, it means it's a leverage. And if you know, like, how you can, smartly manage your debt, then you can generate more and more profit. So here, if you see the, the example, see, initially means 2 years back, we were paying for a same debt amount, we were paying 1,000 rupees, interest cost, correct? But when we change the strategy, strategy, it means we just understood the market, like, how the market is working now, or how the interest payment is in market, how our competitors, let's say, they are paying interest payments and all. So on the basis of that, we just restructure the debt. So this is what we'll call it as a restructure of a debt. Restructure of a debt. So we have this restructure the debt, and through this restructure, we have reissued securities at a different interest payment, and that will save your cost, basically. The cost, which is 300 rupees extra. So it means eventually this decision will help company to increase their productivity, increase their profit, guys. So eventually profit will up by 300 rupees. Let's say here company's PAT was 700. Net PAT means profit after tax. After the debt restructuring, same PAT, it would be somewhere. This means you can see the increase in profit by 30%, which is a sick, right? So you means this is your benefit, correct? So this is how you can save your extra liabilities to increase your profit. Increase your profit. So if you are a, let's say, smart entrepreneur, and if you're looking for debt funds, then you can issue the bonds through callable bonds types. So it means you can include the type and options in the terms. And if investors are agreed that they can buy it, and you will get the rights of a buy. So it means as a company, you can buy that particular securities after 2 years, and that's what it would be in a good position if you are holding callable rights as a company. And this was the explanation of callable bonds. All right. Now let me explain the other bonds. In that case, everything remains the same, but the little bit, you can see the change in, scenario, but it would be like exactly opposite. Okay. Rest, redemption at maturity and all that benefit would be remain same. So I don't want to create a mess over here. So that redemption part and all everything would be remain same. But in this type, we are going to discuss about putable bonds. Putable bonds. Type number 3. In terms of putable bonds, what happened, guys? What if, let's say, see, in terms of putable bonds, first understand this. Investors will receive the rights. Okay. Investors will receive the rights of investments, rights of their own investments, or rights of, I would say, sell off investments. See, in putable bonds, investors will receive the rights, or investors will receive the rights to sell the bonds to the company after specified time at agreed price. Right? In terms of putable bonds, investors will receive the rights. So let's say in a market in 2025, when this bond was issued, the interest rate was 10%, right? Interest rate was 10%, but in the market, means in 2027, XYZ Corporation is offering the interest payment of 12%. Interest payment of 12%. Now think from an investing perspective. Think from an investing perspective. So as an investor in 2027, if you, let's say, sell it out these bonds, if you sell it out these bonds, right? Let's say if you sell these bonds at the current moment, let's say as an investor, you are earning only 1,000 interest income on your investment. But in 2027, let's say here, if you sell it out, if you sell old bonds, right? And if you buy, let's say, new bonds maybe from different company, then you can increase your interest income. Like, on the same amount, which is, see, the interest, your principal amount is 10,000. On the same 10,000 amount, you can earn additionally 200 rupees per month, for per annum. So don't you think that, if you have another opportunity to generate more income than the, let's say, previously, whatever income that you have generated or earned, right? So if any opportunity is available like this, don't you think that you should grab that opportunity? You should grab, right? If you ask my opinion, definitely as an investor, what I'll do, I'll simply sell it out. I'll sell the securities of ABC Corp. So it means bonds, I'll sell it out to the same company back. So I'll get my money, which is face value plus interest payment and all. And I'll save money, reinvest in this company. And I'll buy the bonds of this company. Why? Because here the interest payment is 12%. So it means my profit would be 2% extra. And as an investor, 2% matter a lot. Matter a lot, it means matter a lot. Let's say I have invested 100 crore. If I have invested 100 crore, my yearly income would be somewhere, with this calculation, it would be 10 crore. 10 crore. And with the new interest payment, or as per the new interest payment, my income would be 12 crore. If I buy these bonds of this company, if I sell this and if I buy this, then additionally I'll generate 2 crore extra. Now you tell me, don't you want this 2 crore extra? If no, that's fine. I'm not forcing you to, sell it out ABC Corp Securities and buy it XYZ. But if you ask me, sir, what will you do? Of course, I'll sell it out the securities of ABC Corp and I'll buy the securities of other company, which is XYZ Corporation, which will help me to generate more income on my securities or on my same investment. So this is how your putable bonds works. So basically, guys, putable bonds, it means nothing but it's given a right to the investor to sell the old bonds, right, to the same company back. So it means investor will directly, investor will directly sell this company to the same company, means ABC Corp, and it is a mandate to the ABC Corp to buy the bonds back from the investor. Why? Because investor has purchased securities at an option after 2 years, date of issuance. But here, the one thing is very crucial. Option call price should be something different, or it will different. It means investor will sell it out securities, or company will pay, let's say, only 9,500 as per the that call price it was agreed, and interest payment, of course, whatever the interest payment was due, that will also company will process it to you as per the agreement, and investors will receive 9,500 apart from that income. But here in this case, it might seems like investor will lose some amount of money, right? So you can select 500 rupees loss, something it will incur on this particular deal, but that is fine, right? That I'll recover from my new investments. 9,500, which is something in a decent amount that I have received. I'll reinvest that somewhere, because original maturity amount was 10,000, but if I early redeem my investments as per the callable, the putable options, then company will process, or company will redeem that, securities on discount, and that is something, it's a benefit of a company only. The reason is company will have to arrange the additional buyer of their securities, then additional expenses will incur to the company as well. From a company perspective, debt restructuring is a very costly event. It's not an easy one. Okay. So if company is facing liquidity issues, then company will have to take a loans as well to repay your debt. But it is a mandate to repay your debt. But yeah, so this is how your putable bonds work. So putable bond is works in favor of investor, because investor receives the rights to sell the bonds to the same company back after predefined period, and as well as an agreed price. Okay. And if I talk about callable bonds, it means company receives rights, legal rights to buy the bonds from the investors at pre-agreed price, and you can see even date as well. So this is how putable and callable bonds works. Now you tell me if you have any questions between callable and putable bonds, or any understanding issue or anything as such. If you have, just let me know. Any question, guys? No questions? You understood, right? Putable bonds and callable bonds. Ajay, putable bonds, it means investors को right मिलता है कंपनी को बॉन्ड बेचे, मतलब 5 साल का अगर ड्यूरेशन है तो आफ्टर 2 years इन्वेस्टर्स कैन सेल द बॉन्ड्स टू द कंपनी बैक, और कंपनी को उसे मैंडेटली खरीदी करना ही पड़ेगा। क्यों? क्योंकि इन्वेस्टर्स को अपना पैसा दूसरे बॉन्ड में इन्वेस्ट करना है एट अ हायर इंटरेस्ट रेट। सो दैट्स हाउ पुटेबल बॉन्ड्स वर्क्स। अगर आपको कॉलेबल समझा है, कॉलेबल कंपनी को राइट्स देता है, पुटेबल इन्वेस्टर्स को राइट्स देता है, राइट? इतना ही डिफरेंस है, उसमें कुछ नहीं है। जैसे कॉलेबल के लिए कंपनी क्यों अपने बॉन्ड्स को कॉल करेगा, कॉल मतलब बुलाना, क्यों बुलाएगा? क्योंकि कंपनी को पता चला है कि मार्केट में कम इंटरेस्ट रेट पे भी बॉन्ड्स बेच सकते हैं, जिससे कंपनी को फायदा होगा। अगर कंपनी कम इंटरेस्ट पे करेगा तो कंपनी विल कॉल इट आउट। सेम वे फॉर इन्वेस्टर्स एज वेल। अगर इन्वेस्टर्स को ये लग रहा है तो मुझे मान के चलो गवर्नमेंट के बैंक एफडी में भी, अगर बैंक एफडी का इंटरेस्ट पेमेंट 15% हुआ है और आपने जिस बॉन्ड में इन्वेस्टमेंट किया है उसमें सिर्फ आपको 10% का इंटरेस्ट पेमेंट मिल रहा है, तो आप क्या उसी बॉन्ड को कंटिन्यू करना चाहोगे? आपको नो, यू विल ट्राई टू सेल इट आउट दैट बॉन्ड्स टू द सेम कंपनी, या फिर किसी को भी बेच के आप उसे बाहर निकलना चाहोगे, क्योंकि आपको पता चला है कि भाई एफडी में बहुत ज्यादा इंटरेस्ट मिल रहा है, सो दैट यू कैन इन्वेस्ट इन एफडी टू जनरेट मोर रिटर्न। तो उसको कहते हैं putable bonds. Putable bonds, basically it's a right received to the investors to sell the bonds to the same company after pre-agreed period. मतलब 2 साल 3 साल जो भी period होगा उसमें उसके बाद, so which would be the lock-in period basically. So with that putable and callable, so here if you see in this case, so 2 years, which is a lock-in period. Lock-in. So after that, investors, they are ready to fly, or they are ready to sell it out investments back, and they can buy the other companies bonds at a different at a different interest payments. Or maybe if same companies, let's say if there is so then investor can invest in their series as well, means another series. But in most of the cases, investor will directly change the issuer, and here issuer also it will change, right? Issuer, the company was ABC Corp, but here investors can choose different company, and you can say it's a now investor invested in XYZ Corp. XYZ Corp at 12% interest payment. Investor would be in profit basically, right? Investor will receive now almost 1200 interest payment, right? Investor will invest same amount with this company, and every year company will process interest payment like this. See the profit. Investor would be in profit. Every year I'll receive 1200, 1200, 1200 for same investments. But in my book also, I'll have to update the name of now different corporation or different company basically, because my new company would be XYZ Corporation. But that's fine. That never really matters at all. Okay. So here I have called the investments, and here again I reinvest my money. So this money I'll reinvest it. Reinvest in other bonds. That's the process. That's all. I'll do it. And the remaining process, redemption and everything, that remains same. That remains same, it means that remains same. There is no change in the process. See, with the putable and callable, the difference is, I would say, decision making. So if you see any market opportunity, then as an investor, you can also take the decision. And as a company, if they have any, let's say, the opportunity to restructure their debts, they can also take this, means they can also do the same thing with the debt. So this is how it works. All right. All right. So apart from that, we'll discuss one more type. See, you don't need to sell it. If you have a putable rights, then why don't you, why will you sell it in market? Sell it to the same company, right? Even if the price goes down or something happened, you will receive your agreed price as per the agreement, because bonds, it's an agreement. If you have a putable rights, then sell it out bonds to the company back. It is mandate to the company to buy the bonds from you. It's a legal obligation. You don't need to find someone else in the market. But if you don't have a, let's say, putable rights, right? And in that case, if you have any better opportunity, then see how you can sell it out bonds in the secondary market to the other people who is really interested, and try to get the money back and then reinvest it. That you can do it. So let's take a same bond example, but with a different. Let's say you have invested in this bond. You are investors. You invested with ABC Corp. Bonds terms. Again, it's options, but not options. I would say value, redemption price. Face value is 10,000. Redemption value is, let's say, again 10,000. But the issue price is, there is a problem with issue price, which is 7,000, and there is no interest payment. So it means there is a zero interest payment or zero coupon rate. Zero coupon rate. So basically there is no coupon on this. And this bond type would be this is a fourth bond type. Different bonds. This is fourth number. Right. So bond type is zero coupon bonds. See, there is a coupon which is with a zero interest rate, but the issue price of the bond is 7,000. All right, 7,000. So how it looks like, every every year it will not receive interest payment. There is no interest payment, right? Face value is 10,000. The issue price is 7,000. So it means investors will buy these bonds at this and bond will redeem at this, right? So basically, there would be a 3,000 rupees gain to the investors throughout the period. Investors, it will not receive interest payment because it's a zero coupon bond, right? But investor will receive full amount at maturity. So here would be the maturity basically. All right. So how this process works, right? What would be your main means net profit in this particular investments? See, if we talk about profit from an investor's perspective here, your investing amount is invested amount. Let's calculate that. Invested amount is 7,000 because your issue price, it means that's your investment value, right? You're investing at 7,000, and redemption value at maturity, value at maturity, which is 10,000. So it means net revenue or profit, you can say profit would be 3,000. Am I right? 3,000. But in an interview also sometime you would expect question like, what will you call to this amount? I know it's a discount, but what will you call to this amount? 3,000. You can't call as an interest payment, right? Because it's not an interest payment. Then what we can call? We can call it as an accretion. I wrongly spelled. It's accretion. Accretion, it means incremental value. Accretion, it means, so this will not call it as a profit, we will call it as a accretion. Accretion. Accretion, it means in short, you can treat as it's an incremental value. Incremental value of a bonds. So throughout the period, investor will receive 3,000 as an accretion. And if we divide this 3,000 across all the period, it looks like this. 3,000 will split across 5 years. It is 600. So it means investor can assume that investors main the net income would be, which is again estimated income. It means benefit if we just convert into the years, it looks like this. So investor can treat that, or even company can also record this as a liability, I would say, or as an accretion, and it looks like this. But eventually this accretion would be accretion. Why we'll call it as accretion? Throughout the period we'll treat as accruals. Accrued means liabilities. We'll just treat as accrued liabilities, and that's what this accretion words comes from, the accrued liabilities. And even same in the books of investor also, investor will treat that the issue price is investor paid only 7,000. It's the benefit of investor is 3,000, and this 3,000, if we just split across all the throughout the year, it looks like when 6,000 that the investors can 600 investors can treat as a income, but it's not an actual income. Okay, it's not an actual income. Or instead of this interest pay, you can also treat as a accretion only. That's fine. Accretion payable. The company will create an accretion payable like this. Every year company will book this in the books of account, because at the end of the year company will have to pay agreed amount, which is 10,000, right? 3,000 5. Let's manually update this. 600 600 600 600 and 600. So investor will treat that total accretion amount as a benefit or income, I would say, and at the time of maturity, investor will receive 10,000. See, the point is investor invested 7,000 and investor will receive 10,000. So net profit, which you can see with the zero coupon bond, is 3,000. Profit would be 3,000. All right. And this is how your company will also maintain the same thing. Accretion in a schedule, like company will prepare it and update in the books of account, and annually they'll convert that accretion into liability. So company will treat this as a liability, and every year company will book the liability of 600, 600, 600 throughout the year. And at the end of this period, company will process your maturity price. If you just calculate, it looks like this: maturity price 7,000 of investments, and total accretion value, which is 3,000, company will pay it. Accretion payable, this one, and that investor will receive actual payment, be 10,000. 10,000. So this is how investor will receive. And investor also maintain the same thing. So actual redemption value, the issue price 7,000 as a maturity price, and 3,000 as total receivables, right? And total payment received 10,000, right? It will debit from the company account and investor will receive it. See, and in terms of, we perform the accounting at investors level. So make sure that at investors level also, what we do, we actually treat this as a capital gain, and we apply the capital gain tax. Okay. So, but in US and UK, I have seen argument over this to treat as an income or capital gain, because for income you can see different tax rate, and for capital gain you would see different tax rates. But again, it's a choice that whichever that you want to apply, you can apply and disclose that. This is how it works. This was the example of zero coupon bonds. So let me know if you have questions around it. Otherwise, we are done with this. We have discussed about different types of bonds: clean price, dirty price, then issue of securities at par, discount, and premium. We have also discussed in details about how pricing and interest payment, it works. Then we also covered few types, which is callable bonds, putable bonds, then this zero coupon bonds, and even plain bonds, like how that bonds works, means at the time of redemption, how bonds redemption works, maybe partial redemptions, fully redemptions, right? So that depends. And there are other also, just FYI, there are at advanced level, you can see if the company want to, let's say, convert total redemption value into shares, company can do it. So that depends on the company's management and their funding condition. Okay, so that we have discussed in details along with some practice. The difference between clean price and dirty price is बहुत सिंपल है. मान के चलो 100 रुपए का बॉन्ड है, उसके ऊपर इंटरेस्ट पेमेंट 20 रुपए का है. अगर आप वो बॉन्ड 100 प्लस 20 का बॉन्ड अगर आप 120 को किसी को भी बेचते हो, तो वो डर्टी प्राइस हो जाता है, क्योंकि उस प्राइस में आपको इंटरेस्ट पेमेंट भी मिल रहा है. सो व्हेन वी से डर्टी, इट मींस इंटरेस्ट पेमेंट एंड व्हाटएवर इंटरेस्ट पेमेंट अक्रूड हुआ है, 10 दिन का, 1 दिन का, 1 साल का, जो भी है, वो इंटरेस्ट पेमेंट प्लस बॉन्ड के एक्चुअल प्राइस, दोनों आप क्या करोगे, पार्टीज को बेचोगे. और पार्टी अगर अग्री है आपको पैसा देने के लिए, तो वो डर्टी प्राइस हो जाता है पार्टी के लिए, क्योंकि पार्टी आपको पैसा, इंटरेस्ट पेमेंट और प्रिंसिपल दोनों आपको दे रही है. और पार्टी जब अपने बुक में रिकॉर्ड करेगी उसको, तो उसी प्राइस से पार्टी करेगी, क्योंकि पार्टी के लिए तो वो एडिशनल मतलब एक एडवांस में पेमेंट दिया हुआ है इंटरेस्ट पेमेंट का, वो तो रिस्क भी है और नुकसान भी है देखा जाए तो, ठीक है। और जब हम क्लीन प्राइस की जब बात करेंगे, मान के चलो बॉन्ड के ऊपर जैसे आज ही इंटरेस्ट पेमेंट पे हुआ है, राइट, इंटरेस्ट पेमेंट पे होने के बाद बॉन्ड तो एक्चुअल प्राइस पे आता है, 100 रुपीज का बॉन्ड है तो 100 पे आएगा। तो अगर कोई सिक्योरिटी मान के चलो जिसके ऊपर इंटरेस्ट पेमेंट अभी जनरेट ही नहीं हुआ है, जितना हुआ था उतना पे हुआ है, अगर तब हम कोई ट्रेड करते हैं तब उसी दौरान कोई इंटरेस्ट पेमेंट जनरेट नहीं होता है बेसिकली, एंड इफ वी ट्रांसफर सिक्योरिटीज टू एनीवन एट अ प्लेन एक्चुअल ओरिजिनल प्राइस, लेट्स से जो भी है फेस वैल्यू और उसका इश्यू प्राइस 100 जो भी है, तो उस प्राइस को अगर हम बेचते हैं तो उस पर्टिकुलर ट्रांजैक्शन में आपका इंटरेस्ट पेमेंट है ही नहीं है, सो इट मींस ओनली प्रिंसिपल अमाउंट है, सो दैट ट्रांजैक्शन प्राइस बिकम्स योर क्लीन प्राइस, so it means there is no interest involved in that price, it's just a plain price of securities.
Just a quick info, guys. Intellipaat offers investment banking course training. Through this course, you will learn time management, project leadership, financial expertise, leadership abilities, valuation, and much more from the top 1% of industry experts around the world. With this course, we have already helped thousands of professionals in successful career transitions. You can check out the testimonials on our Achievers channel, the link of which is given in the description below. Without a doubt, this course can set your career to new heights. So visit this course page link given in the description below and take the first step towards your career growth in the field of investment banking.
Then you can transfer securities to the buyer, then again buyer will receive the same certificate, and CDSL or NSDL provide same safety and security services to them. So this process will call it as a basically trade process of a bonds. So most of the bonds like government bonds and all, so they settle in the same day, and again the corporate bonds sometime it will take 2 to 3 days to settle in your account as well. So on trade date basically we send the order, and on settlement date it actually received securities in a demat account and cash in a bank account. See, NSDL and CDSL, they exactly works like a bank. In a bank, what happened when we deposit a money, bank transfer that money into your digital wallet, and that's how you can track your money as well, like how much balance is available in your account. If we talk about depositories also accept the deposit of shares. So it means if you have any physical certificates, you can deposit with the depositories. So depositories will convert your physical shares into digital, and that securities it will available in your wallet, digital wallet. So means through digital wallet you can transfer that securities to anyone. By sitting home you can transfer securities to the Delhi investor, maybe Mumbai, Pune, Hyderabad, you can transfer to anyone. So this is how basically NSDL and CDSL come into picture, right? We also discussed about if you're a buyer, then always banks also come into picture where they actually block the funds in the books of buyer, and depositories they block the securities in the books of seller. Why? Because to avoid trade fails. Because guys, in a market what happened, in a real estate also we have seen such a kind of frauds where, let's say, brokers, especially brokers, sell the same plots to many people, and at the time of ownership always we have seen legal issues and conflicts. One of my close friend who had purchased lands in Pune with a value of rupees 20 lakhs in 2015, but when he actually went to the spot and checked, he was actually surprised, because same land that guy sold it out to the almost other 10 people, and everyone was fighting now. Everyone is saying, look, this is my plot, this is my plot, this is my plot. Why this happened? Because in a real estate it is very difficult to restrict that property or control that property. But in case of shares, even if you don't, let's say, restrict shares, same thing that you can expect in here as well. So we have seen lots of frauds in a stock markets also because of restrictions only. Harshad Mehta scandal happened just because of restriction only, because at that time there was no blocking system available. So it means in most of the cases what we have seen, the securities it was available with the broker only, or intermediator who was working as an intermediate between buyer and seller. For more than 8+ days, broker used to hold the securities, and that's when we have seen frauds as well. Like broker will get opportunity to short sell them for a while to generate some money or profit. But to avoid that, now we have a blocking system where we directly block the securities if that particular securities sold to any other people. And same for a funds as well. So buyer should not utilize same funds for multiple securities. Buyer should only utilize the funds for that particular dedicated security. So that's when we also block the funds as well. So how that fund blocking works, how your security means blocking works, I'll walk you through that process now. Means on a portal only. All right. So this was the brief explanation of basically your bond product. Apart from that, we discussed like redeemable bonds. Redeemable bonds is nothing but at the maturity directly, company will buy bonds back from the investors and settle the amount, and investor will receive the money. Simple. So redemption is meant at the time of maturity, company will buy the bonds back, because at the time of issuance, what is happening here? Company selling bonds, right? Here company is selling bonds, investor is buying bonds. But at the time of maturity, investors, they are selling the bonds to the company and company is buying the bonds. So it means investor will receive their money. At the time of maturity, simply investor will ask money, give my money back, capital plus interest payment, that's all. And this guy issuer means who have issued the securities, this guy will ask for investors, look, give me back, or give my securities back actually. Why? Because securities, it means it was a collateral securities. If we don't buy back, then they can claim on your properties as well. So that's what it is important to buy the securities back is also important process, right? And this was the example of zero coupon bond. We also discuss about redemption bonds. We also had discussed about zero coupon bonds as well. Zero coupon bonds, it means if let's say if issuer issue bonds on discount. So it means, let's say this actual price is 10,000, but same bonds, if company sell to 7,000, then investor will pay only 7,000 at the time of buying. Then what about the benefit? See, at the time of maturity, company will redeem at 10,000. So basically investors should be in a profit of 3,000 on investment of 7,000. So this is how you basically zero coupon bonds work. So zero coupon bonds, it means nothing but, you will receive the OID fees. OID, it means original issue discount fees. As an investor, you will receive the OID fees as a profit, but that will receive at the time of maturity only, not initially. See, if you compare these two bonds, redemption bonds and zero coupon bonds, in a redemption, you can go and check, every year company will pay interest payment, right? Every year. But in zero coupon bond, company, it will not process any interest payment as such. Instead of that, they'll say it's a OID fees, or let's say accretion, or incremental value of your assets. So that will basically company will process at the time of maturity only. So that's become your discounted bond. So it means it's a zero coupon bonds offer a huge discount, which was equivalent to the interest payment. So they have just offer it out. Now your question would be like, sir, look, why company issue redeemable bonds and why zero coupon bonds? See, every bond has some unique feature. If you're like very smart investors, then you will go ahead with the zero coupon bonds. Why? Means not investor, I would say businessman. Why? Because if you issue the zero coupon bonds, then you don't need to pay this interest payment every year. So instead of that, what you can do, instead of paying interest payment every year, you can invest this money as a company. If you generate, let's say, more cash, then reinvest that money and multiply your money, right? At the end, you're entitled to pay fixed liability, which is 10,000 for per bonds. So just repay that only. But if you talk about this interest payment case, so every year company will have to pay 1,000 interest payment to the bondholder. So it means every year company will have to maintain a healthy cash flows or cash available in bank to manage these liabilities. If not, then again, bondholders, they can, penalize to the company as well. See, if you fail to make a payment, interest payment as per obligation, then bondholders, they penalize. Okay. Let me tell you something. This David Kemper fund, they have penalized around 100 to 200 crores something to the Byju's for not to paying interest payment on time. So it's a very difficult, right? But in a zero coupon bonds, of course, here also you can see one risk means from an investing perspective, what if, let's say, at the time of maturity, your company announced bankruptcy or let's say default on payment, then again you will lose entire thing. See, from an investing perspective, zero coupon bond is not a good option. But from a company's perspective, of course, this zero coupon bond is a good option if you don't have a regular or healthy cash flows in your business. Did you get this? So this is how you can means relate this zero coupon bond and the other bond types. Apart from this, we have also discussed about callable and putable bonds. Callable is nothing but callable bonds give rights to the company, rights to the company. So to buy a bonds means this bonds back from the investors, right, at a pre-agreed price, right? Pre-agreed price, we have discussed this. So it means every company decide price, pre-agreed price XYZ amounts, and then company will pay the process to you accordingly. So we have also discussed the flow of callable bonds. So it means, let's say the total bond maturity is 5 years. Out of 5, you might see 1 or 2 years as a lock-in period. During that lock-in period, you cannot sell bonds back to the company. But after lock-in period, company can, or same applies to the investor as well. Then company can buy that bonds back from you. So why company will call the bonds back from the investors? When the interest rate drops in the market, when the interest rate drops in the market, then of course company will reissue the bonds at a different rates to raise capital. So that will call it as a callable bonds. What about putable bonds? Putable bonds is basically, it's a it's you can say it's a rights that it will receive to the investors to sell the bonds at a pre-agreed date. All right, pre-agreed date. Pre-agreed date means at the time of issuance only company will confirm the pre-agreed date as well. So at a pre-agreed date, basically investors will sell it out stakes or investments to the company. Why investors will sell it out? Again, if let's say if any other bonds, if they're let's say if they're offering higher interest rate in the market than the, let's say, your investments, then of course always you will look for like how you can sell out your investments and reinvest that money in the other bonds. So that's how, see, investors, they always play smartly with investments. They know it how to multiply their wealth. They are not like a common man where buy SIP units and wait for 20 years to become a rich. No, investors, they are very smart. They know it. Means big investors that I'm talking about, they know it how to multiply their wealth, how to assess the other different investing options to multiply the wealth and all. So they play very differently. All right. So this was all about the brief of your fixed income as well as your stocks as well. So now just let me know if you have still any questions around it. All right. Any questions? I would like to take a questions. See, the another type is which one? Let me recreate this one. Another bond type is convertible bonds. So this one is very interesting one. Convertible bonds. See, when we say convertible bonds, bonds will convert into preference and common equities at the time of maturity, right? And see, from a company perspective, this will provide more flexibility. The company to manage the debt effective way, and also company can avoid bankruptcy as well. See, a question to you. Let's say you're a businessman. You had raised funds from a bond holder, right? Let's say you're a businessman. Take this case for you. You had raised 1 lakh USD from B investor. When you had raised it, you had assets of 1 lakh USD, and right. So it means at that time your condition was good, but at the time of repayment, you have a liability of 1,50,000. So now you tell me, so how, as a business owner or entrepreneur, how will you deal with this condition? How will you deal with this? I'll give one practical example as well. There is one company called Atos, right? Debt crisis. This company. See this, Atos reaches deal with creditors on a debt terms. If you read this, full case, French technology Atos reached an agreement with a group of banks and bondholders on terms of its, debt restructuring. The company said on Sunday that, the restructuring plan involves 233 million euro contribution via capital increase with the preferential subscription rights. And it said in a statement, about 2.8 billion euros Atos debt will be turned into equity during the total amount of converted debts to 2.9 billion euros. And that will reduce Atos net indebtedness by around 3.1 billion euros, the statement said. So the company again said Sunday's agreement was a significant milestone towards reaching a final restructuring agreement by July. Atos announced last Wednesday that a consortium led by investor David uh, Liani, one point, had withdrawn from discussion on its restructuring. So one point again, it's a fund manager. They had also invested, right? So 1 euros, one is equal to 0.933 euros. So basically, this is the ratio to convert their securities into bonds into common equities. So basically, this is basically, it's a debt burden company. So they have raised huge debt to acquire business. But in terms of revenue, if you see, every year they are just posting, negative revenue. So it means there is no revenue or there is no cash inflow much. And now this company is facing lots of problems. If you can go and check it out. See, they have stated that, they'll convert the bonds into equities, right? So now, if we just try to understand this case in details, let's say you have raised funds with a commitment of 10% interest payment that you will pay to the bondholders. But at the time of actual repayment of interest payment, or maybe let's say actual repayment of principal, you are facing some problems that you don't have a cash. So how will you manage that? How will you manage the repayment? Come on. So in this case, if you see, in this case, the company CEOs or the managements, uh, they were facing lots of challenges. Lots of, it means lots of, because I was keeping an eye on this particular business, because one of my investor was very interested, to buy this company. So he said me to track this out, progress, and tell me. See, if you are not able to repay the debt, and as an entrepreneur, let's say if you don't want to lose your company. See, ultimately, what will happen? Go to the, here and check the Atos stock price, how bond and that stock price works. See this, Atos price reached to the 0.65. So it means at any moment, this price can reach to the zero. And if that reach to the zero, trust me, bondholder they'll take the entire control of this business, entire control. If your stock price become negative, so it means business has no capital and no cash. So now entire company is entire company's assets belong to the bondholders only. Why? Because they have signed collateral agreement and all. And I'm also shocking now because few weeks back price was I believe price was, yeah, yes, see this. Here in 2023, price was 7.8 something, and now price reached to the zero, means almost zero. It's become penny stock now. See, price was around 700 euros, guys, in 1998. But in last, in last 20 years, what happened with this company? See, means every year on year basis, we have seen almost, the reduction in price, and now this stock reached to the 0.65. And I don't know whether this company will survive or not. The reason is, I'm sure debt holders this company is all looking for a buyer as well. Like they just wanted to sell it out this business to the other companies and monetize some, cash so that they can repay the debt. If they don't repay the debt now, they don't have any, see this, even negative earning also, see revenue is which is very low, 44 million. And if you just compare the debt, which is in billion, you can see this revenue and everything year on year, they're just losing, their clients. And I don't know how long they'll, survive in the market. See, in terms of valuation also, is now the data is not available, but they don't have a fund eventually. Debt to EBITDA is over the software average. So it means now debt is over, EBITDA is very low. Negative growth rate, and companies facing lots of problems. If you look at the balance sheet, shareholders equity value is 56 million. Let's talk about revenue, 10 billion, 10 billion. See, their average revenue was 10 billion. And if we talk about, let's say, net profit, only for 2016, 17 and 18. And even here also we have seen where in 2020, they were generating positive cash flow. So it means they made a profit as well, like 51 million, 82 million, 1 million, 149 million. Sorry, this one, 500 million, 771 million. Profit they have generated, good profit they have generated. But what suddenly happened from million to, billion losses. So see this, in 2021, they had a huge loss, which is 2.92 billion loss. Then in 2022, 900 million loss. And in 2023, $3.3 billion loss. And now we don't know, means whether this company will survive or not. Right. And see, on the other hand, see, they are making huge losses. Why? Because they have an interest payment due. Right. The interest payment due, and they don't have a cash. If we look at the cash figure, they have a negative cash flow around, see, 600 million. In 2022, still they had a cash of 160 million, 76 million. So it means even they don't have a cash to pay the salary of their people. This is the brutal fact. And at any point in time, that company can announce, see, the Atos is one of the largest, French IT company, one of the largest. And that company is now on a verge of bankruptcy. Why? Because of debt only, guys. Because see, if you are buying any assets on a debt, and if that, let's say, that asset has no potential, then always you would be in trouble. Even if you buy, let's say, apply for a home loan. So always see that whether that, home will offer rental income opportunities or maybe, let's say, capital gain or not. If not, then do not buy that home. Do not invest. Same for bonds as well. If you want to acquire any bonds, let's say you have decided to, apply for a loans and then invest in stocks, bonds, any other financial instruments. See, if that instruments or assets, if they don't have a potential to offer you good benefit, then do not invest. So my point here is, I'll show you as well in detailed case study of this only, how they have got trapped in 2022, or before that only they got a trap, right? So why and how, let's discuss that. We'll go to the, now they are in a negative cash of 600 million. It means they need an immediate cash of 680 million. And immediately what they did, term loan. See, French technology company Atos said that on Friday it had successfully secured short-term financing via 2 tranches of loans from creditors, adding it still expected to reach a final restructuring agreement this month. So it means they had no cash left. See, could Atos be rescued by creditors? So their creditors actually paid amount to pay the salary of people. So it means even they don't have a cash in their pockets to pay the salary of their people, right? So they applied for a quick loan. And how long this loan will also help the support to survive, I don't know. And more than 150,000 people they're working in Atos. Now your question would be, sir, what if, let's take a hypothetical condition tomorrow that stock reach to the zero, what will happen? See, there are bond holders. Bond holders will directly take a control, right? And they'll just remove the existing people by disposing the equities, right? And if you dispose the equities through legal process, so it means that existing shareholders, they'll not have any rights of investments. Sorry, they'll not have any legal rights to be a part of this ethos as a investors. And new investors, they'll take care of it. Means new investors, what they'll do, they'll convert their debt into equities, and they'll then operate business from there. Because see, eventually ethos is revenue making company, but few things happened in that business. And what are those few things? So let's talk about now. And this message to everyone that if you want to acquire any assets, so make sure that you guys are following, means at least you guys are checking something. If you don't check, and if you directly try to acquire assets, it will put you in trouble. I don't want to log in. I just want to. Here you can track the details of this company. They have secured 1.6 billion committed by group of banks and group of bond holders. But I don't know, in July only they were facing to the problems. But if they have received any commitment for a 1 billion, so they might survive. Lockup agreement reached between the company, group of banks and group of bond holders covering all key terms of financial restructuring plan. Supported by the creditors only, they are paying it. In terms of financing, 800 million secured, providing the liquidity necessary to fund the business until close of the financial restructuring plan. So it means continuously they are raising funds. Even government of France also, they have funded to this. Now, I don't know means how long it will take. But maybe what I'm thinking, they'll wait until this, the stock price gets zero, and then they'll convert this entire their new debt into equities. In that way, they might release their securities, and they'll just wipe out or clean up the public equities and all from the business. So that happened in business. Target new secured financing of up to 1.67 billion. But nobody want to offer funding to this business because of several reasons. What I want to show you is, see, more than 48,000 people they're working. And if you see the company they're operating, means they have offices across 69 countries. See, if they have 48,000 people what they're doing, so that doesn't mean they're doing great. See, ultimately for investors, what matter is, profit. If they're not able to, let's say 40,000 people, even they're not able to generate, let's say, $1. So see this, how this, the big fraud that, you guys are seeing. Even the YouTubers also, they are making profit in crores. One of the YouTuber posted 300 crores profit, right? And more than 48,000 people, even they are not able to generate 1 crore. So it means it's a very, very difficult, I just want to see one thing, their acquisitions. Yes. And by the way, this company was managing, Olympic, right? And post Olympic only, we have seen, a big drop in value, the share price value. This company was taking care of safety, security, and everything. So in terms of technology and infrastructure, they have infrastructure, they have a technology, no doubt, but they're not able to generate a profit. So this is very tough, So since very long, they are, managing this Olympic since 2002, and in 2024 as well, in Paris, they have managed everything, means system, security, arrangement, and all. So they have managed it. Timeline infographic, operating model, testing lab capabilities. Where is that? I don't. So there was one thing I am not able to, get this flow chart. So maybe let me just search it in different way. Across total. Let's see if this allows us to track it out. See, they have acquired list of companies. Okay. So I'll get surprised to see the number. They are continuously acquiring and acquiring and acquiring. Means continuously means continuously. 11 billion in revenue, 95,000 people, employees, 69. This is something old data. I don't know whether it is real or not. But the point is digital formation. There one acquisition which was actually, made them trouble, which was like Atos. Sorry, Atos and Sintel and Atos. They acquired Sintel by paying around 22,000 crores, right? But the business wasn't worth to pay 22,000 crores. And then after they started falling, because Sintel was also already in a blacklisted company and they did the same thing. But anyways, I'm not a consultant for them to advise why they did this. And then if you get the complete transformation, they have a chart somewhere. I'm not able to see that chart where you can see everything. Anyways, so one of the company, that they wanted to acquire, which is Atos, and they acquired it even by paying 22,000 crores. But as I said, if you acquire the assets and if let's say that asset has no potential to deliver return, then you would be in trouble, right? And that's when now they are in a trouble, like they are planning like how they can repay the debt. So as per my as per my knowledge or research, the debt holders, they'll take the control of this company within next max to max 1 year. Once the price reaches to the let's say zero, then security will be delisted from the market. And once the security will be delisted from the market, so it means company will be under control of bond holders only. So bond holders will take the control of a company, and they'll then from there they can operate it, or maybe they can sell it out to the others. So that's how actually business model works. So it means in this example, if you see in terms of convertible bonds, see at the time of repayment, if the businesses, if they're facing problems to repay the debt in cash, then instead of that, what they can do, simply they can convert this equity, right? Sorry, this let's say raised liability into equity. And after that, simply you can remove this liability from here, and instead of that you can just add capital. So basically your capital will increase. Capital base would be 1,50,000. So instead of liabilities. So at the time of maturity, basically you can convert your total bonds into equities. Company will of course come up with the ratios, like maybe one equity into one bonds, or maybe one bonds into one bonds. Let's say for one bonds, company will pay 10 equities. So see this swiping ratio, you may see that at the time of maturity only, but company can provide you that ratio and all. On the basis of that, sometime it will get option as well, option of conversion at maturity. So it means, let's say you decided to participate in conversion, then your bonds will company buy it back, and company will pay you like equities, common equities, right? For example, let's say if this is the bond example, you had let's say investor invested in bonds here, but at the time of maturity, what will happen? Instead of company will not pay any uh, cash to you. So instead of that, what company will do? Company will let's say company will now company's equities company will transfer to the shareholders, and company will buy it back their bonds directly here. So at the time of maturity, instead of cash, if you see in other examples, investors, they have received cash only. Here investor received cash. Here also investor received cash, and company purchased the bonds back. But if we look at this one, this bonds one, which is your convertible bonds, at the time of conversion, company will buy their bonds back, and they'll convert these bonds into equities, and equity will be transferred to the investors. See why this is this is important, I'll tell you. Now if you take the same example of Atos, if let's say bond holders, if they are not ready to allow conversion of bonds into equities, then by default the shareholders of Atos, they have lost the control. So it means, let's say the board of directors, they are like driver of vehicle. And what if, let's say, if you lose the control? Just imagine what will happen if you lose the control, or maybe let's say what will happen if there is no brake to that vehicle. What will happen? Just imagine. So it means it feels like there is no direction. and which is true as well to some extent. And the same thing has happened with that company also. And same company, same, can happen with your business as well. If you, let's say, if you're raising money, that is fine. You are applying for a loans, that is fine. But if you don't know how to manage that liquidity, or how to manage that, let's say, debt fund, or how to manage the loans in an effective way, it is a very essential, guys. And if you don't know that, then it means you may lose the control of your asset. Because after all, we are, if you go and see the flow, see, basically the owners of the business, they are, giving you power of attorney, means sell rights of assets. So if company is not able to pay, then definitely they'll take the control of your business, right? They'll directly take the control of your business. And if they take a control of your business, it means as an equity owner, you will lose the control of your equities. And if you see, this example, now share price, which is reaching towards the uh, zero now. And if this reach out to the zero, so it means shareholders has no liquidity or assets, or let's say ownership interest in that particular business. So by default, the stock will be delisted from the market. Did you get this? So if anyone invest at this price in this group, then they will not receive anything. Anything means anything. So any questions so far? If you want to do the study of this business, you can take a reference, link and all here, name, which is Atos. Go to the company sites, see the debt structuring and all. All right. So I have done lots of research on this, so I know it. In last 1 year, stock price, see the performance, 90% down, continuously, which is down, down, down. See, the problem is not with the business model. The problem is with the high debt. If you see the $10 billion in revenue, which is still fine, yeah, 10 billion, right? Not even million, 10 billion, which is still fine. But the problem is with debt, higher debt. Now they have got trapped. And I don't know whether they'll survive, or if you see their competitors see their price, which is at 95.36, and see their price, which is 0.645. But few days back when I checked it, price was around $4 something. It might have happened something, and that's what price now this particular stock crash. But anyways, I don't want to spend time on this one. So now we'll go to the ICICI Direct site. Let me access. Let me log in. It will take, yeah, finally. Sometime it takes a lot of time. So if you have a, let's say, account with ICICI Direct, okay. So whatever flow that we have discussed, see, the brokers, they are member of, stock exchange, guys. If you see NSE and BSE, it is a marketplaces, okay. And ICICI Direct is a broker. So it means ICICI Direct, they have access of NSE and BSE. So it means they can access the marketplace. If you see this HCL Tech listed on NSE, Shriram Chemical listed on NSE, Sun Pharma listed on NSE, Tata Motors listed on NSE, right? Titan listed on NSE. Most of the stocks, they are listed on NSE, BSE, NSE, BSE. So it is depends on you, means, which stock that you want to buy it out, or which, let's say, bond that you want to buy it out. If you want to buy simply, you can, select any stocks, whatever stocks that you're looking for. Buy limit order, price is given. Always look for a limit order. Why? Because if you select the market one, so it means stock exchange, the system will book your trades at this price, which is higher price. But if you just restrict the price, which is limit price, let's say market price is 1626. So always select lower price if you can, if you're looking for a buy, right? And then send the order. So once you send the order sent to the exchange, see this pop-up. Now, pop-up says we have sent the order to the market exchange, right? And go back in our, discussion, the flow which we have charted out. See this guy is, basically the security is listed, means this, they have listed their, bonds. Company listed their bonds on exchange. So once they have, listed on exchange, so it means marketplace. So it means this, investor, they can send the order to the marketplace. And once the order is, sent to the marketplace, this will available here. Now, if I go to this, or if you see this, any stocks or any click on the market date, see this order quantity, bid order. So basically this bid, it means buy, offer, it means sell. So if anyone want to sell it, quantity, it will reflect here. And if anyone want to buy it, it will reflect here, and they can quote the price as well. So stock exchange track that. Okay. And that order, goes to the order system. So see this, I have sent the order and my order is here reflected. This is a delivery trade. So now if I click on this status, or so it's the segment is rolling T1, it means on the same day this will basically settled, traded, or maybe very next day it will settle this particular trade. See, margin amount blocked. If I purchase securities through broker, then broker will block it out, but ultimately this amount is blocked from my account. I was talking about this one. If you buy any securities, broker will block this amount. This amount got blocked from my account, so I cannot use this amount for another trade. So it means this amount now which has been blocked in my account. All right, and this is how it looks like. But see the flow first. So your trade life cycle flow. Let me search on the trade. See, this is your marketplace, BSE, NSE. When we send the order, you can see the quantities and all, how it looks like. Seller orders, buy orders. I want to see the flow. I had purchased almost 1000 quantities of this Wipro, but I sold it out very early because with the loss, I just sold it out. I thought like, let's not take a risk. 1000 quantity was a very high amount at the time, but I was looking for something else. Yeah. So see this, guys, how your flow looks like when you send any orders to any stock exchange through your broker account. See, I wanted to buy this particular stock, so I purchased 300 quantities at 177 price. Okay. And very next day, this particular trade will settle, means actually securities will reflect in my demat account. On trade date, it will not reflect securities, it will not reflect in my demat account, but on a settlement date, securities, it will reflect in my demat account. I'll walk you through that as well. So how it looks like in demat account. See, when sellers sell the securities, I purchased the security on Friday, I believe, 20th of September. My portfolio will be updated on 21st. So it means Saturday, but this portfolio updated. But I can access the contract note on again 21st, right? The shares will be debited from your linked account. So it means seller's account. In this case, I'm a buyer. Okay. See, in the books of seller, shares will be debited from your linked demat account earliest by 20 September 2024. Once the order get executed on a stock exchange, immediately, stocks will blocked in the account. Why? To avoid the risk of trade failure, right? And funds will be credited to the account 23rd. So it means, see, on Monday, the seller will receive the money. Right? Seller will receive the money on Monday. Now, if we talk about buyer side, if you buy the security, see, I have purchased securities on Friday, which is 20th of September. Then again, I can access my account, but the shares will be credited in demat account on Monday. Right? I have purchased it on 21st, but shares will receive in my demat account on 23rd September. But fund, if you see, funds will be debited from your bank account on same date. If I send the purchase order, then fund will again debited or blocked in my account. And if you see, fund has got blocked in my account already. But I have not received securities in demat account. So we'll see that. So this is actually your trade life cycle flow. So this is how your trade life cycle works. On first day or trade date, only, securities will blocked or fund will blocked. But actual transfer, if you see, means actual transfer, when it will actually transfer from one to, another accounts. So on a settlement date only, actual transaction will executed. Shares will received in demat account to the buyer. So in case of buyer, if you see, shares will be debited on 23rd and sellers fund will be credited on 20 again 3rd. But if we talk about trade date on 20th of September, shares will be debited from the seller's book and funds will be debited from the buyer's book. So this is how, see, this activity which will happen on trade date, and this SBCA activity means fund or debit, demat account transfer, it will happen on your settlement date, right? So see this, I have purchased this on 20th of September, right? I purchased at 177 and stock price which is at 182. Go to the now demat account. I have demat account here. If you see demat holding, see if you see this stock name, there is no, that stock is not available. See this. In a demat account, you can see IRFC, Indian Renewable Energy, then Kilton Tech, Liords Engineering, Mirk Electronic, NCL Research, Shipping Corporation, Visagar Financial, and Yes Bank. But that security I have purchased it out, right? That security I have purchased it out. You can see here in orders. See this. I have purchased this, but that security is not available in my account. You can check the status as well. Executed status. Status is executed. I have purchased it out, but that security is not available actually. Why? So this is how, see, on a trade date only you can see the details, right? On a trade date only you can see the details, but on settlement date, actual security it will receive in my demat account. Meanwhile, that security is now with the broker. Broker will take the control of securities of sellers, right, through depositories, and also broker will take the control of funds as well through escrow account, or let's say, separate account. They just ask parties to transfer the funds and broker will take care of that part. On settlement date, actually broker will exchange that out. So this is how your actually settlement works, right? 5,46,002. See, I made a profit of 3,57,000 on this, but in last 2 weeks, I lost almost 50 to 70,000, I believe, 70, due to market fluctuations. Now I have transfer money to the different investments as well. So I thought, like, let's not take a risk. If you have made a money, do not get stick with it. Anyways, that's not the part of our discussion. Now, if we talk about bonds, go to the bonds here. See, these are the securities which are available. If you want to invest in government T-bills, you can invest. This is a gold bonds actually. So you can invest in gold bonds. IRFC, they have listed their stocks on a stock exchange. But again, if you want to invest in IRFC through bonds, you can invest. Corporate bonds, tax-free bonds. If anyone want to really, save your taxes, then you can invest in this particular bonds. They'll pay the interest payment to you yearly. Maturity of the bond is like in 2031. So bonds will mature in 2031. And if you want to, buy these bonds, simply click on this buy, select the market, because this IRFC bond is listed on a BSE and NSE as well. Because NSE and BSE both are marketplace, guys. We are looking for a buy, then again click on buy. Whatever quantity that you want to buy, again select the quantity. One, get the quote from the market, whatever quote that you are looking for. This is a marketplace for a this IRFC. Only one order that I can see for a sell, but not in NSE. There is no order open in NSE, but on a BSE I can see 2 orders, right? This one, someone want to sell the 100 quantity, 250 quantities, 245 quantities at price of 1255 offer price. But the buyer is looking for, see this guys, this buyer is looking for price of 1,000 only, but the seller want to sell the quantities at 12,550. And there is another seller who is looking for a sell of almost 600 quantities at a 1,400 price, right? So, but those orders, again, it is not possible to execute it you can see this order, still will remain, open. And that's what you should not select, if you're a buyer, then don't select market order ever. If you select it out, trust me, broker can execute your trades at this price also. Why? Because you have clicked on market order. So it means broker will always try to apply higher price to your order, or even your stock exchange also, they'll apply the higher price to your securities, right? So the reasonable price is reasonable price, I would say it should be 1052, but someone have updated 1255 again. So you can select the price, whatever price that you're looking for. So I'm looking for a cash buy. Then here you can, I have limit the order. I'll select the, see, in this case, if you select the price of this, if you select the price, let's say this one, this is a market price. If you see there is no price updated over here, right? Then broker will directly, stock exchange will directly execute the price at this price. So it means if anyone select market price at the time of buying the securities, it is a clear indication that you are ready to pay more fees or more premium to buy the assets. So do not, again, do not select market price if you are buying or trading securities. And also do not do this. Same for a ceiling as well. If you want to sell, then do not select market. Always restrict your price. Restrict your price like 1250 or whatever price that you want to buy, right? So if you ask me, then I'll always select the lower the price at the time of buying. And if you select this price, broker will try to execute, or let's say even marketplace, it will try to execute your trade around this price, 1052, around, at least around, I'm saying. Not at maybe exactly the same price, but at least around. Update the quantity. Every security you can track it through their number, which is, the script code, right? The price which is required, this one, and update it. So this bond. Again, I have sent this bond to the stock. See this. Read this first. It's a very important one. Your order will be sent to the exchange when the exchange opens. So it means your order will be executed on exchange only. Exchange will match the order and confirm to the broker back. Look, this is the buyer, this is the seller for this particular security and all. And then broker team or broker, system will work with custodian, work with, clearing agents to clear that particular trades in your account. I have sent the order. My order is open for one quantity. I have requested that I showed, the interest, I'm looking for this, but I don't know the price. Why this, they have updated 1255. We had updated different price, right? So this is not a right thing. The price, it should this only. See, you can modify that. No, it is not helping us to modify it. Okay, yeah, we have modified it now. We have modified it and send the order, say this. So now my order has been sent to the exchange. So once the exchange opens, the exchange teams, they'll collect the orders and they'll match the order with the other orders, means seller orders, on the basis of time. Let's say I have sent order today. It means my order would be like, first. And if they received any first trades for the same price, they'll try to match my buy order with the seller order. And if that match, then that trade will announce as a, that trade will announce as a buy trade, means executed. They have executed the trade. See, in a stock exchange, everything works on a bid. Bid, it means boli, right? You would have seen in movie as well, like मैं 10 पे लूंगा, मैं 11 पे लूंगा, मैं 14 पे लूंगा. You would have seen that in movie as well. Am I right? In Bollywood movies, or maybe in Harshad Mehta and all. So brokers or agents, they actually quote the price. Hey, I'm ready for 10 rupees, 11 rupees, 11.5, 11.10, whatever it is. And if someone lets you offer best price, then stock exchange will deliver that security to that person. Correct? So this is how actually you can understand this stock exchange term. Stock exchange, it's a marketplace. When we say exchange, it means it's a marketplace. They actually sell the securities, right? They actually sell the securities or offer the securities. If they received any securities, they offer it. Look guys, हमारे पास इतना ये है. Look guys, हमारे पास वो उतना है. And if they received buy orders, then they execute. All right. So this was the example of your bonds. Now that someone asked question like, how to evaluate bonds. See, there are ways to evaluate bonds. First, check it like, who is offering. If it is a government is offering, then see, always good to invest in government bonds. If you don't want a risk, means if you're let's say looking for a zero risk, then always invest in government securities. Always, it means always. If anyone, again, let me reiterate, if anyone is looking for a zero risk, zero means zero risk, then invest in government securities. Let's say if the government securities, if they're not available to invest, then go to the corporate bonds or listed bonds, right? And target the public enterprises like IRFC, it's a public enterprises. See, government bonds is also available. The government of India, they have announced bonds. Then government of Indian Railway Finance Corporation, Bank of Baroda, right? Then IIFL. See, this is a private one. See, private companies, they offer higher interest rate. If you see, IIFL, they're offering 8.2. And if I compare this with the government bonds, they're offering only 5%. 2.5 half yearly, it means 5% would be for per annum basis. Government will offer you the security and safety to your investments, but the same safety and security you can't expect from this IIFL, correct? Rural Electrification Corporation, again, it's a government bonds, but it is offering best, which is 8.6. So you should invest. It's a government enterprise. Then IIFL, it's a private, but they have a NCDs or, the deposit schemes and all. National Highway Authority of India offering 8.3%, right? Power Corporation offering 8.92. See the tax benefit as well as rate of return. If any government enterprises or government, if they're offering higher interest rate on any bonds, then you can invest. But also you should look for a frequency as well. See, higher interest payment, government enterprise, and let's say half yearly payment. That would be a best investment opportunity. Why? Because if you receive, let's say, more and more interest payment frequently, so you can reinvest it and then you can multiply your yield. Yield means income. But let's say you have two opportunities. One is this one, 8.92, and another one is 8.97. If you compare this two, of course you should invest in this one. Why? The reason is there is a slight change in the interest rate, and both are government enterprises. Now, if I compare with, let's say, same security with this one, this 8.3, 8.71, 8.92. So again, I would suggest this one. The reason is all are offering like yearly or annual interest payment on assets or bonds. All right. But if I get any opportunity, let's say this one, NTPC, tax-free bonds. They have a yearly. Government of India, gold bonds offering 2.5 half yearly. See, gold bonds are also profitable nowadays. Instead of buying, let's say, physical golds, so you should invest in gold bonds. Now your question would be like, sir, why? Because gold bonds, they offer capital gain as well as 5% interest payment for per annum. If you have a 25 lakhs to 1 crore, then it is a good investment to invest in gold bonds. Because every year we have seen like 10 to 15% appreciation in gold prices due to international market demands and all. In coming time also, gold would be in prime focus because the gold is one of the metal, which is accepted worldwide. And so you can invest in those bonds. Nowadays, if anyone want to invest, you can, all means you can select the government entities for investments and you can invest. If you are looking for a very safe and secure investments. Secure, it means safe, secure, and average rate of return would be around 8.5 to 9 or max to max 9% at the moment. But on other hand, if anyone is really interested to invest in corporate structured product or corporate, let's say corporate bonds like this, then you can invest. See, these are the again public companies or maybe state companies or the private limited companies and all. See their interest payment. if you see higher interest payment. Akara Cap offering 11% interest rate on investments, right? But rating is BB. So make sure that, rating also matter a lot. BB rating, it means company is not in a good position. A rated, which is still fine. Nindo Home Fin Limited offering 11%, 10%. So if you now compare this two, I would go with this one, 10.3 interest payment. Why? Now you will question me, look, sir, the Akara Capital is offering 11%. But dude, if you see, they have a rating B. So it means risk could be very high with B, right? Risk could be very high. And if I compare with those, then 10%, which is decent with the moderate risk, right? Then apart from this, India Bulls, again, private company. Let me see if we have any highest. Let me filter it out. So these are the listed bonds, okay? So you can find the same information on a stock exchange as well. So all are listed bonds which are available. There is nothing in my demat account, so I will not say anything. See the highest interest rate which I can see, which is 11%. See, now here you can understand this, guys, the term which is, puttable bonds and callable bonds. Let's say you had invested in UP Power Corporation, right? You had invested in UP Power Corporation, but you got to know that, the other companies like Akara Capital or Nindo, they are offering almost 10% or 11%, which is high, like 2% extra that you can earn. Then always you will look for, like, how you can sell it out bonds to the company back or maybe to anyone, so that you can reinvest in other bond series, right? So that's how your puttable bonds come into picture, where that offers, more flexibility or rights to the investors to, means liquidate the existing investments and invest the funds in other investments, right? And same for a callable bonds. Let's say if the other, if other companies, they have issued bonds at 9.7 or maybe let's say below that, or let's say 9%, then why should I pay, let's say 11%, right? Why should I pay 11%, 2% extra interest rate? Why should I pay it? Then what I'll do as a company owner, I'll redeem these bonds. I'll buy back my bonds, which was offered at 11%. And I'll also means reissue the bonds with 9%. So net, I can save 2% interest payment, right, on bond investment. The reason is, see, as a business owner, bond investment, it's a loan. Sorry, bonds capital, it's a loan. We are paying fixed interest payment to the bond holders. Correct. So that means callable and puttable bonds gives more flexibility. You can rate the, but if anyone is really looking for 11%, so you should invest in this. The rating of, this Muthoot Finance is AAA. CRISIL rated it. So it means you can see at least to some extent, safe and safety to your investments. So you should invest in Muthoot Finance bonds then, 11%, which is decent. If you have a 1 crore and if you invest in Muthoot Finance, then you can earn 11 lakhs per annum. Okay. See, big people, they don't expect 50% return, 100% return. See, this is the expectation of poor people. They always expect 1000% returns. Let's say, 5000% returns, because all our stories which we have heard through your YouTube channels or Facebooks and all, that's what we always get, trapped. The big people, if they have a big money, they'll not look for a 100% return. If I have, let's say I'm a businessman and I have 100 crores, see, what I'll do, I'll find 10 different companies like Muthoot Finance and I'll invest 1 crore in each company or maybe 10 crore in each company. And every year I'll earn 11 crores on my investments. And same 11 crores, I'll reinvest in other companies. So that's how they multiply their money. So they don't expect the 100% or 500% returns from the one company, right? This is like something rare where, let's say your grandpa, Nanaji, they have invested in XYZ companies and now your share price is now multiplied like 10x, 20x. But at this point in time, if you ask me, see, most of the businessmen, they have a different mindset. They always look for 10 to 15%, decent return annually. They invest in, assets. It could be business, it could be any fund or anything. If that offers 10 to 15% fixed return to them, the big investor only target to that. But common people like us, They always get trapped in equity market or here and there. And see, there are traders. Now you tell me, SEBI publish it, 90% traders or let's say investors, like small investors, they are in losses. 98%, only 2% people they are making profit from the stock exchange. But in a bond market, only 10% possibility that you can see, you will lose your money. 10% that I'm saying. But in a 90% cases, you can make a money. At least you can make a 10% on your investment. Right? 10% is also very decent. Okay. 10 to 12%, which is very decent. If you compare with America, Europe, Japan, they have a bond yield around, 2 to 3% or below that. But in India, we have a descent around 8 to 9%. And which is fine, yeah. So if you have 10 to 15 lakhs, you should invest in this. So every year on 10 lakhs, you can earn 1 lakh 10,000, right? So it means 10,000 rupees per month that you can generate. There are businesses who invest in a crores of rupees in the business, but still if you see their profit, no, they are not in profit. They're making huge losses. Take the example of Amazon. Amazon is not making any profit from Amazon, India. They're making huge losses, but still you have something, right? If you invest in this product, you will receive 11%, 10%. At least you can expect, means it is kind of an assured return. But what about the assurity and guarantee in equity market? There is no guarantee. There is no assurity. Maybe in 1 month you will generate 1 lakh. Maybe another month you will lose 2 lakhs. It's just a gambling, right? So big investors, they always target fixed income instruments and government securities to invest. And the people like us who want to become a rich in overnight, they always target the stock markets where they want to become a rich by earning 10x or 20x returns. All right. So now if you have any questions around these bonds, you can ask me. I have explained lots of things. If anyone is really interested to invest, you can invest in government bonds. And if anyone is really want to again invest in private bonds, check the rating, check the interest payment, and check the frequency of payment. Here you can check it. This one is, it seems fine, Akara, monthly payment, but rating is B. If you're ready to take a risk, then you can invest. But instead of that, I would prefer to invest, Spandana, Spurti, Fitch. You should invest in this as well because they have a monthly coupon. So it means every month you will receive payout. It's a good opportunity, guys. Again, Muthoot Finance, they have a monthly opportunity. Monthly interest payment, it will be credited in your account. You can invest for this and they are A rated. It means moderate risk that you can expect, right? Next coupon is 28th September. So it means every month they are paying, coupon. See this here, call option rate, but this is not something callable bonds. I believe if the bond is callable, then they update the rate here as well. So let me just check for any bonds if we have a callable and how it looks like. In Indian market, hardly we see callable bonds, putable bonds, but in US it is frequent practice that businesses they issue the callable, putable. In Indian market, you can see the most of the plain securities. We get business owners also, they are not highly qualified, so they don't know how to manage all of this. So there depends on CAs, CFAs people, means the other people. I don't see that, means most of the bonds would be like non-callable only or nor putable as well. So most of the bonds they're like plain. But if anyone is really interested, you can invest in Muthoot Finance. Why? Because of monthly. When you will receive monthly, so it means 1% you can earn monthly. On 1 crore, if you just calculate 1%, which is still fine. If you have a 25 crores or 100 crores, let's say, if you invest in this business, you don't need to do anything. You just sit, relax, enjoy your life. Muthoot Finance and their team, they'll do business for you. They'll generate 1%, return for per month and give it to you. What you want. On 100 crores, if you earn 11 crores, which is a descent. So almost 1 crore you're making for per month. And that 1 crore you can invest in anywhere. Out of that, maybe 10 lakhs or 20 lakhs you can spend on your lifestyle, and rest amount 80 to 90 lakhs every month you get invested, right? Big businessmen, see, they have a different mindset. They always, let's take example of Adani. We always criticize to the Adani. What Adani did, If you are like politician, you will blame to the Adani and Modi. Look, Modi give this and Modi give that. Then you're not a then. Let's say you don't have even vision. You're like common man, typical common man, always who get influenced by others and criticize by sitting home. They always criticize. They don't know how to run their home, but they know it. They'll always guide to the people who are in center and here and there. So my point here is, look, if you are a businessman and if you know, let's say, if there is any assets available in the market, see, you don't need to invest entire money from your pocket. As a businessman, what you can do, let's say if you have a 10 rupees in your pocket and the asset price is 100, still you need a 90 rupees, right? So for 90 rupees, you have two options. One, you can convince to your friends, families, or other people who knows you better to share the fund with you, so that you can invest your money and their money in the assets and you can acquire it, right? That's the one approach. Second approach to the bank, ask for a bank. Look, like it's like a home loan. Look, I want to purchase this, but do one thing, give me a loan of, let's say, 100 rupees or 90 rupees. I'll also pay down payment and I'll give a right of assets to you until I repay it. If I repay it, then release that asset to me, and if I don't repay, then you can sell that assets. So he did the same thing, right? When he got the he got the opportunity to participate for, let's say, port, or participates for any other government project, he just participated it. And when he got opportunity, he just paid a premium. It means that margin amount, 10%, 20%. For a rest amount, he approached to the banks, signed collateral agreement with the banks, and raised 10,000 or 15,000 crores from a bank, because he was aware about that. If he get this opportunity, then he can generate more revenue. See, every businessman does the same thing. Even they did the same thing. Reliance Group, Ambani Group, Tata, Birla, they raise funds from the others. They don't spend entire money from their pockets. Recently, Elon Musk purchased Twitter. How many people you guys are aware about that he purchased Twitter? Come on. How many guys you are aware about Twitter deal? See, Twitter or X, that platform, actual valuation was $44 billion. How much? 44 billion USD. How much Elon Musk paid it? Only 4 billion. What about the rest money? How he raised that? How he raised the other money? See, simply he raised money from I'll tell you the list of participants. MS participated it, Barclays, then Bank of America, Blackstone. Then there are other funds as well. Then the Saudi Prince also invested in that company. And most of the the Blackstone, they have a 10%. Then this company, Bank of America, also they have a 10%, around 7 to 8% something. This Barclays also holding. They are also holding around 10 to 5%. Say the Saudi Prince also is holding around 10%. But why we are only saying, look, Elon Musk purchase it. Look, Elon Musk purchase it. See, boss, Elon Musk only paid 4 billion, but the valuation of entire Twitter it was $44 billion. See, Elon Musk wanted to lead to that project. He wanted to lead, and that's what he just paid a premium, 10% of total assets, and rest amount he raised from the other sources. The other businessmen or other entities, they are not interested to lead to this particular project. But Elon Musk, he was, and that's what he convinced to the others. Look, guys, what you need to do, you just need to pay the fees, or even you just need to invest your money. I'll manage that, and I'll generate return for myself as well as for others. See, as an entrepreneur, or businessman, it's not something that you can generate money for yourself. If you only generate money for yourself, then you are not an entrepreneur, you are not a businessman. If you assure to the people who want to work with you, look, if you work with me or with my idea or vision, I'll make money. I'll also help you to multiply your money. So it means I'll work for your money as well with my team. So that's when we can multiply money for both. And then only people will invest. Did you get this? And the money that he, how he raised, see, same model, your Adani also replicated it. What Adani did, when he got to know port is available, let's say total port size is 10,000 crore. Government wanted to rent it out or lease out for 10 years, 20 years. What he did, submitted orders with 1,000 crore in a value. And once the, let's say his, application approved, then he had opportunity, collateral or power of attorney for 10,000 crore assets, let's say port. He simply reached out to the SBI and said, look, now I have a power of attorney of, 10,000 crores assets. If you can give me a loan of 9,000 crores, then, I'll give this asset to you. So you take the control. You take the control. What I want is like, I'll just lead it as a, face, and I'll make a money for you as well. So it means I'll generate money on 10,000 crores. Even if I generate, let's say 1,000 crores, annually. So bank will receive 900 crores and this Adani will receive 100 crores, right? So that's how we both can make a money. And it's a deal. It's a bloody deal. See, if you're a businessman and if you have mindset, then there is nothing black and white. Everything is gray. And this is not even fraud. See, simply it's just a managing leverage in an effective way. If you see the political argument, every time you will see, some pros and some cons in every government. You can see, at least one or two business tycoons, they will grow it. But actually why they grow it, try to find out that, things, because they manage system, they manage governments, they manage everyone. And it's not easy to manage them. And there is nothing, black in that process. Manage, it means they negotiate, they convince. See, even if you apply for a tender of municipal corporation, it will take time. It will take, it requires lots of efforts for even 10 lakhs, 10 lakhs rupees contract also. I had applied for one of the contract in municipal corporation of Pune, and I'm doing this, continuously, but I have not received, means any application. But there are people who know, I know them very well. They got the contract worth of rupees 100 crore, 200 crore. See, to get the contract of 100 crore, they have just paid 1 crore or 2 crore value. That's all. And once they got a contract rest amount, they ask bank to fund it out. Why? Because they have a purchase order from the municipal corporation. And on the purchase order, you can submit the purchase order with the bank. Bank will provide, rest 90, let's say 98 crore or whatever amount. And then you just complete the work and deliver it out. And whatever profit that you will receive, bank and you both will make a profit. Even if you, let's say, generate a profit of 10 crores, bank will receive, let's say 9 crore. You will receive 1 or 2 crores. You have also multiplied your profit. You invested 1 crore. Now your profit is 2 crore. You have multiplied your assets by 20, let's say 2x, right? So there is actually nothing black in this Adani's model, right? So it could be, see, at the time of, you can say in a way that, look, why the government is only offering, the contracts to the Adani. See, it could be, means this could be your argument, because we are a democratic country. Maybe government should, let's say, reward contracts to the multiple, means other businessmen as well, because to rely on one businessman would be difficult. What if, let's say, they, hike prices and all. So that could be an argument. But that doesn't mean legally, it will restrict it. No. See, what if, let's say, as a businessman, I have 100 companies. I have invested in across 100 companies. If my, let's say, one of the company, participated in Delhi, one of my company participated in Mumbai, one of the, XYZ company participated in another in location to acquire government's assets. Then again, we can't control that. Why we can't control it? Because as a businessman, I have, invested in thousands of companies, and one of my, let's say, portfolio company, they have decided to acquire it. So how will you control that? And there is no law which, such can prevent it. See, law says to rely on one company would be depends, and it would be like, monopoly of that company in that particular space, and it might lead to the prices or hike of prices. But that doesn't mean it's illegal. And that's what nobody, even, opposition also, they couldn't do anything. In opposition's time, they supported to that Adani's brother, now who is now bankrupt. He was taking care of HAL or other, government companies. Means there were lots of, businessmen. Let's say Mala, even Nirav Modi. Because see, the government's bank, again, at that Congress time also, they were funding to it. So basically, it is a responsibility of lender, not the governments. If any, any bank is offering loans to anyone, even to the common man or businessmen. So they should actually evaluate the collateral quality, right? For example, let's say I don't have a collateral, but I have applied with the bank, and there, one of my close friend was working with SBI, and he just approved my file with the 2 crores on a fake collaterals. And after 6 months, let's say, he changed his branch, and after 6 months or 1 year, when the bank was, asking for a repayment, I just announced it, look, I don't have anything to pay now, I'm bankrupt, right? Then now if you see, it's not a fault of Rahul Gandhi, or it's not a fault of, Modi, it's a fault of people who are working at a ground level, right? So they just compromise the ethics. It is all about, ethics. Did they check the collateral? Did they check the asset quality? Did they perform the, the appraisal of the assets? Did they check the capacity of people? Means that person, whether that person will pay it or not. Means on the ground, did they check the asset, whether the asset is available or no? They just compromise with their, business ethics, and offer benefits to the, you can say it's undue advantage of their position. Maybe again, I can also share, benefits to my friends as well. Look, if you approve my 2 crores file, I'll give you 20 lakhs. Friends and I both are in profit. Are you getting my point? So actually, on the ground, who is approving that loan, that person's or committee's responsibility is to evaluate certain things. See, political intervention, of course, it matters, but that doesn't mean, who is in center or state, they're asking the bank, to approve it. Because bank, it's a separate institution. Government is a separate, institution. Government only work as a consulting body for organization. Organization, they have their consulting body or committee who are, actually managing it, right? So he just simply managed the banks to provide funding. So bank provided funding, and they have a collateral. See, if you ask me the difference between Adani and Nirav Modi cheated, to the bank. He had a collateral, right? But in case of Adani, on the ground, he's holding ports, he's holding, let's say, that shipping companies and all. Means he's holding assets. If someone is holding assets, so even if something happened with his business model, banks simply they can, take the control of that port on assets. Are you getting my point? So this is how actually businessmen, they leverage it out through bonds, through equities, and all other different financial instruments. All right.